President Joe Biden is planning 2 meetings with Ukraine's Volodymyr Zelensky in the coming weeks. The U.S. leader is seeking to show solidarity with Kyiv in its war against Russia, despite plans to skip an upcoming peace summit in Switzerland. Earlier this morning, the president arrived in France and will meet Zelensky this week on the sidelines of the 80th anniversary of D-Day in Normandy. A second meeting is planned the following week at the G7 summit in Italy. Well, coming up, it's a busy day for retail with Inditex earnings. Plus, we discuss how Birkenstock is actually convincing investors it's a luxury brand. This is Bloomberg.
And so at 4:30 a.m. Eastern Time, we do get our UK services and composite PMI numbers. Services with a forecast of 52.9 on the prior 52.9, and composite with a forecast of 52.8 on the prior 52.8.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
From the world of politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lyons deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern. Only on Bloomberg TV and radio. Context changes everything.
As we see the supply chain improving, we keep ramping up. So the more they produce, the more we need, and we are very fortunate to have in front of us a very important backlog of orders to deliver. But that comes with higher rates if we want to be at the pace expected by customers, and therefore I think it will at least take 2 to 3 years to see a certain normalization.
Any company, especially large-scale companies who are willing to be transparent about everything, they'll suffer less. We presented this comprehensive plan to our regulator. Here's one thing I want to make sure everybody understands. This is our plan, it's not our regulator's plan. If we slow it down and stick to the disciplines that will synchronize this supply chain with the insatiable demand for airplanes and stay disciplined on that, we will put all this in a rearview mirror.
Well, that was the Airbus Chief Executive, Guillaume Faury, and the Boeing Chief Executive, Dave Calhoun, at the Berlin Aviation Summit with our Guy Johnson. Let's also turn to a top feature in Bloomberg Business Week called The Ballad of Birkenstock. Now, it explores how the 250-year-old German orthopedic shoe company transformed itself into a luxury behemoth with family drama at the top of management like a hit TV show, Succession. Now, shares up nearly 30% over the past month on robust earnings. The company also raised its forecast for the year as consumers snapped up its clogs and sandals. Let's discuss all of this with Andrea Felsted from Bloomberg Opinion. I mean, it's unbelievable, right? This is like an old company for, it was an orthopedic shoe, and then you can't even get them online.
It's about the fashion cycle. These things go in and out. I mean, I can remember at least 3 times over the last sort of 30 years where Birkenstock's been in and then it's been out. But I feel it's kind of transcended that now, and it's sort of an accepted part of our wardrobe. It really has become a fashion staple, and young and old, everybody wears Birkenstocks, and that's quite a difficult thing to achieve, and it's not universal. I mean, we've seen Dr. Martens have an absolutely terrible time on paper, same as Birkenstock, but it's had 5 profit warnings over the last year because it was a great hit. We had the chunky boot, was a big look 2 or 3 years ago, and then it faded. So it's quite a feat to keep it going.
But Andrea, so again, Birkenstock and Dr. Martens both listed. Birkenstock, has done very well since the IPO. Can they keep it going?
I think they probably can. I mean, it's been quite patchy since the IPO. It initially fell.
So just less than 5 minutes to go now till we get our UK figures. Services PMI final with a forecast of 52.9 on the prior 52.9, and composite PMI final with a forecast of 52.8 on the prior 52.8.
But I could see it carrying on.
I mean, in other fashion news, we have Shein that we're waiting for that IPO, and they've decided to list in London. And then there's also Inditex earnings.
That's right, and what we've seen with Inditex is it's almost become, it's not a high luxury brand, but it's become like an aspirational luxury brand because the true luxury brands have increased their prices so much. The mid-market has shrunk. You've got people like Banana Republic struggling, shrinking, so that sort of middle, clothes for work, etc., is sort of shrinking. Inditex has filled that void.
Also here, Israeli PM Netanyahu says we are prepared for a very strong action in the north.
Andrea, thank you so much. As always, Andrea Felsted there with everything retail. Coming up, the world's largest private equity event gets underway in Berlin. We speak to the co-chief executive of THL live from Super Return.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking?
Yeah.
I mean, like, what's that about?
We're not forcing everybody to be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier, right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have for the next 5 years, 10 years. What's the best way to contribute to the world?
This This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech.
Just less than 1 minute away now. I'll be leading with the services figure.
Data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Well, signs of a cooling U.S. labor market. Boy Fed rate cut bets. Treasury yields climbing after their largest two-day drop this year. The Indian Prime Minister Narendra Modi gears up for coalition talks after his party loses parliamentary majority, while stocks rebound after
10
yesterday's
seconds.
sell-off. And here in the UK, Rishi Sunak and Keir Starmer face off in the first TV debate of the general election, with the Conservative and Labour leaders trading barbs over their rivals' tax.
52.9, 52.9 in line with the forecast, and UK composite PMI final 53.53, higher than the forecast of 52.8.
Chip-making plant in Ireland to Apollo Global Management. The $11 billion deal actually brings in more funding for Intel's massive expansion of its factory network. Well, Bloomberg's Danny Berger spoke to Apollo's Scott Kleinman at the Super Return Private Equity Conference in Berlin earlier.
These type of blue chip, large cap companies, they're not talking about 100 million or 500 million. They're talking 2 billion, 5 billion, 10 billion plus. And so the ability to really come up with those creative solutions in scale is really, really critical. But I think you're going to see more and more of this coming.
More from Apollo?
Absolutely more from Apollo. But in general, just the need for this type of capital is insatiable.
Bloomberg brief anchor there, Danny Berger, speaking to Apollo's Scott Kleinman earlier. Now let's get back to Danny at the Super Return Private Equity Conference in Berlin with another great guest. Hi, Danny.
Hi, Francine. That's right. I'm pleased to say that we're going to continue a bit of the tech conversation. Joining me now is Scott Sperling, THL co-CEO. Scott, thank you so much for joining us.
Just take a look at the key findings from the reports here. Business activity growth is solid, but down for April's high. Hiring activity rises, but labour market tightness a constraint, and the slowest increase in prices charged for over 3 years.
Quite disappointed the market. Saw something similar from Workday. We saw Vista write down $3.5 billion on one of their online earning platforms.
Right.
What's happening?
So I think it's a matter of more managing expectations than anything fundamental. Software still is at a really
And so we have ourselves the full UK Services PMI report for May 2024 on the FJ feed.
Sticky business model. The expectation of infinite growth for the overall markets, and then specifically for growth in the market for certain companies, that probably has gotten ahead of itself. And I think part of it is the enthusiasm for the new technologies that are coming online, particularly generative AI, where the promise is always ahead of the reality. And it takes a while for the market to adjust, but then those realities will sometimes, in fact, oftentimes, come to bear.
We were talking about this, Jensen Huang saying recently, you got to spend more to save more in that CEO math. So when you're looking at companies, especially when you're looking at ones to buy, how much of in your head are you thinking, is there an AI play here? How important is that, make or break?
Yeah, we look at it as either a great opportunity or an incredible challenge. And sometimes it's both. And some of it is the uncertainty about how it all unfolds. Right now, we're seeing generative AI be a valuable tool for a lot of our companies that provide either automation services to a broad range of customers, whether it's a healthcare system, or it's a factory floor, or it's a distribution center. We see the ability to use generative AI as a way to reduce the cost of code creation, because of the very nature of how it operates. But there's also, again, more promise than there is reality to a lot of the things that we've been talking about. And it's going to be a long time before we see how that settles out. The cost of running generative AI is also quite high when you think about the compute power that's often required. That's something that we don't talk as much about. but it is part of the business model element of a broad range of companies who are in this area.
Do you think tech investing needs to change to keep up with this idea? Because presumably there's a lot of companies out there, maybe CRMs, that could easily be disrupted by AI that, this industry for a large part has liked those software deals.
And I think you're exactly right that there's a high risk of disruption of those business models. There's also the ability to look at what the implication for margin generation might be on more legacy or traditional businesses that now may use automated tools that may be generative AI based or not for a lot of their business processes. So take accounting firms. There is a belief that this technology will allow you to do a lot more, particularly on the tax side, for individuals and corporations. Early on, that may be a significant cost savings for these companies that lead to excess margin. The question is, how much will their customers let them keep?
Right.
And so there's a dynamic here that's yet to play out that we know presents, again, opportunities, but also could have severe disruption risk to some of these underlying business models.
Now, the other disruption risk, I just want to get to this, Scott, is regulation. And I know one area you're very active in is healthcare. Now, the healthcare space, I know this is more technology, more systems for healthcare, but there has been increased scrutiny on healthcare from regulators. Again, more so on the people side and roll-ups and staffing, so not exactly where you are. But I wonder if that overall regulation puts an ice on healthcare deals. Does it make you pause at all?
I think it increases the risk pretty significantly on some of these deals and the very nature of healthcare. So I have this night job as chair of the board of the Mass General Brigham system. So I'm looking at it now from a not-for-profit, an enormous $20 billion not-for-profit who does research and very high-end clinical. And they do unbelievable things that us mortals couldn't do. And, it's really amazing. But the pressure, even on that not-for-profit, because nobody wants to reimburse to really truly cover the cost, is enormous. So if you're a for-profit going into this, you're trying to pick off the best payer mix. You want commercial payers as opposed to government payers. You want to do things that are going to drive the margin of your business up in ways that may not be as patient-friendly as what some not-for-profits do, all in an environment where the government wants to continue to squeeze the amount they spend on healthcare. And so that leads to a very difficult formula if you're in some of these for-profit players, and creates the political risks that we're now seeing manifest in the things that you're hearing from the Elizabeth Warrens and others of the world.
Scott, I do want to end here because it has been over a year since Thomas H. Lee passed away, your founder and someone you cut your teeth under. I mean, he started leverage buyouts before leverage buyout was even a word.
Right, a real pioneer.
A real pioneer. And again, the times were different then, and leverage has become another hot button issue because of where rates are. I wonder if you look at sort of the foundation of THL and where we are now and the concerns about leverage, is this a paradigm shift?
So the paradigm shift, Tom left us really in 1999, and then without economic interest starting around the mid-2000s. So the business, when Tom was with us, and he started, real pioneer, the firm, focused on growth buyouts, mid-market growth buyouts, which at the time was unusual. That part, the culture that he created still exists in the firm. But the difference is we've grown dramatically because the very nature of what we need to do to generate the kind of strong returns we're aiming for has changed dramatically. So we have much more specialized expertise in the areas that we invest. We have significant investment in operating expertise. And this is true for a number of people in the industry. I think I'm characterizing more generally. But certainly I know from our firm, when you go from 30 people to 150 people, it's a very different world. And I think leverage is not as impactful as it was. The business models that we're seeing today, the impact comes really from the growth in EBITDA, the ability to manage to a acceleration in growth rates where you earn multiple expansion is a very important element of how we think about the business. And when you look at the capital structures that are now very equity intensive, it's a very different world than when I started 40 some odd years ago and you were putting up 10% of the deal in equity.
Right. Well, I mean, it's also a higher for longer world. Scott, unfortunately, we don't have time to get into that because that would take us another hour. But thank you so much for joining. Really appreciate it.
Welcome.
Francine, that is Scott Sperling, the THL co-chief executive looking at everything from AI to higher for longer for a bit there.
There you go, AI to higher for longer. Danny, great work as always with Scott. Now we'll have plenty more from Super Return throughout the day. Plenty more, of course, great guests joining us. Anuj Ranjan, the Chief Executive of Private Equity at Brookfield Asset Management, Ares Management Partner Matthew Chirtnell, and General Electric Co-President Gabriel Caillou, just amongst some that will be joining us throughout the day. Coming up, Rishi Sunak and Keir Starmer face off in the first TV debate of the UK general election, trading barbs over their rivals' tax plans. More analysis next, and this is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New season starts July 10th, only on Bloomberg. Brought to you by Workday. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Now to the UK election campaign, where Prime Minister Rishi Sunak and Labour's Keir Starmer clashed over taxes in the first TV debate of the campaign.
We will raise specific taxes, and we've been really clear what they are. We've already dealt with the tax break on private schools. We want to end the non-dom status completely. I think that the super rich should be paying their tax.
Independent Treasury civil servants have costed Labour's policies, and it's £2,000. But you asked for specifics, Julie. So let's have a specific difference.
Please let Mr. Sunak finish.
The Triple Lock Plus, so that we raise the personal allowance for pensioners and ensure that the state pension is never subject to tax. That's what we will get under a future Conservative government. Keir Starmer hasn't matched that pledge, which means for the first time in our country's history, if Labour are elected, pensioners will pay tax. I do not think that is right.
Well, let's get more on all of this with Bloomberg's Carla Canuvet. Carla, thank you for joining us. It was an interesting debate. I thought it was a good debate. Who came out on top?
So that's always the question you have coming out of those. And in this case, I actually think there's something for everyone to take. The immediate snap poll right after the debate ended was giving a very small victory to Sunak with 51 over 49 against Starmer. So at the looks of it, at first blush, that would be a really tiny win for Sunak. But I do think that there's two other ways of looking into it. The one is Sunak is the Prime Minister, the sitting Prime Minister, who is coming into the debate with an over 20-point
disadvantage. Yeah, so it doesn't change the polls. This was basically a poll on how they did in the specific debate. It doesn't necessarily change the poll on how people vote.
No, I think in that respect, there wasn't really anything to move the needle. And again, it's good that the one going in defeated in the polls gets a lead, but also for Starmer, it's a matter of he already has the lead. He just has to keep it. Right. So that can also be seen as a win for it. But in terms of did anyone win the election on that night? No, I don't think anyone did.
Sunak's main attack was that Starmer would raise taxes. Did he land any blows?
Yeah, he did. I think his biggest blows were in terms of the NHS. And the big one was that in the track record, Sunak at some point was trying to defend that the waiting lists are going down, they're improving, and Starmer obviously latched onto that to say, well, in fact, while they are now coming down a little bit, they are still higher than when you first made the promise to make it better. So I think that was one of the best ones for him.
Carla, thank you so much for joining us. That was Carla Kennevet, of course, joining us with the very latest on that debate. Now, look at this. We have King Charles banknotes, and they've entered circulation today. So where can you get them? At some post offices, but only a few because they'll be very gradually changed. The sovereign is being changed on the Bank of England's notes for the first time. We knew that there was actually a line in front of the Bank of England today. The portrait that you can see here of Charles is appearing on all four banknotes, the £5, £10, £20, and £50, with no other alterations to the existing designs. But it will be a very gradual change. Several post offices, for example, in London are issuing the new notes today. Now, coming up, we also discuss the UK housing market and the mortgage sector with the chief executive of Skipton. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
The top names in business are on Bloomberg.
They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets, which are kind of wide open. That's all good. Doesn't tell you what the future is going to be. But I think there are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect. My view is whatever the world is pricing it for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
Bloomberg. Context changes everything.
Most products are priced according to the value they bring. And I feel really good about the value of our medicines, what they bring to the individual patient, but also the value to the healthcare system. And we have today healthcare systems around the world who were typically designed for acute care, but finding that 80% of the cost in the healthcare system is linked to chronic care. And we have a portfolio of products that are really addressing some of the chronic diseases of our day and age.
Well, that was Lars Fruergaard Jorgensen, Chief Executive of Europe's most valuable company, Novo Nordisk, on the pricing of its blockbuster diabetes and obesity drugs, Ozempic and Wegovy. You can see that full interview on Leaders with Lacroix airing at 9:30 p.m. New York time tonight in the U.S. and at 6:30 p.m. London time on Thursday. Now back to the UK and rate cut expectations for the Fed, the ECB and the Bank of England have all pulled back in the face of stronger economic data and sticky inflation. Now it could impact the recovery of house prices here in the UK 1 month out from the country's general election. Let's discuss all of this with Stuart Hare, Chief Executive of Skipton, one of the largest building societies in the UK with consolidated total assets of around £37 billion. Stuart, thank you so much for coming on. There's so much appetite to understand what the mortgage markets look like, what it means for Skipton, and of course what happens in this general election. First of all, the housing markets appear to be stalling as the Bank of England hasn't cut yet. So how do you see that developing?
Well, alongside the Building Society, we also own the UK's biggest estate agency, so we see some real-time data, and what that tells us is that actually demand is up year on year. Now, it was a quiet year last year, but it's up about 20%, and that's because people are readjusting their expectations of what they can buy in the face of probably longer interest rates.
And so do you see a pattern depending on where in the country you're looking at?
Yeah, in London, for example, the rental market's going nuts. You're also,
that's a technical term.
You're also seeing house buying, the number of house buyers in London starting to pick up as well. But it's actually a relatively broad swathe across the country. It's more affordable outside of London, which means there's more activity picking up there now as well.
So, Stuart, what's your outlook for house prices?
House prices, we think, will stay around the level they're at for the next 12 to 18 months, and then gradually start to pick up to the long-term trend.
And so you launched the first 100% non-deposit mortgage also since 2008. How has the uptake been on that?
It's been fantastic, actually. Across our whole first-time buyer range, we lifted ourselves to helping over 20,000 people last year. That was up 70%. So we're feeling pretty good about first-time buyers. And indeed, the market overall, we're seeing more first-time buyer transactions than we've ever seen. 1 in 3 transactions in the UK are to first-time buyers.
So more lenders appear to be extending terms also.
And so at 5 a.m. Eastern Time, we do get our Eurozone PPI numbers year on year with a forecast of minus 5.3% on the prime, minus 7.8%. Eurozone PPI month on month, minus 0.65% on the prime, minus 0.4%.
Finances improve, they can actually adjust that term down as they progress through the mortgage.
But that's here to stay. It'll be 30 years or above.
At the same time, we do also see the UK to sell £4 billion of 3.75% 2027 bonds. The 3-year gilt yield is on the prior 4.204%, with the 3-year gilt bid to cover on the prior 3.68.
Stuart, talk to me a little bit about what kind of policy you would like to see from the government after the election.
We're chronically, in the UK, we have a chronic shortage of houses. There's actually less houses per 1,000 people in the UK than there is in France, there is in Italy, across the whole of the OECD. So we need to build more houses, full stop. But we need more social housing. So we need to support planning rules that build social housing, private rental sector housing, and residential housing for purchase. So overall, we just need more houses built. So anything that supports planning reform is really important to us.
Stuart, why has it been so difficult? Because everyone's fully aware of it. This is one of the policies that was telegraphed from the start.
Absolutely, but it's been telegraphed from the start, but we haven't had supportive policies around bringing capital into the housing market. We've had an awful lot of rules, planning rules created, and also local councils with planning departments that have been decimated. So we need some concerted policies. We probably want a politician, a housing minister in role for a very long time as well, so that those policies can turn into reality.
Do you see the industry of real estate actually, real estaters changing? I know there's been a bit of consolidation. There's more also like independent websites that are coming up?
I'm exceptionally proud of the work that our guys do. You know, 1 in 10 of the houses bought and sold in the UK is done through us. But we are ultimately concierge of quite a difficult process. And I think digitisation can play a part alongside the great humans that can help sell your houses. So I do see technology coming in there. I also see more vertical integration. So the whole home buying and home selling journey can be done through one operation.
I mean, what's the one thing that people ask you at dinner parties? Because you're like the mortgage expert, and everyone's obsessed with house prices.
Yeah, I mean, everyone that has a house is obsessed with their house price not devaluing. Anyone that doesn't have it is when's it going to be affordable.
Want them to go down.
Yeah, so it's how stable is the housing market. And for me, as a 100-year bet, it's one of the best asset classes the UK's ever produced.
What, are you surprised that we didn't see more defaults, given where interest rates have gone? Defaults or just anxiousness in the mortgage market?
Bluntly, yes. A little bit surprised on the upside. Now, that's a good thing. But don't forget, lenders have been stressing affordability for over 10 years now. So it's not just being able to afford the mortgage payments now, but potential increases. So there has been a cushion in household finances. But, for example, in the last couple of months, we've actually seen arrears coming down. So we're seeing people better able to adjust, but it does mean that some of their other consumption has had to reduce down as well to be able to afford those payments.
When you look at the last 18 months, again, there's been, the high-end property market has changed quite a lot. Will it change with some of the rules coming into place on non-doms, or do you think that's actually untouchable?
It's a very resilient market, London, for example. So we have 2 estate agents in London, John D. Wood and Hamptons, and what we've seen there is actually increased demand. London's considered a safe haven. It's a great place to come, it's a great place to visit in the summer, it's a great place to shop, and there is an awful lot of serious foreign money that is always interested in buying properties alongside aspirational Brits.
Do you think, is it really true that they
So just less than 5 minutes away until we get our Eurozone PPI numbers year on year with a forecast of minus 5.3% on the prior minus 7.8%, month on month with a forecast of minus 0.65% on the prior minus 0.4%. We'll get our UK 3-year gilt numbers, the yield on the prior 4.204%, with a bid to cover on the prior 3.68.
Go ahead.
And I think generationally there is a real challenge for politicians just now, because I think there's a sort of trap whereby those with houses don't particularly want to see too many more houses built around them. But there's an awful lot of younger people who don't have the same opportunities that I had when I was younger to be able to buy a house.
Stuart, thank you so much. That was a wonderful update on the housing market. Stuart Hare, their Chief Executive of Skipton Building Society. Now, up next, Bloomberg Brief. Manus Krani is in New York. Danny Berger, of course, is in Berlin at Super Return. So they'll talk about markets, private markets, and there's a lot going on in India as well, with Indian assets finally after the slam dunk that they had yesterday, getting up a little bit. This is Bloomberg. Saturday mornings, I understand you have off.
Yeah, Saturday is always a day where I power down. So I run at a relative high pace throughout the week, try to wrap things up, and Saturday is a quiet day for me in terms of work. And I start typically by playing tennis with my wife. We go for a swim all year round. After that, have a nice lunch, and then I'm on to a good trajectory for the weekend. And then Sunday, I try to prepare for the coming weeks. But through a weekend, I would send either no emails or very few emails, because I want to drive a culture where all get an opportunity to spend the weekend as they fancy. I think what we do is so difficult, and it takes so much creative thinking to succeed, that if you're always on, always busy, the bandwidth of your reflection is just too narrow. And I generally believe that Monday mornings I'm a better leader than I am, say, Friday afternoon. I also take all my vacations. I generally believe I'm a much better CEO right after a vacation than I am before vacation.
Access the financial world on demand.
So just less than 1 minute away now, I will be leading with the year-on-year figure for the Eurozone PPI.
Policymakers and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
10 seconds. -5.7%, -5.7%. That's lower than the forecast of -5.3%. Eurozone PPI month on month, -1%, -1%. Lower than the forecast of -0.65%.
On the road in Berlin, speaking to the private equity titans. Welcome to Bloomberg Brief. Let's set your agenda. Apollo strikes an $11 billion venture deal with Intel. Co-president Scott Kleiman says they're just getting started.
This.
More from Apollo?
Absolutely more from Apollo, but in general, just the need for this type of capital is insatiable.
Round two, Elliott Management targets SoftBank a second time, pushing for a $15 billion buyback, according to the FT. And super return is in full swing. We'll hear from the top voices in private equity as Danny grills them on the ground in Berlin. A very good morning. You've had a lot of data to absorb, and that has bolstered the equity market within 0.6% of a record high. Yields dropped, stocks did the needful. And again, it was a little bit of a drag on the equity market.
As I have posted out the full report for the Eurozone PPI figure on the FJ feed.
Month low, down an eighth of 1%. Inventories are building in the API data and indeed at Cushing. So oil trades at a 4-month low. RBC reminds us, Helima Croft reminds us, OPEC has not abandoned their active management. The taper, as they say, is an aspirational taper, but oil is down for the 5th day in a row. So that's the drag. That's the offer on the S&P 500. The bid on the S&P 500 is Intel at the bottom of your screen. Apollo doing an $11 billion deal to buy 49% of a joint venture stake in Ireland, and more of those deals will be done. Yields, as you can see, they're doing the needful. Yesterday we saw job openings at the lowest in 3 years. JP Morgan's survey showed the longs are the highest since March. Going into this jobs report over the space of the week, 5, 10 and 30 are all down by 15 basis points. We're going to talk more about the job market, I'm sure, with Amy Wu Silverman in just a moment. They've released her to her native environment to super return in Berlin. And the news gods were good to you. I'm envious. Good morning, Danny. How are you? What's the big story?
Good morning, Dennis. I'm good. Well, okay, we got one big story. Apollo, $11 billion deals with Intel, as you mentioned. We got the exclusive. We had the first interview with Apollo, the message man is more is to come. I know we're going to talk about that later in the show. But for everyone else here, it's fascinating that the concentration of the market is something you and I talk about all the time. It's that it's big cap tech leading this market. And for folks here who want to IPO, unless you have something that can match an NVIDIA, it's not an easy environment to do that. So it's getting tougher for exits, despite the fact they're doing more deals, like, again, the one Apollo did, $11 billion, Manus.
Do you get the sense that the gap between the two, between the investors and indeed the asset managers, is closing, Danny? Who have you got set up that you can prod on this topic?
I was going to say I have two great guests that we're going to be prodding on exactly this. Coming up in about 10 minutes' time, we're going to be speaking with Anuj Ranjan, the Brookfield Private Equity CEO, and Matt Swertnia. He is the Ares head of private equity. Don't worry, Manus. I'm going to be grilling them both on this topic exactly. The feeling does seem to be that it is starting to shrink, but the dam might break.
Okay, well, if anybody can break a little bit of news out of this lot, you can. Enjoy yourself. We'll hear more from Apollo when I see you in a little while, and we look forward to those interviews. Danny Berger at Super Return in Berlin. So Danny has the Apollo Intel deal to deal with. We've got SAP in Germany agreeing to buy Walkame for $14 a share. This will be a cash deal. Walkame is expected to close in the third quarter of this year, and it will have an immaterial impact on their reporting. So this is SAP, as you can see, up 0.6%. There really is this sort of frenzy around the whole tech sector at the moment. And it's an intention to buy this. We've also got a little bit more news for you on Dollar Tree, a potential sale or a spin-off of Family Dollar. Now, this is according to the Wall Street Journey. There is Walkame and SAP. We'll see how that deal and how the market takes a hold of that. Business transformation by enhancing customer experience, enriching SAP business in the AI space. The magic dust. It's almost like going for a burger at Salt Bay. The magic dust. AI. If that's in the title, you're rocking. Or not, as the case may be. Well, yields, they're doing their job. We had the latest jobs data showing the lowest openings in the JOLTS number since 2021, boosting the bets that the Fed cuts will come sooner and in more size. Conor Cooper is with me. Today, it's all about the ISM data, and it's not been a good week, has it, so far for the data? It's amazing how we've almost sort of done a 180 from last week, higher for longer, rate hikes from some of the Fed speakers were intimated. And here we are. Suddenly, the dual mandate comes alive. Good morning.
Morning, Manus. Yeah, it hasn't been a good week for US data. We started with that down revision to first quarter GDP. We had a slightly softer personal spending number on Friday. ISM manufacturing missed on Monday. JOLTS was soft on Tuesday. And we've got the ISM services number to contend with later on today. Did have a check on the terminal this morning. The ISM services number, it's actually missed expectations in 4 of the last 5 months. And that does include the last 3. So we'll be watching that number closely this afternoon.
So I'm looking at the euro dollar at the moment. We had HSBC with Darren Maher with me yesterday morning, and I think he sort of said it 3 times. I'm short euro, I'm short euro dollar, I'm short euro dollar. Look, it seems to be all in the price, 108.74. The debate is going to be is how dovish Lagarde is in terms of keeping the July rate cut dream alive. And they're not under as much pressure as they were even just a month ago.
No, the ECB's been pretty clear. They've telegraphed a 25 basis point move, and markets and economists have both listened pretty carefully. Market pricing implies a near 100% chance that we get a rate cut tomorrow. Economists are almost unanimous in their view that we'll get the same. So a bit of a non-event in terms of the rate move. There's going to be more focus on the forward guidance that we get from Lagarde. I think that's where the key from tomorrow's meeting will be. Is the ECB to cut rates again, or is this a one-and-wait approach from the ECB? Market pricing suggests that there'll be a pause in July as well. And I don't think that's a bad position for the ECB to be in. If they hike tomorrow and pause in July, that gives them to September to gather more data, especially on wages, which we're told is key, and then they can make that decision. I imagine any comments on the path of rates to Lagarde tomorrow will get a pretty boring answer centred around data dependence.
Yeah, well, they love a bit. Everybody loves a bit of data dependence. Don't worry, we've got OPEC Plus now, the Central Bank of Oil, with their forward guidance being very, very clear, and the market's disappointed. Conor, thank you very much. Conor Cooper there, setting up the agenda. We count down to those services numbers. In our headlines, we talked about the activist investor, Elliott Management, rebuilding a sizable stake in SoftBank, pushing for $15 billion buyback. That's according to the FT in their reporting. Tom McKenzie is with me. Round 2 for a punch-up. They did this before, and one could say that Elliott did bring Masayoshi-son to heel before. So why take a second swipe at SoftBank?
You're absolutely right. Second time round for Elliott when it comes to the story of SoftBank. They piled in 2020 with a bet of around $3 billion US. They pressured SoftBank into issuing buybacks. That happened. Then they pulled out of the trade. They sold down. They sat pretty on the back of that trade. That worked out for them. Now they're trying again, and the rationale for this is that there is a gap, a screaming market gap in terms of the market value of SoftBank and its underlying assets. In fact, it's something that Masayoshi Son of SoftBank has been talking about himself. Elliott want them to go through with buybacks then of around $15 billion US. They say that will signal Masayoshi Son his own confidence in this business. That's what they're pushing for. They say the time is right now. This is a business, SoftBank, of course, has been walking back some of those investments in tech, of course, some of those ones that went wrong for SoftBank, like WeWork, for example. But they are now looking, SoftBank is now looking aggressively at AI, and of course they have exposure to part of that through their holdings in ARM, which has worked out pretty well for them.
I mean, this is maybe Masayoshi Son, my apologies on the mispronunciation the first time round. You know, he's maybe got a better case to push back against Elliott this time. In other words, if you want me to develop SoftBank and you want me to have those AI investments, I want to use my dry powder, and it is a sizable scale of dry powder for deploying on opportunities rather than buybacks. It's the classic kind of counter defense, isn't it? What size of dry powder do they have?
Around 6 trillion yen, that's about $40 billion US, about $40 billion US. And look, you're absolutely right. We know through Bloomberg reporting that Masayoshi Son has been in discussions about raising up to $100 billion US to build out a competitor to NVIDIA. I mean, the ambition is there, a hugely ambitious project, but it would require that much capital. So there's still 60 billion short of that. They're also looking at maybe buying the UK chip company Graphcore. So that will be the pushback. We need this capital, as you say, to invest around AI. The stock is up 50% year to date, and it's still not at those 2021 highs.
Tom, thank you very much. Tom McKenzie there on the very latest. The battle between Elliott and SoftBank. Other top stories on your Bloomberg terminal this Wednesday morning. BlackRock and Citadel are among the investors backing a Texas upstart will challenge the New York Stock Exchange and NASDAQ. The Texas Stock Exchange has raised $120 million, and it plans to register with the SEC. The CEO, James Lee, told the Wall Street Journal that the plan is to entice companies seeking relief from the increasing compliance costs in New York. NXP is teaming up with a company partly owned by TSMC to build a chip wafer plant in Singapore. A $7.8 billion plant will be built in the second half of this year, with production starting in 2027. Southeast Asia is emerging as a force in the technology manufacturing and as a global tech firm diversifying from China. eBay is dropping American Express cards as a payment option. The online marketplace says it's no longer accepting Amex because of unacceptably high fees. eBay plans to notify customers this week about the change, which is set to take effect August 17th. Coming up, we head back to the Super Return Conference in Berlin. The CEO of Brookfield Private Equity sits down with Danny Berger. Context Matters on Bloomberg.
We'll have to build a portfolio of interventions. Lifestyle will also play into for some of them, and I think we can help many patients get down to a weight that they can maintain and live the life they want to live and avoid many comorbidities for the healthcare systems.
DOJ or other authorities
could face bigger challenges next.
It was going to keep
Great World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Brief. A very good morning. I'm Menace Cranny in New York. Danny Berger is on location in Berlin, where we go live. She's at the Super Return Conference. Danny, what have you got?
Did you say I was on vacation, Manus? We are hard at work over here. Don't let some of the nice greenery behind us fool you. But we are hard at work, and we're talking with someone else who has also been hard at work. Meeting after meeting, he took some time for us. It is Anuj Ranjan, Chief Executive Officer of Brookfield's Private Equity Group and Brookfield Business Partners. Anuj, thank you so much for joining this morning. I had to look down for your title because you've got a new title now. First time joining us since the promotion. So first of all, congratulations on that.
Thank you. Thank you.
And I know when that announcement was made, you made a very clear statement. Look, we're going to scale up this business. It's an interesting time in this industry. There's concerns about can you exit, concerns about higher for longer. So why is now the time to scale up private equity at Brookfield?
Well, first of all, thank you for having me back. I'm very fortunate because I've stepped into this role at a time where our private equity group is at a true inflection point at Brookfield. And I genuinely think we can triple the size of this business in the next 5 years. We have everything in place. We've got the best team we've ever had. We have real boots on the ground, operational capability in every market in the world that we invest in. An incredible track record. We've been doing this for 25 years. So I'm very fortunate to step into this sort of opportunity at a time when we've got this platform that I can hopefully help grow and steer into the right direction.
So just to make sure I heard you right, triple in 5 years.
That's right.
What leads that?
You know, it's funny. Of course, the deal environment is not as exuberant as it was in 2021 or 2020. But activity's back. Good sponsors that are buying good businesses to generate cash flow, ones that have sort of an angle to bring a real operational capability to the businesses that they own. They can get financing, and that financing is enabling a deal environment where transactions are happening. We think that it's back to roll up your sleeves private equity, and you really have to get into a business and improve the margins rather than relying on multiple expansion to generate your returns.
Right, the financial engineering part of it being over. Well, so that's kind of the deal structure, but what about region? Is there a specific region you're leaning into?
So we've always been very big in North America and Western Europe. Those continue to be two key regions for us. In the rest of the world, India and the Middle East has always been very important. We continue to find great opportunities there, in Australia. But we're seeing opportunities around the world. The United States is quite interesting because it's been very resilient. Our businesses are performing very well, even in the last 12 months. Market leaders continue to be able to set pricing and to be able to pass through inflation and handle this environment quite well. So we're going to continue to focus on the core things that we do, which are industrials and essential services in the United States and Western Europe.
When it comes to industrials, though, I mean, it's the companies that Brookfield traditionally invest in, but they tend to be capital heavy, and we're at a time when growth is compressed. Is the macro environment becoming more challenging for industrials?
You know, I'd say it's becoming more rational. And it's becoming, I'm actually glad that some of the exuberance is gone. I think it's a healthy market. Financing is available. We've financed almost $20 billion of debt refinanced in our portfolio companies at often the same cost or less than what we had before. So you can get great financing for great businesses, again, if you're a great owner of that business. So, I think that this environment's actually quite healthy. Industrial companies, if they are market leaders, they provide an essential product or service, they can still thrive in this environment. And, again, it comes back to really going into these businesses, rolling up your sleeves, and relying on margin expansion, not multiple expansion, to make your returns. And I think even at this conference, that's, I think, a realization across the industry.
The other thing, though, that's been talked about this conference is, sure, there are deals to be done. There's some attractive things out here, but the selling isn't happening. The selling is still at a standstill. LPs are not happy about that, especially as you're extending the business. Do you have to have a clear view with exits? How do you handle this conundrum?
Look, we always say if you're not selling a business at a certain price, you're buying it at that price. And that might be okay for a great business that has a lot of runway ahead, but you have to constantly be thinking about exits. We think about exit from the time we make an investment.
Right.
And as the largest LP in our funds ourselves as Brookfield from the balance sheet, we really care about that DPI or that return to our partners as well. And so that focus is throughout the business. We've actually managed to make quite a few exits in the last 12 months, notwithstanding this current environment. We sold a business in Europe to a strategic. We sold a business in Asia to another sponsor. And of course, we had a big exit of a large business in the US, which again was sold to a strategic. So there are exits happening. I think it's about the types of businesses. These are high cash yielding, really market-leading businesses that people want.
But there's some stuff out there that this industry has done, especially when there was that period of time where rates were low, that everything was bought at high multiples. Anuj, there's things out there that are not quality companies.
Absolutely.
When do those get sold, and what does it look like when they do?
It's thankfully I don't think we own any of those, so I think we're not in that challenge. But there are people that depended on a low rate environment to get exits. And I don't think that low rate environment's coming back anytime soon. I think rates will probably come down from here, but we are in this environment for some time. I think that's a good thing. Some of the businesses that relied too much on unprofitable growth are going to have challenges getting exits, frankly, at any price at any time in this environment.
Anuj, I want to end here because you have global experience. Brookfield has led you all over the place. You've started up many businesses, and I know you were in the Middle East for a while. The Middle East is obviously, and the sovereign wealth funds, has been a very fertile ground for fundraising. There does seem to be this concern, though, that if you look at the PIF, for example, that they want to start spending more internally. They have a lot of projects they want to put money towards. Do you think some of the fundraising slows down from some of the Middle Eastern sovereign wealth funds as they look internally?
Look, I think it's all relative. I think the Middle East has been a huge supporter of the industry and provided a lot of capital globally over the last decade, and they will continue to. They will continue to be a big supporter of ours, and I think of the industry. They do have a focus also on investing in the country. We've been investing in the country for 10 years. We've done about $10 billion of deals in the Middle East. And in fact, we're really excited about that market. We think it's been very, very valuable for us. It's been great returns. We think of it as kind of emerging market returns with developed market risk. And so we'll keep investing locally, and some of them will partner with us in that region.
What's competition gone like there, though? Because when you started there weren't a lot of players there. There was a recent story on Bloomberg, our colleagues writing that Chinese investors are also increasingly getting interested in the Middle East.
Absolutely. Look, Asia and Middle East broader are all interested in that region. We're seeing, though, that a lot of them want to actually partner with us because not everyone has the boots on the ground, and it comes back to that operational capability. We've been in the Middle East since '97, been an active investor since 2015. We got a big operating capability locally. We don't invest in the region from London or from another market. We invest from that market, and hopefully all this capital that wants access to it will find partners like us valuable.
Anuj, thank you so much for joining this morning. It is always a pleasure to hear from you. Come join us when you're next in New York. That is Anuj Ranjan of Brookfield. More ahead from Berlin. Manis is also going to walk you through the news you need to know this morning here on Bloomberg Brief.
Every single thing I've done It's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It is Bloomberg Brief. I'm Menace Granny in New York. Danny Berger is on location in Berlin. The oil market holding near 4-month low amid increased stockpiles here in the U.S., according to an industry report. That is adding to the bearish sentiment, compounded by OPEC Plus's plan to boost supply. Let's get to our executive editor for commodities. It is Will Kennedy. So the stockpiles are rising, and this market is still chewing the OPEC Plus deal like a wasp. Halima Croft says it's an aspirational cut. This market is fixated with additional supply. Will, good morning.
Good morning, Manus. And I think, yes, like all OPEC decisions, there are options for adjustment down the line if they decide to do that. But I think it is clear that the broader picture of the meeting was that to maintain the group's unity, some of the members wanted the ability, the UAE notable among them, to start putting more oil back into the market into 2025, and that is what's going to happen. I think it would be hard to put that genie back into the bottle, and the modest market move that we've seen, it hasn't been a crash, there's been a sell-off. That market move, I think, has been driven by the realization that they are going to get more oil as we get into the latter part of the year and into early 2025. The big question, of course, is the demand picture. Will the global oil market be able to soak up that supply? It's been very robust over the last couple of years coming out of the pandemic. Will that continue? Of course, lower prices are a big benefit for Joe Biden as he goes into an election.
Absolutely. Those gas pump prices equal votes. Will, thank you very much. Tucking it up very neatly and compactly. Will Kennedy, our executive editor on commodities. We'll be catching up with RBC's Amy Wu Silverman in just a moment to talk about vol.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of ON's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined ON as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but ON's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
From our global headquarters in New York, I'm Manus Cranny. Danny Berger on location at the Private Equity Leaders Summit in Berlin. Welcome to Bloomberg Brief. Let's say your agenda. Apollo strikes an $11 billion joint venture deal with Intel. Co-president Scott Kleiman tells Bloomberg they're just getting started.
I think you're going to see more and more of this.
More from Apollo?
Absolutely more from Apollo, but in general, just the need for this type of capital is insatiable.
Round two, Elliott management targets SoftBank a second time, pushing for a $15 billion buyback, according to the FT. And super return is in full swing. We'll hear from the top voices in private equity as Danny Berger sits down on the ground in Berlin. A very good morning. The tail that wagged the dog was the drop in yields, 15 basis points over 3 days, right the way across the spectrum of the curve. That invoked the bid to the S&P 500. You're barely 0.6% away from a record high. Two stocks to watch. Intel manages to sell off part of their joint venture in Ireland. Apollo will take a 49% stake, $11 billion. That is smart debt management. That is Pat Gelsinger really beginning to fine-tune the balance sheet over at Intel. Intel is bid by 1% this morning. Another breaking news story in the past 30 minutes. Dollar Tree, we understand from the Journal, is to spin off Family Dollar. They get 45% of their sales from Family Dollar, by the way, which is the out-of-town location store. And they had promised to close nearly 1,000 of those stores earlier in the year. So two stocks to watch. BMO say that the JOLTS data, the lowest in 3 years, really helps the case for a September cut. And oil is at a 4-month bouncing from a 4-month low. OPEC have not abandoned their active management program, according to RBC. And of course, Joe Biden gets a good boost. Oil had been down for 5 days in a row. We've just reversed it this morning. What does that mean for gas prices at the pump and elections? We know it's one of the most prescient issues for the voters on their mind. Prescient issue for me is that Danny Berger is on location, not vacation, at the Super Return Private Equity Conference in Berlin. My apologies to you. I think it was Freudian. I look at you in Europe and I'm thinking of the southern beaches, but you're in Berlin. Good morning.
I'm in Berlin. Honestly, you might have said location, Manus, and I misheard you as vacation, so that one might be on me. It is busy here. It is loud, so it's a little bit hard to hear, but it is busy, and there is a sense, Manus, that the environment is coming back. You and I have had these conversations. Deal making is up. Buying is happening. The issue is that selling is not happening. So what is it going to take for this industry to finally unload some assets? Is it going to be painful when they do that? Will they have to take discounts? Manus, I'm really excited to have these conversations coming up. We're going to be speaking to Matt Swertnia. He is the head of PE at Ares. He has a lot to say on this and a lot to say on what he says are broken public markets that have changed the game for IPOs.
Yeah, but if you can't IPO, where do those assets get sold off to? And as you and I have discussed, at what discount? You've had the rain gods with your Apollo interview, so well done on that. And we'll see you in just a short moment with your area interview. That's anytime I've got on location in Berlin. So stocks holding up May's gain. We're kicking off June with moderately dovish Fed rate bets. RBC's Amy Wu Silverman looks ahead to the summer. This is what she writes. Historically, June and July tend to be lower volatility months of the year. The market also tends to rally prior to US elections. This time, it could be different. Amy Wu Silverman joins me now. Amy, good to see you this morning. I would say to you, you know, we've almost done a 180 from last week where we had this discussion maybe about a rate hike. We had higher for longer obsession. This week, we've now moved to earlier rate cuts in the year as the jolts and the PMI give us a little bit to chew on. Do you think not we're moving towards a Volmageddon, but sort of a vol moment, an increasing vol environment?
Hi, Manus. That's exactly right, because as you said, we keep swapping kind of predictive views on what's happening with rates, what's happening with a lot of things. And investors, frankly, they're getting this sentiment whiplash. And when you get the sentiment whiplash, you tend to get volatility start to bubble. Now, we've kind of had this pretty suppressed low vol, low VIX handle this whole year, but we're going into, you know, dare I say, a relatively unprecedented situation with U.S. elections, with one trial that's concluded for the Republican candidate, but another one that's on its way. So, you know, I don't think it's that unfair to say that this time, looking ahead, the U.S. elections could look different than history, along with many other things.
Now, you talk about the hump and volatility, and you very clearly say this. We do not have a hump for very long. We may have a moderate spike over the election, but of course, it's all the contingent decision tree analysis after the election that's perhaps not discounted. We're showing cross-asset volatility at the moment, but around that election, you think that my question would be, is volatility still relatively cheap after the election, and should I be looking at that as an opportunity?
I think it is relatively inexpensive, and I do think that's the kind of fat left tail that the market hasn't started to price in yet. Look, when I talk to investors, you know, they kind of look at elections and then they throw up their hands in the air and say, we don't really know how to price this, so let's just price this kind of the median in what happens during history, which is typically you get a rally into elections, you get that hump in VIX term structure for November, and then, you know, it's done and dusted. But the reality is we do have one precedent to look back to. That's the year 2000, where there was a contested election. And to me, you know, it maybe rhymes with history in the sense that we could get something that looks more like that than just your average run-of-the-mill election. If that is the case, volatility isn't pricing longer term, that just simply finding an outcome will take longer. And that's why I think that left tail hump is probably a little bit fatter than people are pricing in.
Yeah, we're just showing the SEP futures. I mean, they're obviously pricing higher than OC and DEC. Now, I love what you talked about. I mean, I started the show by saying we're 0.6% away from another record high. I mean, we over 23, 24, maybe 25 record highs is what we've had. And I like what you call the call exuberance. I mean, we've called up intermittently once a month. The call exuberance, that exceptional call buying, was actually waning. And then, bam, Keith Gill and Roaring Kitty came back to life. Is that a seminal moment in vol?
You know, I think some investors would like to think that it isn't, but it really is. And I'll tell you why. Because the first time we had the meme frenzy, it really was something that people just didn't know what to expect the next day. To some degree, we have a little bit more of a playbook, right? We have seen this happen before. And I'll tell you, the one secondary effect that people have to really consider is as these stocks, like a GameStop, grow, they also become larger weights in different benchmarks. So like an XRT or an IWM. And the reason that matters is the last time around you had value investors, you had small mid-cap investors who became very concerned that they were going to start dragging their benchmark as this became larger proportions of the weight. And so you have this right tail risk again, this call exuberance that we're going to start to see because of the meme frenzy. So look, there are secondary impacts of this, even if you're not a long or short investor in GameStop itself.
is this where institutions and more sort of proprietary traders are bouncing? I mean, I know there's an entire entourage of retail that trade this, but then you have professional traders who actually trade this in their private books. And then you've got institutions, and this is where I really want to understand the impact on institutional risk-taking. What are people talking about as this meme frenzy reasserts itself?
Yeah, so the one thing, and I can tell you because these are kind of the incoming requests I'll get when you start seeing something like this meme frenzy reemerge, which is that call exuberance, which we also call skew inversion, when that call implied volatility outweighs the put implied volatility. People start to ask, okay, we see it here. Do we start to see it in other stocks? Because if you, again, we have a playbook now. If you look back to history, it doesn't tend to be just, siloed to this one stock. It tends to bubble to other names that people consider, I guess, part of the meme umbrella. And so, they ask, like, where else do you see call exuberance? Because maybe that's where we get other positive momentum begetting positive momentum. And again, it's very interesting because had this not happened, I would have actually told you that the right tail's been being sucked out of the market, actually. You hadn't seen it as sustained in AI names, for instance, but this is sort of like what I mean by sentiment whiplash. It just comes back the next day, and then people are kind of scrambling to rewrite their playbooks a little bit.
So let me take the other side of the bell curve then and go to the left-hand side of the tail risk, which must mean exuberance, call buying, meme stock frenzy to the left. Let's deal with the hedge. PIMCO are saying, look, modest bond losses, we both know that. The market is ignoring recession risk, JOLTS, PMI, services today, jobs tomorrow. The market is essentially ignoring the potential for slowdown, soft landing, quasi-hard landing, and they say bonds are a cheap hedge in that context. For you, how can I pick up cheap protection now?
Look, protection, that left tail is incredibly inexpensive. I think the hesitation for investors is, burn me once, shame on me, but then, am I going to repeat it? The skew in the market, that downside protection just hasn't been working. That doesn't mean it won't work. We certainly have a slew of unknown unknowns, geopolitical risks, but, the post-COVID volatility regime has not been friendly for folks who have been hedging, and that's been really difficult. However, we do see S&P skews start to tick up. We are starting to see pockets of hedging, and we also have been seeing VIX call buying, which is sort of like thinking about a tail event occurring.
Yeah.
But it's just been difficult because those velocities have been very quick when there is downside, or you just haven't really seen that happen. And so especially as you go into the summer months, you have to take into account that seasonally you're actually getting lower volatility months that you're getting into.
Okay, Amy, great to have you with us, setting up the risk agenda. That's Amy Wu-Silverman there of RBC Capital Markets. Coming up, we're back to Berlin and super return. Ares head of private equity sits down with Danny Berger. Context matters on Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New season starts July 10th, only on Bloomberg. Brought to you by Workday. The top names in business are on Bloomberg.
They're kind of predicting a soft landing, and you see that in both stock price, which are kind of high, credit spreads, which are kind of low, markets, which are kind of wide open. That's all good. Doesn't tell you what the future is going to be. But I think there are a lot of inflationary forces in front of us that, may keep it a little bit higher than people expect. My view is whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
Bloomberg. Context changes everything.
Let's get back to Berlin. Danny Berger is standing by with another top voice in the private equity world at Super Return. Danny.
Thank you so much, Manus. That's right. I am here with Matt Swertnia. He is the head of private equity at Ares. Matt, thank you so much for joining this morning.
Thanks, Danny. Happy to be here.
So the environment we're in right now, about $250 billion worth of deals announced for this industry so far this year, up about 23% compared to last year. It's from a low base. So where are we? How far away are we from normal right now?
So I think the deal market is going to continue to improve here in the back half. I do think it's been slow. I think 2022, 2023, and the first half of 24 has been slow as rates have come up and people have adjusted to that. But I think whether it's here at the conference or talking to limited partners, our customers, look, I think people want money back in the private equity business. Investors want money back. And I do think the drumbeat is getting louder for that. And with that, I think GPs, like ourselves, are going to be looking to sell assets. And I think deal flow will pick up here back half of 24 and into 25.
When that deal flow picks up, because we have seen some exits, but it's been the really high quality, the stuff that you can find a buyer for. So what does it look like when it picks up in the fourth quarter? Is this going to be painful for folks?
I do think what you referenced is right. I do think the high-quality companies, the companies that are growing nicely, I think they have lots of alternatives. I think it is that second tier of companies that isn't growing as well, and there's been price discovery about that. So I do think there needs to be a bit of a meeting in the middle between buyers and sellers on some of those second-tier companies. But we expect that to happen. Again, if the LPs are really asking us for cash back, I think that's across the portfolio, not just with your best companies. And so GPs have to look at what is the market price, for some of these companies. And I think that will help deal volume to pick up here in the back half that include that kind of second tier of companies.
Well, a lot of these companies were bought when rates were low, valuations were quite high. So that price discovery you're talking about, I really want to get into what that price discovery actually is. Are we talking about big discounts, slight discounts? What sort of things are we actually going to see in terms of price in this market?
Sure. I think that it really depends on the growth rate of the company. So a lot of people ask, hey, is the deal volume going to get much better when the Fed cuts rates or the ECB cuts rates like it may do here shortly? Well, I don't think it's really as rates driven as it is growth driven. So the question now is, if I'm trying to sell a company that's growing at 20% a year, I think that market and the opportunities for exit is wide open. If we're talking about a company that's growing 5% a year, I think that becomes more difficult, and I think you would have to take potentially a bigger discount than what you might have bought it at in 2021. So I think that's where a lot of private equity firms are focused, is really, can I grow my companies? Can I grow them faster than the industry rates? Because that's how I'm going to get the best price overall.
Right. Well, one exit option that is frozen over, iced over, choose whatever metaphor you want, is IPOs. Yep. But this is a stock market that is trading at record highs. I could easily conduct a thesis that says, now would be a great time for IPOs. Look at what the public market is doing. It keeps going up and up and up. Yep. So what's going on?
So I do think there's been a big shift over an extended period of time of money from the public markets to the private markets. So there's a lot of that discussion that's here at the conference. whether that's private credit, whether that's private equity, et cetera. I think some of that has really been the smaller cap and the mid cap IPO space has really been taken over by private equity, broadly speaking. So now when we're a private equity firm and we focus in the middle market, when we're thinking about taking a middle market company public, we have to think about, can we take it public and can it have a relatively steady trading price and volume over an extended period of time, usually 2 or 3 or 4 years for a private equity firm to sell out of the company? Can it have that steady backdrop with which to sell shares? And what we see is a lot of volatility. So we see a lot of volatility in the market up and down. There are a lot of forces, there are a lot of money flows that I think have made that small and mid-cap public area more volatile than it was 10 or 15 years ago. And I do think then the public scrutiny for CEOs, for companies, I think it's made it more challenging to do IPOs.
I mean, the public scrutiny has always been there, though. So what's different this time?
I do think it's the volatility. I think it's the steadiness. So when CEOs and companies went public, there was a anticipation that I could grow my company and the stock price would stay relatively moderate and grow over time with the earnings of my company. Today, we're seeing stock prices go up and down fairly significantly, sometimes
is that
on no news.
A temporary phenomenon, do you think, or is this a broken market that is not coming back?
So I think it's a changed market for sure. Whether it's broken or not, I think it's changed. I do think this is one of the reasons why the private markets have become more attractive, especially in this middle market or the mid-cap range. I think companies, CEOs, even shareholders prefer that less volatility and staying out of the public eye for longer. And if you have a number of liquidity options that are not just going public, which I think private equity does, I think then you're going to see more people stay in the private markets and not lend themselves to that kind of scrutiny.
So this reminds me of a criticism that I'm sure you'll have a certain feeling about. I was with Cliff Asness a few weeks ago, who has this criticism of the private equity sector. He's a public equity guy, make of that what you will. But he calls what you do volatility laundering. This idea that your returns are outsized is just because you've masked over the volatility that is in public markets. And at the same time, basically what you have is just leveraged public equities. And that's the only difference. Tell me why he's wrong.
Right. So it's a great question. We get this a lot. So from my perspective, I actually believe the private markets are more consistent in terms of their valuations because the companies are being more consistent in their results overall. Right. I don't think there's as much volatility. In the public markets, I think there are a number of factors that can affect stock price that go beyond just the company performance. And we see that in terms of money flows, in terms of mutual funds, in terms of ETFs, and yes, in terms of meme stocks or other things that have played to the small cap universe.
Just quickly, Matt, on that, I mean, your conversations with CEOs, presumably there's been this desire to not have the volatility of public markets for a while, but what sort of tone are you hearing from them? Is it different when they talk to you about IPOing and maybe the fear of becoming a public company?
So for sure, I think as a CEO, what you're looking for is a fiduciary of your company, which includes not only your shareholders, but many employees, many other constituents that you're taking care of. And so when you're thinking about all of those and you head into the public markets, what you're trying to do is to not have this huge volatility in the stock price, which especially when it goes down, can cause some concern among your employee base, maybe among suppliers, among other people. I would rather stay in the private markets with the consistency of at least my valuation, my destination, and I can talk about how our company is doing and hopefully succeeding and adding value to everyone under that fiduciary banner, rather than having to deal with the latest news of whether my stock went up or down 20%.
Right.
So we for sure hear that.
Yeah, and you know that firsthand what that's like working for a public company, Matt.
We do.
We're going to have to leave it there. Thank you so much for joining us. It was really a pleasure speaking with you. That was Matt Swertny, the Ares head of private equity. This is Bloomberg.
Danny.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
We'll have to build a portfolio of interventions. Lifestyle will also play into for some of them, and I think we can help many patients get down to a weight that they can maintain and live the life they want to live and avoid many comorbidities for the healthcare systems.
Let's set up your trading day for you. The Bank of Canada rate decision hits the tape at 9:45 Eastern. U.S. services PMI will be closely watched after the manufacturing data yesterday, 9:45 a.m. and 10 a.m. More retail coming, Dollar Tree before the bell. Of course, we've got that journal story they're talking about selling Family Dollar. Lululemon will hit the tape after the close. She's on location. Let's see what the Apollo co-president had to tell Danny Berger.
These type of blue chip, large cap companies, they're not talking about 100 million or 500 million. They're talking 2 billion, 5 billion, 10 billion plus. And so the ability to really come up with those creative solutions in scale is really, really critical. But I think you're going to see more and more of this coming.
More from Apollo?
Absolutely more from Apollo. But in general, just the need for this type of capital is insatiable.
Danny, deep pockets there at Apollo, but I was fascinated by your Aries conversation, which is, private for longer and avoid the vol.
Yeah. Yeah, I mean, look, it's been a thing for a while, right? That CEOs, as nice as it is to go public and maybe cash out a little bit, they're hesitant to do so because of the idea of quarterly to quarterly, but it's worse now, Manus, Aries said, because of the volatility in this market. So companies are going to be private for much longer.
Well done on the Apollo. You've got the news gods with you. We'll catch up with you tomorrow. More interviews to come from the team on the ground. Danny Berger on location in Berlin at Super Return. That's it for Bloomberg Brief, and the team surveillance is up ahead. Context matters on Bloomberg. From New York, good morning.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
There is absolutely nothing in the data that indicates that things are actually slowing down in any perceptible way.
For markets anyways, I think probably the next few months are going to be very choppy.
The market always moves ahead of the Fed.
The market dynamics and the market structure actually afford the ability to hedge really almost like never before.
We're not really in a typical cycle. We're in a cycle that has been boosted by mega forces that we haven't seen before in terms of the magnitude.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance begins right now. Equity futures on the S&P 500 positive by 0.2%. Monday looked a lot like Tuesday, squeezing out a day of gains right at the end of the session. In the bond market, pretty consistent. A rally, 4 consecutive days of yields dropping, down about 20 basis points at the front end on a 2-year. Over that period, down about 30 on a 10-year. We are 2 for 2 this week. ISM manufacturing, weaker than expected. JOLTS, job openings, lower than expected. A massive focus, a lot of weight being put on the ISM. A little bit later on this morning, Bramo, that's the one to watch.
You're asking a good question, which is 2 for 2. Is bad economic news going to be negative for equities? The answer is we don't know. And really, one thing that Jim Reed over at Deutsche Bank pointed out is even though you do have some of these wobbles, on an entirety basis since we got back to trade after Memorial Day, stocks are only down about 0.25%. So it's not as though it's been a massive drawdown in response to some of the negative news.
But you can feel that tension. It's like that tug of war. You're going nowhere, but there's tons of tension in that rope right now. I think a great example of that is job openings yesterday. So let's look at the ratio of openings to unemployed people. That's east to 1.2. We know where that was at the peak of all of this. The ratio was 2 to 1. It was 2 to 1. It's come all the way back down to 1.2, the lowest since June 2021, and really, really close to where we were in 2019. So we've got to ask the following. Are we normalizing, or are we going to a deep, dark place that we don't want to go to?
Which is part of what some people are saying with Andrew Hollenhorst calling for more rapid deceleration in some of the jobs growth. There's another potential option here, too. If we're going back to trend growth, are we pricing that in accurately? How do we price that with some of the mega trends that Wei Li was talking about, sort of overlaid on top of it? Struggling with that is also sort of giving people a sense of, okay, what do valuations look like after some of the run-up we've seen so far this year and last?
More data coming up later. The ADP report, one to watch. And, of course, the ISM services before that. You get a PMI too. And then Friday. It's the big one, isn't it? Payrolls Friday. The number looks like this. A sneak peek, 185, the previous number 175, and a lot of strategists trying to work out what bad news actually is this coming Friday.
Although, is it going to be in the headline number or is it going to be in the revisions? An increasing focus on revisions, not just to the previous month, but also to what we're going to get this week, which is revisions to 2023 numbers. This has been something that has been giving people a sense of insecurity around the data. Mohamed El-Erian talking about this. We're data dependent on data that gets shifted around in that post facto. And so, yes, we're going to be focusing on what is bad news, but how do we understand the trends after we get some of the revisions that maybe reset some of the expectations expectations akin to what we've seen over the past few years.
Would you like to talk about some volatility? Let's do that. Let's head over to India and talk about the Nifty 50, the benchmark equity market index over there. Today, biggest one-day rally since 2021. Okay, yesterday, biggest one-day drop in about 4 years. We've been all over the place, and I think right now we're basically back to where we were on Friday, and we're still trying to work out what the future of things look like in that country politically.
So we're trying to figure out what the actual policy implications are. It highlights how, if we're concerned about the polling in our country, in the United States, polling in India after the election was incredibly inaccurate because it seems to suggest a much bigger win for Narendra Modi. How he gets this coalition of allies in a way that he hasn't had to for years is going to really be important for policy. On a broader sense, though, it raises this question about political volatility in a broader scheme, not just in developed markets, not just in the United States, but globally.
Massive focus, lots of interest in that story. I can tell you in about 25 minutes from now, we'll catch up with the team on the ground in New Delhi. Looking forward to doing that. The scores this morning, and good morning and welcome to the programme. Your scores look like this. Equity futures on the S&P 500 positive by 0.2%. Yields a little bit higher after dropping for 4 straight days on a 10-year, 433.96. And we get closer and closer to that ECB rate decision / ECB rate cut. 108.71 on euro dollar. We're negative by about 1/10%. The lineup for this hour looks a little something like this. Emily Rowland of John Hancock, passing on the bad news is good news narrative. We'll speak to Ed Al-Husseini of Columbia Threadneedle as India's Modi clings to power, and Stephanie Roth of Wolf Research expecting another slowdown in US jobs. We'll begin with our top story. Bond yields declining for 4 straight days coming into Wednesday, following another downside surprise on economic data. Emily Rowland of John Hancock Investment Management writing this. We are not chasing the bad news is good news narrative. Eventually, bad news will just be bad news. Emily joins us now for more. Emily, how close are we to that point? Are we at that point right now?
Well, to your point, John, it's just been a couple of days here, but there's been some pretty notable cross-asset trends. We look at things like small cap equities. Yesterday, they were down over 1%, even with that decline in yields. Over the past month, we've seen the 10-year Treasury yield decline from 4.70 to 4.35, and small caps have not kept up with their large cap counterparts. Of course, the narrative that's been permeating the markets is small caps should be the biggest beneficiary of rates coming down because they have higher interest burdens, and as the cost of capital comes down, that'll be a positive for those small cap stocks that tend to be less profitable. We're just not seeing that play out. We're seeing cyclical stocks get hurt. So we're feeling kind of sniffs of the market reacting to, hey, maybe this isn't so great, and that the Fed pivoting is actually maybe not going to be for the best reason.
We're in new territory, and I need your help navigating it, Emily. I'm trying to work out the distinction between a welcome cooling in the data and an unwelcome deterioration. What does that look like come Friday?
Yeah, it's really tough, and I think it's right to be watching the labor market because we've seen some cracks forming. You mentioned the JOLTS job openings data this week falling to the lowest level since 2021. The labor market continues to normalize. The whisper numbers lower than that 180,000 consensus view on job gains this month. I think we could see jobs kind of join the string of weaker than expected data. We've had retail sales. Look at the Atlanta Fed GDP Now estimate. It was over 4% pretty recently for Q2, and now we're at 1.8%. So we're seeing a notable deceleration in the data. Now, if you look overseas, those economies are actually looking a little bit better than expected. So the U.S. may sort of draft off of better growth in areas like Europe. China PMIs overnight showed some strengthening. But we're going to have to see kind of when that point is. And I think looking at things like initial claims are going to give us a sense.
How do you understand the Fed's policy and sort of their response function at a time where you really codified a pivot party and you talked about how it was fueling a lot of the gains in markets? Maybe the Fed wasn't wrong to pivot. Maybe they're going to cut rates in July. This is the assumption of the likes of Andrew Hollenhorst and Steve Englander. Do you think that that looks increasingly appropriate, that maybe they were onto something about a weakening in the economy?
Yeah, Lisa, we think they were onto something, but the party just started way too early. I don't know if you remember kegs and eggs back in our sorority days. Maybe you guys recall that. But, back in October, the Fed hinted at 3 cuts, and then I just thought of that. And then, the bond market extrapolated that to price in 6 cuts. So the party started a little bit early. And I think the challenge with that was that you had this massive loosening in financial conditions. You saw risk-taking take hold, and the better economic growth was a good thing, but it comes with a nasty side effect of higher inflation. And I think you saw that in the form of the resilience across the housing market, especially in the first quarter. So the Fed's got a challenge on their hands. Yes, inflation's coming down, but it's taking a lot longer than expected thanks to the Fed's own sort of rhetoric back in the fall. So the Fed's sort of backed in a corner here. I think wage growth on Friday is going to give us some more clues on the inflationary backdrop, but it's probably going to be a little while here until we can see those cuts.
You're raising an interesting point about some of the optimism that was baked in that needs to come out. Where does it need to come out in particular in markets where you're looking at quality stocks, you're trying to stay away from cyclicals, and we're defining what does quality mean at a time where NVIDIA to the moon trades like a meme stock and yet seems to be the biggest winner always?
Yeah, you've got to focus on the earnings, Lisa, in our opinion, and we would be looking to trim areas that are not profitable. We talked about small caps already. We would be fading that and continuing to lean into quality. We want to own companies with great balance sheets, lots of cash, but we also want to think about owning them at a reasonable price. You mentioned technology companies. Yes, the valuations are looking somewhat extreme. No late 1990s, but they're looking overbought, but the earnings are there. You look at NVIDIA, yes, the stock's up a lot, but the earnings are up over 400% year over year. So you've got to find those quality companies. We're finding it mostly in U.S. mega cap tech, communication services. We'd even be sprinkling in a little bit of utilities now to balance out that tech exposure.
We'll speak to Lizanne Saunders a little bit later, Lisa, of Charles Schwab. NVIDIA's correlation to the market was 0.95. It's now 0.3.
Oh, yeah.
What a change.
I mean, essentially, NVIDIA is no longer the market in the same kind of way. It's interesting. Emily was talking about 1999. Washington Crossing advisors, Chad Morganlander and Kevin Karen, came out and said, in both 1999 and today, the stock market exhibits strong momentum and herd mentality, particularly among, that's right, the largest, most valuable companies. So some people are drawing the analogy with 1999 in a more aggressive way.
What do you make, Emily, of that breakdown of the correlation between NVIDIA and the broader market?
Yeah, we think it's healthy. Again, you're seeing a bit of a broadening out here. Some more breadth is certainly a good thing. It was time for those names to maybe take a little bit of a breather in terms of their dominance. It's still there. And again, it's a key reason for our emphasis on U.S. versus international equities, just the fact that we have a massive exposure to tech here. That's where we're finding the most quality. But we would also be looking at areas like mid-cap stocks. If you look at the S&P 400 index, it's actually trading at the steepest discount to its large cap counterparts since the late 1990s right now. So we think that there's a nice opportunity to lean into mid-cap stocks, take advantage of that valuation discount, and also get exposure to areas like industrials, which are benefiting from onshoring and industrial production that's picking up in the United States.
Emily, help me out here. So basically, we start the conversation by talking about bad news is bad news and end it by saying lean into mid-caps. Can you make that work for us?
Yeah, so we're balancing that out, John. You know that we've also had an overweight to high-quality bonds here. We love the fact that bonds are giving you income, 5-6% income. Even if you've got to wait a little bit for the duration tailwind to kick in, you're still collecting income in an environment where we do think economic contraction's coming. It's hard to see it right now, so we want to maintain exposure to areas that are benefiting from fiscal spending that's going on. We're finding that in mid-cap equities. We want to have some offense in the portfolio, but we're balancing that out by collecting 5-6% income here in high-quality bonds. We like that trade, too.
Just before you go, can you tell us how important you think that ISM services number is a little bit later this morning, particularly given what we saw on Monday?
Yeah, I think it's very important. Markets are very sensitive to that right now. Retail sales disappointed. We are seeing cracks in the consumer. So we're going to need to see, how that side of the economy holds in here in a time where a lot of people are pushing back on higher prices.
Emily, thank you. Emily Roden there of John Hancock Investment Management. On the labour market, you mentioned Andrew Hollenhorst a few times this morning. Let's talk about the man from Citi. As the labour market moves from excess demand, too tight, to excess supply, too loose, there will be a period of seemingly normal balance. Is that where we are right now? We think this is where the labour market is now, and further weakening, including job losses, is likely in the coming months. This is quite amazing stuff coming out of Citi. Citi is sticking with it. July rate cut. We're going to see that weakness in the labour market over the next 2 months.
And other people are joining him right now because there has been this consistency to the negative revisions, to the downward shift. You talk about JOLTS, the ratio of job openings to unemployed individuals. 1.2 is basically pre-pandemic. And this goes to exactly Andrew Hollenhurst's point. This is a point in time that looks normal, but it is on a line that is moving. And that, I think, is what a lot of people are hooking into.
Is it normal, or are we going to a darker place? Bramo will discuss through the whole of this week. Tomorrow, look out for this. Veronica Clark from Citi joining us on the programme at 8:30 Eastern Time tomorrow morning. A conversation you don't want to miss. Equity futures right now on the S&P just about positive by 0.25%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Shares of Hewlett-Packard Enterprises surging in the pre-market. The company reported revenue that beat estimates and raised its outlook for the year. Increased demand for its servers and more availability of NVIDIA's chips led to a jump in its sales of AI systems. Hewlett-Packard has seen only modest gains this year, while its competitors Dell and Supermicro experience big jumps in their share prices due to their booming AI server businesses. And Intel and Apollo are teaming up. The chip maker announcing that the private equity firm is acquiring a 49% equity interest in a joint venture related to Intel's Fab 34 for $11 billion. Apollo's co-president spoke to Bloomberg's Danny Berger at the Super Return Conference in Berlin.
These type of blue chip, large cap companies, they're not talking about 100 million or 500 million. They're talking 2 billion, 5 billion, 10 billion plus. And so the ability to really come up with those creative solutions in scale is really, really critical. But I think you're going to see more and more of this coming.
More from Apollo?
Absolutely more from Apollo. But in general, just the need for this type of capital is insatiable.
And celebrities and well-known brands were the target of a TikTok hack. The hackers sent a malicious link through private messages to hijack prominent accounts, including CNN. TikTok said it's taking steps to mitigate the incident and prevent it from happening again. TikTok's future in the U.S. is uncertain as its Chinese parent company ByteDance currently faces a deadline to sell the app or face a ban. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara again in about 30 minutes' time. Up next on the programme, oil markets under pressure.
We estimate that over the last 3 months or so, global oil markets have been building inventories by about 900 KBD, so moderate inventory builds.
Yeah.
I think it's a combination of upside surprises to supply in February and March in the US.
We've had quite a slide over the last week. That conversation is just around the corner, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equity futures doing okay, positive here by 0.24% on the S&P 500. Got this message just moments ago. Sure seems like your guests are tilting very cautious, not just Emily Rowland. Need some Jake Pulaski to cheer me up.
well, Jay Pulaski used to have company in Neil Dutta, but no longer. So your one stalwart is Jay Pulaski, who can come on and say buy everything. And Jay, if you're listening, call in, give us some optimism.
Jay's on like a bullish island right now. In the bond market, yields a little bit higher by a basis point, 433.96 on a US 10-year. Under surveillance this morning, oil markets under pressure.
Roughly 70% of global oil demand depends on the services sector and the consumer, as opposed to the goods sector and the industrial sector. We estimate that over the last 3 months or so, global oil markets have been building inventories by about 900 KBD, so moderate inventory builds.
Yeah.
I think it's a combination of upside surprises to supply in February and March in the US.
So here's the latest. Oil holding near 4-month lows. A surprise in US inventory data boosting supply concerns. The American Petroleum Institute reporting a rise in US crude stockpiles and gasoline inventories. Nadia Martin-Wigan of Svelling Capital joins us now for more. Nadia, always great to get your perspective on these things. Lisa and I were talking about it yesterday. Is it demand? Is it supply? Is it a combination of both?
In our view, at Svelling Capital, the market's really focusing on the demand side of the issue. What OPEC communicated is that they will extend the cuts through Q3, but then they would like to bring back some oil in an orderly fashion in Q4 if demand merits it. Instead, the focus of the market has been on the fact that, oh, they're going to bring back oil, they're under pressure within the group, and therefore we might have an oversupply. And at Svelling Capital, that's really not how we view the communication. And when you look at these surprises on the supply side, we haven't been surprised. You know, we had big winter outages in the US in January, and oil production came back in the US in February and March. So it's not really a surprise on that side, but the concern has been whether OPEC would be okay with this rising market share and if members would throw in the towel and leave like Angola did last year. The communication from this weekend from OPEC suggests the group is intact. They are discussing things openly, and if and when production comes back, it will be in an orderly fashion.
Can we just talk about demand a little bit more then? What are your baseline expectations for the next several quarters?
So we expect that the demand will actually rise in the third quarter. We're not at a 2.2 million barrel per day increase expectation the way OPEC is, but neither are we as low as 1 million barrels per day. We probably see around for the year 1.6, 1.7 million barrels per day year-on-year demand growth. And in Q3, we should see that pop locally coming. The problem is that refinery margins have become much, much weaker. And coming out of maintenance season in China now, we're not seeing an expectation of a run boost, and we've actually seen run cuts. And this is where we need that first line of demand to come to the forefront and take up some of the overhang we've seen in the crude supply market in the last several weeks.
It's a bit too confusing for me to focus on the entire world and all of the demand just in one lump. So I want to break it down. You mentioned gasoline stockpiles, and John was talking about the build that we saw over the past week, jumping by 4 million barrels. How do you place that?
Deutsche Bank saying they're confident of hitting their Q2 €5 billion cost target.
You just talked about. Is that really just because there were some power outages over the winter?
Part of it can be that. It's also a concern, you know, what were the refinery run rates that produced that gasoline in the first place, right? As your kind of implied source of demand. And part of the concern has been that the refinery run rates have been quite low in the US since maintenance season. And that started to change last week. So the next set of data that we received this week on the EIA will be a very important telling sign if we really do have that demand, or if the economy is feeling pressure on a personal level. When we look last year, we had a lot of short covering in gasoline going into Memorial Day weekend. We're going to have that data result, this week now. And then the market was not convinced that demand was there and continued to short on the gasoline side basically until July or into the start of July. And that is where we're at this tipping point on, do we think there is actually healthy demand in the US for this summer right now?
Nadia, a number of people come on the show and say that they're bullish on energy, they're bullish on oil stocks in particular, in part because of the whole AI trend, that this is going to somehow increase demand in the very near term. We are seeing adoption in a number of places. Do you buy that? Do you have to calculate that at all into the demand forecasts, or is it all more traditional types of travel and domestic demand that typically has really fed into the supply-demand dynamic?
Right now, on the actual oil side, oil is still an expensive source of energy. So that incremental additional demand shouldn't come from oil immediately on the forefront. On the other hand, when we look at things that the Biden administration has done, we've actually had 100 factories built in the U.S. Those are building demand, and that's not just in terms of AI, in terms of the administration. On the marginal side, yes, if you're looking at that last source of demand, then oil does really matter. But still, relatively speaking, we should be looking at renewables. We should be looking at natural gas. We should be looking at coal costs first.
Let's talk about the cyclical signal, which essentially is what Lisa's getting at. What kind of signal can we take away from crude as a cyclical signal? I think in the same way about copper now as well. We used to refer to copper as Dr. Copper. I'm trying to work out if it still has a PhD in economics or whether it's a climate scientist now. Nadia, what is it?
Well, on the copper side, absolutely. That long-term story, very much intact, and that is being promoted by the AI picture, and that is where in the medium term, it can also have an impact on this overall oil cycle. But it's an even more important natural gas story and LNG story in that medium term, because we're dealing with grid power that will help it, not just backup generators based on diesel. So I think it's an even bigger story for natural gas and grid investments. And what do you need to build grids? You need copper, right? So it is an argument in that regard. And then finally, a little bit on the oil side.
Nadia, appreciate your input. Brent crude bouncing back. We're positive by about 1/3 of 1% on Brent. On WTI up a quarter, 73.42 this morning on WTI crude. The move in crude sort of reinforcing the general mood off the back of the economic data over the last couple of days, right?
I think that that's a good way to characterize it, because right now, even as Nadia said in her notes, that it didn't really seem to justify the kind of reaction that we got from the OPEC Plus announcement, considering that they're keeping in place a lot of the production cuts through October. Yes, people are focusing on the bringing things back online in order to confirm what we're currently seeing.
You wake up, you're looking for the risk of a slowdown. You search the screen for something red. Crude shining brightly for a few days.
You watching me?
You're like, economic slowdown. No, I think that's what a lot of people do. Coming up on the programme, we'll take a look at Indian equities bouncing back as India's Modi clings to power. That conversation just around the corner, live from New York City. This is Bloomberg.
times in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. The world has very few experts in C++ and C. But the world has many people who knows how to converse and ask somebody for help. Instead of instruction-driven computing, it's now intention-driven computing.
You know, this AI opportunity is really tremendous. You have an ecosystem of companies coming together along with all these incredible innovations. It's causing a new industrial revolution.
This is a tsunami, Ed. This is a tsunami of change. And only the smart ones are going to recognize I have to plant the flag now.
Nobody covers technology like Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Three days of gains on the S&P 500, including very small days of gains Monday, Tuesday, right at the end of the session as well. Very similar sessions. Check out this morning's. We're positive by 0.2% on the S&P, on the NASDAQ up by about 0.4%, on the Russell up by about 0.15%. I have to say, Bramo, I think the equity market's kind of dazed and confused, doesn't know what to do with this economic data. The bond market is very, very set on what to do with this economic data. That's buy it. Rally. Yields lower. Yields look like this: 2-year, 10-year, 30-year. Retracing some of the move lower we've seen over the last few days. We're higher this morning by a basis point or two on a 2-year and a 10-year. Though, Lisa, we've seen a double-digit basis point move lower over the last 4 days.
You mentioned almost a 30 basis point move in just 4 sessions for the 10-year yield lower. That is the biggest going back to mid-December. There is conviction that, yes, we are going to be starting the rate cutting cycle. We're building in a greater expectation of the number of cuts. But also it seems like people are resetting longer term expectations in terms of longer term base rates as well. I mean, it's entire shifts as people sort of get this sort of starting gun to go by duration even.
It just feels like the bond market's at the mercy of the next economic data point. There's several of them a little bit later. We'll talk about them in just a moment. I just want to turn the page to foreign exchange. The euro shaping up as follows, going into the ECB tomorrow. Slightly negative by 0.1% at 108.66. If I'm on that governing council right now, this is a fight about July. It is not a fight about June. That is done and dusted, over with over the last several months. What does the next quarter look like for this central bank?
And how much do they really draw a parallel between the inflation that they're seeing in the euro region with what we're seeing in the United States? There's a real question, especially with hotter than expected data. That said, some cold water on that this morning with German employment coming in light. So you look at this scenario, how do they sort of look at, yes, inflation that's stubborn, but growth that's clearly decelerating? And frankly, it is the same issue that the U.S. Federal Reserve is going to be dealing with.
Germany seems to do what Germany keeps doing. That economic data is not great at all.
Exactly. At a
kind of been the thing for a while, right?
Yeah, which raises this question, who's going to be the hawk and who's going to be the dove? And we've been talking about this in terms of usually Germany being the one to have restriction, et cetera. You know, are they going to be sort of arguing, look, we need a little bit of help? It's sort of a really interesting question at a time where the ECB doesn't have the luxury of acting as one economy in the same kind of way that the United States ostensibly does, even though a lot of people are saying it isn't really when you look under the hood.
How divided is that governing council going to be in the next 24 hours? Under surveillance this morning, a downside surprise to JOLTS data. US job openings hitting their lowest level since 2021. Another look at employment later this morning at 8:15 Eastern Time. We'll get the ADP numbers. Plus, I think the big one for most of you out there, ISM services, Lisa. 10 a.m. Eastern.
I thought you were going to say the Bank of Canada decision. No, I'm kidding. ISM services, to me, really will be potentially the 1-2 punch of this week in terms of ISM manufacturing coming out. And then if services come in weak, do people come around to the idea that, yeah, we are decelerating, and now it's just a question of what is normalization versus true weakness? I just wonder, though, what this does to stocks. I mean, you started out saying it's bad news, bad news. It's bad news for the Russell 2000. Everything's bad news for them right now, pretty much, either way. But what about some of the big tech names? Are they sort of insulated in this way, or are we looking at sort of a 1999 moment that Julian Emmanuel was talking about, given the fact that we've seen this incredible run-up?
Well, before we get to the equity debate, let's just sit on The Economist. I don't think you settled that debate in any way, shape or form this week. We'll have the same conversation. Take yesterday, for example. You and I have talked about this a few times already this morning. Quits rate, held at the lowest level since 2020. Ratio of openings to unemployed people, talked about this a few times, 1.2, lowest since June 21, down from the peak of 2 to 1 and very, very close to the pre-pandemic norm. So you're going to have some people that say we're just normalizing, other people that say, yeah, that's what it looks like right now. We're going somewhere darker.
That's the reason why I think revisions are going to matter a lot. Remember back in 2022, when we got those revisions for that year, it totally shifted the narrative about how much resilience there was in the economy and how much inflationary pressures were building up and how much the employment market was tightening. Do we get a similar kind of move in reverse if we get, say, revisions that show a real decrease of jobs in 2023? That's the kind of thing that could actually settle that debate in a more material way, at least in terms of market action.
Much more on that debate throughout this week, particularly around payrolls this Friday. Let's turn to this story. President Biden in France, ahead of a state visit with President Emmanuel Macron. The president is set to mark the 80th anniversary of D-Day. Later this week, he'll meet with Ukrainian President Volodymyr Zelensky and deliver remarks on democracy and freedom before next week, the big G7. And I have to say, one thing that was talked about maybe a month, 2 months ago, and hasn't been talked about at all really over the last couple of weeks, what happens to Russian assets in European financial institutions? I'm thinking Belgium, I'm thinking France. What happens to them going into next week?
The Financial Times actually put out a piece saying that the rumor is that the U.S. is working with its allies in Europe to come up with some sort of loan backed by these assets that will then allow them to basically monetize those assets, the loan being indefinite and possibly something that can be, relieved at some point. It really does seem like this is getting increasingly pressing as the political imperative decreases, at least among a population in the places like the U.S. and in Europe. So that, to me, is going to be a real question with some of these meetings, especially with the idea of Macron and Zelensky sort of paired together.
What is the loan? Against future income streams or something like that? Is that what it is?
It's something like that, where they can get away with it, basically saying if we have it for 50 years, we have an income stream of a certain amount, we can basically imply we can give you guys as much money as we want.
Watch this space. You're going to hear a lot about this in the next week or so. Let's turn to India. Lots of attention on this story. Narendra Modi vowing to continue as Prime Minister for a third term. Modi and his BJP party losing seats in Parliament despite exit polls, which fueled expectations for a super majority. The Prime Minister will now have to rely on a coalition for the first time. I'm pleased to say that we can catch up with Bloomberg's Menaka Doshi joining us from New Delhi. Menaka, can you give us the current state of play? What is going on and what's changing on the ground?
Well, good afternoon from New Delhi. The shock has worn off of that very weak mandate that Narendra Modi won. The outcome, as you described, coming as a very big surprise to investors. We've seen some recovery in India's stock markets, which sold off yesterday and have recouped some of those losses through the course of today. I think investors are coming to terms with the verdict and maybe even hoping that this could likely be a stable coalition because both the key alliance partners of the BJP, which is Modi's partner, have reiterated their loyalty to this coalition through the course of today. So they're expecting a stable government and policies similar to the policies of previous Modi governments. In short, that is fiscal discipline, continuing incremental reform measures, though of course the lack of a supermajority, as you called it, will curb this Modi government from any large reform processes. Now, that's how the markets have fared today. The rest of the investors from across the world, whether it's an Apple or a Samsung, will be watching to see how Narendra Modi addresses some key weaknesses in the Indian economy, which have contributed to this weak election verdict. For instance, very weak rural consumption and no pickup in private investment. We'll get to know more once the government is sworn in. We expect that to happen this weekend. That's what media reports locally are suggesting. And then we'll have cabinet formation. We'll know who the key economic ministers are, what accommodations have been made for these allies in this coalition government. And eventually the Indian budget will give us the best clue on what kind of economic policy Modi 3.0 will follow. Will it be close to the previous 2 terms, or will it be a fresh start altogether?
We're all following your coverage, and we appreciate it. Bloomberg's Menika Doshi there on the ground in India's capital, breaking down the surprise election results and a surprise move in this equity market as well. A big move. Big pop today, biggest one since 21. Big drop yesterday, biggest drop since 2020.
And this goes to this question of expectations and the idea that the exit poll initially gave him the majority that people expected. So you saw that massive rally, and then it all was taken away yesterday. So this is about expectations as much as it is about economic policies that really are a black box.
Let's continue the conversation. Ed Al-Husseini of Columbia Threadneedle joins us now with some experience of EM sovereign debt ratings. Ed, let's get straight to it. Your notes. If you are a global supply chain manager at a company like Apple, waking up to the news you woke up to yesterday, looking at these results this morning, what are you thinking?
Yeah, you've got to be a little bit more nervous. The whole story in India going forward is leveraged to the infrastructure investment. India is catching up to East Asia. India is becoming more competitive vis-a-vis China, but that's going to take a lot of infrastructure investment, and a lot of these big ticket projects may now be on hold given this coalition construction.
You pointed something out, Ed, drawing a parallel between this election with Mexico, saying that there is a takeaway, which is investor nervousness about eroding governance. Can you give us a sense of what that means at a time where a growing number of people have come on this show saying emerging markets are going to benefit from some of the investment in some of the new technologies and looking to diversify away from China?
Yeah, that's right. I mean, fundamentally, the bedrock of policy is governance. It's predictability. It's the extent to which we can build institutions to facilitate that investment, particularly private sector investment. And in a lot of these emerging market economies, I mean, if you look at the last 20 years or so, investment and productivity have underwhelmed. India is a fantastic case in point, where it grows 6, 7, 8% a year, and yet is unable to generate jobs. It's unable to distribute that growth effectively. And unless you have those institutions in place, the forward-looking productivity story gets that much weaker. And on that front, across the EM world, the elections over the course of the past couple of weeks have been a little bit of a setback.
Is there an investment thesis that's longer term, more than the knee-jerk reactions that we've seen so far in Indian stock markets? Is there something that you're taking away, that you're shifting a little bit around the edges, your allocations?
Yeah, I mean, I'll speak to the corporate bond markets a little bit, which is where we have most of our exposures. India disproportionately, and I think in contrast to many major emerging markets, disproportionately borrows in local currency. So they're not as dependent on foreign investors as many of the other larger EMs. But however, in the dollar bond market, most of the issuers are again geared and leveraged towards the infrastructure story. Adani is a fantastic example of that. Port infrastructure, energy infrastructure. So far the reaction there has been very muted, particularly relative to the equity market. But looking ahead, I think your previous speaker noted the budget that's coming up. Those budget priorities are going to be very important in shaping our exposure.
Ed, can we just build on some of the outcomes, not just India, but also Mexico, as you both mentioned just a minute ago? In Mexico, we got a big majority and people are unhappy. In India, we don't get a big majority and people are unhappy. And I think for those of us that spend a lot of time in DM and not enough time in EM, tourists, not like yourself, we're trying to work out, what do we actually want from these governments? What is it about India specifically when it comes to coalitions that is so negative for markets?
Let me come back to the story of institutions. I think in both Mexico and India, the narrative is this. If you have a government that's too powerful, and in Mexico is a case in point, it can erode the institutions that undergird that government. They're at the moment talking about potential constitutional reforms. They're talking about Supreme Court reforms. In India, at the same time, when you have a government that's leaning populist, the fact that they now have to form a coalition means they're going to be taking their eye off the ball on the economic issues and potentially pivoting more towards domestic, more nationalist issues. And this is a distraction really from a very significant challenge that India has over the coming decades. Again, lifting productivity, creating a job market that is much more efficient and effective. This is somewhere where India has lagged significantly. And so as investors, you sit back and you say, look, the through line here is institutional quality matters. In EMs, ultimately, we're underwriting the quality of policymaking. And these election outcomes make us take a little bit of a step back and reassess.
And I tell you, I think for a lot of people waking up this morning, listen to this conversation, they're not thinking about Mexico City. They're not thinking about New Delhi. They're not thinking about what's happening in South Africa. And you know where I'm going? They're thinking November in America, in Washington, D.C. Is there any read across here at all for you, Ed, for you and the team?
Look, I think trade policy is on the ballot in the U.S. There's been an important shift in U.S. trade policy over the course of the past several administrations that's been impacting EM. The relationship with China, particularly the economic relationship with China, is reshaping the opportunity set for emerging markets. And again, India and Mexico are at the center of that conversation. So yeah, I think the outcome of the election from an economic perspective will matter quite significantly, particularly for trade-exposed emerging markets. There's a good number of emerging markets that are relatively isolated. They're commodity traders. That's a separate story. But if you're part of the global manufacturing value chain, India is trying to move up in that space. Mexico, by virtue of being proximate to the U.S., is a very important part of that piece. For those economies, this is going to be a critical election. And I'll set aside the issues around what the Fed will do after the U.S. election as well, which will be critical for EM.
We'll save that for another day. Ed, thank you, sir. Ed Al-Husseini there of Columbia Threadneedle, breaking it down for you. I was thinking more along the lines of erosion of governance, degradation of institutions, institutional resilience come November and beyond.
That is the one line that I've highlighted from Ed Al-Husseini. The idea investor nervousness about eroding governance is something that we hear a lot in the United States. Is that being priced in? What is the price for that?
How do you do that?
And this is something people are grappling with in a time where it's sort of some people who don't mention it at all in their outlooks. And then you've got PIMCO's sort of 3 to 5 year outlook that had that as their first point, sort of underpinning why yields are structurally higher. To me, this is just sort of, again, it's sort of a mystery depending on people's view of, the future and just how significantly those governance aspects will be eroded.
Ray Dalio gave a nod to it, I think, a subtle nod to it overnight at the Greenwich Economic Forum. Look for those comments a little bit later. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. British Prime Minister Rishi Sunak and opposition Labour Party leader Keir Starmer sparred over taxes, the cost of living, and the country's health system in a televised debate ahead of a July 4th election. A YouGov poll of viewers found that Sunak just barely came out on top by 51% to 49%. Both contenders said they would maintain Britain's close ties with the United States if Donald Trump wins in November. The New York Stock Exchange and NASDAQ may be getting some new competition in Texas. BlackRock, Citadel Securities, and other investors are backing an upstart stock market based in Dallas. The Texas Stock Exchange has raised $120 million and plans to file registration documents with the SEC, according to a LinkedIn post by the exchange's CEO, James Lee. He says his exchange will try to entice companies seeking relief from increasing compliance costs at the NYSE and NASDAQ. And Elon Musk confirming he diverted artificial intelligence chips away from Tesla and to his X and XAI ventures. CNBC had reported that the billionaire redirected 12,000 of the NVIDIA GPUs originally slated for Tesla to X. In a series of posts on X, Musk wrote that Tesla had no place to put NVIDIA chips where they could be used, saying they would have just sat in a warehouse. Musk had posted back in April that Tesla was planning to spend around $10 billion on AI this year. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, the labour market looking for balance.
I think the hard labor market data is really what is important to us. The soft data has been telling us that the economy stinks for quite a while now, and it's the hard data that is actually going to move the needle.
A story up next. You're watching Bloomberg Surveillance.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Equities a little bit firmer, positive by 0.2% on the S&P. Under surveillance this morning, the labour market looking for balance.
I think the hard labor market data is really what is important to us, because when we look at the Fed's reaction function, we think it's becoming more asymmetric, meaning that the Fed is going to be more sensitive.
And so at 7 a.m. Eastern Time, we do get our US MBA mortgage applications figure on the prior, -5.7%.
For quite a while now, and it's the hard data that is actually going to move the needle.
So here's the latest. Job openings falling to the lowest level in over 3 years, with more labour data ahead of payrolls on Friday. Stephanie Roth of Wolf Research expecting, quote, another month of continued moderation in the labour market, albeit firm. We're looking for a below consensus payrolls print of 165, the consensus 185. Stephanie with us around a table in New York. Stephanie, good morning to you.
Good morning.
The difference between just normalisation and going to somewhere sort of sinister, dark and scary, what is the difference?
The difference is layoffs, and we're not really seeing any signs of that. So, I mean, if you look at historically, a payrolls print of 165 has been the average over the past decade, and that's a really solid number. The concern is that we're all of a sudden going to sort of spiral into something that's more significant. But
we go
there's no
beyond
sign of
that. Why wouldn't you be concerned by that? Do you not
Because
see
profit
that in the
margins are
ISM manufacturing disappointing? None of that stuff entertain you?
The measures of sentiment haven't been a great measure of the economy over the past year. If you look at consumer confidence, that would have told you we were in an outright recession for all of last year when consumer spending was fine. So, yeah, I mean, of course, you're starting to see a moderation, and these measures of sentiment measure month-over-month changes. And sure, you're seeing a moderation, but that's what you would be expecting for payrolls to go from an average of 250 to something in the 100s.
In the revisions, when you look back at the JOLTS in particular, you can see that basically it's been flatlining for the past 3 years in terms of job openings, really a downward shift that we've seen pretty consistently. Based on some of the revisions that have been coming in lower, could that shift your view about how sanguine things truly are right now?
I mean, if you rewind back to last year, we were talking about job openings being too high, and that was a problem, and that hurt the Fed. And now we're talking about the exact opposite, with job openings coming back down towards normal. So that's kind of a good thing. We want the labor market to normalize. Of course, everyone's going to start extrapolating on the trend and worry about that. But it all comes down to profit margins. And so far, margins are generally pretty good. And companies are unlikely to do layoffs unless their margins are really starting to get squeezed and they're forced to.
Well, they're good on the sort of averages, but when you dig under the hood, they're real winners and losers here. And you see that pretty consistently across the board. Smaller companies are the ones that typically employ more people, right? And they're the ones that have been hurting more. How quickly could this turn come? This is what Andrew Hollenhorst has been talking about.
I mean, and it could happen quickly, but the good thing is for the Fed, they have the liberty of being able to cut. Last year, inflation was way too high. If you started to see the cracks in the labor market, there was nothing the Fed could do. But this time, the Fed is able to be very reactionary to the labor market data, and that's why we think they're still going to be able to cut in September. Inflation's looking a little bit cooler, and we're starting to see signs that the economy's moderating.
Okay, not to go existential on you, but there's this question about how effective some of the rate hikes have been that the Fed effectuated, whether the rate hikes actually themselves have been slowing growth and inflation, or whether it's just simply the sort of year-over-year comps on the post-pandemic realities that we've been seeing. So how do we know that rate cuts are really going to have any effect when it hasn't really been percolating through the system all that much?
So there are parts of the economy that have been feeling it. A lot of it's small businesses. They're the ones that really struggle with higher financing costs. So to the extent that lower rates would help to improve their profit margins, that would certainly have an effect on the cyclical areas of the economy. Equipment spending has been weak. A lot of areas within CapEx that are particularly labor market sensitive are the areas that are sensitive to interest rates, and that's what would feel it. And the rest of the economy, especially on the consumer side, probably wouldn't see much of a difference, but that's kind of the point here.
How are you expecting the team over at the Federal Reserve, Chairman Powell, the FOMC, to engage with some of these themes next week?
It should be an interesting one. I think what we'll see is a continuation of kind of the same, although perhaps their tone will shift a little bit more dovishly. We're going to have CPI on the second day of that meeting, which will certainly set the tone.
Yep.
We're looking for 0.27% on core CPI, which would be consistent with a core PCE of 0.2%, which is a second month in a row of core PCE kind of close to their target.
So we are sufficiently restrictive right now, right? Not too restrictive? Sufficiently restrictive.
I would say sufficiently restrictive. I think the Fed should be cutting at some point this year in order to sort of reduce the risk of something bad going wrong, like last March, the banking crisis.
Put some numbers on this. What does that dot plot look like come Wednesday? In line with 1 or 2 this year?
I think I'm looking for 2.
You're looking for 2?
Yeah.
September and again in December.
September and December, and I think that's kind of what the Fed will pencil in as well.
Tougher question, 2025. When you start to really think about 25 and some of the policies that could be introduced that could really, really shape this economy over the next 12, 24 months and beyond?
So the two most important ones arguably are going to be tariffs and what happens from a labor market perspective in terms of immigration, right? So we had the executive order today that probably won't have a big, or yesterday, that probably won't have a big impact on in terms of labor flows. If Trump is in the office, he'll probably
restrict. So less than 5 minutes away now until we do get our US MBA mortgage applications figure on the prior, -5 spot 7%.
But labor demand will probably be soft enough by then that it might not be that inflationary.
Go ahead. I mean, just to bring it all together, I guess the question is, Adal Hosseini was on and he said, investors are nervous about eroding governance in emerging markets. Are we going to see the same kind of fear expressed in the United States in a serious way in both the economic numbers, but also with market reaction?
It is possible. I mean, the one thing is that Trump is fairly market sensitive. So if you start to see anything unravel from that perspective, I would imagine the dynamics will change. The second important piece of the puzzle for next year is going to be on tariff policy. It probably will get tied into a TCJA extension, so that probably won't happen until the end of 2025. So next year, you might not actually see the inflationary impacts. 2026 could be a different story, and that could be a much more challenging environment.
You said it. The greatest regulator of some of the former president's worst instincts was the S&P 500. Or for that White House, it was the Dow. It was to be the Dow. That was the big focus.
Yeah, which is the reason why people say he might retrace if it's, sends the market down.
Maybe. Stephanie, it's good to see you. Thank you. Coming up in the next hour, your lineup absolutely stacked. Former Barclays CEO Bob Diamond, Bloomberg's Mario Parker, PIMCO's Rich Clarida, and Matt Brill of Invesco. From New York, this is Bloomberg.
The top names in business are on Bloomberg.
They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets, which are kind of wide open. That's all good. Doesn't tell you what the future is going to be. But I think there are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect. My view is whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
Bloomberg. Context changes everything.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So just less than 1 minute away now.
Which we think will be the biggest winner in what AI and data storage will do for the world.
Was going to keep Rain World Cup.
This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
We'll have to build a portfolio of interventions. Lifestyle will also play into for some of them, and I think we can help many patients get down to a weight that they can maintain and live the life they want to live.
10 seconds.
Many comorbidities for the healthcare systems.
-5 spot 2%, -5 spot 2%.
The Fed really needs to think very long and hard about cutting rates when you have this degree of speculation still in the markets.
The Fed is going to be more sensitive to weaker economic data than they are to continued strength.
The Fed is cutting rates anytime soon, especially ahead of the election. Things have to slow down in a more pronounced way than they have done so far.
Equities are still well positioned, especially in the context of rate cuts coming.
Our view has been on the Fed that nothing changes until something changes. Very much sitting in that space very comfortably right now.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide, coming off the back of 3 days of gains on the S&P 500. Friday, Monday, Tuesday into Wednesday, equity futures positive by 0.2%, and we're coming off the back of quite a rally in the bond market, inspired by one thing: weaker than expected economic data so far this week. ISM manufacturing, onto job openings later on this morning, onto ADP, and Lisa, then the ISM services read.
What's been interesting, as you point out, stocks have eked out gains. But which stocks have eked out gains? It's been the S&P and the NASDAQ, not necessarily small caps. Small caps have kind of lost out regardless, because bad news is bad news for them. On a broader level, there is a question about if you get rate cuts, if you get declines in yields, does that support valuations where you are, even if it's for the wrong reason?
Bad news is good news for this Treasury market, right? Quite a drop. Double-digit basis point decline, 2-year through to 10-year over the last 4 days.
30 basis points, almost 28.6 basis points when you look at the 10-year Treasury, not to be overly pedantic about it, but this question of this is the longest stretch and the deepest stretch of declines that we've seen going back to December. Question is, for the longer term, does it matter that much? Does this really reset some of the appetite globally to go buy Treasuries, domestically to buy Treasuries at a time where there still are some of those questions percolating? To me, it just highlights again the lack of certainty that people have about the long-term paradigm as well as Fed policy and the response to data.
And so just taking a look at the market wrap now for the European session. Stocks rose on optimism that a weakening economy will allow the Federal Reserve to decrease interest rates this year. Treasuries halted a surge that had resulted in the largest two-day drop in rates this year. Contracts for the S&P 500 surged as the underlying gauge finished only 0.6% below its all-time high set in May. The 10-year Treasury yield increased 2 basis points to 4.35%. Markets are shifting their focus to a series of labour market measures this week, particularly Friday's US employment report for more signals on when the Fed may lower interest rates. Private payroll statistics and the newest report on the US services sector will be released later Wednesday.
4 days were higher this morning by a single basis point, 433.96. Plenty of checks on what's happening in the FX market ahead of the ECB tomorrow, Lisa. 108.69 on the euro dollar.
A lot of people are looking to understand what their guidance is for July, whether they're going to cut rates there. I do think, and I have to say, I got some hate mail about mentioning Bank of Canada with sort of a shrug of my shoulder.
Was the hate mail from Canada?
Yeah, basically saying, you're really going to dismiss us. I was actually serious because this might be the first bank to cut rates, and it's kind of a 50-50 right now in markets. If they cut, what is the guide to the ECB? I care about Canada. It's always sort of interesting. It comes out. I always look at it.
Who are you looking at? What's their name? Who are you talking to? I feel like this is just for one person. James.
I'm watching
James.
Canada.
Okay.
There we go.
James, I'm watching Canada too. Thanks for watching. Appreciate it. Coming up this hour, we won't talk about Canada. Bob Diamond of Atlas Merchant Capital on the Fed's path forward. Bloomberg's Mario Parker as President Biden touches down in France. And PIMCO's Rich Clarida on a generational reset of bond yields. We begin with our top story, cooling labour market data reinforcing speculation the Fed will cut rates this year. Bob Diamond of Atlas Merchant Capital saying the market has caught up to reality on Fed rate cuts, saying, quote, any cuts they make in the second half will be minor. Bob joins us now for more. Bob, good morning.
Good morning, Jonathan.
The market's moved towards you. They were looking for 6 cuts this year. It was ridiculous. We're now looking for like 1 or 2. Can we just start with what you think of the recent economic data, the information we've sort of got our hands around over the last couple of days?
I think it's consistent with what we're seeing in the whole first half, which is if you look at the second half last year, then the numbers coming out were a little bit pleasing for economic growth, probably a little bit pleasing for inflation being lower than we expected, and the labor market continued to be very robust. You get into the first half of this year, and the economic numbers are probably a little bit weaker than we thought. The inflation numbers are a little bit higher than we had anticipated, and for the first time, we're seeing just a little bit of looseness in the labor market. I don't want to overstate that because I think, the labor market is still in very good shape. But I think in both cases, the economy is strong second half last year, you can't cut. Inflation a little bit higher than you want this half, you really can't cut. So, Jonathan, I think 25 basis points here or there, who knows, right? There's no precision in this. But by and large, I think the risk for the Fed, the risk for the chairman, is to cut too early before there's any economic weakness and then having to reverse course as inflation, begins to grow. So my sense is they're going to be patient. They're going to be, everyone's used this word data dependent, but until we see a weakness in the economy or inflation really down to 2%, then they're just not going to cut.
Both the economy and the market have surprised a lot of people. I talked about expectations in January, where we were then, where we are now. Let's talk about where we were last spring. Yep. Last spring, if we were sat around this table, the majority of people were speaking to Lisa, to me, to Anne-Marie, and they were telling us that what we're going to see is a real tightening of financial conditions. Banks won't be able to lend as much anymore. Companies are going to suffer. Yeah. Here we are 12 months later, credit spreads are super, super tight. And credit availability, particularly for large companies, is there and ready for everyone, even with rates of 5.5%. You've got your finger on the pulse of this. Have you been surprised by that, the availability of credit to this economy still with interest rates where they are?
By and large, no. And I think sometimes there's an advantage to travel. A lot of times there's not. But I spend a fair amount of time in the Middle East and in Asia. And when you listen to people there looking at what's going on in the U.S., it was, okay, waited too long on taming inflation, raised rates 550 basis points in 9 months. We all know the economy is going to collapse, and it's kind of like, really? Like, the economy is still there, the labor market's still there, and it's so clear to me that we have such a competitive advantage in this country with the depth and breadth of the financial services industry, and I think it's a real asset. Europe doesn't have it, China doesn't have it. Hedge funds, venture capital, private credit, all of these ways to get credit into the economy, into small businesses, into middle market businesses. We have many investments with Cascadia in Seattle and Austin, with Marshberry in Cleveland, investing in advisory platforms for middle market and family-owned businesses. And it is incredible how many angles we have to get credit out into the economy in this country relative to other countries. And I think it has, I think looking at the U.S. from outside, there's real admiration for how did we manage this with 550 basis points in 9 months and the economy has stayed relatively stable.
There also is a question underpinning that, which is how effective is Fed policy and really having any influence whatsoever on credit growth, et cetera. There's this theory that the economy has just been a whole lot more resilient to rates as they go up to 5.5%. Is anyone talking about how rate cuts won't necessarily have any effect whatsoever on the economy also, especially just peripheral ones, because of all of this credit creation already in the system?
I think there's a lot of people that have an axe to grind. If you're in commercial real estate, you want to see rates come down for kind of the sector that you're in. But you mentioned history, Jonathan. Yeah. If we take a more historical look, since 2008, the great financial crisis, 2008 until the Fed started raising rates, Fed funds averaged just under 1%. If you look at 2, 3, 4 decades prior to 2008, Fed funds would have averaged about 4%. So I think we're in a much more normal environment right now. And I think the worst thing that could happen is that we saw the Fed, if the Fed starts aggressively cutting rates, it's going to be because the economy is weak. And so that's not necessarily good news. So we're not rooting for Fed rate cuts, but we do think, if you look out over the next couple of years, rates in the 4 to 4.5%, 4.5 to 5% range is probably the logical explanation. A bit lower than here over time, but not below 4%.
We've been talking about is good news, bad news, bad news, bad news, bad news, good news. For smaller companies, it has been bad news regardless, it seems like, over the past couple of weeks. And for small banks, regional banks as well, in particular, the KBW index is down some 12% on the year, really down sharply over the past couple of sessions. Do you think that rate cuts will eventually be positive for these shares? Or do you think that there's some sort of structural issues with holdings and other potential challenges that just make it bad news is bad news for them no matter what?
We have a strategy to invest in regional banks, so I do have a bias here. We see a great opportunity. And, kind of if you turn that on its head and say, you're a strong regional bank, you've addressed your capital issues, and we all know that higher interest rates were impacting their Treasury portfolios as they have for every bank, and they've impacted loan provisions. But let's just, pick an example of an investor like us investing in a strong regional bank, so the capital levels are fine, there's no issues with the portfolio, and then look forward. You're really doing well with interest rates at this level. Higher interest rates are really good for banks, and it's been a long time since we've seen loan demand like this. So the go-forward position for a strong regional bank is actually outstanding. The question is, will we see consolidation, which we believe we will, and are there strong banks, which we believe there are? Okay. And I think one of the great attributes for again, you go back to the depth and breadth of the financial services industry in the U.S., the fact that we have these regional and community banks providing a service that the larger banks can't to small family businesses is a real strength.
You talk about consolidation. I wonder how much is going to be consolidation and how much is going to be failures. Yesterday, there was Access Financial, the latest potential target of some bad research, and a lot of it stemmed around its commercial real estate holdings. Some people argue that lower rates will actually cause property prices to go down because it will allow more sales to kind of get unleashed in the market. Do you think that there's going to be a rash of failures, that basically it's sort of like people sniffing out cockroaches, and if they smell something that's not okay, they just pull their money, and it's sort of a self-fulfilling prophecy? Do you expect that kind of activity to sort of come back?
Well, I think in our view, one thing that is certain is that since 2008, when the regulators and the political leaders claimed that we will never see too big to fail again, the larger banks in the U.S. have gotten bigger, more concentrated, closer to government, and far more systemic. So they're safe, the economy is good, but it's in no one's interest to allow the larger banks to continue to acquire the smaller banks. What we think is appropriate is that we strengthen some of the strong regional banks, whether it's the capital markets, whether it's Atlas Merchant Capital doing investments, to give them the capital levels that are necessary for them to acquire some of the banks that I think are too small to succeed. Really, really good banks that have been more like community banks that have had good, solid ROEs for decades. But in this environment with the shock in rates, they have to adjust their Treasury portfolio. With the loan loss provisions, they have to adjust that. And the thing that is more permanent is the regulatory intrusion post-SVB will increase their costs around technology and KYC. So we do see an environment where consolidation is a positive and a natural as opposed to weekend failures and big banks taking them over at the last second.
We started this conversation by talking about some of the misconceptions people had from the outside looking in, from outside of America looking inside America. From inside the financial system, what do you think is the biggest misconception that people in Washington have about the world you work in?
I think they misunderstand what has happened over the last 14, 15 years since the financial crisis with larger, more concentrated, more systemic, the big four, the big eight, if you look at the top banks. I think, between the top 2 or 3 banks of Wells Fargo and Bank of America and JP Morgan, it's over 50% of the deposits. And we saw a recent report where if you take 4,500 banks in the U.S., JP Morgan alone is 20% of the profitability. So banks are more concentrated. And I think what they're missing is the value to the economy of having a strong, robust regional and community banking sector. And I think for us, that is an opportunity over the next couple of years. And I think the thing that is really, really key here that people miss is the go forward. If you are a healthy bank, the go forward with higher interest rates and loan demand is outstanding. The question is, are you ready to be investing and are you ready to be lending?
Precisely. What's the starting point? Bob, you're going to stick with us. Bob Diamond, sticking with us for the next 15 minutes or so. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. President Joe Biden landed in Paris this morning. He's in France to mark the 80th anniversary of the D-Day invasion. On Thursday, he'll visit hallowed ground near the beaches of Normandy, where rows of headstones mark the graves of U.S. soldiers who died to bring an end to World War II. He's speaking on Friday at Pointe-du-Hoc, a spot on the French coast where Army Rangers heroically scaled 100-foot seaside cliffs to overcome Nazi defenses. Shares of Dollar Tree rising in the pre-market, the retailer announcing earnings that beat estimates and saying it's exploring a sale or spin-off of Family Dollar. Less than a decade ago, Dollar Tree beat out its rival Dollar General to acquire Family Dollar in a roughly $9 billion deal. And eBay is dropping American Express cards as a payment option. The online marketplace says it's no longer accepting Amex because of what it says are unacceptably high fees, according to an email reviewed by Bloomberg. eBay plans to notify customers this week about the change, which is set to take effect August 17th. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, President Biden's many battles.
Today, I'm announcing actions to bar migrants who cross our southern border unlawfully from receiving asylum. Migrants will be restricted from receiving asylum at our southern border unless they seek it after entering through an established lawful process.
The latest from Washington, D.C. up next, live from New York City this morning. Good morning.
multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Live from New York, welcome to the program. Equity futures positive by 0.2% on the S&P 500. Under surveillance this morning, President Biden's many battles.
Today, I'm announcing actions to bar migrants who cross our southern border unlawfully from receiving asylum. Migrants will be restricted from receiving asylum at our southern border unless they seek it after entering through an established lawful process. This action will help us gain control of our border, restore order to the process. This ban will remain in place until the number of people trying to enter illegally is reduced to a level that our system can effectively manage.
It's the latest. One day after signing an executive order aimed at curbing migrant flows at the southern border, President Biden touching down in France to mark the 80th anniversary of D-Day, with plans to meet Emmanuel Macron and Ukraine's Volodymyr Zelensky later this week. Bloomberg's Mario Parker joins us from Washington for more. Mario, can you go through the list of items for the next 2 weeks that this president has to confront?
Yes, the list of items is a great way to put it, right? We've got the president in France this week. He comes back to Washington, D.C., immediately pivots back to Europe for the G7 as well on the week of June 13th or so. And so what you're seeing from the president, at least over the last couple of weeks, cumulatively, is he's going down, he's ticking a box on all of the things that he has to shore up ahead of the election, right? While these are geopolitical issues, with 5 months before the November election, there's nothing that doesn't have at least a hint of an effort toward the furtherance of him being reelected to the White House.
When you think about what's on the agenda for the next week or so, Mario, and then you compare it to the concerns of the electorate, there's not much crossover here. In America, the concern is the domestic economy and immigration. Abroad, that we're talking about Ukraine. Is that helpful or unhelpful for the sitting president next week?
Well, here's what's interesting about that, right? In the polls, Americans care much more, to your point, Jonathan, about what's going on at home, right? Domestic issues, the economy, inflation, the cost of housing, et cetera. Biden scores quite poorly relative to former President Donald Trump in the latest polls and those subjects. Where he does have a strength, though, is in terms of character issues, in terms of preserving democracy. And so what you see him doing, essentially, is playing to his strengths, right? He's essentially saying he's going overseas to rally support for Ukraine against Russia's aggression. He's last week quite publicly and full-throated, may I add, saying that he wants a peace deal between, a ceasefire between Israel and Hamas, right? The backdrop before that was his entreaties toward black voters. And so you see him trying to kind of tick off both his liabilities, but also play to some of his strengths with the hope that voters essentially will give him some credit there.
Just before the big debate later on this month. Mario, appreciate the coverage this morning from you and the team. Thank you. Mario Parker down in Washington, D.C. Bob Diamond back with us around the table for some final thoughts. Bob, we've got to talk about November. All the concerns that people are talking about, trade, tariffs, the erosion of governance. Lisa was talking about that a little bit earlier this morning. What are you concerned about? What's on the radar for you going into 25?
So I think, Jonathan, if there is a dark cloud, and I've been pretty positive when we were talking earlier on the depth, the breadth of the financial services industry here, the strength of the U.S. economy, the strength of the U.S. dollar relative to other. If there's a dark cloud, it's the debt levels. You know, when President Trump started his first term, so 7.5 years ago, between then and now, during the the 4 Trump years and the 3.5, if you will, Biden years. The debt of this country has gone from 20 trillion to 36 trillion. And you can't say that was a bad economy. It was kind of a Goldilocks moment, right, of 7.5 years of a strong economy. So where are we going to go? It's not in the markets right now, Jonathan and Lisa. I don't think it's talked about a lot. But if there's a dark cloud over the next couple of years, it's how are we going to manage, you know, what changes are we going to make? I think the second piece of it is, no matter who is elected president, you know, out as far as we can see, what president is going to come in and say, you know, no more debt? It's kind of been the easy solution to spend, spend, spend. So I do worry about it. I think it's out there somewhere. Is it a year away? Is it 3 years away? Is this comes back to be an impact? I'm not sure, but I'm a little bit surprised it's not talked about more in the markets. So.
Well, we talk about it plenty, probably too much, some people might say. We talk about it pretty much on a daily basis, and Steve Eisman of Neuberger Berman, I just can hear him if he were sitting over there. He'd say, this is all hogwash. People have been talking about this for 40 years, and they've been wrong. They've been late. I mean, it's not going to happen for 20 years, 30 years. It could happen, and then it doesn't really matter. It shouldn't be baked into the markets. Do you agree?
No. I mean, I think I do think that there's, you know, going to be consequences of the debt levels. And I think going from 20 trillion to 36 trillion, and, you know, economists will give you all kinds of different percentages of, it's too high. And it's become a significant burden in terms of the, you know, balancing the budget each year. So I think it is going to have an impact on the U.S. economy over time, and I think it's going to have an impact on tax policy and other things. It's not discussed much in the market today.
How do you see it playing out? You've got some experience in the United Kingdom. We all do over the last couple of years, particularly all focused on what happened with Liz Truss. How do you see this ultimately playing out? Just a slow game where they've got to slowly respond to this and show the market they're serious about it? Or is it something where you see the market start to reject the policies that come out of the White House?
Listen, right now the dollar is very strong. I think, I don't have the data exactly, but I think we're at an all-time high, you know, relative to most competing currencies. And I think one of the implications, if I'm correct, that the debt levels are too high in the U.S. would be, is there an alternative to the dollar? And it's a legitimate question, but there is no legitimate alternative. Where are you going to go? I mean, Europe. I remember, Jonathan, in 1992, when I was with Morgan Stanley, we did the first euro-wide European currency bond for, of all people, the Bank of England. You know, there was a lot of hope that you'd have a single bond market across Europe. But today, you do euro bonds for Italy. You do them for Germany. You do them. So each one has different risks, and there's not an integrated capital markets in Europe. I think they look at what happens in the U.S. with hedge funds and venture capital and private capital, and they look at what happens in the U.S., you know, and the impact of that on the economy. And they don't even have an integrated bond market. If you look at China, they have absolutely no interest in the transparency or convertibility that's required. So I think it's a very, very legitimate question to look at an alternative for the dollar. But there is no legitimate alternative. So,
and that's the problem. When it hits the fan, what are you going to do? Bob, this is fantastic. Always great to see you, sir. Thank you.
Good to see you, Jonathan.
Bob Diamond of Atlas Merchant Capital. Equities right now just about positive on the S&P. Coming up shortly, don't miss this. PIMCO's Rich Clarida from New York. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
3 days of gains on the S&P 500, really small days of gains Monday, Tuesday. This is Wednesday's price action for you. Good morning. Equity futures positive by 0.25%, up 0.5% on the NASDAQ, 0.2% higher on a Russell 2000. That's the futures board. Turn a page to the bond market. 2-year, 10-year, 30-year looks like this. Yields higher by about a basis point on a 10-year. After yields declined for 4 consecutive sessions, we're back down to about 433.57 on a 2-year. Came close to 5% at the back end of May, all the way back down to about 478 on a 2-year yield, higher by a single basis point. Going into the ECB tomorrow, big focus on the Governing Council and the rate cut we're all expecting. It's about what they do after that, the kind of guidance that President Lagarde may or may not provide in the news conference following that decision. Euro dollar right now, 108.63, negative by 0.1% on that currency pair. Under surveillance this morning, India's Narendra Modi vowing to stay on as Prime Minister after his ruling party fell short of the votes required to govern alone. Modi will now have to rely on a coalition for the first time since he took office back in 2014. And Lisa, this market, let's just put it this way, surprised, whipsawed by the last couple of days.
Yesterday, stock selling off the most in 4 years. So yes, after then rebounding the most since 2021. So these are the sort of whipsaw actions that we have seen. Adel Husseini, I want to go back to this. We just have to sit on this. He said what it highlights, this move and what we saw over Mexico, for the opposite reason, as you pointed out, is investor nervousness about eroding governance. I'm glad that you raised this parallel with the United States and other developed markets. At what point does it start getting priced into markets?
I think it's so difficult to do. So difficult to do. I had someone ask me this yesterday. What about Fed independence? What does that look like? Fed independence. What if the president fires Chairman Powell? I said, you know, sort of don't underestimate the power of the institution once you set into the Federal Reserve. Do you actually think that person's going to take the phone call from the president and start doing whatever they say? Don't underestimate that. But perception, and you know as well as I do, perception for financial markets is as important, if not more important, than reality sometimes, and that can do the initial damage, and it's very hard to repair once you do that damage.
If you start to undermine the concept of just how independent. You're absolutely correct. This raises a question, though. He has every right to remove the Fed chair and put a different Fed chair in. Question is, will he do that if that does cause some material sell-off in markets? As we were pointing out, Stephanie Roth talking about how, you know, he tends to respond, the former President Trump tends to respond to market action.
I think we're all listening to Adel Husseini in the last hour or so, all thinking the same thing, just thinking about November. Shares of Hewlett-Packard flying in the pre-market. Let's get that up on the screen. Demand for its AI servers fueling a big jump in sales, while it also raised its outlook for the year. HP has so far missed out on the AI server rally, which has spurred big gains at the likes of Dell and Supermicro. It's rallying this morning, big time.
I find this fascinating, especially because really we've seen the winners and the losers of who's adapting AI quickly enough. We've seen Salesforce fall out of bed because they can't monetize until 2025. And then you have the likes of Hewlett-Packard coming out and being able to monetize in a more significant way. That's what I'm watching in the months to come.
Up by 15%, just about, in the pre-market. Let's turn to that bond market rally, hitting pause after its biggest 2-day gain this year on renewed optimism for Fed rate cuts. Equities pacing bond so far in 24. PIMCO saying a, quote, generational reset on yields is set to spur a bond revival. The bond manager releasing its secular outlook saying active fixed income is positioned to perform well if there are no recessions, and even better if there are. Rich Clarida, PIMCO's global economic advisor and former Federal Reserve Vice Chairman, joins us now for more. Rich, good morning. It's great to see you.
As always, yeah.
Congratulations to you and the team for another fantastic read. I want to start with last year.
Yeah.
I was with you, the aftershock economy, and one of the big calls came from you. Just sort of getting back down to 2 point something at the Federal Reserve. Can we start with last year?
Yeah.
How happy were you with last year's outlook, and then we can build on the new outlook this year?
Well, you know, as the author, of course, I'm proud of it, but I would say, yes, you know, our call last year was what we called the 2 point something destination, which some folks, including maybe my former colleagues, thought was a bit flip, but it had a message, and the message was 5 or 6 is too high. But if inflation gets to 2 point something, that gets the Fed and the RAIN and other central banks to begin adjusting rates. The risks become more two-way. I think it happened sooner than many of us thought, but that actually has big impacts for looking ahead. The fact that central banks are no longer part of the problem, they're now part of potentially the solution. So that's an important difference in the macro landscape.
So we've got this new reality, and we've got this big reset in bond yields too. Can you tell us why this is so compelling on a multi-year outlook for you and the team now?
It's compelling simply because the last 15 years, and many of your viewers probably weren't in markets 15 years ago, the last 15 years, curves have been very flat, yields have been low, they were negative in Europe, and historically the yield on a bond is the best single predictor of the total return. And so an investor buying a bond is going to first look at the yield and then look at the risk and other characteristics. And so yields now, especially adjusted for inflation, are at levels that we haven't seen in 15 plus years. Plus, if you adjust for volatility and valuation, altogether it does make a compelling story.
For which aspects of fixed income? This has been one of the biggest disagreements that people have had.
Yeah.
There's been this rush into private capital, private credit. Yeah. There's been a rush into T-bills. Where is active management? Where should it focus within the fixed income sphere?
Well, and thank you for asking, Lisa, one of our key messages is that there are opportunities in private credit. This is a super secular trend. After the GFC, big banks, regulation, supervision was changed, and so a lot of credit intermediation occurs outside of banking, and so there are opportunities, but we do say in the essay that we do see froth and valuation in certain pockets of private credit, in particular, you know, mid-market corporate lending. We think there are much better opportunities in asset-backed lending to the consumer whose balance sheet's in really good shape. So we think investors need to be discriminating. When it comes to more traditional bond, the key point now is that investors can get an equity-like return, 6 or 7%, without a lot of volatility or interest rate risk. So that's why our subtext is seize the yield advantage right now. So no longer is there a reach for yield. Investors should seize the yield advantage.
They've been seizing it all year.
Yeah.
And this is part of the problem, right? That we talk about the macro risks, and then there's a question of valuation risks. And I'm stealing your words. I'm just going to be very blunt about it. You talked about that earlier. So how do you sort of weigh that? It seems like that's right now the biggest struggle for markets that are not facing off with bad data.
Right.
They just are trying to figure out whether it justifies the valuations where they are.
Well, again, I think there's an element of the fact that the U.S. last year did outperform globally, and so there is a U.S. exceptionalism theme that is grounded in hard data, and it's natural for markets to put some probability that continues. What we point out in the essay, Lisa, however, is part of that U.S. exceptionalism was fueled by big budget deficits in a fully employed economy, and it's not clear how long that can go on. So I think that markets sometimes do get into these bandwagons. They do extrapolate, and maybe we're seeing a bit of that, especially, I would say, in some other markets.
There was a phrase you used, equity-like returns.
Yeah.
Generational reset in yields, equity-like returns. Why do you and the team think all of that merits a reversal of the traditional 60-40? How are you now thinking about this approach?
We think 60-40 has served investors very well, but at extremes in valuation, it's worth reassessing, right? So if you look at traditional equity valuation measures, you know, the CAPE or Shiller price earnings ratio or whatever, Equities are very expensive historically. Now, that can continue. It did in the 90s. But we do think 60-40 is worth assessing when you get at extremes in valuation. Perhaps, you know, when rates were negative in Europe 5 years ago, that was another opportunity to look in the other direction now. So the reset is not a mechanical chain you should pull, but it is important to step back and see if you want to adjust the portfolio given valuation.
So what, 70-30? How are we thinking about this? Just help me understand a little bit more.
Well, the traditional is 60 equities, 40 bonds. And so, you know, as a shop that sells a lot of bonds, we think 40 equities, 60 bonds could look good for a lot of investors at these levels.
At these levels?
Yeah.
You mentioned the debt. Does the debt complicate that at all, the deficit?
It does, and I think probably what we were navigating, and like a lot of investors are navigating, is there's not really any debate, either among economists or investors, that the U.S. is on a sustainable fiscal path. We're not. The question is the day of reckoning next week? Is it in 3 years? Is it in November of this year? Is it in 10 years when the Social Security Trust Fund is exhausted? We don't know. And so we do, in the essay, emphasize that in most sovereign markets, in the advanced economies, interestingly enough, in the emerging world, because of all the challenges emerging market economies faced in decades past, they have much more sensible levels of debt relative to the economy than many advanced economies now. So that's another thing that we're looking at is a global opportunity set, not just focusing necessarily on the developed markets.
Should you accept a lower yield premium for, say, Apple than to lend to the United States for 30 years?
Well, as a former Treasury official, I do think at the end of the day that the Treasury will find a way to make its coupon payments one way or another. So I wouldn't sort of get into comparing the risk there.
So I know it's
at
difficult.
Least not at 7:30 in the morning.
Well, I mean, I'm trying to get to this idea of, you know, on the margins, you're going to start to see odd distortions in the market.
Oh,
sort of to sort of not necessarily have a Liz Truss moment. I mean, you know, everyone comes out and says that's ridiculous.
I was trying to set you up for that.
I know, but the
you
thing
wanted
is,
single security analysis. If you want that, go to the Swiss National Bank, Bramo. They'll tell you about Apple.
No, I'm not saying Apple in particular. You know my point. You're sort of one of these high-rated corporate companies, but you're welcome. Well, so Liz Truss, you know, there's this question about, you know, what point structurally do you start to see a real kind of retracement on the margins? It's not necessarily a breakdown entirely of the market.
Absolutely, and we are certainly attuned and attentive to the fact that in the Treasury market, over a 5-year horizon, we could have one or more of those moments. Our baseline view is, at least for the next 5 years, the reserve currency role of the dollar, the fact that the Treasury is the global reserve asset, you know, that's what has been called an exorbitant privilege, and the U.S. is doing everything it can to take advantage of that privilege. But at least for a 5-year horizon, we would see those disruptions as not being permanent reshapings of the Treasury market, but maybe as a signal for Washington to get its act together.
Let's sit on Washington. Bob Diamond was sat in your chair just moments ago.
Great segment, by the way.
Thank you. Appreciate that. It's wonderful. We were talking about the election in November. You are a Trump appointee. You went to the Federal Reserve, confirmed by the Senate. You served as Vice Chair of the Federal Reserve.
Yeah.
There's now these concerns that the former president becomes the sitting president and starts to make some funky choices about the Federal Reserve leadership, and things start to change. We erode independence. Can you walk us through your experience of that confirmation process?
Yeah.
What it was like sitting at the Federal Reserve through his tenure? And are we underestimating the power of the institution?
I think so, John, and here's why. The Fed really is an institution. It was created 100+ years ago. In some ways, it has a very clunky, archaic structure. There are 19 people around the table, 12 of whom vote. Some are appointed and nominated by the president. Others are the Reserve Bank presidents. And what it means is that there's a lot of institutional both pride and inertia within the Federal Reserve System. So, for example, right now there are no vacancies on the Federal Reserve. At some point there will be, and of course Chair Powell's term ends in May of 2026. But until there's a vacancy, there's nothing for any president to do. Fed officials have very long terms, and there's not really any legal dispute that they can serve without the risk of being fired. And so that's not really an issue. But over time, any president can shape the Fed to the extent he or she can put people on the committee. But I can tell you, once you get inside that room, and at least in my day, in that building until the pandemic, you really are aware of both your institutional responsibility and that the history books are going to be looking back at you in terms of what did you do in terms of achieving price stability and maintaining maximum employment. And that's a pretty powerful incentive to do the right thing.
There's another kind of political interference with the Fed that maybe is less obvious and less maybe sexy than say, you know, I'm beholden to you, I will do this. There's a question about whether the Fed will essentially be forced to lower rates to make the deficit more acceptable, right? To basically finance the deficit. Will there be a sort of implicit monetization of the deficit in order to keep the market going on a certain pace? Could you foresee that as sort of likely?
Well, we have seen that across global history, and we saw that actually in U.S. history coming out of World War II. So the Fed basically capped interest rates to help the government pay down that huge World War II debt. And as I used to tell my students, World War II ended in 1945, but the Fed kept pegging interest rates till 1951. So yes, can it happen? Sure. Will it happen? Not likely, but of course, when there's a large stock of debt, there will be pressures on the Fed, probably from both sides of the aisle, to try to keep rates low. The Fed, I think, will resist that, but certainly, is there a risk? There's always a risk. I think the institution would resist that, but it is a risk.
What was it like when the tweet started? What was that like inside the FOMC when the tweet started that you were doing the wrong thing?
Well,
because you read them, I'm sure you did. You saw
well, couldn't avoid it. I'm going to sound sort of like Joe Friday on Dragnet. Just doing my job. We were just doing our job. So we had a very clear. Interestingly, in 2018 and 19, the economy was in a really good place. Unemployment at a 50-year low, inflation right at 2%, wage gains at the bottom end of the distribution. So in some ways, it's a little bit disconcerting. Like, what's the problem? But so we just powered through it. It was an honor and a privilege to work with Jay and the committee during that period, and it really didn't factor in. But yeah, you couldn't help but notice it.
I remember a phrase you used. You used to talk about an ounce of protection is worth a pound of cure.
Yeah.
And that was because interest rates were very low. We were all worried about going into the next downturn without having the firepower to respond to it. Do you think that phrase applies to where we are right now, given the current economic data going into next week?
Well, this is what I would say on that. I do think there is path dependence in the following sense, that a decision that the central bank should make right now, in part as a function of how we got to where we are. And the reality is inflation's been too damn high for 3 years. And so, at least if I were still on the committee, but I'm not, that would be a factor in thinking about such issues as when do you start cutting, how rapidly do you cut. And as Chris Waller, my former colleague and really admire Chris, has liked to say, look, we have the ability now to be patient. The economy's in a good place, strong labor market. And so I think, to me, given the history that inflation's been too high, and given where the economy is right now, I would be in the mode of not being keen to either hike too soon or too rapidly, because I do think it's very important that this episode be an episode which is thought of as there was a temporary inflation shock. It's just transitory. It took too long to unwind, but ultimately it was transitory.
T+3.
And you really do have to make sure that the inflation genie, in terms of expectations, doesn't get out of the bottle. So I think that'd be the way I'd think about it.
Rich, this was a pleasure. Congratulations to you and the team for another fantastic read.
Thank you.
Really appreciate it. Thank you. Rich Clarida there of PIMCO. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hakez. Hey, Yahira.
Hi, John. Donald Trump wants the gag order related to his hush money trial lifted. The former president arguing the basis for limiting what he could say, quote, no longer exists after the jury convicted him of 34 felonies last week. Trump's lawyers said his First Amendment rights are especially important after President Joe Biden, Stormy Daniels, and Michael Cohen all commented on the verdict on social media. Trump's team wants the order lifted before the June 27th presidential debate. The New York Stock Exchange and NASDAQ may be getting some new competition in Texas. BlackRock, Citadel Securities, and other investors are backing an upstart stock market based in Dallas. The Texas Stock Exchange has raised $120 million and plans to file registration documents with the SEC, according to a LinkedIn post by the exchange's CEO, James Lee. Lee says his exchange will try to entice companies that are seeking relief from what he says are increasing compliance costs at the NYSE and NASDAQ. And in just a couple hours, Boeing and NASA are set to try again to launch the Starliner space taxi into orbit. After weeks of delays, the spacecraft is set to launch at 10:52 Eastern from Cape Canaveral. This mission, which will include 2 astronauts, is a key test for NASA to prove that Starliner can safely transport crew to the International Space Station. The delays have added pressure on Boeing, which has racked up roughly $1.5 billion in cost overruns on the program. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, taking on risk in credit.
The yield on a bond is the best single predictor of the total return. There are opportunities in private credit.
We'll talk about those opportunities next, live from New York. This is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
The top names in business are on Bloomberg.
They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets, which are kind of wide open. That's all good. Doesn't tell you what the future is going to be. But I think there are a lot of inflationary forces in front of us that, you know, may keep it a little bit higher than people expect. My view is whatever the world is pricing it for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
Equities on the S&P positive here by a third of 1%. Under surveillance this morning, taking on risk in credit.
The yield on a bond is the best single predictor of the total return. And yields now, especially adjusted for inflation, are at levels that we haven't seen in 15 plus years. Plus, if you adjust for volatility and valuation, altogether it does make a compelling story. There are opportunities in private credit.
Let's talk about some of those opportunities in credit more broadly. Credit investors turning to bank bonds, unfazed by tight spreads and risks in the banking sector. Invesco's Matt Brill saying this: we've been adding to it with the expectation that banking fundamentals have been fixed, not completely, but certainly in much better shape. And with the economy now more likely to have the soft landing, it seems like we should have more rather than less. Matt joins us for more. Matt, good morning.
Good morning.
Let's talk about that soft landing call first. That's really the framework for ultimately this investment. Why is it more likely now?
Well, you know, I'd heard it was called a unicorn and it could never possibly happen. There was no way we could get the soft landing, and here we are. And certainly feels like we haven't gotten it yet, but it's on the way, and we're not expecting the economy to fall off a cliff is the most important thing. And if we don't see the economy roll over here, you know, banks prepared for the worst last year, and they're probably not going to get that. So I think that sets them up pretty well.
So, Matt Brill, let's imagine that Andrew Hollenhorst is sitting on the other end of the table there, and he says, actually, we've never seen a decline in unemployment that's just been sort of a step down and then just sort of sits there. So what would you have to see to really start thinking, okay, this isn't just a soft landing, something else?
Yeah, so, I think we do want to see some slowing, right? We do want to see that, but if it goes too far, yesterday's JOLTS, openings were a little bit alarming, but still very, very high. So we're still in a very good economy. I think if you see, something along the lines of just people no longer feeling like they can't hire back employees, that would be a concern of ours. But overall, corporations are making the right decisions in investing, and CapEx growth is pretty good. So it doesn't feel to us as if this is just about to stop.
People who worked at Credit Suisse are probably listening to this saying, where were you a couple of years ago? You're talking not just about bank bonds in general. You're talking about AT1s, the sort of convertible bonds that a lot of banks are forced to issue, particularly in Europe, to offset capital requirements. Is there an area, is this really where you want to focus sort of big banks and staying away from regionals that are still kind of buffeted by some other issues?
I think you can get kind of the national champions and stay in the AT1 space and do well. So you're talking about some of the biggest banks out of Europe that were essentially untouchable for a month or two last year. And everybody stepped back and said, what does an AT1 mean? Is it possible that you can have the equity still have value and yet I'm going to lose everything? That's just not supposed to be the way it's supposed to be.
Can I ask if you've got an answer to that now?
No, we still don't. We still don't. But the documents that are being written are much clearer going forward to address that. So
when you look at those documents, what has changed?
Well, certainly it talks about the waterfall of who's going to take a loss and who it's very explicit who can and cannot take losses first. When in the UBS Credit Suisse situation, would not be allowed to happen in these docs going forward.
So this is a Europe call.
Yeah.
Can we talk about what you're doing domestically here in the United States? Lisa brought up small regional banks a little bit earlier. Are they sort of a head case that you want to leave to one side, or is there opportunity there?
There's opportunities there. Now, I think you still have to be very selective with what you're playing in there. But in general, the rising tide has lifted all boats there. Where just I think the Fed and their facilities they put in place to pledge, at par, not having to crystallize the losses really helped. A lot of concerns around commercial real estate. We view that as a very slow bleed that's going to happen. Companies have addressed it. If you look at the loan loss provisions for most of these big banks, they've already reserved for 10, 12, 15% losses within commercial real estate. So I think it's already been addressed. We're probably going to get there in terms of losses, but it's just going to be taking time. And you can look at preferreds in the U.S. space. You're getting 7.5% kind of for the big six preferreds. And regional banks in the senior space are closer to 6. So I like staying up in quality with the larger banks, but down in the capital structure with the preferreds.
Just sort of zooming out and finishing where we began, the sort of a soft landing backdrop. How much do you maybe not see this as the year of the bond, but agree with PIMCO that you can get equity-like returns in debt markets for the next 3 to 5 years?
Yeah, so I'm an active manager, so I certainly like their call that active management will win out from here. But I think we came into this year thinking it would be the year of the bond, and here we are 5 months in, and returns are basically flat on the indices, which they were down, so flat is starting to look like a little bit of a win. Going forward, we do believe there's significant money to be made within fixed income. You're likely going to get the Bank of Canada cut today. You're going to get the ECB probably cut tomorrow. So with signs like that cuts are on the way, I think it's sort of a wake-up call to everybody that this is actually going to happen. The soft landing can occur globally as well as domestically. And when that occurs, you're going to start to see all-in yields go lower and the total returns pick up.
We've got one viewer who really appreciates you. James, that was for you. Matt Brill of Invesco on the Bank of Canada there at the end of that conversation. Matt, it's good to see you.
You too.
Thank you, buddy. Thank you. Coming up next, in the next hour, Liz Ann Sanders of Charles Schwab, Ronald Yevsikov of Guggenheim, Tom Porcelli of PGIM Fixed Income, and BlackRock's Marilyn Watson. That's all coming up next from New York. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits.
Secured overnight financing rate 5.33% for June the 4th versus 5.35% for June the 3rd.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New season starts July 10th, only on Bloomberg. Brought to you by Workday.
We'll have to build a portfolio of interventions. Lifestyle will also play into for some of them, and I think we can help many patients get down to a weight that they can maintain and live the life they want to live and avoid many comorbidities for the healthcare systems.
This is Bloomberg.
There is absolutely nothing in the data that indicates that things are actually slowing down in any perceptible way.
For markets anyways, I think probably the next few months are going to be very choppy.
The market always moves ahead of the Fed.
The market dynamics and the market structure actually afford the ability to hedge really almost like never before.
We're not really in a typical cycle. We're in a cycle that has been boosted by mega forces that we haven't seen before in terms of the magnitude.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide. All eyes on the calendar. It's one of those weeks you've got to keep returning to it. The economic data very much in focus. Looking ahead to ADP in about 15 minutes' time. Then it's on to the ISM services read a little bit later on this morning. And Andrew Hollenhorst of Citi is looking for more economic weakness. Lisa, this morning, the Fed is likely to conclude that the labour market has come into better balance. A soft jobs report Friday, as they expect, they go on to say, would create more urgency for the Fed to cut rates.
Urgency, the key word. They're still calling for that July rate cut, and other people are coming around to this idea. It goes to the fundamental question that you brought up earlier this morning, which is essentially, where are we on a normalizing path? Where are we in terms of weakening? I actually think ISM services might be the most important data point of the day. If it is weak, if it's not, then it'll be shrugged off as just sort of the mess that we've been seeing. But if it is weak, are we seeing some more consistent data showing a slowdown that then you have to start to extrapolate out the direction of where that's headed?
Will it actually settle any debates? Let's say it's weak a little bit later. You'll have people like Kelsey Barrow of JP Morgan who say the soft data overstates the weakness. Look to the hard data. So we'll look to the hard data. You'll get payrolls on Friday. Might come out at about 150. We're looking for 185 in our survey. At least you'll still have people say, we're normalizing here. we're not going to some deep, dark, ugly place. We're just normalizing.
Okay, here's my frustration with that, is that then you'll have people come on and say that the payrolls data is completely distorted by immigration and will be completely revised within 3 months. So it's very difficult to get a read on hard data that's moving as quickly as anything else. And then you have Fed officials who come out, including Patrick Harker of the Philadelphia Federal Reserve, saying actually he thinks that some of the soft data and frankly even just the anecdotal data has been more sort of prescient about months to come. So when you put this together, I'm not sure, but when you get ISM data that might be softer than expected, plus a Bank of Canada rate cut, you could have suddenly a narrative shift, at least for a couple days.
Pick your journey. Choose one. Here are the scores right now. Equity futures on the S&P 500 positive by 1/3%. In the bond market, yields down for 4 consecutive days coming into Wednesday. We're just about unchanged on a 10-year at 432.20. Talked about the move we've seen over the last 4 days. Equity market hasn't done much. We've had 2 days of grinding higher, and that grind has been like 1/10%. The bond market, we're talking about a 20 basis point move at the front end on 2s lower, a 10-year by almost 30 basis points lower in 4 sessions.
It's just shocking, the pace of it. I mean, this to me, we saw the pace in the opposite direction going up, right? With people suddenly saying, well, maybe things are hotter than expected. I keep thinking about Mohamed El-Erian. His voice is sort of ringing in my head. This is what happens when you have an uber data-dependent Fed without a framework. The market is just responding to every input that they get, and it will continue to. Is that going to be a problem? Well, it's only volatility when yields are going up or stock prices are going down. And when they come down, it's suddenly a path that you can bet on in a more concrete way.
You've noticed that, yeah?
100%.
Mohamed joining us Friday. Don't miss that. Here's the lineup for this morning for the next hour. Liz Ann Sonders and Charles Schwab on what she calls a bifurcating economy. Guggenheim's Ron Yevsikov on why he sees more pain coming for Tesla. And PGIM's Tom Porcelli on signs of an easing labour market. We begin with our big issue. All eyes on the US labour market as investors look for more signs the Fed can begin cutting. Liz Ann Sonders and Charles Schwab saying this: the jobs report Friday is obviously pivotal, but details are just as important as headlines. A weaker labour market likely holds the key to giving the green light to the Fed for easing. Liz Ann, I'm pleased to say, is with us this morning in studio. Liz Ann, good to see you.
Hey, nice to see you.
Great to catch up. The current market environment is brought to you by the letter K. Liz Ann Sonders. Liz Ann, what is the letter K? What's that all about?
You might remember earlier in the pandemic, the K-shaped recovery was sort of
in 10 minutes time now at 8:15 a.m. Eastern Time. See the release of the US ADP employment change. Forecast 175k on the prior 192k, with a range of 190 to 120k expected.
High income versus low income, large company, stronger balance sheets, less rate sensitive versus smaller companies. You see it in the spread and within consumer confidence. You even see it, you talked about soft data conflicting with hard data. How about soft data conflicting with other soft data? We remember we had the SP Global version of PMIs were hot on the upside. The market sold
Only 2
off.
weeks ago.
Now we have the ISM version that is soft. So even within things like the soft data, you get these bifurcations. It's a tough environment.
Do you see reason for this bifurcation to endure?
Some of them, yes. I think the large company versus small company, maybe thought of another way, rate insensitive versus rate sensitive, given that so many large companies are earning more interest on their cash and they're paying on debt. So we're at an 18-year low in terms of net interest payments for U.S. corporations. I think that bifurcation will continue. What's interesting is in this recent move down in yields, it has not been to the significant benefit down the cap spectrum. And that's a bit opposite of what started to happen last October when yields came down. It provided a huge tailwind for the market overall, but particularly for small cap indexes. Russell 2000 outperforming, equal weight outperforming. This latest move back down in yields has not accrued to the benefit of small. And I think the shift is now toward, well, is this slowdown? What does it mean from a profitability perspective, not just a rate sensitivity perspective?
Basically, bad news is bad news for small caps, and good news might be bad news for small caps too if rates stay high. So either way, they seem to be in a weaker spot, and we've been talking about that this morning. Going forward, though, there is this issue of valuation, and that's, I think, sort of what's sticking in people's craw. Because you could say the economy is doing okay, but valuations have gone so high on a lot of assumptions, and frankly, on the fact that the people who are buying them are wealthy Americans who are benefiting, who've gotten incredible interest payments that they've been able to deploy. So how do you understand valuations within a normalizing economy?
So I think you can look at overall market valuation. You look at the forward PE on the S&P, it's in the low 20s. But then if you parse out whether it's the Magnificent Seven or the largest 5 stocks or the largest 10 stocks or the Fab 4, you can segment it. You're looking at more than a 10 multiple point difference. So something closer to 30 for those small group of large cap stocks and down into the 16, 17 range exclusive of a category like the Fab 4. So that's not a bad backdrop, particularly if and assuming inflation continues to come down. The sweet spot for valuations broadly, historical average of 18, 19 times, is when inflation is around that 2%, maybe not coincidentally around the Fed's target. So if we continue to move in that direction, that's broadly supportive of valuations, but clearly the richer valuations are up the cap spectrum. That's where the earnings growth has been most significant. But we're going to see a convergence this year where you've got, whether it's the Magnificent Seven, whether it's the Fab 4, seeing earnings growth rates trend down at the same time, sort of those stocks are trending up. And by the time you get to the second half of the year, you have less of a spread between the mega cap stocks valuation, earnings growth rates and the overall S&P.
This is a fascinating point. It's one that Washington Crossing advisors picked up on overnight. We had Chad Morgenlander and Kevin Karen writing that basically they see kind of a 1999 moment in some of these stocks. Not necessarily there's going to be a big sort of meltdown, but in their words, investors should consider rebalancing portfolios that drifted or selling overvalued stocks, acknowledging that extraordinary growth rates cannot persist indefinitely. Right. Do you see this change of leadership meaning declines in some of those names, or just that they're going to be left behind as some of these others rotate
I think there is an opportunity for catch-up elsewhere in the market. There's also, for all the talk of resilience in the market this year, and it is at the index level. So I often show, and I put this on my Twitter feed every morning, the NASDAQ, as an example, is up, 11, 12% year to date. Has had no more than a 7% maximum drawdown at any point year to date. But the average member within the NASDAQ has had an average maximum drawdown of 36% this year. So there's a lot of churn and rotation going on under the surface, rotational corrections. And that's, in essence, where you might find opportunity. But that tells a more accurate story of what's going on than the story you
in
would
5
hear
minutes time now at 8:15 a.m. Eastern Time. See the release of the US ADP employment change for the month of May. Forecast 175K on the prior 192K. With a range of 190 to 120K expected.
That's maybe where opportunity presents itself.
Raises a question. I just wonder how vulnerable we are, given that NVIDIA is no longer doing the heavy lifting for the broader market.
Very good point.
There's a stat that you've got, and I shared it a little bit earlier this morning, and I think it's sort of something we all need to hear. The correlation of NVIDIA to the broader market was 0.95, and you say it's now 0.3. How vulnerable are we?
Well, it's not necessarily vulnerability for the overall market. It's just a simple fact that NVIDIA as a single stock doesn't have the power to drive the market. And that really just shifted around when they released their earnings. So I think it was the 4 days following the earnings release, which was in conjunction with the stock split release, the stock was up more than 20%. Yes, yet the S&P was down a little bit. That is a real world description of correlation coming down and how it manifested itself. And I think the NASDAQ was also flat in that period of time. So it just shows you that there's more dispersion within the market, even within groups like the Magnificent Seven, much more dispersion, much lower correlations. In essence, that suggests stock pickers kind of market, but there's also a lot of minefields you have to avoid given the statistic of 36% average drawdown for the...
Amazing, amazing. Learn something every time we speak. Thank you, Lizanne.
Thank you.
Appreciate it. Thank you. Lizanne Sanders there at Charles Schwab. Your equity market positive by a third of 1% on the S&P with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Heckers. Hey, Yahara.
Hi, John. Indian Prime Minister Narendra Modi did not get the landslide victory predicted in exit polls, that outcome forcing him to rely on allies to form a government. He's gearing up to hold coalition talks after his party lost its majority in parliament. Since taking office a decade ago, Modi hasn't had to share power in the government and will likely have to make concessions to other parties. Shares of dollar with the retailer announcing earnings that beat estimates and saying it's exploring a sale or spin-off of Family Dollar. Less than a decade ago, Dollar Tree beat out its rival Dollar General to acquire Family Dollar in a roughly $9 billion deal. And Google parent Alphabet is naming Anat Ashkenazi as the new CFO and senior vice president. The move is effective starting July 31st. Ashkenazi joins from pharmaceutical company Eli Lilly. She spent more than 2 decades at the company. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the morning calls, plus Guggenheim's Ron Yevskikov on why he sees more pain coming for Tesla. That conversation just around the corner, and an ADP report just moments away.
One minute remaining for the US ADP employment change. 1 minute.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials.
10 seconds.
Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit
152k, 152k, lower than forecast, 175k. Let's look into the markets. We're seeing a little bit of weakness in the dollar come through here.
ADP report just seconds away. We're looking for 175. Mike McKee's with us. Mike, what's the number?
152, a disappointment perhaps for the markets. It is a sign that the economy does seem to be slowing to the extent that you take ADP seriously as an indicator.
Also noting a downward revision to the prior, 188k from 192k.
Some people on Wall Street, some economists on Wall Street, and they say, don't look at ADP as a forecast for what's supposed to happen. Look at it as just an alternative number. We don't go to the ISM numbers and say, well, they were wrong in the same way we do about ADP. And if you look at ADP over the last year or so, it comes in pretty close. We'll see what happens this time. So 152 is the total number. Goods producing up by 3,000. Construction up by 32,000. Now that's interesting because the numbers have suggested, at least the job openings in JOLTS yesterday suggested construction was not hiring all that much. ADP says manufacturing dropped by 20,000. In the service providing area, 149,000 jobs total. Leisure and hospitality, only 12,000 of those. As always, education and health services, 46,000 jobs. Let's look at the pay numbers because, of course, they do their pay survey. Job stayers get a 5% change in median annual pay. Job changers, 7.8%. That does show there's still a bit of a premium if people are looking for new jobs. So that maybe works a little bit across businesses for the headline.
Pretty decent number. 152 is the number. 175 was the estimate. We get people
So looking
coming
into
on
the
saying
ADP
it doesn't
report
matter, it
here, it
doesn't
notes
matter,
the
and then
job
the
gains
market
were
moves
slower
on
in the
it.
month
Just
of
a
May
marginal
due to a
move, but a
steep
notable
decline
one.
in
I mean, average bit
manufacturing,
bonds.
leisure
We
and
just turn the
hospitality
page to the
also
bond
showed
board and we look
weaker
at the 2-year,
hiring as
10-year,
well.
30-year.
So
Yields were a
the
little
chief
bit higher
economist
this
for
morning,
ADP
but
notes
lower
that
again
job
by about a
gains
basis
and
point.
pay
I know
growth
it's
are
not much,
slowing
Lisa, but it's
going
the
into the
fifth day
second half of
of
the year.
yields grinding lower.
The labour
It's
market is
basically
solid, but
confirmation
they are
of the trend,
monitoring
which just
notable
shows you
pockets
that
of
people
weakness
dismiss
tied
it
to
until
both
it confirms
producers
the
and
trend. I
consumers.
do think, there isn't necessarily a correlation, but just to sort of point out that the revision for last month was also revised lower. So the trend line also gets lower if someone is looking for anecdotal data to confirm a weakening bias. Here you go.
Mike McKee, stick with us, sir. We've got more to talk about. We'll be looking ahead to that ISM services read a little bit later this morning. Then on to payrolls as well. Payrolls on Friday, 185 is the median estimate in our survey. We'll see if that sort of inches lower as we get closer to payrolls Friday. Maybe some of that dependent on jobless claims as well going into Thursday. Time now for the morning calls. First up, Stifel raising its price target on Hewlett-Packard Enterprise to 22. The analyst highlighting strong earnings results thanks to AI demand. Plus, HPE's expectation for a strong second half. Their stock is up by 16%. Next up, Mizuho lowering its price target on ConocoPhillips to 132. The analyst saying the company's Marathon Oil acquisition is a positive for near-term cash flows, but dilutive for long-term inventory quality. And finally, Guggenheim sticking with its sell rating on Tesla. Analyst Ron Yevsikov citing the EV maker's push into self-driving as a massive growing pain, writing this: Tesla is increasingly an investment underpinned by autonomy, a challenging balancing act requiring investors to buy into a vision of the future with limited supporting evidence. I'm pleased to say that with us is Ron to talk about this call. Ron, let's talk about it. Top of the pile, autonomy.
So just seeing some
What's
weakness
not to
come
like
through in
from
the
your
S&P
perspective?
500, still up spot 2% on the session in pre-market trade.
Appreciate that autonomous driving is a massive opportunity. The ability to commercialize 3 trillion miles just in the U.S. alone is a huge opportunity. I think where we struggle is steady state economics. There tends to be more than one company. These aren't winner-take-all markets. We don't have any really supporting data for Tesla to bridge to when autonomous driving happens. And I think if we just go back 5 years, 2019, at Tesla's own autonomous event, we were expecting robo-taxis in 2020, 2021, and people were underwriting in the net present value of Tesla then. We would have robo-taxis at scale today. If you have these 5-year shifts in commercialization for robo-taxis, it cuts your net present value in half. So I think there's a lot of overconfidence in forecasting this. And for a business that we think is going to earn less than $2 this year, there's a significant implied value for robo-taxis, autonomous driving that we think is just going to take a lot longer.
In 10 minutes time now at the bottom of the hour, see the release of the Canadian labour productivity rate. So the forecast is minus 0.1% on the prior 0.4%.
What is the path back to volume growth here, Ron? Where does it come from? Before we get into the future and all these bright, shiny things, what about sort of the nuts and bolts of where we are right now and where we're going?
Yeah, there is volume growth in one major region of the world, obviously China, where I think you're seeing competitive product, good prices, competitive with ICE vehicles, the pricing, internal combustion engine vehicles. For the rest of the world, it's tough because I think there's a mix of consumer adoption issues, range anxiety, things like that, but also demographic issues. If you look at the average buyer of vehicles in the U.S., it's historically old, and they're also less likely to adopt electric vehicles statistically. So I think there's some demographic shifts that will help. For Tesla specifically, returning to growth, new models next year will help at the margin, but ultimately we've seen that without cutting price, Tesla really cannot grow volumes at this point. It's pretty challenging.
Ron, is the volume story a Tesla problem or an electric vehicle problem more broadly?
I think in the U.S. and Europe, it is a mix of both electric vehicle and Tesla. In China, it's a bit more of a Tesla problem just because the amount of competition in China is very fierce. You're seeing BYD putting out a car last week with 1,200 miles of range, basically New York to Miami, that is priced like Volkswagen, Nissan, et cetera's lowest price ICE vehicle. So I think China's unique where it's more of a Tesla specific problem. Western markets, it's electric vehicles are struggling currently, and I think that that's going to take time to play out. We talked about the demographic shift that should help over time. But
there's also this issue of the Elon Musk problem. This is at least according to some people, particularly with the latest news being reported, where he basically said that he is just transferring all the chips that he's buying from NVIDIA over to X Corp and XAI, not to Tesla, because, as he said, Tesla had no place to put them. This sort of flies in the face of some of the AI adoption that we've been hearing about in Tesla. How much does this sort of move the needle for you in terms of your expectations for Tesla?
Yeah, I think during our discussions with investors, at least, I think what was most noteworthy about the headline yesterday is, was this done independently or not? Basically, were other executives and their board members aware, or was this a unilateral decision? Because that has much different ramifications for kind of even the Delaware court decision in terms of they deemed that Elon had control over Tesla despite not having actually equity control. Otherwise, it's going to be a debate in terms of the sourcing of AI talent, where it goes, whether it goes to XAI or whether it goes to Tesla, and the allocation of resources and time. I think it's a bit of an open question. It's really tough to have an answer on, but we are surprised how much implied value Tesla is getting for their autonomous and AI efforts without a lot of tangible data to support it.
It seems to be the core of your sell call. Can I just finish on the leadership question that sort of Lisa alluded to? We've got this shareholder meeting, I think on June 13th run. Where do you think we're going to be regarding Elon Musk and the leadership of this company at the end of this month?
Yeah, I would say what we've written is we expect the comp package to pass. Frankly, candidly, we think that it's kind of promises made, promises kept. And we expect the Texas reincorporation to fail. Ultimately, I think that means Elon stays. It's a bit tougher to say what that means for the comp package with respect to the Delaware courts. But I would be very surprised if Elon Musk is not the CEO of Tesla both a month and a year from now. It is ultimately the best funding mechanism for his AI goals and ambitions. It has the lowest cost of capital, I would imagine, of any of his ventures. They're private, but I would imagine Tesla has the lowest cost of capital, the best funding base, 26+ billion of cash to see this out. It's going to be a considerable cost to develop any of these autonomous and AI technologies.
Ron, appreciate your input, your perspective and opinion. Thank you, sir. Ron Yevsikov of Guggenheim on Tesla. Sal, 125 price target, trading at 176 right now in the pre-market. Stock is higher by 0.7%. Just a moment, we need to recap those numbers, Bramo, don't we? 152 on ADP. The call was for 175, at least the median estimate in our survey. Previous number, 188.
Yeah, and that was a downward revision from 192. Question here is, of course, the relevancy. But today, the fact that markets did move highlights the sort of nervousness and the balance of risks right now baked into markets, which raises this question. How high is the bar for a downward sell-off versus some sort of rally if we get an upside or downside surprise in ISM? In other words, are markets more sort of attuned
In 5 minutes time now at the bottom of the hour, see the release of the Canadian Labour Productivity Rate for Q1, forecast minus 0.1% on the prior 0.4%.
Just because of experience in the last 2 weeks, I'll just take the last 2 weeks. 2 weeks ago, Liz Ann Saunders said this. We had this PMI come out, S&P Global. And then we were talking about the economy being too hot, a re-acceleration again. 2 weeks later, we're meant to be measuring the same thing. The ISM comes in soft and everyone's like, whoa, whoa, slow down. And then everything just reinforces that. You look elsewhere, job openings, whatever it might be, quits. Job openings relative to how many people need a job. And then you start looking at what's happening in crude of all places. Narrative's going to go back and forth, back and forth. If we get confirmation of the trend, yes. If we don't, yes, we'll be hyper nervous to it.
Well, so who's trading, on any given data point? Who's trading on ADP? If you are trading on ADP, please write in. We would love to talk to you because that is really a key question also. What's driving some of the ping-ponging action that we've seen?
Well, if they were trading on it, it's changed in the last 5 minutes anyway. So for a moment, yields were down and they're back up again on a 2-year by a single basis point. It's exhausting, isn't it? Up next on the programme, PGIM's Tom Porcelli and BlackRock's Marilyn Watson. And we'll get the latest thoughts from Mike McKee, still with us around the table too, from New York. This is Bloomberg.
from the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Just less than 1 minute away now.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
10 seconds.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Minus 0.3%, minus 0.3%, lower than forecast, minus 0.1%.
On the S&P 500, on the NASDAQ, up by 0.5%. Little bounce on the Russell, up 1/3 of 1%. In the bond market, plenty of volatility in the last 10 minutes or so when ADP dropped and yields went with it, down a basis point, now just about unchanged. On a 10-year, 432.59. We'll talk more about that data in just a moment. I want to turn to foreign exchange going into the ECB tomorrow. Talk more about this ECB decision throughout this week as well. Looking for that first rate cut from a major central bank. Not that the others aren't major, just I call these tier 1 central banks and then everyone else. I'm going to keep offending people in Switzerland. Okay,
Just like dig
euro
your
dollar,
hole. Keep going.
108.75. Just about unchanged on the euro. We'll leave that there, all right? Because Switzerland already cut rates and they're major, important, I know. Under surveillance this morning, Intel announcing another investment program as it works to keep up with competitors. The chip maker agreeing to sell 49% of an Irish plant to Apollo Global Management for $11 billion. The deal bringing in much needed funding as the CEO, Pat Gelsinger, pursues an ambitious turnaround plan.
This, to me, actually is one of the more interesting stories, because we always talk about Infrastructure Week. When is the government going to finance all these foundries and all of these chip production plants that's going to allow the U.S. to have some of the more advanced technology? Is it really going to be, corporate USA, or is it going to be some of these private management funds that have pools and pools of cash that are looking for some AI exposure? You just wonder how much that's going to be the fuel to the next leg of the fire, more than, company Joe Biden.
I don't know if I'm looking for it, but I'm just noticing it more and more. Every time there's some kind of deal, our friends at Apollo are like in the story. Have you noticed that too? Paramount, Apollo's like in the story, Apollo's in the story. You see it more and more.
They're massive. They've got their tentacles in a lot of things, and they have a lot of money. And when you have a lot of money, you can't do as many, or you can, but if you need to gain scale, you need to go big. And so you start to see them as sort of a major partner for some more significant companies and some significant projects that are, what are in all of our kind of eyesight, which raises the question, how much of a role these companies are going to have in kind of financing that next tier of development that a lot of people have been counting on government financing for.
We're seeing it in the news flow. That's for sure. Good morning, Mark, Jim, Scott. We'll talk more about this.
Lots of shout-outs.
Shares of HPE Enterprise, they're watching, I know they are, are set for the biggest gain since 2016, thanks to what else? AI. HPE's server business generating $3.87 billion in revenue. The company seeing a big jump in sales as demand for AI-oriented systems only grows stronger. HPE finally getting a slice of the market as its peers Dell and Supermicro Computer see significant year-to-date gains. It's quite a year-to-date run. Supermicro Computer up 171% so far. Let's turn to the bond traders. Tilting dovish once again, piling into bets that the Fed could cut sooner than expected. Swaps now in pricing an initial 25 basis point cut in November, moving up expectations from December. This as investors keep an eye on US labor market data. ADP just moments ago coming in at 152,000 versus the estimate of 175 after yesterday's downside surprise. Job openings hitting their lowest level since 2020. 21. Mike McKee, put it all together going into payrolls on Friday.
I would just say nobody knows nothing, the old William Goldman quote about Hollywood, because it was last week that we had a guest on this show, and I can't remember who it was, but I'm going to quote him because it was great. The Fed has a reaction function. The markets have an overreaction function. And the numbers that we've gotten recently have them overreacting to the idea of rate cuts. Now, that may happen. April may have been a turning point in the economy. We don't know. We don't have a lot of data yet. But at this point, everybody's buying into the idea that the Fed's going to cut rates sooner, that the economy is slowing significantly. But there's a lot of stuff on either side. You look at the JOLTS report yesterday, and everybody's focused on the lowest since 2021, but it's still 8 million, which is still way higher than the average before the pandemic. And we saw hiring go up in April by 16%, the second strongest since January of 2023. So the labor market, is it weak or not? I mean, are we going to see a strong number on Friday? ADP might suggest
According to a poll, the Federal Reserve had cut rates 25 basis points in September, according to 74 of 116 economists, which is up from the 70 of 108 that was seen in the May poll.
Today, 9:45 this morning.
So the poll also notes the Federal Reserve had cut rates by 50 basis points this year, according to 68 of 116 economists. 28 see 25 basis points, and 5 economists see no cuts this year.
In Canada, as we know.
Tier 2. I'm going to say tier 2. What I'm really nervous about doing is putting anyone in tier 3. So I'm just going to tell you there's like tier 1, which is ECB, Federal Reserve, BOJ, and then it's like tier 2. And I'm not going to say who's in tier 3.
It's like Bs
right?
in most schools that now count as pretty much Bs, Cs, Ds, and even
Just
Fs.
everyone gets a medal.
Yeah.
Participation. All right, everyone gets tier 2.
Carry on.
Mike, here's the problem. Destination versus journey. I remember this phrase from Chairman Powell, we all do, in Jackson Hole in the last speech in August when he talked about navigating the stars under cloudy skies. Help me navigate the stars under these skies. So when you look at the ratio of openings to unemployed people sitting at 1.2, so we're back down to about 2021 levels, very close to where we were pre-pandemic, all the way down to 2 to 1 at its peak. So we're talking about a really hot labour market. We're trying to work out, are we just normalising, talking about 2019? We're on a journey to somewhere else, somewhere bad. How do you even know?
You don't. I mean, the evidence is that we are normalizing, and almost all the economic indicators suggest that we are normalizing. There are some red flags out there that people are watching, the number of bankruptcies and the number of people who are getting delinquent in their loans, but they're still not out of what would be called a normal range. The issue is, do they tip over that edge? And we don't know that. And that's one of the reasons that, as they say, economists and Wall Street have predicted 7 of the last 3 recessions. I mean, we're always looking at these numbers, and people pick some out and say we're gonna have a contraction, and once in a while they're right, and then they come on this show a lot and we tell them that they were great.
No one's ever told me that before. Literally every day someone gives me that stat. Just want to throw that out there. I will say, though, there is this question going forward about the data and then the revisions. And I don't know if I'm making too much of this or not. I know Bloomberg Economics came out with talking about a potential 730,000 jobs eliminated from the labor force as reported in all of the revisions for 2023. Do you buy into this credence, this idea that the data's been messy? We've seen some pretty significant revisions in the past. It's been harder to get it right, and they're more likely to be in a significant downward trend than upward.
I was looking at the what they call the QCEW numbers this morning after that piece from Bloomberg Economics, and I don't know if I buy that we're going to have this massive revision, but certainly the data has been very messy. Ever since we got out of the pandemic, it's been very hard to know what the final number is going to be, because all of the seasonals have been interrupted and the patterns that we had have been interrupted, and you see data after data being revised more than they usually are. But it goes back to what's the ultimate goal here of everyone watching this data is to predict what the Fed's going to do. And the Fed can only deal with the data that it has. So you can look at the revisions, but you have to take the data that we have at face value when you're trying to predict what the Fed's going to do.
That decision a week today. Let's bring in the panel. Tom Porcelli of PGIM alongside BlackRock's Marilyn Watson. Marilyn, first to you. Let's go to the calendar. Later on this morning, we all know what we're looking for, ISM services. Do you expect that to confirm some of the weakness we've seen so far this week?
So as Michael McKee said, I mean, the data has become so highly scrutinized that we've seen quite big moves on very small amounts of data. In terms of the ISM, we actually think it's going to continue to show a relatively robust economy, particularly in terms of services. And so we think it's going to continue to show that actually, as most of the data is showing, that actually the economy is normalizing, it is decelerating, but in a sort of a bumpy way. So we're not taking too much store by the ISM today. Obviously, we have payrolls tomorrow, we have CPI next week, along with the FOMC, and there's plenty of data to come in the next few weeks as well. But we think that ISM is going to continue to show that actually overall the US economy remains relatively resilient.
Tom, we've heard that word so many times in the last 24 hours, normalizing.
Yeah.
What is the distinction between a welcome cooling and an unwelcome deterioration?
Yeah, and I think this is the challenge for the Fed, right? Because I think it's really easy. I think the stat you highlighted, Jonathan, is spot on, right? If you look at the ratio of openings to unemployed, you're basically back to where you were pre-COVID. But what keeps it there? And I think what would actually help keep it there is for the Fed to start the process of removing some of the tightening. And I think that's the real challenge for them. I mean, when I look at, it's funny, the QCEW, which you mentioned earlier, to me, this is like one of these great metrics that no one really pays attention to. I mean, and if you take it at face value, which is basically used in the benchmark, right, revision for payrolls, it would suggest up to, 50,000 less jobs per month, right, last year. And that's not a small thing. And again, the smoothing of that is a little trickier. But again, just taking it at face value, I think it suggests that you're going to look at actually some lower numbers for last year. But I think thinking about where we are right now, I think what we have to keep in mind is there are an assortment of data that actually are suggesting that things are looking a little softer from a labor market perspective. Now, look, let me hasten to add, I think on Friday, I think you could probably see about 200,000 jobs being created. But when I look at something like, the small business survey, hiring intentions there, which, by the way, is comporting with actual data, hard data on what small business are doing from a hiring perspective, which is to say it is lower. If I look at something like the labor differential from the Conference Board, which is also deteriorating, which again, soft data, which is comporting with the hard data. The unemployment rate is up modestly, but it's up. So there are things that are actually suggesting that labor is slowing, and I think this is where the Fed comes into play, and I think this is why the Fed wants to start the process of taking back some of that tightening that they put in place.
Messy data was blamed for, some say it was the Fed error in 2022 of not hiking rates sooner. Do you think, looking back, that some of the messy data that's going to be revised heavily will be viewed as the reason for another Fed error, that they didn't cut soon enough?
And Lisa, I think that this is what's on the Fed's mind at this point, and I think this is why they actually want to start. Look, I think if we just take a step back, I think it's very easy to say that, you think about Powell and what they were trying to achieve. They stopped hiking rates in July when core was at 4.2%. I think that whole process, that whole thought process was built around, let's try to limit the downside from a labor market perspective as much as we can. And so I think that's already on their minds. And I think this is why the conversation of, hey, let's cut is happening even with, 2.8% core PCE.
Marilyn, this uncertainty really has led to this question of the incredible volatility that we've seen in markets and how things have been ping-ponging along with the narratives. You focus on flexibility and liquidity. Is that because you want to move on a dime in response to some of these data points?
It's because we think there are a huge number of opportunities out there, particularly in fixed income right now. You can lock in very, very attractive all-in yields, very attractive carry with very good liquidity and limited duration risk. But that being said, it's a very uncertain time in terms of the Fed. We do think they may start to cut rates at some point this year, but it's too early right now, we think, to tell exactly when. Likewise, we do have, obviously the ECB, we think are very likely to cut rates tomorrow, and then they're most likely to be data dependent as well. Bank of England may cut rates at some point in the near future, and again, will be very data dependent. And I think, as you say, a lot of the data is becoming sort of as you say, quite messy. And as we do see this normalization and two-way risk coming in a lot of the data, whether it's the labor market, whether it's other economic activity such as manufacturing, consumption, retail sales, you name it. And so we do think it's important that we are flexible, that we can actually, deploy money where we think we see the best opportunities. We want to lock in the best income that we can for clients, but we also want to protect against outside events. And as you say, we don't know a catalyst for, the data to really swing dramatically one way or the other, but we want to be prepared. And we think that's very, very prudent at this stage in managing the portfolio. We want to be very, very risk aware, and we really want to understand exactly where the risks are in each position that we have, and be aware that we can change portfolios if we think necessary.
Talk to us about how to confront this negative yield curve, this inverted yield curve. 2-year, 10-year, negative 45 basis points. You're talking about normalization. You're not talking about deterioration. You're talking about 1 or 2 rate cuts. We're not talking about deep rate cutting cycles. So what is the argument for people out there who are looking at a 2-year that gives me 480 and a 10-year that offers 432? Why would I extend duration, go out along the curve? What's the reason for that?
So I think certainly in the US and in the Treasury market, it's hard to really give a good reason why you would go out the curve, particularly sort of between 10 and 30 years. It's hard to see a good rationale for taking that duration risk, as you say, when you can get better carry at the front end. And particularly as if the front end, if we do start to maybe hear a little bit more from the Fed, maybe potentially to cut rates potentially this year, then you could see, a little bit of a shift down in yields in the front end in particular. But as I say, the curve is very inverted, and it's hard to see yet a reason for taking duration further out the curve then. That being said, when you look at investment grade, when you look at other areas of the global bond market, then we think it does make sense to take a bit more duration risk. So, for example, in the UK, we're overweight duration in areas of the Eurozone, IG corporates. We have added a little bit more duration risk there as well. But I think it's about being very, very tactical and very specific about where you choose to take that duration risk.
This is a fascinating point, Tom. I'd love your take on it in terms of, higher yields in the U.S. over the long term. Why? Is it because of inflation, or is it because of something else?
And I think that this is where the context part of the conversation comes into play, right? Because, in fact, I think we talked about this when I was on last. I hate the idea higher for longer. It's not higher for longer. It's normal for longer, right? I mean, I think, to me, I've been saying this for a long time, and I think that that's really where we are. If you look at like 100 years worth of yield data, the outlier was the prior 10 years. Otherwise, you're in this sort of like 3 to 5% zone. So to me, again, and if we're right that, the Fed does cut rates, but this is going to be one of these, sort of fairly modest easing cycles, that idea remains true, this sort of normal for longer.
Were you trying to start a Liz Truss conversation again?
I wasn't trying to. I'm just, this is sort of the question, right? I mean, there's also a question of buyer base. And actually, Marilyn wrote about this, about Japanese buyers and what happens if you end up with bank. But seriously, it's
just so you know, I can read it. I knew what you were going. Marilyn wants in now. Marilyn, your thoughts, please.
Excuse me.
So, I mean, we certainly think that rates will remain higher than the market expected and higher than they have been for a long time. So even as the Fed does start to cut and as the ECB starts to cut, we think it's going to be very, very gradual. And as you know, there's been a huge debate around where our star is. We need to see inflation come down in a sustainable way towards, the various central banks' targets. And it's not there yet in most cases. And so we do think that rates will remain higher than they have been for quite some time, and certainly higher than has been expected both by the central banks themselves, whether it's the summary of economic projections or other things as well, than maybe and also certainly than the market had been anticipated.
Marilyn, this was great. Marilyn Watson there of BlackRock, alongside PGIM's Tom Porcelli. Tom's going to stick with us and get some final thoughts from him on a payrolls report. I happen to agree with you, by the way. I expect a ton of research between now and November that's going to mention things like Liz Truss moment, UK, what happened to the gilt market a couple of years ago, can it happen in this market, in the Treasury market? I'm not saying it will happen. I'm just saying that I think a lot of people are thinking about the same thing, that both these candidates going into November aren't going to tackle the deficit anytime soon. And at some point, of got no idea when that is, and that really is the trillion-dollar question. At some point, this market begins to reject some of the policies they have.
I don't think it has to be the same kind of Liz Truss moment that depends on the currency. What some people are talking about, including Michael Feroli over at JP Morgan, is different, that it's basically a dysfunction of the Treasury market that causes real angst and an extra premium, possibly because the market's just gotten too big, given some of the infrastructure underpinning it. There are other aspects to this that don't sort of look exactly like Liz Truss moment, but rhyme.
You're not alone.
Ms. Musk.
Peter Scheer of Academy is thinking about the same thing. I'm not sure what you said at the end there. Was that Musk?
Ms. Musk. I don't know. It rhymes. It doesn't. It's not the same thing.
Let's move on. All right. Let's get you some stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Gold is rising as investors shift their focus to Friday's jobs report and look for clues on when the Fed will cut rates. Lower rates are typically a boon for gold since the asset doesn't offer interest. UBS recently raised its yearly gold price forecast out to 2028. For next year, the bank expects the precious metal to average $2,700 an ounce, saying macro uncertainty and geopolitical risks will continue driving strong demand from global central banks. The NYSE and NASDAQ may be getting some new competition in Texas. BlackRock, Citadel Securities, and other investors are backing an upstart stock market based in Dallas. The Texas Stock Exchange has raised $120 million and plans to file registration documents with the SEC, according to a LinkedIn post by the exchange's CEO, James Lee. He says the exchange will try to entice companies from seeking saying deals with ABC, ESPN, and Amazon. The three companies would split games, and ESPN would retain the right to air games on an upcoming direct-to-consumer streaming service in 2025. TNT owner Warner still has a right to match a rival package. The NBA Finals begin tomorrow between the Dallas Mavericks and Boston Celtics. That's your Bloomberg Brief. John?
Yahara, thanks for this morning. Appreciate it. Up next on the program, setting you up for the day ahead, looking ahead to Payrolls Friday with Tom Porcelli. Just a few days away.
The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. The world has very few experts in C++ and C, but the world has many people who knows how to converse and ask somebody for help. Instead of instruction-driven computing, it's now intention-driven computing.
You know, this AI opportunity is really tremendous. You have an ecosystem of companies coming together along with all these incredible innovations. It's causing a new industrial revolution.
This is a tsunami, Ed. This is a tsunami of change. And only the smart ones are going to recognize I have to plant the flag now.
Nobody covers technology like Bloomberg. Context changes everything. The top names in business are on Bloomberg.
They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets, which are kind of wide open. That's all good. Doesn't tell you what the future is going to be. But I think there are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect. My view is whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Equity futures on the S&P positive here by 0.4%, counting it down to the opening bell about 38 minutes away. Here's the trading diary for the rest of the week at 9:45 Eastern Time. We'll get US PMIs, then the big one at 10 a.m. The ISM Services data Thursday, ECB rate decision and Lagarde news conference, plus another round of jobless claims. And finally, it's the main event, it's payrolls coming on Friday. Tom Porcelli of PGIM still with us around the table. Tom, let's talk about it. 180, 185 is sort of consensus in our survey. What are you and the team looking for?
Yeah, I think you could be around 200,000. Look, I wouldn't split hairs on the difference between 200 and 185. I think it's going to be a decent number. The one thing that I thought was really interesting from yesterday's JOLTS report, and look, I don't tend to be a big fan of JOLTS. I just think that they have sampling issues and et cetera. But sometimes you can glean something interesting from there. And I think one of the really interesting things was, if you look at openings for healthcare, I thought it's been getting dinged, like over the last few months. And why that matters is because if you think about what's really been an engine of job growth, it's actually been healthcare. And we've been really trying to drive home the right way of looking at of job growth at large is to look at cyclical hiring. And cyclical hiring basically strips out healthcare. So if openings are an indication that things are maybe slowing down, you're going to lose what has been one of the main engines of job growth. I think that's a really interesting thing to sort of consider. I mean, it's been adding almost, 80 to 90,000 jobs per month, so, right? So X that, you're averaging 120,000 jobs private, cyclical. So to me, that's an interesting thing to sort of entertain.
You know, we're at the half-year mark. A lot of people are putting out half-year, mid-year outlooks. And I'm just wondering whether the range of potential outcomes heading into the end of the year has gotten wider or narrower for you. Yeah, so for us, we take a probabilistic approach to forecasting, which I love. I mean, it's sort of totally different than when I was on the sell side. You have these point estimates, and which is just, let's just be honest, like, don't listen to point estimates. But we take a probabilistic approach, and I think it's a really smart way of thinking about it. So we basically have some scenarios, and we assign probabilities to these scenarios. And what we've been saying this, I walked through the door almost a year ago at PGIM, we've been saying basically since then that we have a really fat tail distribution. And that remains true, as true today as it did when, when I first walked through the door. So I like that idea of really recognizing that there are some pretty fat tails out there around the distribution. I have been saying, and I think that this is, again, as true today, I think that you probably have to go through the left tail before you get to the right tail. But I like the idea of having fat tail risk out there right now.
Was that some buy-side snobbery? Is that what that was?
It was relief. It was buy-side relief.
Throwing shade.
Yeah. I actually am very curious. When you get those messages, send them over so we can see.
Done.
Tom, it's good to see you. Thank you, sir. Tom Porcelli of PGIM. Coming up tomorrow, your lineup. Christian Muller-Glissman of Goldman Sachs, Chris Harvey of Wells Fargo, BMOs, Ian Lincoln, and Citi's Veronica Clark from New York City. This was Bloomberg Surveillance.
Welcome back to another special Roland Garros update for Bloomberg TV and radio from Tennis Channel. Coco Gauff fought back from a set down to take out Ons Jabeur to reach her second semifinal in the City of Light. After losing the opening set 6-4, the 20-year-old found her A game, taking the second 6-2, before closing it out 6-3 in the third. And don't forget, you can watch all the action live on Tennis Channel. Our daily coverage starts at 5 a.m. Eastern.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses.
The effective Fed fund rate unchanged at 5.33% for June the 4th.
The deal. That deal. The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
From New York City for our viewers worldwide, I'm Matt Miller. We're looking to see how much investors care about bad news is good news today. The countdown to the open starts right now. We begin with the big issue, the bad news data point from yesterday. All eyes are on the labor market.
It's right to be watching the labor market because we've seen some cracks forming. The JOLTS job openings data this week falling to the lowest level since 2021. The labor market continues to normalize. The whisper numbers lower than that 180,000 consensus view on job gains this month. I think we could see jobs kind of join the string of weaker than expected data.
Joining us now to discuss is Kevin Holt. He is Invesco U.S. Values Equity CIO. And obviously, Kevin, the JOLTS story from yesterday is going to possibly continue tomorrow with non-farm payrolls. We get some fresh economic data out this morning as well, which we're going to talk about in just a moment. But is bad news good news? Can you count on that as an investor in the stock market?
Yeah, I mean, I do think with inflation having run quite high the last couple of years, that a little bit of slowness in the labor market and a little bit of slowness in general inflation probably gives us a more constructive backdrop, assuming it doesn't weaken too much.
The job openings fell to the lowest since 2021. When I saw the headline, I was a little bit moved until I opened up to a 5-year period or a 10-year period. We have a great function on the Bloomberg that you can use, ECAN Go, to look at all this data. And really, it doesn't look that soft. I mean, this economy still seems to be running pretty strong, first quarter GDP data notwithstanding. What's your view?
Yeah, man, it's interesting how we've all really kind of skewed our view the last 4 years. But if you look over a 20-year period, you're exactly right. The labor market's normalizing, and we're not in an uncomfortable period. So I agree with you, and we're just getting back to a normal level. And maybe the last 5 years, I think most of us would agree, probably weren't normal.
All right, I'm going to put a pin in that right now. We're going to come back and talk to you about value stocks and investing in this market. But first off, let's go over to Michael McKee. He's Bloomberg's international economics and policy correspondent. He's got more on what to expect today and maybe more importantly, Mike, tomorrow.
Well, Matt, what we're looking at today is a lower than expected number for ADP, 152,000. And the folks at the payroll processor saw big losses in manufacturing, but service industry jobs came in about at the same level they have, led by, as always, education and health jobs. Now, does ADP matter? People trade on it. We saw a little bit of a trade right after it came out, but then that was given back because it doesn't really predict what's going to happen next. And you look at what ADP forecast, the 152,000 weakest since, as you mentioned, January when it was 111, but we got 196,000 jobs in the payroll report in January. So can you count on it? Probably not a whole lot. So we are focused on Friday and what we get in the payrolls report, and everybody's trying to put together all these other indicators to come up with their forecast for what's going to happen. 165,000 would be the comparable number to ADP private sector jobs. The ISM number rose to 51.1. We have to get services, which is coming up at the top of the hour, 10 o'clock Wall Street time. The forecast is for not a very good number, still contracting 47.2. That's not what we saw from ADP. And the jobless claims in the survey week, 211,000, a very low number. So it does suggest the labor market has not collapsed. And we'll see if we get this total number of 185 that is forecast at the moment for payrolls. Matt, you mentioned the idea of the JOLTS job openings falling and then double checking the stats. And what people have overlooked is the number of people who were hired in the month of April was up 16%, almost 17%, and that was the highest since last October. So is it openings? Is it hirings?
Yeah.
We'll have to wait and see. It's very hard to make a guess right now.
Well, JOLTS is also always so fascinating. Mike, thanks very much. Michael McKee, Bloomberg International Economics and Policy correspondent. So that's the economic backdrop. Let's get back over to Kevin Holt. He's the head of value equities, the CIO of U.S. value equities at Invesco. And I think this is also a fascinating subject, Kevin. I mean, what is value right now? How do you define it? Because if I look at just a basic definition and I screen for it in my Bloomberg, growth has been on a tear versus value. I think we have a chart. It's 728 in the Bloomberg library. We can pull that up right now. How do you define the stocks that you're looking at, that you're screening for?
Yeah, I mean, ultimately in most industries, it comes back to your cash flow and your ability to generate cash flow, and then what is the return on invested capital of that cash flow. So, you know, a growth stock, you know, may, if it looks inexpensive, we're going to go ahead and act on that if we think it's below its intrinsic value. You know, and then in some of the more cyclical areas, you know, particularly financials, we are looking at price to book, price to tangible book value. And those tangible book values have been depressed recently just because some of the bond, with rates increasing, some of their bond portfolios have gone down, which we view as a transient issue over the next 24 to 36 months.
How do you avoid a value trap? This has been a question, you know, I've been asking people for 20 years, but it's important, right, in this line of investing with this factor.
Yeah, I mean, it's really the most difficult thing, but I think it comes back to your, you know, when you're evaluating your stocks, why is a stock inexpensive? There's usually 3 or 4 reasons. You know, we're looking at things on a 3 to 5 year period, typically, sometimes even up to 7. So, you know, why is the stock cheap? Why does Wall Street not like it at this point in time? And do we think it's kind of a transient issue over that period that can reverse, or is it something more systemic? And I think, you know, one of the things that we like to look at, again, is cash flow, because the health of the cash flow within most of these industries, if it's there, it tells you really about the long-term integrity of these businesses. So, but, you know, there are, you know, things are changing. Media industry's changed a lot the last 20 years. So you really have to understand where the puck's going and not where it's been.
What products do you use? I mean, when you mention cash flow, I think about ETFs. There are a number of funds out there that an investor can buy and sort of set it and forget it. What do you invest with?
in terms of software services, or
no, in terms of products. I mean, do you pick single stocks? Do you like ETFs? I think of cows and calf, for example. When you talk about the importance of cash flow, you have, I'm sure, at Invesco some products. What do you think is the best way for maybe a retail investor to get a deeper hold into value investing?
Yeah, so I run one of our large cap value funds. So I think individual stock picking, particularly in a market where you have such disparity between the MAGA 8 and the rest of the market, and the rest of the market's pretty reasonably valued at this point. So I think individual stock picking is key. Now that interest rates have moved up over the last 2 to 3 years, I think it's even more imperative, because now that money's not free, people put more emphasis on those near-term cash flows. So I think as we move out over the next 5 to 10 years, assuming inflation stays in this 2.5% to 3% range, that's usually a pretty good backdrop for value, although it's been a little bit challenging recently with AI and the GLP-1 stocks. But I think it's a good backdrop, but it's a stock picking backdrop, and it's not a momentum backdrop. So if you look, if you're going back 20, 30, 40 years looking at history.
It's interesting. I mean, the broadening out is something we've been talking about a lot. The S&P 493 or 492, I guess, if you consider 8 stocks to be magnificent. Is it important to see rate cuts, or because you don't see any this year, right?
Well, I think we came into the year, thought we would maybe possibly see 1 or 2. With that said, the economy's been more resilient. So the lower end consumers weakening a little bit, but not that much. And the majority of the consumers are still hanging there pretty healthy. The job market we just talked about, yeah, it's not quite as strong, but it's still relatively strong relative to history. So it's kind of our expectation at this point that we'll probably go in for a soft landing this year. I personally do believe the next move is down, but I think that's probably a 2025 event. And as long as we don't overheat on inflation, I think the market is in an okay spot. But again, these valuation disparities between these 492 stocks and those 8 stocks at the top are quite extreme, and we think, looking at history long term, there's some pretty good value in some of these areas.
So talking to Michael Kantrowitz yesterday, a number of investors make me feel like, are we in a Goldilocks situation? Is that how you feel?
I mean, near term, I think we are in this Goldilocks situation, because we have a little bit of inflation, which is really good for some of the cyclical areas of the market. When we had 0 interest rates, it was very difficult for financial companies to earn that interest income. It was tough for the commodity companies to get any pricing power. So, yeah, I do think at this point, we are kind of in this Goldilocks scenario, and it's going to be up to the Fed to kind of determine when things do weaken economically enough that we need a little stimulus in terms of interest rates. But again, we think that's a 2025 story. So we're in a pretty good position right now, knock on wood.
What sectors do you like right now? If you have to pick a few, and we've seen some real underperformance in the S&P 500, for example, from utilities, from healthcare. Are those that haven't done well, your best picks for the rest of the year?
Yeah, and I really do think there are more idiosyncratic opportunities right now. Historically, when rates were 0, you'd see a lot of cyclicals that looked inexpensive. Right now, there are a lot of idiosyncratic opportunities within individual sectors. So you mentioned healthcare. We think the HMOs, which are the healthcare insurance companies, look particularly attractive at this point. Really within the Medicare population, they've suffered some profitability hits. We think that'll resolve itself over a 24 to 36-month period. But we think that rate of change when pricing comes out here in a few weeks, June 1st, when it's set for 2025, we think that'll give the ability for those stocks a little bit better. As we move into some of the regional banks, we think, again, the net interest income, they'll be able to get that through. And as long as the economy stays in an okay position, they won't have the credit risk. So we think as we move into 2025 and the stocks will start to discount that in the back half, they'll get past some of these concerns and the contagion risks that happened in 22 with the regional banks. Valuations are very attractive. On a historical basis, book values are slightly depressed because of some of the bond issues we talked about earlier. So we think some of the regional banks have tremendous upside from this point, and we'll start to discount it in the back half of the year.
All right, Kevin, thanks so much for joining us. Great talking to you today. Kevin Holt there, Invesco U.S. Value Equities CIO, joining us. By the way, I incorrectly said utilities was an underperformer. Actually, utilities has done pretty well. If you look at a breakdown of the groups on the S&P 500 year to date, you can see utilities is up about 13%. What I meant was real estate. That's been the real underperformer. It's actually down year to date. If you look at, again, a GRR, a group ranked return on the S&P 500, which you can run by typing SPXL1 index GRR. I want to quickly mention some breaking news on India. You know, yesterday we had so much movement in the stock market, especially a huge drop in Indian stocks after Modi and his party failed to win a majority, and they had to reach to allies to form a government. It looks like Modi has won backing from key allies to form a government, and you can see some what looks like a ticker tape parade footage here. They had meetings today all day long, and they've come up with an agreement, so he will be able to form a coalition government to rule in India. All right, let's talk about the stocks moving ahead of the opening bell this morning. Abigail Doolittle joins us with that. Abby?
We do have some gains for the indexes this morning, Matt, of course, and helping out CrowdStrike, the cybersecurity firm. These shares are rallying in a big way, up 10.4%. They put up a big beat and raise quarter. Analysts impressed by the company's strong execution in a slow quarter. This stock has really been outperforming the space, up 20% into today. Now, you were just mentioning AI, or you were mentioning utilities, I should say, and one reason utilities have been outperforming despite the competition from yields being up, it's that possibility that AI could drive the need for power. Well, Hewlett-Packard really benefiting from AI as well, up 16% in the pre-market, heading to its best day since 2016. Apparently, their AI server sales have really been very, very strong, providing a nice tailwind. To the downside, though, Dollar Tree down 1.9%. They basically put up a mixed quarter. They maintained their full-year net sales, but they are talking about the possibility of strategic alternatives for the Family Dollar brand. Early days, they don't know, but investors do not seem very impressed. That stock down 1.9%.
All right, very interesting stuff, Abigail. We're going to talk a little bit about AI chips in servers. If you don't have the servers, do you really need the chips? Coming up, we're going to talk about Elon Musk diverting some of those chips from Tesla to Twitter, now known as X.
Debate in terms of the sourcing of AI talent, where it goes, whether it goes to XAI or whether it goes to Tesla.
That conversation coming up. This is Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. The world has very few experts in C++ and C. But the world has many people who knows how to converse and ask somebody for help. Instead of instruction-driven computing, it's now intention-driven computing.
You know, this AI opportunity is really tremendous. You have an ecosystem of companies coming together along with all these incredible innovations. It's causing a new industrial revolution.
This is a tsunami, Ed. This is a tsunami of change. And only the smart ones are going to recognize I have to plant the flag now.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. from more than 120 countries. The moment news breaks, 24 hours a day.
So just to make anyone aware, if anyone interested, at 9:25 a.m. Eastern Time, our own Tony is going to be doing a live stream prepping for the Bank of Canada interest rate decision, which is taking place today at 9:45 a.m. Eastern Time. So the live video, again, starting in less than 10 minutes now, is available on the feed if anyone wants to tune in. They're completely free and no sign-up required.
Where it goes, whether it goes to XAI or whether it goes to Tesla, and the allocation of resources and time. We are surprised how much implied value Tesla is getting for their autonomous and AI efforts without a lot of tangible data to support it.
All right, Elon Musk apparently diverting AI chips from NVIDIA away from Tesla, a company that he runs, over to X, another company that he runs, but with different, obviously, minority shareholders and different expectations. He said on X, Tesla had no place to send the NVIDIA chips to turn them on, so they would have just sat in a warehouse. So if you take him at his word, I think that makes sense. Joining us now is Bloomberg's Detroit bureau chief, David Welch. David, you know, there's a couple of issues going on here. One is the resourcing of the allocation of resources, and the other is a leader of different companies, and he has different masters in a sense, or at least different minority shareholders. Let's talk about the first. What's the chip story? How many chips did he divert? How important is it for those to be at Tesla? What is he doing with them at X?
Look, the whole issue with chips gets down to how far along is Tesla with AI and with this self-driving vehicle and the supercomputing that is required to make all of that work. Tesla stock wasn't doing so well earlier this year and has been slumping for a while because EV sales haven't been doing that well. The Cybertruck has not been a hit. They haven't sold that in big numbers. So there are two theories when Elon came out with the self-driving vehicle that he's going to talk about in August. One is he's a master of diversion and marketing, and he kept the narrative going that Tesla's not a car company, it's a tech company. And the other is, hey, they really have something here. And the latter won out, so the shares have run up. And anything that indicates that they're not ready to push ahead with AI and with self-driving, and in this case, it's diverting chips from Tesla to X, gets shareholders a bit concerned. There might be something next week that Elon says that gets the stock back up again in relation to all this, but right now it is raising concerns because there hasn't been any real proof that they've got vehicles out there that can drive themselves. And a lot of companies worked on them for a long time, showed demos, and ended up tripping over themselves with this. So if Tesla can actually have a self-driving vehicle that works really well, that would be huge. But there's a lot of doubt because companies like GM's Cruise, Waymo, they've had stumbles with this, and it takes a long time to develop. So it's all part of this narrative, whether or not Tesla's really making progress in that area.
Well, and the other issue, which I think is all the more fascinating because of the huge numbers involved, is how does he please shareholders of Tesla, as well as shareholders in Twitter, SpaceX, the Neuralink company, the Boring company, especially when scarce resources that he needs for each of these companies, he diverts to one or the other. A week ahead of a vote on his pay package, a $56 billion pay package. We heard from Ron Barron on CNBC this morning that he's going to support that pay package. Marcy Frost over at CalPERS said she's not going to support that pay package. Doesn't this highlight an issue, a weakness for the Tesla CEO?
It does. Well, so it's sort of a threat to him, really, because you've had this concern for quite a while with Elon that he's got all of these different companies, and it was always sort of overlooked with Tesla because Tesla was a hot growth company, mostly because EV sales were doing great. When that slows down, he comes up with an AI story, and look, it may very well come true that he's got great self-driving technology, but we're not seeing the growth from Tesla that keeps the stock multiples this high, and if he can't do that, then his shareholders are unhappy, and that's where the controversy is. And Tesla's once again a battleground stock. You've got those who think Elon has a great story and a great company, and he's got to keep pushing that. If he doesn't, they'll be very disappointed. And you have others who doubt him, and that's where the fight is. And that extends to this pay package too, right? Because if he doesn't deliver, then people are going to be very upset that he's making this much money.
The other issue is for Tesla, an affordable car, right? That's long been the goal, and that was, I think, pushed out by Musk and then brought back by Musk. Yes, we are going to make an affordable car, especially, well, lucky for him, we don't have to compete with China, right? Because they have a pretty good one in the BYD Seagull. Is Tesla going to be able to make an electric car a green choice for Americans who don't want to shell out 40, 50, 60 grand?
They could certainly do it. Tesla has the technology, they've got the battery, they've got the software. They're a leader in all of that. They're really the only American company, maybe the only global company that can compete with the Chinese when it comes to cost and comes to battery development. So they could do it. The question is, do they really want to this soon? Because one of the problems they've had is their stock multiples come down, is because their margins have come down because they've cut prices, and that's been has really battered the stock. So does Elon Musk really want to make this cheap car that's going to have lower margins, going to bring in lower profits, and basically water down his stock multiple again? I think that's maybe what this is really all about. He did say, look, that they're still going to do this, but he was pretty vague about that. And
European tech stocks are up around 3%, on track for the biggest daily rise since March.
Is pushed out indefinitely until we get more specifics from him. And I think it's really wait and see whether or not they do this car and when it actually comes to market.
With that as well, US index futures are as well extending gains as well. The S&P up around 0.45% pre-market.
Back on the program again soon. Obviously, I love talking about cars. Coming up, the morning calls, and then later, Katrina Dudley joins us from Franklin Templeton on why she expects a soft landing for the economy. This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up is Barclays, upgrading Applied Materials to equal weight. The analyst citing an uptick in demand from China, so that's a hold equivalent. Next up, Gordon Haskett upgrading Instacart to an actual buy. The analyst saying there's evidence of increasing orders in the second quarter. And finally, Boston Beer The company behind Sam Adams is getting upgraded at Morgan Stanley to equal weight. That's a hold equivalent. The analyst says there's a strategic halo on the stock, given recent M&A rumors with Suntory. And there's also a lot of talk about cannabis companies interested in Boston Beer. Coming up, Katrina Dudley of Franklin Templeton joins us around the opening bell as we look ahead to Friday's payrolls report. Will it continue to show us a Goldilocks scenario? This is Bloomberg.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the place to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
This is the countdown to the open. I'm Matt Miller, moments away from the start of trading, and we do have futures up across the board. S&P futures up about 0.5% right now. NASDAQ 100 futures up a little more, 0.8%.
So we're looking now to the market on open imbalance. The S&P 500's a buy side of 138 million. The NASDAQ 100 near flat with a 1 million buy side. Dow 30, that's a 30 million buy side. The MAG 70 flat at 0 million.
10-year yield right now at 430.84, so that continues to come down. That should be a catalyst for stocks. And NYMEX crude right now up about 0.5% at $73.60. Now I will get to one of the stocks we're watching at the open, which is Dollar Tree, the U.S. consumer, still in focus for us. The company said it's reviewing options for its Family Dollar business, which could include a potential sale or a spin-off. That makes a big difference to investors. Abigail Doolittle is here with more. Abby?
It could make a big difference to them. Right now, though, the stock is lower. Matt, investors not really digesting this message so well. They are saying that it's early stages, down 1.5% right now. And if you recall, they bought Family Dollar back in 2015 for $9 billion. That brand is more grocery oriented, so that could be a piece of the strategic thinking. They did announce recently that they're closing 1,000 stores, so they're clearly thinking of ways to shore up that side of the business. Relative to the quarter that they reported, it was mixed. They put up a small miss for adjusted earnings of $1.43, sales of $7.62 billion. That was a small beat. Importantly, they did maintain the full year sales guide, but I think that this uncertainty and also questions of when this time period when we have Walmart outperforming because we have folks flocking to Walmart for cheaper prices, why aren't they flocking in the same way to these two stores? That could be another reason this stock is not performing quite so well yet, Matt, off of its lows.
Yeah, very interesting story there because we have seen these higher income consumers come down to Walmart, maybe from Target, for example, but not going down to the dollar stores yet. That's, again, kind of this Goldilocks scenario, Abigail. And do we see that across other spaces?
That's an interesting question. So when I think about, I think it's probably that shopping experience at Family Dollar and Dollar Tree that has maybe not attracted the higher end consumer. I mean, in terms of other spaces, a comparable doesn't come to mind, but in retail overall, it's been so mixed in terms of some consumers flocking to some of the niche brands, such as Birkenstock. On the other hand, Abercrombie and Fitch, but then American Eagle didn't do so well. And then Target, that's the big puzzle. That store really quite right in the middle of, I guess, the Walmart and the Dollar Tree, and consumers not really flocking there either. It seems like Walmart's really the company cleaning up in this environment. And to your point, a lot of that has to do with their online presence.
All right, Abigail Doolittle, thanks very much for that. Let's turn to tech right now because Alphabet announced a new CFO to replace Ruth Porat, who announced last year that she would be stepping down from the role. Ed Ludlow has more from San Francisco. And then, Ed, we can talk. I want to talk to you for a moment about Tesla as well. But first, Google. What's the story with the new CFO and how does Google look right now?
It's a really interesting appointment. Anna Ashkenazi was at Eli Lilly for 23 years. She'd served as Eli's CFO from 2021, had quite broad responsibility over the commercial business, other business P&L leaders. And as you said, Ruth Porat announced last July that she would step down from the CFO role. And in the interim, she has been acting as president and also chief investment officer, more broadly thinking about how Alphabet and Google invest in the infrastructure needed for artificial intelligence, but also engaging with regulators, thinking about Alphabet's or Google's moonshot bets, its other investments in more nascent technology areas. And that's where Anna Ashkenazi coming in as CFO is quite interesting. Our colleagues at Bloomberg Intelligence, particularly Mandeep Singh, have this idea in their reaction note that this kind of lines up really well with some of the parallel areas Google's looking at, namely healthcare. You know, there is a high degree of overlap between the work being done on large language models and drug discovery, or looking at genetics, DNA, assessing treatments for rare diseases. So that could be an area that she comes in. But I've been asking Ruth Porat every quarter for a whole year who's going to replace her, and we finally have our answer, and the stock's up 0.8% in reaction.
All right, let's get over to the Tesla story because this is kind of the parallel I was thinking about with the consumer, right? In retail, Walmart says it's getting the higher income consumers looking for a deal, but they're not going down to the Family Dollar or the stores, the even cheaper equivalents. In cars, you see kind of the same thing because, you know, we were talking with David Welch about the $25,000 Tesla, which isn't there yet, but they're not even selling very many of the $35,000 Teslas. Consumers are still opting for one step up from that.
Yes, we've done some really detailed reporting on this.
So in 10 minutes time now at 9:45 a.m. Eastern time, we see the release of the Bank of Canada interest rate decision. The median forecast sees a 25 basis point cut to 4.75% from 5%. With this, we see the Bank of Canada rate statement as well. Keep in mind as well, in 10 minutes time, we get the US S&P Services PMIs. The final read for May forecast is 54.8 on the prior 54.8, with a range of 59.6 to 51.5. A US composite PMI final forecast 54.2 on the prior 54.4.
You know, there is no single cheap $25,000 EV coming from Tesla.
And so just to go a little
What
bit
we've
more in
reported
depth
is that
into
they
the
did a
Bank
lot
of
of work at
Canada
the
rate
component
decision
level
expectations
to lower
then.
the cost of the
So
existing
the
lines, one and
range,
three.
well, sorry,
And
the
starting in early
median is made
2025,
from
as
a
Elon Musk
group of
verified from the
30
earnings call,
qualified
a big part
economists.
of that is
21 of
working
them are
out that
looking for this
single motor
25
variant of
basis
Model
point cut
Y
down to
from a sort of supply chain and
4.75%,
component
with the remaining 9
perspective,
looking for it to remain
making it
unchanged
attractive
at
for the
5%.
consumer from a sort of a performance standpoint, but also having a margin profile which is palatable to Elon Musk, right? He still wants to make money.
Yeah, it's a very interesting and kind of a nuanced story, but very interesting. And you've done such detailed reporting on it. I recommend people go to the Bloomberg terminal or Bloomberg.com and check out your reporting or watch your program, obviously. Ed is the anchor of Bloomberg Tech, which kicks off at 11 every weekday. Now, as we count down to the ECB decision coming up tomorrow, investors are growing more concerned that the central bank is facing a similar inflation challenge to the Fed. Joining us to talk a little bit more about that is Katrina Dudley, Senior Investment Strategist at Franklin Templeton. Katrina, we're in this spot where it's like not too hot and not too cold. Is that the same place that Europe finds themselves?
I think you're describing Goldilocks, and as an investor, that's a great place to be because there's a lot of certainty when things are not too overheated and companies are scrambling to do things, and that they're not too cold, meaning there's not a lot of demand. So Goldilocks, in my opinion, is a really great place for the economy to be in. And I do think you mentioned the Fed. We really do have the Fed to thank for the fact that we're in this position because they have really looked at the data, been data dependent, and they've been responsible, in my opinion, for this kind of soft landing that we're anticipating.
So I was talking to Kevin Holt from Invesco earlier, he's CIO there for U.S. Value, and he doesn't think we're going to get any rate cuts. He thinks we are in a Goldilocks scenario right now. Maybe inflation continues on the path down, and you don't see the cracks in the labor market that we're all worried about. Do you feel like the U.S. economy is in the same place?
I think the U.S. economy probably has room for one rate cut, and it's just more of an adjustment type of rate cut. It's not a rate cut in response to the economy going down significantly. So it's a different expectation. I think it's more a recognition that rate cut will be that inflation is under control. And I think that is why the Fed will do it. And that's why I do think the Fed will do that one rate cut as a signal to the market that we have really tackled that inflation problem that has been part of the narrative for such a long period of time.
What do you think about the consumer right now? We've been talking so much about the consumer as we wind up earnings season. Obviously, we get all these retail companies out with outlooks that seem, you know, a little bit dreary, but not like it's the end of the world. And obviously, with interest rates this high, you would expect a weaker consumer. They spent off their savings that they boosted up from the pandemic. How do you view the U.S. consumer?
I think that there's a couple of things. In terms of talking about the impact of interest rates, I think we need to separate. The fact is that many homeowners were able to lock in very low interest rates and mortgage costs. Now, the downside of that is that there's probably slightly lower labor mobility because people are locked into their home, and the fact that if they were to move, the cost of refinancing would be high. In terms of the rest of the economy, where we are seeing those high interest rates having an impact is really in that lower end consumer, and they're the ones who are not yet in the housing market, for example. You're seeing businesses react, and that to me is really a good sign. So think about a McDonald's, which is really starting to cater their menu to a much more cost-conscious consumer. Now, I think that that's what we expect. You look at Walmart. Walmart has not only positioned itself well in terms of its retail physical footprint, it's also
So in
expanded
5
its
minutes time
online
now at
offering
9:45
and really
a.m. Eastern
invested
time,
into that
we
so
see
that
the
it
release
can
of the Bank
adapt
of
to this
Canada
new
rate
reality.
decision.
Where
Median
you've mentioned
forecast
Target
sees
is
the
another
rate being
company,
cut to
and I think Target is in a very
4.75%
difficult
from
position, as you've
5%.
indicated,
We
because
also get
it's
the
kind of
Bank of
stuck
Canada
in the
rate
middle.
statement with this as well.
You've seen a number of store
Alongside this, we
closings
get the
there
US
in
S&P
big
Services
leases that have
PMI
got
May
long
final
tails on
read,
them.
forecast of
But I do think
54.8
that
on the
that
prior
Target
54.8,
can, with the right
with a range of
offering, muddle through
59.6
this. But
to
I think that, as you say,
51.5.
Walmart is
Composite
probably better
PMI
positioned.
forecast
What's your view for the
54.2
jobs
on the
number
prior
tomorrow,
54.4.
Katrina? I think the the consensus is 190. The whisper is a little bit
So again,
less,
in terms of market probability for a rate cut from the Bank of Canada here, currently pricing in around 75.4%. A qualified economist making up the median forecast. A 21 of 30 are looking for this 25 basis point cut, while the remaining 9 are looking for it to remain unchanged at 5%.
Weak. The stronger jobs number also would be positive as we look at manufacturing. And the reason I mention that is that, manufacturing companies have been complaining about a labor shortage. So if they're now starting to find labor, it would show up in that jobs number, and it'll also show up, with a bit of a lag in more positive manufacturing data. So I actually hope we come in around that 185 number.
All right, Katrina, great talking to you. Thanks so much for joining us. Katrina Dudley there, Senior Investment Strategist over at Franklin Templeton. I just pulled up the WHIS function on the Bloomberg terminal, and I do see the survey is for 185. Right now, the whisper number is for 170. We have breaking news right now from the SEC in terms of hedge fund fee disclosure rule. It's been struck down by the court, and we're going to bring you more on this story. Obviously, hedge fund investors and hedge fund managers are among our biggest viewers. So the SEC hedge fund fee disclosure rule has been struck down by a U.S. court. You won't get too much transparency, or as much transparency maybe as you would have there. We're going to break it all down for you. Coming up, we're going to talk about deal making picking up in private equity.
The deal flow in the first half of last year compared to the first half of this year, there's clearly a pickup in activity. There is also pressure on asset managers and sponsors to realize assets, to distribute money back to investors.
All right, we're live at the Super Return Conference in Berlin, Germany next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people. It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
1 minute remaining now. I'll lead with the Bank of Canada rate decision.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now.
10 seconds.
24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Cut, 25 basis point cut, 25 basis point cut to 4.75% as expected. US S&P Services PMI 54.8, 54.8 as expected. Composite PMI 54.5, 54.5, higher than forecast 54.2. So looking to the Bank of Canada rate statement now, the recent data have increased their confidence that inflation will continue to move towards the 2% target, and risks to the inflation outlook do remain though. says with continuing evidence that underlying inflation is easing, monetary policy no longer needed to be as restrictive. Macklem noted that further progress in bringing down inflation is likely to be uneven and risks do remain. Says it's reasonable to expect more rate cuts if inflation continues to ease, though, and we are taking our rate decisions one meeting at a time. Bank of Canada notes that 3-month measures of core inflation suggest continued downward momentum in CPI. Governing Council is particularly focused on balancing the risks of demand and supply, inflation expectations and wage growth, as well as corporate pricing power and behaviour. The Governing Council for the Bank of Canada is closely watching the evolution of core inflation. Wage pressures remain, but look to be moderating gradually. Overall, the recent data suggests that the economy is still operating in excess supply. Bank of Canada note that shelter price inflation does remain high as well, and the economy is in excess supply. There is room for growth even as inflation continues to recede. Bank of Canada's Macklem notes that although Q1 growth was weaker than the bank had forecast in April, consumption growth was solid while business investment and housing activity also increased. Macklem noted as well that inflation could be higher if global tensions escalate, if Canada house prices rise faster than expected, or wage growth remains high relative to productivity. Macklem also notes that total CPI has declined consistently over the course of 2024, and indicators of underlying inflation increasingly point to a sustained easing. Their confidence that inflation will continue to move closer to the 2% target has increased over the recent months. So following the Bank of Canada rate decision there, where they cut rates to 4.75% as expected, as well as the rate statement, I did see a little bit of weakness in the Canadian dollar there as well.
The markets were expecting a cut, although there are some who say that it may be a bit premature. The governor says that inflation progress is going to be uneven and that risks remain. That is sort of the same story we have heard from Jay Powell. The Fed meets next Wednesday, a week from today. No move expected from the U.S. Central Bank, though, Matt.
All right, very interesting stuff. The first G7 central bank to cut, Bank of Canada down to 4.75, and more cuts. It's reasonable to expect more cuts on the way. Michael McKee, thanks very much for that. Now let's talk about deal making, poised to accelerate this year, according to private equity leaders at the Super Return Conference in Berlin. Danny Berger is there now and joins us with the co-president of General Atlantic. Danny?
That's right, Matt. Thank you so much. I'm joined by Gabriel Caillou. As you say, the co-president of General Atlantic, also heads up the EMEA business and is head of climate, too. Gabe, thank you so much for joining today.
Thanks for having me.
It's great to see you. Look, we are in this moment where it feels like something is happening, that the animal spirits are out there. The data, about a 25% pickup in deal making from the end of last year. But last year was rock bottom. So where are we actually right now in the deal-making environment?
Yeah, listen, it's interesting. First of all, thanks for having me. You have me on every year, and it's interesting. If you think about where we were 2 years ago, I think everyone was anxious about how far can it fall, what is the rate environment really going to do to valuations. I think last year, the big question was, does your model as an investor still survive in this new environment? And I think what we've seen in our business is actually the last 2 years have been pretty good years, but we're seeing now a deal-making environment that's probably more favorable than any time in my career. Because there's been this really healthy reset in the market. And you've heard me complain more than once that during the 2021 bonanza, what was challenging was not only valuations, but it was the way competitors behaved.
Canadian swap market data shows a 60% chance of Bank of Canada cutting rates again further in July.
I almost want to say the good old-fashioned way, where you select a great entrepreneur, you convince them you're the right partner, and you help them build a great business.
Well, it felt like everyone and their mother built a growth equity platform at some point. So some of that backed off?
A lot. So, and for good reason. Listen, there's a lot of great firms out there. I think they underappreciate some of the differences in the growth equity model. Our entire philosophy for 40 years of our history has been, how can we be a great partner to entrepreneurs? We don't buy companies, we partner with people. And that subtlety is something I think a lot of larger firms didn't really pick up when they built their franchises. So they've retracted, and we see a much more favorable competitive environment.
So that environment is really good for deal making. You see a lot of opportunities. What about exits? Because it feels like for the past 3 years, LPs have said, where's
As we're in 10 minutes time now, at the top of the hour, see the release of the US ISM services PMI for the month of May as well. The forecast 51 on the prior 49.4, range 52.5 to 49. For the breakdown, the ISM services employment index forecast at 47.2 on the prior 45.9, The prices paid is forecast at 59 on the prior 59 spot 2, and the new orders index forecast 53 spot 2 on the prior 52 spot 2. So keep in mind as well, we've posted the S&P Services PMI May final report on the feed.
Investor or selling to a consolidator, right, an industrial. And one of those parts right now is completely shut. The IPO for the last
So
2
Harker,
years
who's an
has
economist at S&P Global Market Intelligence, says that a return to growth of new businesses following April's blip supported a market strengthening of growth in U.S. service sector for the month of May. Coming on the back of a similar acceleration in the manufacturing sector, the data suggests a healthy pace of expansion in the U.S. private sector, approaching the midway point of this year.
Hasn't really been coming to market. It hasn't really been valued by fundamental investors. Has something changed?
You know, I think there's a lot of analysis to be done on how the 2021 vintage of IPOs has performed, because it was such a bonanza in the IPO market. And what you realize a few years in is that people who went too soon without the right stability and recurrence in their business, people who were too small, so that mid-market, have really been punished as soon as they've had a slowdown. And so I think there's a realization, and same in our portfolio, that when you go public, you need to be prepared for this quarterly scrutiny. You need to be prepared for attracting the right investor type. And that I think is a defining moment now for the IPO markets. Now, we think we have a whole set of companies that are at a scale growth, quality of model, quality of management that could reopen the markets, and we're eager to see it happen.
One of the things also that really underpins Jay's business is your very global nature. I know you've been very active in China, but we're at a moment where you could have a great thesis about a Chinese company, but you could get a president that turns away around the next day and slaps an 100% tariff on it, or Congress passes some legislation that says you got to ban or sell yourself, not to name any specific companies. But how do you think about investing in China with that background? Has it changed the way that you invest in that country?
Yeah, a few things there. The first is, it feels like we've been navigating tough geopolitics forever in an odd way. And if you look at the impact that that's had on the performance of our portfolio, it's actually been relatively small, right? Our portfolio last year, despite all of the noise, grew 36%. We expect that to continue. So the trends that we're backing haven't been impacted by these geopolitics. And that's true almost globally, right? In Europe, we've had Brexit, we've had, and yet the portfolio is performing really strongly. I think the case of China is an interesting one because we've been there for over 20 years. It's been a hugely successful market for us. We've built a wonderful franchise. We have a great team. But it's true that there's a new overlay of risk that needs to be managed, which is this geopolitical tension. Now, we're still committed. We're constructive on that market. We're seeing great investment opportunity. I think it's just another layer of risk management that we have to take into account in our underwriting.
So, I mean, you've pulled back a little bit on deal making, or?
A little bit. I think in certain sectors, there's some binary risk that's hard to measure, right? So certain pieces of life sciences, certain pieces of high tech, we've had to pull back a bit.
Also with environment, there's a huge story there too of onshoring, reshoring. Think about BYD. Again, this is another environment, putting on your head of climate hat, where you could say, what a great story in an environmentally friendly company. It's making green tech, it's doing EVs, but all of a sudden, again, overnight, you have that story change. Is there a problem in this world where you have these environmental stories that can no longer exist because of the political environment?
I don't think so. I think the trend towards a sustainable economy is one that will continue its course come what may. I think there's going to be bumps on the road because of geopolitics, which is a real shame. But at least in the early stages of our climate strategy, as you know, we've been building this now for 4 years, the momentum behind it is unbelievable across all stakeholders, right? We see it from government, we see it from corporate, we see it from entrepreneurs, we see it from consumers. So I think you're right, we're going to have to navigate this, but the direction of travel to us is pretty obvious and is hugely positive.
Gabe, thank you so much for joining. See, we had to get climate in there. We couldn't let you go without it. That's Gabe Cailloux. He is the co-president and head of EMEA and head of climate at General Atlantic.
All right, Danny, thanks so much. Danny Berger there at Super Return over in Berlin. Now let's get more on that breaking news from Federal Appeals Court. It struck down the SEC's rules requiring hedge funds and private equity firms to detail quarterly fees and expenses.
At 10 a.m. Eastern Time, we get US ISM data. Services PMI forecast 51 on the prior 49 spot 4, with a range of 52 spot 5 to 49. Services employment forecast 47 spot 2 on the prior 45 spot 9. Services prices paid forecast 59 on the prior 59 spot 2. And services new orders Forecast 53 spot 2 on the prior 52 spot 2.
Really by very specific industry groups. The Managed Funds Association, I've got to say, in this round, they have been fighting hard against many of the SEC's rules against the private funds industry, and they have been making significant gains, not only, Matt, to water down existing rules, but also really come up and block rules like this one that would have required hedge funds, private equity firms to have a lot more disclosure when it comes to fees and otherwise.
So the SEC losing this battle, does it look like they've been losing more battles lately?
Not technically. They have definitely made a lot of strides in making sure that the industry has more oversight, but to the point that you're making, they haven't won everything. And of course, we're in an election year. Let's see what next year looks like.
All right, Shonali, we're going to continue obviously talking about this throughout the day. Shonali Basak there covers Wall Street for us here on Bloomberg TV. Take a look at what's going on in terms of stocks. About 26 minutes after the opening bell, we do see gains. The S&P 500 up 1/3 of 1%, 53.08. So getting back closer to the high that we hit on May 21st. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do.
1 minute remaining. I'll lead with US ISM Services PMI.
The first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg.
All right, we are 30 minutes into
10 seconds.
Trading Day on this Wednesday, June 5th. Here are the top stories we're following. Location, location, location. BlackRock and Citadel among the backers of the upstart Texas Stock Exchange.
53 spot 8, 53 spot 8, higher than forecast 51. Services prices paid 58 spot 1, 58 spot 1, lower than forecast 59. Services new orders 54 spot 1, 54 spot 1, higher than forecast 53 spot 2. Services employment 47 spot 1, 47 spot 1, lower than forecast 47 spot 2. Seeing some upside in dollar, downside in stocks.
Long-delayed inaugural inaugural human spaceflight, currently scheduled to blast off at 10:52 a.m. Eastern this morning. We'll bring you second-by-second coverage when the time comes. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets right now, and there is some green on the screen. You can see the S&P 500 up by 0.2%, but if you're looking for some action, take a look at big tech. The NASDAQ 100 higher by about 0.7%. So you have big tech leading this rally, and all the while you have volatility draining from the VIX. You can see the VIX, we're at a 13 handle. We were below 13 earlier today. If you're looking for volatility, you're not going to find it there, but right now green on the screen. But we do have some breaking ISM services data.
The US dollar extends gains versus the yen after US services data, last up 0.7% at 156.01. And US 10-year Treasury yields rise, last at 4.324%.
53.8, that's up from 49.4 last month. The forecast was for just 51.0, a slight improvement. Instead, we get a big improvement. And at the same time, prices paid falls. The prices paid index at 58.1, down from 59.2. Employment's a bit of a disappointment. 47.1, the forecast was 47.2. Last month it was 45.9. And the new orders index improves 54.1 from 52.2. So when you look at what's going on with the ISM numbers, you have to ask the question, Katie, is this economy slowing significantly and the Fed should be worried, or is this economy growing at a reasonable pace and just normalizing?
Yeah, those are some big questions, of course, and it'll be interesting to hear from the Fed itself, Jerome Powell himself, of course, at this June Fed meeting. But let's look ahead to tomorrow. The jobs report, of course, coming up. We had JOLTS, we had ADP. How does that set us up for 8:30 a.m. Eastern tomorrow?
Well, 8:30 a.m. Eastern tomorrow is jobless claims.
Oh, you're right.
Noting the Dixie rising, last up 0.1% at 104.25.
But right now, it's looking like the consensus is 185,000. Now that we've gotten the ISM numbers and we've gotten the ADP numbers, that may change a little bit between now and Friday. But no change in unemployment at 3.9% and no change in average hourly earnings. So this may not be a dispositive report for the Fed. We'll get through that at 8:30, see what happens, and then everybody's eyes are going to turn to the CPI next Wednesday, same day as the Fed meets.
Breaking news, it's only Wednesday. That is just devastating. Mike McKee, thank you so much. Let's turn this
and the euro turns flat versus the dollar, last at $1.0874.
From the fact tomorrow isn't Friday, but let's talk about what we've learned so far, because we've gotten a lot of data so far in just the 3 days of this week. When you add it all together, you think about the big rally that we've seen in the bond market. What do you make of it?
Well, to be honest, June has been really a huge shift in sentiment. We have seen, even though some of the data is positive, like you're seeing some indications today, ISM data, manufacturing data earlier this week, but the biggest thing that we have been watching is these synchronous moves that you've seen in the commodity markets, as well as how much of an impact you've seen in the fixed income markets. So I think it does feel a little bit like we're feeling a shift in sentiment that could indicate that there are things that we need to think about and worry about that I wasn't really worried about until this last week.
Well, that's what I've been wondering. You know, we've been so focused on inflation, and for good reason, but wasn't just the focus shift from worrying about inflation, about price pressures, over to worrying about growth in the labor market?
Precisely. And I think our narrative this year has really been higher for longer, and the equity markets being disconnected with that narrative. And anytime we've seen bad news, we've noticed that the equity markets have actually thought of that as a good indication that we'll get cuts. Now, when we're seeing some concerning news, we're actually seeing the opposite. We're seeing risk off behavior, which means that the market has really shifted much more to worrying about demand, worrying about the consumer, and worrying about if we do get cuts, will it be enough? And that's where you see the equity markets really taking a little downturn in the last couple of days.
And do you think that's fair? Would you lean against that? Or do you think that maybe being a little bit cautious, a little bit defensive here makes sense?
Yes, I do. And I wouldn't have said that a week ago. And that's what's interesting is you've really seen the market try and reprice, particularly the commodities. And I think the commodity moves in particular have been something that held up the higher for longer narrative for us. And now that we've seen that change and that we're seeing some data that looks like maybe the consumer is getting a little tired, and that makes me start to worry about how much demand destruction we might have right now and whether or not we have an issue with growth. And that is something that I wasn't as worried about until I saw such extreme moves in the markets, really reacting to some of the data in a very different pattern than what you saw earlier this year.
And so, Katie, how do you build a portfolio around that? Obviously, you have a very unique cross-asset view here. And when you look at the different asset classes and that same fear about demand destruction and, of course, what the economic backdrop looks like, I mean, where's the best place to place your bets right now?
That is a good question because right now it may be a shift in tide. So you might start to see short positioning in the commodity markets. You might also need to think about cross-sectionally across equities, which equity markets, particularly you've seen transports and utilities and others struggling in relative sense. So relative value positioning in equities, but also you might see a pivot in some of the key asset classes. So seeing a weaker dollar, potential short positions in commodities that we haven't seen for quite some time. And also just kind of thinking about whether or not the probability of a challenging market environment, such as a harder landing than we expected, could be feasible. So I think that's what I would start thinking about, increasing the probability that we could have a challenging market environment for equities going forward.
Is that the green light to go long duration here? Because I speak to a lot of bond folks, and the narrative has been that you have to have a really tough stomach to go out the curve right now. And why even bother when you can get 4.5%, 5% in the shorter end of the curve? But if we are heading into an environment of demand destruction, cooling growth, whatever you want to call it, I mean, is it worth going long here?
At some point, I'm going to say yes. And I'd say that the market is indicating that to some degree. And if you just take a quick look at the pivot that we've seen in fixed income, I know signals are still short, higher for longer is still kind of a theme in trends that we've seen. But it's really going to be interesting to see tomorrow's ECB meeting, to watch data coming out, to see the probability of potential cuts increasing. If that's the case, there's going to be an eventual shift towards long duration, which could be a very good play as well if you are concerned about a hard landing or some sort of scenario where we have deteriorating growth.
Okay, so not yet, but at some point in the future, maybe we'll get there when it comes to some of those longer duration bets. Let's talk about the stock market, because you were talking about sort of those relative plays that you could make. And it's interesting, we had Jason Trennert from Strategas on earlier this week, and he said that it's really hard to bet against the Magnificent Seven right now. Those big tech names, they broadly showed up during earnings season, Katie. And how are investors and how are you over at Alpha Simplex sort of wrestling with the fundamentals versus valuations right now?
This is a very good point. And I think the challenge is you've seen a massive divergence in the trends in those very strong tech names, and they've sort of been the ballast of the market. But if you look deeper below the surface, you're not seeing as much potential. And I think you're seeing that even today when you look at how the NASDAQ is recovering so much stronger than the Russell or even the SPY or other broad indices. And so I'd say that it's really going to be a question of how long can we keep that narrative, and is this sort of a new normal where we have sort of that sector of the economy coming ahead and other sectors really struggling. So I think it's going to be a continued theme that we continue to second guess, but we got to watch earnings next season, and we need to also continually look at the data and see if eventually the Magnificent Seven feel some of the challenge of that as well.
Is it worth buying up protection right now? You aren't seeing it in the VIX necessarily, but then you take a look under the surface, you can see that traders are paying up to hedge against S&P 500 downside here. If you take a look over the next couple months, that June swoon that some people have warned about, is that a hedge worth making?
Well, I'd say you could say that the market is actually doing that to some degree. Look at how much movement you saw in fixed income. To me, that's an indication that people are shifting their sentiment. So yes, of course, you could also consider more explicit hedges on this type of scenario. But instead, as people pivot more risk off, they're essentially redirecting their portfolio to be more prepared for the potential for a harder landing or for the inability of cuts to deal with deteriorating growth and also issues with the general consumer.
All right, Katie, I think that's a good place to leave it. Always great to speak with you. Really appreciate your time. That, of course, is Katie Kaminsky of Alpha Simplex. And let's take a look at what's moving underneath these markets right now. We're going to do that with Bloomberg's Bailey Lipschultz sitting to my left. Happy Wednesday.
Happy Wednesday. I thought it was Tuesday, so we're all over the place here at Bloomberg. Katie, best performer in the S&P 500, HP Enterprise. Best day since 2016, trading an all-time high, up right now 14%, beating expectations. Analysts calling out the tailwinds around AI as a major driver of those results, raising their expectations for the full year in terms of adjusted earnings and revenue growth. Really seems like a solid all-around beat for a company that 18 months ago was kind of one of those stocks that investors were really debating around how could they capture AI enthusiasm. And it seems like, at least when you look at the chart, doing very much that.
Yeah, it's pretty amazing just to see this double-digit surge right now. Let's also talk about another name that's having a good day, CrowdStrike. We've seen a little bit of a pairing, but still up pretty solidly here.
Yeah, up more than 4% right now, beating expectations on earnings, delivering a boost for their guidance. The one thing to keep in mind when you look at CrowdStrike, stock fell almost 10% last week when Salesforce reported results that really took a lot of the wind out of the whole software narrative. But when you look at it nonetheless, it does seem like a really strong result. Analysts kind of calling out the ability to generate significant recurring revenue on an annual basis, free cash flow upside relative to what Wall Street is currently looking for. So that's why you're seeing CrowdStrike trading higher again, up 4.5%. But I like to keep things relative, still below the levels that it was at just a week ago.
There you go. Some good perspective there. Bring it home. Let's talk about Dollar Tree. Interesting review going on right now.
Yeah, underwhelming results, but also now they're considering selling or spinning off through potentially an IPO Family Dollar, that franchise, which really has been struggling when you look at kind of some of the results and the ability for this company to really execute. We saw some analysts really kind of casting it as a quote-unquote problem child that has been dragging on earnings. You got to keep in mind also Dollar Tree announced plans to cut nearly 1,000 of those Family Dollar stores. So really trying to reshape that business. Again, right now the stock is down more than 2.5%, even on a year-to-date basis though, Katie, down closer to 18%. So a struggling business that investors really want to see the company do something new to try to drive shares higher.
All right, Bailey Lipschultz, it's always great to see you. Coming up on this program, Wall Street heavyweights planning a new exchange to take on New York's dominance. We'll bring you the details next. This is Bloomberg.
From our world headquarters in New York, I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt.
That's why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
Well, BlackRock, Citadel, and other investors are backing an upstart Texas-based stock market exchange to challenge New York's dominance. For more, we're joined now by Bloomberg's Catherine Doherty, and a pessimist could say that this is a bit of a long shot in the Lone Star State. How hard is it to actually build and launch an entirely new exchange?
That's right, Katie. Well, they first have to get approval from regulators, so they will file with the SEC. Once that gets done, they have to actually then gain momentum. They actually have to see the trading start to happen. And whenever you have a new exchange, really what needs to happen first is that the volumes increase, and that incentivizes investors and market makers to route to that exchange. Really, if there's increased liquidity, that means that there's going to be better pricing more often. And that's why NYSE and NASDAQ, in growing their own liquidity, have been able to keep such dominance and keep their volumes so high over time.
Yeah, it's a good point, of course, that at the end of the day, it's all about liquidity, and also, too, on the timeline here. I mean, there's a lot of steps still, but it's interesting to see this because you know very well that there's a bit of an IPO drought right now. IPO volumes have been very, very muted. When it comes to the Texas Stock Exchange, I mean, what is the potential vision here for the business in terms of what they're targeting?
So it does seem like they're targeting corporations that would go to NYSE and NASDAQ, but might be frustrated with some of the new rules and regulations, the compliance that is put in place. Think about NASDAQ's board diversity program that they have put in that might limit some companies that don't meet the certain threshold that is placed for listing on NASDAQ. If they still want to go public but don't meet the threshold, they might choose the Texas Stock Exchange. That is really what this business is targeting. They want to be an open venue that has less rules, less restrictions than NYSE and NASDAQ. They're going to really promote themselves as the welcoming Texas state that is welcoming to companies that might not want to go through the hurdles that they would see in New York.
And I mean, this news is interesting in and of itself, but also interesting are some of the backers. Like we said, Citadel, BlackRock, among the investors here. What could be the bet on their part? Are they trying to hedge something here?
So this is not the first time that we've seen market makers like Citadel, Virtu back exchange operations. In 2019, the members exchange, MEMEX, which is still up and operating, they, along with some of the biggest banks, backed their new exchange that is, again, still in play, and they are taking market share from some of the big incumbents. And we've seen Howard Lutnick's futures exchange that is to launch later. That is not in equities, but in futures. But again, this is a big play for participants that might just want more venue, more choice. And there's also sometimes a financial incentive when you are a backer of the exchange. You might get actually more of the ownership in the exchange if you send more volumes to that venue.
All right, well, it's going to be absolutely fascinating to follow. I'm sure it's going to keep you busy as well. Our thanks to Bloomberg's Catherine Doherty. Meanwhile, some investors, activist investors, are encouraging overseas companies to switch to U.S. exchanges in pursuit of better returns. For more on this story, let's bring in Bloomberg's Crystal C., one of the authors here. And what's the logic, basically?
The very simple thesis here is valuation. If you look at the valuation on a price to earnings basis, The FTSE is lagging by about half of what the S&P is trading at. So
At 10:30 a.m. Eastern Time, we get our weekly EIA data. Crude oil inventories forecast a draw of 2.3 million on the prior draw of 4.156 million, with a range of a build of 1.5 million to a draw of 3.51 million. Distillate inventories forecast a build of 2.17 million on the prior build of 2.544 million. Gasoline inventories forecast a build of 1.7 million on the prior build of 2.022 million. And crude Cushing inventories forecast a draw of 1.766 million. Bear in mind yesterday's API crude oil stock change came in at a build of 4.052 million. We also get the Bank of Canada press conference with Governor Macklem.
It's true that when they switched their listing over to the U.S., their market cap definitely expanded.
And there's also more logic to that as well, right? Because CRH, for instance, they have a lot of revenue coming in the U.S. already. So their customers are in the U.S. and they have contracts that will be coming from revenues that will be coming from the U.S. continuously. So that is another reason for them to come. But that's obviously is a problem for London to deal with.
Well, let's talk a little bit about London, because it actually lost its crown as Europe's biggest market by value all the way back in 2022. Now you have activists pushing to get companies to list elsewhere in the world. I mean, what does this mean for London? What does the city do from here?
Yeah, obviously it's a huge headache, and it is really going to be the government's priority to either pressure their companies, to pressure the bankers, lawyers, but as well as offering incentives for companies to stay. Not only do you have to improve your exchanges, there will potentially be like tax benefits. There will potentially be other incentives just to keep the homegrown companies within the country. And that, with the election coming up in July, whoever is winning will have to figure these out and make sure that the capital is staying within the UK.
Yeah, it's definitely becoming a problem there. Going to be really interesting to see how this transpires and if it does come up as the election draws closer. Bloomberg's Crystal C, great reporting as always. Really appreciate your time. Now, still ahead, we're going to take a look at the companies making the most social buzz today in our Social Climber segment up next. This is Bloomberg.
We'll have to build a portfolio of interventions. Lifestyle will also play into for some of them, and I think we can help many patients get down to a weight that they can maintain and live the life they want to live and avoid many comorbidities for the healthcare systems.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup.
This is a three as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
All right, right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, Soup for You. Campbell Soup licking third quarter earnings expectations. Strength in meals and beverages offsetting weakness in snacks. And prices hold steady for the first
At 10:30 a.m. Eastern Time, we get our weekly EIA data. Crude oil inventories forecast a draw of 2.3 million on the prior draw of 4.156 million, with a range of a build of 1.5 million to a draw of 3.51 million. Distiller inventories forecast a build of 2.17 million on the prior build of 2.544 million. Gasoline inventories forecast a build of 1.7 million on the prior build of 2.022 million. And crude Cushing inventories prior a draw of 1.766 million. Bear in mind, yesterday's API crude oil stock change came in at a build of 4.052 million. We also get the Bank of Canada press conference with Governor Macklem.
Let's take a check on these markets. We're almost an hour into the trading day. You can see the S&P 500 building on gains, maybe getting a little bit of a lift from that economic data that we got at the top of the hour. If you take a look at the sector level, though, it's pretty narrow. You actually only have 3 of 11 sectors in the green right now. Consumer staples, your biggest lagger, and tech is the big winner today, and you can absolutely see that in the NASDAQ 100, currently up about 1%. It definitely helps that you have NVIDIA up almost 3% right now, definitely helping to lift overall tech benchmark. Now coming up, as farm profits fall, Tractor Supply continues to grow. Hal Walton, he is the company's president and CEO. He joins us next. This is Bloomberg.
You have to distill down what is the purpose of what you do, what is the purpose of your company, and make that very clear, and repeat it and repeat it and repeat it. And it's very clear what our purpose is to make money for the Norwegian population.
So why did you accept the job? You had a great life. I mean, you had a hedge fund that was doing very well. You were earning lots of money.
Well, I had a great life. I had a great life, but I still have a great life, and a really good life. No, I was very keen on that job because one, I think it's one of the most important positions in asset management, right? I love asset management. In terms of the opportunity to develop that organization further, there were great opportunities, and I love organizational development. And then to do something nice for the country. I mean, these 3 things came together in the same job.
Why do you love asset management? Because you can influence and change the future, or is it being cleverer than anyone else?
Asset management is the most interesting job in the world, perhaps after being a journalist. Why is that? Well, everything you eat, drink, drive, all these kind of things is made by a company. You need to understand psychology in terms of the companies. You need to understand the corporate culture of companies, and then these things.
1 minute remaining. I'll lead with EIA crude oil inventories.
Interest rates are changing, currencies are changing, and the data points are just changing all the time. You just couldn't invent a more fascinating game, even if you tried.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
10 seconds.
All right, an hour into the U.S. trading day. Let's get a check on these markets with Abigail Doolittle.
We're seeing something, Katie, that we haven't seen in about a month, and that is the S&P 500 up for a fourth day.
Build 1.233 million. Build 1.233 million, higher than the expected draw of 2.3 million. Gasoline inventories. Build 2.102 million. Build 2.102 million, higher than the expected build of 1.7 million. Distiller inventories. Build 3.197 million. Build 3.197 million, higher than the expected build of 2.17 million. And crude Cushing inventories. Build 0.854 million. Build 0.854 million.
1%. It was not so long ago. Right now, 0.9%, sort of adding to this risk-on mood. The yen, of course, a haven currency, so the fact that it continues to sell off, that is supportive of the risk-on mood. So too is the reaction that we saw, initially at least, from bonds to that ISM number that came in. ISM services for the month of May coming in at 53.8 versus the estimate, the survey at 51, and versus the prior month of April below 50. So we're back in expansion. So bonds initially sold off a little bit, yields going higher, and now basically about flat. It's going to be interesting to see whether or not this turns into a fifth down day in a row for that 10-year yield. And then finally, oil. I believe we have some data coming out right now, but oil not reacting all that much to it. Over the last 3 days this week, down 4.3%. U.S. stockpiles thought to be high going into that report. And then, of course, OPEC Plus not so long ago indicating they do have a plan to halt the production cuts.
Yeah, certainly been a tough couple of days for oil there. Bloomberg's Abigail Doolittle, thank you so much. We want to switch gears now because it's been a tough time on the farm. Farmer income forecast to fall 26% this year, and that's caused companies such as Deere to cut their profit outlooks. Let's take a look at how it's impacting other ag-focused retailers. We're going to do that with Hal Lawton. He is the president and CEO of Tractor Supply, which of course is a U.S.-based company that sells farm supplies, animal feed, tools, and fencing. Hal, it's great to see you in person.
You too, Katie. Thanks for having me on the show.
So as I said, I mean, it's a tough time for farmers. Obviously, crop prices have been falling pretty substantially, hitting the likes of Deere, but not so much Tractor Supply.
Yeah, Tractor Supply caters to a different customer base than the large-scale agriculture farmers. Certainly, that has some halo effect on the communities that we serve, but we really serve that hobbyist farmer, that so-called kind of gentleman farmer, and then also a new cohort of millennials who have all migrated out into rural America over the last 4 or 5 years and really taken up many of the hobbies that we cater to, that we call life out here. And from our perspective, rural America is thriving, vibrant, and doing incredibly well.
You know, I said the phrase gentleman farmer in our morning meeting, and I think my team thought I was joking, but it's a real thing. I mean, that's a very real category, and it's what you serve. But even said, I mean, it's a tough time for those farmers, maybe not for the gentleman farmer, but even still, the U.S. consumer has been faring with very high inflation, higher price levels than the last few years for quite a time now. And we've seen a trade down across industries, and I'm worried from where I'm wondering, I'm not worried, but are you worried that some of that Tractor Supply customer base could migrate to a Walmart, for example?
You know, our customers continue to be very engaged in our business. In general, they continue to spend and, you know, be very healthy. We cater to a demand-driven business, and so it's animal feed and dog food are, you know, nearly 50% of our business when you look at it holistically. And, you know, those drive footsteps into our stores. We've got market-leading pricing on that. In animal feed, you know, we're 20 to 25% market share in the United States. And, you know, our customers own land, they own their homes, they have animals, they have pets. They have a tendency to not overspend in good times and typically not underspend in bad times. They stay very conservative and just kind of paced in their approach to life. And, you know, we reported our Q1 results and had a positive 1.1% comp, and you know, our business continues to perform very well.
Well, we've seen time and time again that Americans are happy to spend on their pets, on their animals, and that's certainly benefiting your business. I am curious, though, what your pricing and promotion strategy looks like right now, and have you changed that, of course, heading into the summer months?
We are an everyday low price retailer. You know, we don't promote things like our animal feed, chicken feed, horse feed, cow feed, livestock feed. They're everyday low priced. During the pandemic, we took the opportunity to eliminate virtually all the promotions in our business and stop doing print ad marketing, converted that all to either digital, video, or TV, and haven't reinstated those print ads. So we only have one a year that we do on Black Friday, and by nature, that's reduced our promotional activity. We are seeing a little bit of, particularly in the pet industry, manufacturer-sponsored promotion activity, but for the most part, we've remained EDLP.
And tell me about your loyalty program, because you recently lowered the limits there to potentially meet some different tiers. How have those changes impacted that program?
So our loyalty program is called the Neighbors Club program. We have 34 million members. It represents nearly 80% of our sales. So it's a large, vibrant, and robust program and driving significant growth. It's tier-based and loyalty and a tier-based reward system, as you mentioned. Great retention on it. Nearly 80% of our customers retain themselves from one year to the next in terms of being an active house file. But we really this year, after the last couple of years, the middle tier and the high tier just really driving their behaviors and supporting them. We now are focusing a little bit on that lower tier, reduced the threshold a little bit, reduced our rewards redemption areas as well, and we've been very pleased with those results. But Neighbors Club program is a core foundational element of our business model.
And I'm curious, when you take a look at what people are spending on right now, your customer base, I mean, what categories do you see the most activity in?
Yeah, so it's interesting. It's kind of both sides of the spectrum. We certainly see continued demand for the feed and food and kind of usable and edible and consumable products that we sell, those transaction driving, you've got to feed your animals, you've got to feed your pets. But we're also seeing big ticket be very strong. So this year we've commented that like riding lawnmowers, very strong, UTVs, mini bikes, go-karts, golf carts, all those sorts of things, gun safes, grills. So literally kind of on both sides of the spectrum, we've seen strength.
And I mean, you've definitely seen that in earnings. And I want to talk about the share price a little bit, because you recently hit an all-time high, and then you got some valuation concerns coming from the life of Loop Capital. And I feel like when I ask CEOs about their share price, they say that they don't really look at it. But how are you thinking about just how far the stock has come over the past couple months or so?
Yeah, so if I step back, over the last 25 years, there's only 4 stocks that have averaged a 25% compound annual growth rate in their total shareholder return. We're one of those 4, Amazon, Apple, and Monster Beverages being the others. So, we've got a long-term track record of share price appreciation, and in the last 2, 5, and 10 years, similarly. So we're, very long-term focused. We have our strategic initiatives we're focused on, expanding our market share, growing our TAM, serving our customers. Certainly look at some of the day-to-day movement of the stock, but really focused just really on the long-term share price appreciation. But we've had a good run, and we're focused on continuing to drive that.
All right, well, I appreciate the color. Whenever a CEO tells me they don't look at the share price, I say, really? Really? But that makes a lot of sense. Hal, really great to speak with you. Hope we can do it again soon.
Thanks, Katie.
Our thanks to Hal Lawton, of course, the CEO of Tractor Supply. Now coming up, the starting bell is starting to sound for M&A activity. We're going to take a look at the deals landscape with Ralph Schlossstein. He is the Evercore Chemeris Emeritus. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Well, it's time now for our daily Wall Street Week conversation. And today we're taking a look at how corporate deals are being affected by increased yields and higher uncertainty. Wall Street Week's David Weston spoke with Ralph Schlosstein. He is Evercore Chairman Emeritus about the current status of deals.
Well, we're actually in a period of returning activity. So if you look particularly in the U.S., announced transactions in the first 5 months of the year are about 40% of last year. The last 2 years have been a period of low activity, driven predominantly by uncertainty rather than economic uncertainty, because that is the enemy of M&A activity. And if you look back over the last 45 years, go back to 1980, M&A has generally been characterized by 5 to 8 year up cycles and 2 to 3 year down cycles. And we're kind of at the end of that 2 to 3 year down cycle and at the beginning of what I suspect will be an extended period of increased activity, 24 being better than 23 and 25 being better than 24.
So as you know, here at Bloomberg, we pay a lot of attention to the Fed. Are they going to cut it? They're not going to cut it. They're going to raise. What's going to happen? At the beginning of the year, there was something like 6 rate cuts priced in. Now we're down to maybe 1. Does that affect CEOs thinking about doing deals?
It really doesn't. What they care more about is the availability of debt capital rather than the cost. And I think we're at a period right now where the cost of debt capital, the risks are asymmetric. The risk that it goes up is lower than the risk that it stays where it is or drifts down. So that's kind of off the table today in terms of transaction activity. Economic uncertainty and political uncertainty now are not unimportant in having people think hard about whether they do transactions.
When you talk about the availability of capital or credit, you would have thought 500 basis points would dry up a fair amount of that. And yet, right now, we've had a lot of people come into the market. What is the situation with supply of credit for people wanting to do deals?
Well, supply of credit today is probably as good as it's been at any point over the last 4 or 5 years. The reason for that is, number one,
Bank of Canada's Macklin says the path of any future interest rate cuts are likely to be gradual.
So they are actively seeking the opportunity to deploy capital. And then, of course, you have this massive growth in the alternative banking system, so-called private credit, where massive amounts of capital. That market today is in excess of $1 trillion. It's not levered generally, and so there's a huge push on the part of those who fundamentally are alternative asset managers to push out that credit. So right now you have intense competition between the traditional banking system and the alternative banking system. And whenever there's lots of supply and limited demand, prices go down.
If you talk to private credit people, as I know you do all the time, they say, yes, we're lending a lot of money, but we're much more careful about it. We put a lot more restrictions and covenants and things like that on it. Is that true in your experience?
No. To be honest, I think credit, there's this thing called the credit cycle that we've heard about for many years. Credit, there are periods of time, like right now, where people feel some amount of pressure to put assets on the books, whether they're private credit or banking, and that tends to weaken a little bit the underwriting discipline, not thrown away, because I think we all learned from 2008 that discipline in credit is really, really important. But I recall once when I was at BlackRock, we were hired by Xerox to make a decision about what they should do with their insurance
Bank of
business.
Canada's Macklin says
And,
we don't need to move lock and step
one of
with the
things
US
we
Federal
did is
Reserve.
We visited 5 of the smarter people in the property and casualty business, one of whom was Warren Buffett. So we flew out to Omaha and we met with him, and he talked about the property and casualty business. He said, you know, I've bought every single one of my underwriters a golf club membership. And the only thing that I do is I tell them when they must use their golf club membership and when they can't. And his point was, there are some times when the underwriting cycle is really bad and I want you all to play golf, and there are times when it's really attractive and that's when I want you to not play golf and write
Fitch
lots of
says we
policies.
expect China's
And,
new home
you know,
sales value to
bankers and
decline by
private credit
15 to
don't have that
20%
same
to
luxury.
8.3 trillion
You know,
Chinese yuan
discipline,
to
not in
8.8
major
trillion
ways,
Chinese
but
yuan in
minor
2024.
ways, ebbs and flows.
And that was Ralph Schlosstein. He is Evercore Chairman Emeritus, and of course, Wall Street Week host David Weston. Now tomorrow, we'll be joined by Bill Daley. He is former White House Chief of Staff. Meanwhile, I take a quick look at these markets, and we have a rally on our hands. The S&P 500 currently higher by about 0.4% or so, but really it's big tech that's leading gains here. You can see the NASDAQ 100 higher by more than 1%. A lot of those gains are being driven by what we're seeing going on in NVIDIA continuing to power ahead, and that's dragging up both benchmarks higher, as you can see. Meanwhile, volatility continuing to fall. You can see the VIX currently below 13. That does it for Bloomberg Markets. I'm Katie Greifeld, and Bloomberg Technology is up next.
And Fitch says signs of stabilization in China's secondary home market have diminished, with asking prices maintaining a downward trajectory.
This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bank of Canada's Rogers says there's a pent-up demand in the housing market.
In Bitcoin, you have crypto. Stocks also surging.
Bloomberg's covering all things crypto. The people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Good morning from our world headquarters in New York. I'm Menace Crenny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's world headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
And we are counting you down to the launch of Boeing's much-anticipated Starliner in Cape Canaveral. The crew of 2 will be the first astronauts to travel aboard the so-called space taxi. And this launch, look, it's been plagued by problems. Delayed twice already in the last month due to a number of technical glitches. The craft, key to NASA's plans to take crew to and from the International Space Station. A lot is riding on this, Ed.
Yeah, this has been 10 years in the making. Boeing's been working on Starliner since 2014 when NASA first awarded the contracts as part of the Commercial Crew Program. And it's massively behind schedule, 7 years delayed, $1.5 billion or more over budget, Caro. And we may finally be here. And the important context is that in that time, the contract was also awarded to SpaceX, who have flown NASA staff to the ISS 9 times and 4 private missions. And you can see how far behind Boeing has fallen.
Let's just talk about the people that we're seeing on board at the moment. Veterans, as we say, this will be both of their 3rd time going to the International Space Station. And what we've got, Suni Williams, Barry Butch Wilmore. Can you tell us a little bit more?
Yes, Suni Williams, hugely experienced astronaut, 322 days in space, first time in 2006 through 7, second time 2012, a number of spacewalks. Butch Wilmore, 178 days in space. He will be the commander of this mission, been a pilot aboard previous missions, and it's a different system to SpaceX, right? It's a very different system. It has side boosters, a main booster, a second stage booster, and then the capsule Starliner on top. So there is a lot here that is not as tested as thoroughly as the SpaceX system, but we're getting closer to this happening, Kara, and I have to say, I've been skeptical that we would get here given the multiple delays, even in the last month alone. But Starliner looks clear for launch.
10, 9, 8, 7, 6, 5, 4, 3, 2, 1, ignition. And liftoff of Starliner and Atlas V, carrying 2 American heroes, drawing a line to the stars for all of us.
Commander Butch Wilmore, they're calling down to Mission Control here in Houston that the spacecraft has begun rolling into the right attitude for its ascent, and the Guidance, Navigation, and Control Officer here in the room seeing good data on that.
Starliner passing through max Q, or the point of maximum dynamic pressure where the forces of air friction are highest, which in Sunny will shortly be passing through Mach 1, or the speed of sound.
We've passed through max Q, or the moment of maximum aerodynamic pressure or stress on the complete craft. 1.6 million pounds of thrust generated by the main booster, and on the side of that, the 2 solid rocket boosters. And that's the next thing that's going to happen, Caro. We're about 90 seconds into this, but at the 2-minute and 20-second mark, those solid rocket boosters, the 2 smaller boosters on the side, generating 348,000 pounds of thrust each, they will separate and drop off back to Earth, and we continue on our journey relying on that main booster for about 2 minutes or so, and we can pick up from there.
We, of course, are going to be keeping an eye on Starliner, but just talk to us all about...
Bank of Canada's Macklem says so far it's looking like a soft landing for the economy.
The rocket, and this is ultimately 2 working seamlessly together here.
This is a really important milestone because the Atlas V system has flown around 100 times, the majority of that under the ULA umbrella. And a lot of the setback is the integrated system, and I believe that what we just saw there was the separation of the solid rocket boosters, those 2 that dropped off of the side. But this is the first time that we've had some serious human space flight under the ULA umbrella with Atlas V, and it's part of a much bigger integrated system along with the Starliner capsule for which Boeing is responsible. Interesting, the share's up 0.3%. I'm not sure what you'd expect. Maybe a relief rally, maybe not, because of how many years behind schedule we are and how many billions of dollars over budget we are. But yeah, it's an important milestone for that combined system. But we add the context that in the meantime, since 2014, when NASA first awarded the dual contracts to SpaceX and Boeing, SpaceX has made this routine and done it many more times.
And let's just run through some of the differences here of what we're looking at compared to SpaceX in terms of the nuances of how the flight is approached, the fact that we're not seeing a reusable rocket here, and indeed, well, a very small amount of size differences.
And Macklem says there is room for the economy to grow faster than potential for a period.
Falcon 9 has a fully reusable booster. There are ways that they're similar. So the total thrust at sea level of Falcon 9 is about 1.7 million pounds. The total combined system of CST-100 is about 1.6 million pounds of thrust. They will both travel at similar top speeds. So on its way to its next stages of separation, which I'll get to in a second, we're traveling maybe 17,500 miles per hour, similar to Falcon 9. Falcon 9 does not rely on those 2 additional side boosters or the 2 additional solid rocket boosters like the CST-100 system does. And then there are additional stages of separation. I'm flipping my bits of paper all over the place here because I want to make sure that we get this right. 4 minutes in, and the next key milestone is that the Atlas booster, that main booster, will cut off its engines, and from there, the Centaur, which is the secondary stage, will separate off from the main booster.
So ultimately, we're waiting for that 4-minute 34 mark when we do see that separation. And as we can see thus far, 4 minutes 32 seconds in, Ed, this seems to be going smoothly and much to the release. Here we are. We can take a look. Ed, that was the separation, correct? That was the Atlas Centaur separation from what we understand. We're, what, about 4 minutes and 50 seconds in.
Exactly. That's what is called Centaur, or basically the second stage booster pulling away from the main Atlas booster in a stage called BECO, or Atlas Booster Engine Cutoff. The next big sort of milestone is in about 10 minutes' time, I'd say, which is where Starliner, the capsule sitting atop of Centaur, will separate on and send those 2 astronauts on their way. But it's just incredible, the images that we've seen. You know, space is hard. Yes. You know, and Boeing has come in for a lot of criticism. It is $1.5 billion over budget, as we say. The stock now modestly lower, basically flat. But everything is nominal, as they say in the space industry. It's going to plan, and we finally got here.
We have, and space is hard. It's costly. And we want to go to someone who really understands.
And Macklem says we still need restrictive monetary policy.
Private and public integration of getting more humans to the International Space Station. Esene is with us. Esene Uzo-Okoro for more. Senior Fellow at Harvard's Belfer Center, former White House Assistant Director for the Space Policy, former NASA Executive. Esene, I don't know who else would be more perfect on a day such as this to weigh in, and thus far this is going successfully. How important is this to the U.S. space ecosystem?
It is critically important. You know, what we're seeing here is American ingenuity and The success of this launch so far indicates that we continue to lead as a nation because we're no longer in a space race. Today, we've got over 90 space programs globally. And so continued leadership is important for the U.S. to keep our edge, to continue to pioneer. And this is just a beautiful sight, frankly.
Azina, you contributed in your career to dozens of different NASA missions. Since 2014, when NASA first awarded those contracts and the much bigger picture of the Commercial Crew Program, it's been super frustrating to see Boeing take 10 years to get to this point. SpaceX has pulled ahead massively. How will that have gone down inside of NASA? How is staff at the agency going to be viewing this moment?
There's a lot of celebration and a lot of relief because what you're seeing here is the resilience of scientists and engineers over, as you mentioned,
Macklem says quantitative tightening is likely to end when the balance sheet normalizes.
Be disappointed for 3 seconds and then move on to find a solution to the next problem. And we witnessed it for this launch in particular over the last month. And that's what's happened over the last decade. And NASA is experienced at this because over 60 years of putting together missions and spacecraft, we've had our share of challenges. And so we understand, and we are frankly cheering Boeing on today.
I'm very humble of you to sort of outline some of the ways in which NASA feels its own issues. When I just want to outline some of the concerns we had leading up to this particular launch. There was a pressure valve that was a concern with the ULA side of the equation, the rocket. We had a small helium leak that seems to have been deemed not a worry, and so therefore that helium leak didn't need to be fixed for this mission to continue. Then previously, we saw, of course, the whole mission was called off but 4 minutes before launch, and that was all based on a launch computer being somewhat delayed. There is so much intricacy when it comes to these sorts of humongous, very costly launches, Azina. And I want to understand from your perspective how important it is to have more private players in the game. How many more do we need than ultimately the duopoly we have at the moment?
As many as we can have. This is a very challenging business, and we continue to support lots of smaller companies, lots of rocket companies that are focused on launching cargo, smaller spacecraft into space. And there is a lot of exciting opportunities, not just in the US, but in other countries. And it's important because when we have launch become more ubiquitous, then the idea of space tourism becomes even accessible. And your children may one day, take a field trip to space because the opportunities to fly are available and accessible.
For our Bloomberg Technology audience, what we're looking at on our screen is a computer-generated image giving the approximate status of the Starliner capsule attached to the Stentor second stage booster. In about 5 minutes' time, those two will separate, and the Starliner capsule, Azina, will continue on its journey to the International Space Station, about a 24-hour process. The International Space Station makes me think a lot about the future. It's due to be decommissioned in 2030. And so today is a massive success. Credit to Boeing to finally achieve this as it stands, the stock down 0.4%. But it seems like the Starliner system has a limited shelf life. They might get, 6 missions before ISS is decommissioned or so. Do you see a future for Boeing in the passage of humans from Earth into orbit and beyond?
Yes, so most companies don't share some of the research and development that they are currently working on while they are completing other complex missions. And as you notice, this is an effort that is combining, multiple companies, ULA, Boeing, and other thousands of smaller businesses and contractors who have helped to make this happen. And so with the retirement of the International Space Station in 2030, we are likely to see not just commercial US-owned space stations replace the International Space Station, but also increase commercial launch activity. So the space sector continues to be described as emerging as a technological space. However, what we've seen and what we've witnessed is that it takes sometimes 30 years to emerge. And so some of these companies continue to work on this, including Boeing, and they might surprise us with what they have in store for future commercial space stations.
Esene, your focus is often sustainability here, efficiency ultimately. How sustainable is Boeing ULA vis-a-vis what we see from SpaceX? How much do you think that ultimately sustainability can be achieved and a clean process of putting a whole ton of satellites into low Earth orbit as well?
Sustainability is a very tough challenge in space, and rightly so. Reusable rockets are more sustainable than a rocket with a single use. However, we have to think about the systems that are developed. If this has 6 flights in it, and after a development cycle that was at least 10 years long, getting at least 6 launches out of it is a helpful start to a future where we will, with hope, have an increased amount of reusable rockets. Now, with spacecraft and satellites in space, we have a whole slew of regulatory rules around when satellites can deorbit so that they don't end up as space debris or space junk. And so we have a process in place, and companies do help to mitigate and help to ensure that we have as little debris as possible in space while we try to clean up everything that's there currently.
Esene, I'd like to spend a moment thinking about the men and women of NASA, and particularly the control staff at the agency. What's kind of interesting about CST 100 is that it is NASA control teams that are running the mission alongside Boeing. You know, SpaceX has its own control teams. So for your former colleagues and friends at NASA, it's also been a very long journey for this system and project, even though we focus on the Boeing component of it. Just explain sort of the depth of talent and those colleagues you know that have worked on this project.
You've got people who have been at the agency for at least 2 decades, people who have worked in mission control for 3 decades. You've got people skilled in physics, in chemical engineering, in aerospace engineering, in a plethora of engineering disciplines who have time and time again supported even the shuttle program and are today supporting this Boeing Starliner. You've got colleagues who have helped to ensure that the International Space Station and the astronauts that visit it remain in constant communication with Houston and the ground. And you've got lots of NASA leaders who have been with the agency, some for almost 4 decades. So there is this continuity and resilience in engineering and leadership that we see at NASA today.
Esene, we're just about to start witnessing, I believe, a key moment. Starliner separation, is it, Ed, coming up?
Yeah, Starliner separation coming up, where the Starliner capsule separates from the Centaur second stage. That's probably happening as we speak.
Bank of Canada's Macklem says interest rates won't return to levels as low as they were before the COVID pandemic.
There is your computer-generated representation. What timing that was. We planned that one. And before that, you had the Centaur main engine cutoff happen prior to it. There's a really important technological distinction, right, Kara, between what we're so used to with SpaceX and Falcon 9 and this CST 100 system, which is the only reusable part of CST 100 is the Starliner capsule. The secondary boosters, main booster Centaur, are not recoverable in the same way that the Falcon 9 booster is. But as I keep saying, and let's repeat it one final time, so far everything is nominal, meaning everything is normal. This is going to plan. Boeing stock's down 0.4% modestly, but it's now a 24-hour journey from this point to the International Space Station.
It is, and Esene, this is such, I'm sure, contained exuberance going on in Cape Canaveral at the moment. But there is much to look forward to. Not only, of course, within the next 24-hour process, these 2 veteran astronauts arriving at the International Space Station, but you mentioned how maybe Ed and my children will be visiting these outer parts of space soon enough on a consumer basis. And I think to what's happening over the weekend, and Virgin Galactic, I think, is still planning for their next particular trip. Are you seeing things going as well as you'd like?
Yes, this is extremely challenging. We have to remember that astronauts have typically been Marines, the best of the best, and they train for at least a decade at NASA before they fly. And the fact that we can simplify that process to allow citizens and non-Marines and non-Air Force pilots and non-rocket scientists to fly and even conduct some experiments on some of these flights is really encouraging, because as we continue, it reminds me of the first days of history and the first days of aviation. But as we continue to see these flights happen, then what we hope to see
And Bank
is
of Canada's
yes,
Macklem's news conference has ended.
to a future private commercial space station or a trip around the Earth. And that is exciting to behold. I believe we will see that in this generation.
We're looking at your live shot right now, and we've been relying on sort of computer-generated images. It's interesting, or I observed that we don't have the sort of as reliable camera feed with Starliner and CST-100 as perhaps we do with Falcon 9. Even so, everything from the NASA feed tells us that we're nominal so far. Esne, we've really enjoyed having you with us on Bloomberg Technology for this launch. Just your parting thoughts on this moment, but I guess also whether or not it will be a catalyst for broader progress in commercial space beyond what we've relied on SpaceX to bring.
You know, the global significance of this is large. We have young engineers locally and nationally who will be inspired, but we also have rocket entrepreneurs who will be inspired in other nations to start their rocket programs and companies, to join space agencies and other countries who may decide this is the time to start their own space program. And so with this inspiring and exciting, successful feat, we can only hope to see more involvement globally. And what that means for the commercial space sector is more resources and a multiplication of capital and more interest in space from investors and others who are interested in technology writ large.
Over 60 NASA missions and programs you're involved with yourself, 20 years, of course, of US government service. Perfect guest to live through some of these incredible images that we see now of what's occurred with ULA and Boeing. Esne Uzuokoro, thank you for joining us, Senior Fellow at Harvard's Belfer Center. Meanwhile, let's get back to Earth. Let's look at what's happening with the markets. Very briefly, we're seeing, well, Boeing on the downside, but on the higher side is NASDAQ. Big tech leading the charge, up more than 1.2%. Some mixed data today. Services still showing really resilient US economy, but maybe some cooling jobs market data helping feed a bond market rally that we see down 3 basis points on the 10-year. Important rate cut happening in Canada. The dollar is higher versus the loonie. We're currently up 0.25%. But Ed, dig into individual stocks for us.
Yeah, earnings is a big part of the story. CrowdStrike beating in the quarter, really bucking the trend of a pullback in cyber spending, one of the beneficiaries of Microsoft missing the mark there. And then HPE surging. There's a clear tailwind from AI infrastructure build out. We've talked about this a lot. It's not just the chips, but it is the casing and the rest of the server components, which HPE is a contributor to. Those names. Wow. That was fabulous. I really enjoyed doing that with you, Caroline. What a moment in commercial spaceflight. We'll be right back. This is Bloomberg Technology.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Indian Prime Minister Narendra Modi has won crucial backing from two key allies in his coalition, allowing him to form a government and extend his decade in power. Joining us now is Jayant Krishna, a non-resident senior fellow at the chair in US-India Policy Studies over at the Center for Strategic and International Studies. And Jayant, what maybe will have to change in the next government under Modi is perhaps more of an equal distribution of economic progress, particularly when it comes to the jobs market. And I'm interested as to whether technology will be a solve for that in some way.
Yeah, I would reckon so. See, this is going to be a coalition government because the BJP, which is led by the Prime Minister Modi, has not got a majority of its own. They have got 293 seats along with other partners which contested the elections together. And the opposition alliance has got 232 seats. So it's not a clear majority. It's going to be it's a return of the country to coalition politics. Many would think that, you know, technology decisions, business decisions, reforms would get slowed down. But that may not be the case all the time. If you look at the history of Indian politics, the coalition governments have delivered better on reforms. The most transformative reforms, if you look at, which have happened since the last 76 years when India became independent, have been in the year 1991 when the government, it was a minority government actually, not even a coalition government, headed by the Prime Minister.
Just noting the S&P 500 extending gains up to 0.65% now. The dollar still up as well. Dixie's up 0.2% on the session.
But I think most of the coalition governments have delivered better actually on the reforms process and have met the business expectations better, contrary to the popular belief.
So we've just been carrying Boeing's mission on CST-100 into space. I think we're going to get to India's space ambitions. We've reflected on this program about Modi's open arms to those working on artificial intelligence. But he ran on a business-friendly policy platform, right? In the coalition scenario, is he going to be able to carry through with that as he would otherwise have done were he to have a majority himself?
So I would believe so. If you look at the Prime Minister Modi's party, BJP's election manifesto, you know, they talked about many things. They've talked about artificial intelligence mission, the AI mission. They've talked about having a national quantum mission. Since you're talking about space, they've talked about the first human space flight mission that you know, government is voted to power, and they have been voted to power, although with a thinner majority. They're going to embark upon. They've also talked about having an Indian astronaut on moon, you know, and the Prime Minister has been very upbeat about you know, the space mission. You know, if you look at the American company SpaceX, you know, their parlays with the Indian government, there have been some changes in the FDI policy, the foreign direct investment policy to accommodate you know, the genuine business aspirations. So I would feel that you know, there's a huge amount of focus in several areas, defense technologies, semiconductors, space, telecom, and various sectors. There's a huge amount of, and I don't think that's slowing down at all with a coalition government vis-a-vis government having a majority of its own.
Jayant, just briefly, we talk about India a lot in the context of homegrown big technology services companies, but largely big companies coming to India to invest. What about the venture capital ecosystem? What about startup culture? Is that going to be flourishing under the new government, do you think?
See, one thing is very clear. Whichever government comes to power in India, there is a certain continuity in the economy, in the reforms process, in being friendly to the business community, and so on and so forth. I don't see that slowing down, at all. So I think, there are several sectors. If you look at defense itself, so one difference is India should no longer be seen as a low-cost back office destination.
Right.
I think major financial powers all over the world have to look at co-developing and co-producing with India. I think that is gone are the days when you give components to us, we assemble it, leveraging our cheaper manpower and deliver. I think we have to have a role in the development process, in the research and development space, and then co-manufacture. Okay. I think that is going to be a genuine win-win between developed countries like the US and India. That's what I would feel.
Jayant Krishna of the Center for Strategic and International Studies. An important conversation on India. Thank you. Stay with us. We will be right back. This is Bloomberg Technology.
Or other authorities.
Could face bigger challenges next.
It was going to keep
in World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Intel has just agreed to sell a 49% equity interest in a plant it's building in Ireland to Apollo Global Management, $11 billion. Intel will have a 51% controlling interest in the joint venture and will retain full ownership and operational control of it. But Bloomberg's Danny Berger sat down with Apollo co-president Scott Kleinman on the sidelines of the Super Return private equity event in Berlin to ask him about it.
I think you're going to see more and more of this
more from Apollo?
Absolutely more from Apollo, but in general, just the need for this type of capital is insatiable.
Okay, that was the finance side. Let's get the chip side with Bloomberg's Ian King. Look, this is core to Pat Gelsinger's plan of smart capital. Intel's money, the government's money, and then someone else's money to achieve a transformation.
Yeah, I mean, the key thing in what you just said is Intel's money, and the simple fact is Intel doesn't have that much money anymore. It has more than $50 billion in debt. It has negative free cash flow, and as we've seen, its earnings have been under pressure. So it needs external capital to protect that balance sheet as much as it can, hence arrangements like this.
It's interesting, Ian, that we've seen other interesting relationships being born. You've got NXP, of course, chip maker over in Europe, teaming up with TSMC to be building out in Singapore. Are we just going to have to see more coming together of capital and alliances like this because it's so expensive?
Yeah, no, you nailed it. I mean, these things, this is not a hobby, right? I mean, these things cost, a plant can cost $20 billion and its useful life is not that long, right? A bit like me, right? 5 years and it's gone, right? You need to put a lot of money into this.
And, need more money into Ian King.
Yeah. No, I mean, the cost of capital is really important when you're in an expansionist phase like Intel is in right now. And, Gelsinger has a lot of pressure on him on all sides, so he's absolutely going to have to do more of this kind of thing.
And the customer base, Ian, have we heard any more in terms of orders of these future, supplies being made?
Yeah, no, and again, that's the big question, right? We need a big customer. We need an NVIDIA, we need even an AMD to say, hey, Intel, we want to give you orders for all of these brand new factories that you're investing in, for all of this great new manufacturing that you're putting in place. So far, we haven't heard that. Intel's explanation is, well, they don't want us to talk about it, but trust me, we've got plenty lined up, and at the moment, the market is kind of in a wait-and-see mode on that one.
You say we need an NVIDIA. It's so important to be crystal clear about what Intel's talking about. He's talking about customers so it can be a contract manufacturer for them. And at the same time, Gelsinger wants them to have their products be at the cutting edge, the ones that they offer for PC data center. How do you pull off both?
Exactly, and that's a tension that is at the heart of this project, right? This is a company that has been brutally competitive for multiple decades, that has made every other company out there suffer in its wake, and now it's saying, hey guys, give us your best stuff, we'll make it for you.
Bloomberg's Ian King, who leads our semiconductor coverage here at Bloomberg Technology, and Intel continuing to be in the news headlines on all sides of its business, the foundry or fab, and then the product side as well. Okay, coming up on Bloomberg Technology, we're going to break down the earnings of another player in what's happening in the data center and AI build now. That's HPE earnings with its CEO, Antonio Neri, a conversation we're very much looking forward to. Stick with us. This is Bloomberg Technology.
Hamas chief says the Hamas will deal with any agreement that is based on complete halt of the war and Israeli withdrawal from Gaza seriously and positively.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the place to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right. That's
so
right.
whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Welcome back to Bloomberg Technology. Ed Ludlow in San Francisco.
Caroline Hyde in New York. Quick check on these markets for you, because we are up and away when you're looking at the NASDAQ today. We're currently still up more than a percentage point, 1.4% on the NASDAQ 100 as well. Big tech managing to lead a charge amid some mixed economic data. Slight cooling of the jobs market, which probably helps demand for bonds at the moment. Yields coming down. Will we see the Fed able to cut later into the year? We're off by 4 basis points. 4.28 is where we trade on the 10-year. But still resilient services sector and business activity here in the United States. Bitcoin on the up, 1.6%. Look, we're at that 71,000 level. If we eclipse the 72,000, we go to yet more record highs. Well, we heard, of course, from some of the key players at Galaxy Digital yesterday saying that we could be at $100,000 by the end of the year. Move on, have a look at what's happening on the micro. The individual names are on the move. I shine a light on sort of an AI theme and indeed a chip theme as well. We stick with it. ASML, this of course Dutch company trading here in the US in terms of its ADRs, but also over in Europe on the higher side of more than 7%. This as we see that, yes, it will be delivering its latest equipment making facilities over to TSMC. We knew Intel had already taken delivery in Oregon in December. Then we want to see the latest versions of the chip equipment being shipped over to TSMC. That pushes us higher. Cisco, though, just at an investor event, and analysts are kind of mixed on basically this is a show me story, a tell me story, a still long-term investment coming from Cisco to ensure that they are the networking gear of choice when it comes to getting in the likes of focus on AI particularly. We're down 2.8%. Some worries about how much really AI will add to their overall profitability in the here and now. And I want to talk about AI adding to profitability and revenue in the here and now, because boy, is it helping HPE. We're up 11% after its numbers came out. And Ed, this is clearly a sign of revenue returning to growth for the quarter. We're also seeing, of course, the idea that AI systems is where we're really seeing almost $1 billion in revenue being done in a quarter. The fact that they're tripling their enterprise AI customer base. But we want to see how much margin is coming out of that, Ed, too.
I think that's exactly the focus of the market this morning. Luckily, joining us to discuss is Hewlett-Packard Enterprise CEO Antonio Neri. I look at HPE and the stock performance, and you're not getting the credit that Dell is or Supermicro. I see Jensen Huang pat Michael Dell on the back and say, if you need a scalable server solution, you phone Michael Dell. But your margins are better. Are you finally starting to get some credit for the role you're playing in the AI infrastructure build-out?
Well, good morning, Ed and Caroline. Great to be here with you today. I completely agree with you that HPE is not getting the due credit for the potential of what we do for AI and the results we have been delivering, including this past quarter. So when we think about our quarters, number one, we beat revenue and we beat EPS, non-GAAP EPS, and that was all driven by the AI system revenue conversion. To your point, Caroline made, almost $1 billion. We exceeded $900 million, and we have a terrific pipeline, which is a multiples of the current backlog. And now we start seeing the uptick in enterprise, which obviously HPE has a significant presence. But the reality is that we have unique capabilities. When I think about the capabilities HPE has in this particular inflection point, AI, number one, we know how to run AI at scale. We have done it for decades. It has been more than a supercomputer now in engineering.
US 10-year Treasury yields fall to 4.287%, the lowest since April the 1st.
Intellectual property, so we know how to build these systems, how to cool it. And then we have a unique manufacturing footprint for water cooling as we think about the next generation of silicon, we require 100% direct liquid cooling. And HP is one of those companies that can do it all. And then last but not least is the services piece. And when you talk about profitability of AI, we think about as a complete pull-through. It's not just the infrastructure side, it's also the services side. And we had a very solid margin performance in our AI systems, which is part of the server segment, where we deliver 18% growth year over year, and we deliver an 11% operating profit. In the guidance, we provide 11 to 13%.
Your CFO talking about prudent cost discipline. Is that what helps with the margin as well, Antonio? Because, look, let's call out JP Morgan, the analysts over there this morning, saying the results in the outlook echoed a similar AI server story of revenue with limited margins. They're not hearing you on the fact that you've got stronger margins.
I think it's a combination of three unique things, Caroline. Number one is prudent business discipline. We have been on that journey for a long time. We pursue deals that we can add value, that we see path to profitability, and that we can drive pull-through. That's number one. Number two is our complete portfolio. And so one of the key areas that I think the market doesn't understand is that we don't just ship servers. We actually ship the server, we install it, and in many cases, we run it as a part of our HP GreenLake platform. And that includes an enormous amount of services. That's why you see HP GreenLake also growing rapidly. And the fastest growing area of HP GreenLake this past quarter, which grew 39% year over year, is actually AI. And last but not least is our ongoing brutal management of cost across the company. And also we are now deploying AI in our own company.
Ah, that's interesting. So you're deploying within your company, generative AI, I'm sure, but who's coming to you? Who are the clients? Because I'm actually surprised that where else have you been focusing if it's not enterprise?
Well, I think about AI in three unique segments. Number one, obviously, is what I call the model builders. These are the people who are building the models and need an enormous amount of accelerated compute to train the models, from hundreds of billions of parameters to now obviously a trillion plus parameters. And in that, we also mentioned yesterday that Microsoft is extending the Azure AI cloud to HP infrastructure and to serve the clients. And one of the clients just happened to be OpenAI. So that's a great example of it. But there's also other service providers like Scalewell in France and many others we support. That's one segment. And obviously, that's where a lot of the demand has been. The second segment, which is growing now, is actually sovereign cloud. And the third is enterprise.
Antonio, there is an interesting tension happening in your industry and with your partners. You know, Lisa Su and AMD and Jensen and NVIDIA principally have the GPUs and CPUs, right? But they want to be systems vendors. And so in the context of a server, there's not a lot left over after that. But they don't have the experience in the sales channels that you guys operate in. Businesses big and small, enterprise. How are you able to convince your investors that you can all grow together when you know that the biggest partners on the tech side want to do more stuff themselves?
Yeah. And we have obviously decades of experience in doing so. I think it's multiple things. Number one, obviously, we work with them to make sure their IP with our IP deliver a better experience and a better performance. And so we co-engineer a lot of things. And you're going to see here with NVIDIA, in particular at HP Discover in Las Vegas, an enormous amount of innovation we're bringing to the market. So I hope you can join us and take a look at that. But also with AMD, obviously, we have a long-standing relationship. In fact, some of the large supercomputers with the Department of Energy has been built together with AMD. What we will bring is the infrastructure expertise. So it's not just the silicon built in a server, and you and I were chatting before the call. It's actually about the whole infrastructure. And in that, now we have unique IP when it comes down to air cool, mixed cooling, and direct liquid cooling. That's very hard to do. Second piece, you need the manufacturing capability to do so. HP today has one of the largest water-cooled manufacturing footprint in the world. And as you follow the roadmap, that will be necessary. And last but not least, obviously, is the services piece, because this system requires a lot of maintenance and a lot of kind of TLC, if you will, and HP knows how to do that at scale.
So, Antonio, Jensen Huang will be on stage with you and he'll give you a public endorsement. Is that right?
No, I think what's going to happen is Jensen and I are super excited to announce solutions together that will advance the adoption of these amazing technologies. And obviously, that's where the two companies come together, but also doing it in a spectacular venue, which will be at the Sphere. And so the way we're going to showcase all that innovation is going to be very engaging and I think, the first of a kind.
Ed's been spending some time in Las Vegas. Going again, Hewlett Packard Enterprise CEO Antonio Neri. It's great to have you with us today. Thanks for joining on the earnings. Meanwhile, coming up, we're going to talk about the private side of investment right now. Ken Elephant's with us. He's partner at Sorensen Capital for today's VC Spotlight. That's next. This is Bloomberg Technology.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. The world has very few experts in C++ and C. But the world has many people who knows how to converse and ask somebody for help. Instead of instruction-driven computing, it's now intention-driven computing.
This AI opportunity is really tremendous. You have an ecosystem of companies coming together along with all these incredible innovations. It's causing a new industrial revolution.
This is a tsunami, Ed. This is a tsunami of change. And only the smart ones are going to recognize I have to plant the flag now.
Nobody covers technology like Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The biggest thing we're going to see in our lifetime from today will be the picks and shovels driving AI. And that's around the data center space. Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
He manages the money of the tech billionaires. Iconic founding partner, Devesh Makhan there, speaking with David Rubenstein on this week's Bloomberg Wealth episode about, some of those AI investing opportunities. Let's just dig into how AI is changing everyone's landscape for VC investing. VC Spotlight with Ken Elephant, partner at Sorensen Capital. Ken, I imagine even in the focus area that you have in cyber, it's all about generative AI.
Yeah, pleasure to be here. Thanks for having me. Yes, as you said before the break, I'm a partner here at Sorensen Capital. We're an early stage and growth stage venture capital firm with over $1.5 billion of assets under management. We focus on investing in enterprise software, and I focus on the cybersecurity part of that. So AI is a big theme, like you mentioned, and certainly in security, AI is an important aspect. There's really two areas where AI can be applied in security. The first is that AI needs to be used inside of security products. So imagine today, most enterprises have a security operations center. What happens is you have a network security person, you have a host security person, you have a cloud security person, and all these people need to work very closely together to stop attacks. AI can be used to really leverage all of the information, make it a lot quicker to respond to these alerts. So that's one way. Yeah.
The thing that I've struggled to understand for a few weeks now, for venture capitalists that invest in the cybersecurity space at the early stage, is what's missing out there. There's so many cybersecurity companies. We just talked about CrowdStrike doing well in an environment where cyber spending is down. So what is it specifically you're looking for?
Yeah, great question. So there's two theses that we have at Sorensen in terms of investing in security startups. One is we like to invest in terms of where the puck is going. And the other is we like to invest in companies where we think the legacy vendors are not innovating. So let's talk about where the puck is going. We have two recent exits in our portfolio. The first one is a company called Talon Security.
Yeah.
They invented the secure browser that was acquired by Palo Alto Networks for about $625 million. The reason this was important is because work was changing inside the enterprise. Employees were accessing applications and data through the browser, and the browser was unsafe.
Yeah.
And this is a huge problem when you're working on unmanaged devices like your tablets or your personal device at home. So that is an area that is brand new. It's an open space, and it really fit well with Palo Alto because Palo Alto is really good on their secure edge solution.
Ken, I believe as well, Zscaler acquired AirGap as well. So you've had these two M&A exits, which are really interesting. Is it all about M&A at the moment in terms of exits, given where the public markets are at the moment?
What we try and do here at Sorensen Capital is build companies that are long-term sustainable companies. And if you're solving a problem, you're going to get many acquisition offers along the way. And in this case, the acquisition offers were a really, really good win-win fit. And to your question about AirGap, what AirGap does is it was acquired by Zscaler in April, and the founders saw that, unfortunately, enterprises are going to get breached. I mean, we saw that today with TikTok, right? When you get breached, that is a problem. But the biggest problem is when that ransomware or malware moves from system to system inside the enterprise. That's called east-west traffic. Now, this was a really good fit for Zscaler because Zscaler is really good at north-south traffic, meaning protecting traffic that's coming out. So there's these security gaps in platform companies that our startups are really well positioned to help fill. And we can fill it through partnerships or, in some cases, acquisitions, and in some cases, IPOs. And as you know, better than I do, to go public, you need to have really good, repeatable earnings and revenue growth.
Sorensen Capital partner, Ken Elephant, on a subject that is top of mind for a lot of our audience around the world. Thank you. Now, coming up on the show, a changing of the guard at Alphabet, the company finally announcing its new CFO. We're going to have who that person is next. This is Bloomberg Technology.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The top names at the Fed are on Bloomberg.
The way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced.
I do think that our new steady state is likely to be higher than what people have known over the last decade. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything.
It is time for Talking Tech, and first up, eBay is dropping American Express cards as a payment option due to, quote, unacceptably high fees. The two companies have been embroiled in negotiations around the fees charged with American Express, stating that the fees were comparable to its competitors. The change is set to take effect August 17th. This one we talked about earlier, NXP Semiconductors is teaming up with a company partly owned by TSMC to build out a $7.8 billion chip plant in Singapore. The move comes as customers demand diversification amid geopolitical tensions. Construction of the facility is set to begin in the second half of this year, with production starting in 2027. And Alphabet has named Anat Ashkenazi as its new CFO. Ashkenazi spent 23 years at Eli Lilly, where she served as CFO and Executive VP for the drug maker since 2021. She replaces Ruth Porat, who announced her departure last year. Ashkenazi's new role will be effective July 31st. Caroline.
Let's get more on the announcement. Davey Alba joins us, helping give the context of the news. And it was a long baton handing over that was the process going.
Yes. This process took quite a while, almost a year. So Ruth Porat announced that she was stepping down as Alphabet CFO in July 2023. And we've been waiting for her replacement, and it's finally been announced. I think this is a great pick for Alphabet. It gives them some credibility and boosts them, particularly in the healthcare industry, where there are many generative AI applications that are possible.
Let's just think about, exactly. She's coming from Eli Lilly, now the most valuable pharmaceuticals company out there. The applications are clear from healthcare. What else can she bring to the table from an Eli Lilly? There must be sort of an R&D for an investment ideal here as well.
Yeah, absolutely. Alphabet has really shifted its focus and turned to generative AI as its mission and the thing that it's pouring its investments into. But as it's done that, it has also kind of let some of its moonshot healthcare efforts languish a little bit, and I think that Anat can bring, some revitalization to those efforts. So we'll see how it goes.
Hey, Davey, it's Ed. As you know, every quarter for the last year, I got to ask Ruth Porat when they would have a new CFO. And each quarter, she would also point out, she's doing other stuff. While they're looking for a new CFO, she's technically been president and chief investment officer. And in that time, Alphabet's done really well, with Porat still there. What do we know about the kind of big picture plan for her and what she's going to be focused on or where she's going?
Yeah, well, Ruth Porat is a pretty legendary figure in the tech industry. She oversaw Alphabet's restructuring when Google blew up its corporate structure and created these tiny companies under Alphabet. And she's also grown the company in its cloud and YouTube businesses in particular. They're a force to be reckoned with at this point, and Alphabet says that they will have a combined annual run rate of $100 billion by the end of this year. She's also been overseeing the other bets sector of the company and sort of pushing the company to sort of enact greater fiscal responsibility. So I think we'll see more of that from her, and she will very likely work hand in hand with Anat to make the company even more successful as it turns to generative.
I find that super interesting because you're absolutely right, like fiscal responsibility, discipline, but also give everything that Alphabet needs on the AI side, which was largely data center growth, infrastructure spend. Maybe that's an area that Anat Ashkenazi doesn't know as well. You know, the Google Cloud portion of the business she needs to get to grips with.
I think that makes a lot of sense. Ruth has really proven herself through her track record of being able to sort of responsibly allocate resources. And generative AI, as you point out, is an incredibly expensive endeavor. So Alphabet is really in the top tier of companies that are competing for talent and also need to continue to invest resources into data centers and other tech infrastructure. So I think we'll see some of that from Ruth as well.
I love the quote in your story coming from the Mizuho analyst saying that this gig is probably one of the best in corporate America, so don't question why she's leaving one rocket ship that is Eli Lilly to go to Google. I just want to for a moment dwell, hate to shine a light on it, but there are a lot of really great female CFOs in the tech sector. I just think about Meta, Microsoft. I mean, NVIDIA, so many of these juggernauts have females in the finance role.
Yeah, it's a welcome development, especially for an industry that has struggled with diversity issues and highlighting top female leaders over many years. So, you know, I think this is a pretty good choice for Alphabet, and we'll see how it goes. She has big shoes to fill here.
She does. And the shoes remain on campus too, which is kind of interesting how that dynamic will play out. But some female shoes. Davey Alba, thanks for breaking it all down. That does it, though, for this edition of Bloomberg Technology, Ed. What a show.
Yeah, what a show. What a moment for Boeing, for American space exploration. Recap everything on the pod. You know exactly where to find the podcast. What an honor that was. This is Bloomberg Technology.
Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We'll have to build a portfolio of interventions. Lifestyle will also play into for some of them, and I think we can help many patients get down to a weight that they can maintain and live the life they want to live and avoid many comorbidities for the healthcare systems.
Welcome to Bloomberg Markets. I'm Shonali Bassick. Right now, tech is driving record highs for the S&P 500, the NASDAQ, and traders are also weighing the latest economic data for clues about Fed rate policy, and that's driving yields lower. Let's get a check on the markets. As we were saying, S&P hitting record highs today, as well as the NASDAQ 100. You're seeing a 0.7% gain on the S&P 500, shaking off the worries that had started the week. Remember, we started the week lower. The NASDAQ 100 up more than 1.3%, almost 1.4%. You're seeing a 2-year bond bid here, 3 basis points lower on 2-year yields on the day to 4.73. Incredible when you think about how we started the week at 4.80 and the 10-year yield below 4.30 at the moment, more than 3 basis points lower on the day. Some midday movers on the equity side. NVIDIA, the biggest point gainer in the S&P as it continues to hit all-time highs ahead of its 10-for-1 stock split. Many investors are betting that the rally in the world's most valuable chip maker still has room to run. And on Monday, Bank of America analysts lifted their price target to a street-wide high of $1,500 per share. Meanwhile, CrowdStrike delivered first quarter earnings that beat Wall Street expectations despite a pullback in spending that has challenged its cybersecurity rivals. The company shares had roughly doubled over the past year, handing it a valuation that makes it more expensive than nearly all of its rivals. And today, ADP data for May showed a slowdown in private payroll growth, but the services sector just posted its strongest growth in 9 months. So now what? Let's discuss this with Bloomberg Intelligence rates strategist Ira Jersey. And you see all of this conflicting data crossing the tape, yet yields just barreling lower. Do you think that the bid that we've seen just this week alone in the bond market makes sense to you?
Well, I think it might have gotten a little bit too far, but keep in mind that a big part of what's going on with Treasuries is really a global rate story. So you just had this morning the Bank of Canada cut interest rates for the first time, really the first G7 country to do so. The ECB is likely to follow. And so I think part of the Treasury move is just it's being dragged down by the global rate environment. That being said, to your point, that ISM data, particularly the services data, was very robust. And you know, you do have this disconnect between the goods sector and the manufacturing sectors being a little bit weak, but services is still growing like gangbusters, and that's really where all of the inflation currently is coming from. So I think there's this this idea in the rates market that, hey, eventually the Federal Reserve is going to cut interest rates, and eventually we're going to have a slowdown. This services boom can't last forever, but you certainly didn't see that in the most recent ISM survey.
Where's the tail wagging the dog right now? Ira, if we think about the central bank divergence, certainly it's a big story, but you and many other guests we've had this week have talked a lot about this idea that perhaps we are looking too far too soon in the bid we've had in this bond market so far. So how do you read the data when the rest of the world is changing course?
Well, I think that's one of the challenges we have, because the U.S. is a little bit stronger, and you certainly see higher inflation here than we do in some other jurisdictions in Europe and even in Canada. So I don't think it's really a tail wagging the dog. It's more that you know, what ranges and where is fair value for longer term rates. So when you look at the very short end of the curve, so you look at Treasury bills and what's going on in, say, the 6-month space, you don't have the same type of rally and lower yields than you have in the longer end, because the longer end is going to reflect not only what's going on in the economy today, but what the market anticipates is going to happen next year and in 2026. And the market still thinks that there's going to be lower interest rates. Just it's not going to be as severe, and and the terminal rate that the Fed's ultimately going to cut to is not going to be at the same level that we were, say, 6 months ago when we thought that the Fed was going to cut all the way to 3%. Now the market's thinking more like 150 basis points of cuts instead of 250. And I think that that's the big sea change. And around that 15, 20 basis points on 10-year yields, that's just going to be noise and positioning. And all of those things, I think, are contributing to some of the recent rally we've had. And some are technicals, quite frankly. 430 was a pretty important technical level on the 10-year. If we close below that level, then that's a signal that maybe there's going to be some people who are short who are going to get nervous and maybe unwind those shorts, and we could see a little bit more of a rally. But I still think it'll be very hard to break 4% in Treasuries until the Fed actually starts to cut rates.
But even in the near term, to your point, that 430 level, fascinating. And if you look, it's not just the absolute points in the curve that a lot of people have been trading on. The people that have bought steepeners, it's kind of like Wall Street got levered on those steepeners, and you would be in the red if you got in at the beginning of this year. That 210 curve is more negative now than it was at the beginning of this year. How do you feel about the reversal of this trade?
Well, being in those steepeners was always going to be difficult because the market had been pricing on a forward basis for the curve to steepen. So it was going to be hard to outperform the forwards at the beginning of the year. And those, like you said, have unwound pretty significantly with the 2-year yield, backing up again and approaching 5%. But even the 2-year yield has rallied quite a lot the last couple of weeks, where we were close to 5%. Now we're down almost 30 basis points from there. So I do think that eventually the steepener will pay off. But to your point, the timing of when to get into that trade is exceptionally important. And it's not clear, and I don't think it will be clear that you should be in that trade until it moves very dramatically. And that's going to take things like the services sector unwinding. It's going to take probably some surprisingly low CPI and PC deflator prints in order for that rally to be more sustained and the market to price in for deeper rate cuts than is currently being priced. Because remember, what the 2-year yield right now is pricing is a very slow cuts by the Federal Reserve over the next 18 months, and that has to change in order to wind up seeing a massive steepening of the curve. In fact, our view is that 2s10s curve is going to remain inverted maybe for all year. Now, it might be less inverted, but we still do think that we're going to wind up in a situation where we don't uninvert over the next 6 to 8 months.
Bloomberg Intelligence rate strategist Ira Jersey, we thank you so very much for your time. The ever brilliant Ira Jersey on a very complicated bond market. And as he's been saying here, that it's really the central bank divergence driving the bond market now. And outside of the Federal Reserve, the Bank of Canada is the first group of 7 central banks to cut interest rates. And here's Governor Tiff Macklem earlier today.
Our judgment today is that the Canadian economy doesn't need monetary policy as restrictive as it has been, and so we cut the policy rate by 25 basis points. There are limits to how far we can diverge from the United States, but we're not close to those limits.
BNN Bloomberg's John Ehrlichman joins me from Toronto to talk really about what was been a dramatic move here for the bond markets from Treasuries and elsewhere. What happened today?
Well, and look, you're right. We did see the market reaction, Shanali, and Canada's currency weakening against the U.S. dollar today. We should point out, though, that there was a growing expectation that the Bank of Canada might be ready to be the first G7 nation to make a pivot. And there were expectations among the economists surveyed by Bloomberg. Don't be surprised if come the June meeting today that they ultimately do this. Look, there's a few differentiating factors for the Canadian economy that we have to highlight. Let's just talk about household debt. We often hear about the big home price increases over the last decade in Canada. That means people have to pay up more to get into the housing market. That means that they've had to take on more household debt. So as we got into this interest rate hiking cycle, that started to put a bigger squeeze on consumers. We've seen record population growth in this country, Shanali, and yet the growth that we're seeing in the overall economy really isn't keeping pace with that. And that was one of the early clues that maybe consumers were feeling a little bit stretched. And so maybe Canada is a little further ahead of the United States, but at the end of the day, we likely wouldn't be at this point to talk about a pivot if we weren't seeing some of those underlying inflation trends improving that Ira was just talking about. Several months of improvements on the inflation front. Not that we are back at the inflation targets that the Bank of Canada would ideally see, but they are increasingly confident that we're going to get there. And if you can go today and pivot and ultimately get that soft landing scenario instead of waiting too long, that seems to be the thinking right now if the inflation trends are there. There's expectation, Shanali, that they're not done and that they'll keep cutting rates over the course of the year.
You know, this is a question for the Bank of Canada, but it's really a question for a number of central banks around the world. It's how comfortable is the central bank really diverging from the Fed's policy?
Yeah, and we heard those comments there from Tiff Macklem about that. That was one of the immediately obvious questions, especially when coming into this pivot point, the overnight rate in Canada was already divergent from the United States. And how comfortable is a country like Canada in having a growing divergence? Now, the Bank of Canada Governor Tiff Macklem really looked at it through the lens of inflation. He said, look, at the end of the day, Canada's its own economy. We have our own central bank, which sets monetary policy. We have our own currency. We're trying to address the inflation reality, and we're going to do that through interest rate policy. But at the end of the day, how much can Canada ignore what happens in the U.S. if we continue to delay this conversation on a U.S. Fed pivot? And then there are some economic implications. A lot of the economists, Shanali, have been asking questions about if you've got a weaker Canadian dollar as a result of this, are you just by nature importing more inflation? Canada buys a lot of stuff from the United States. And then Canada's also been challenged in growing its economy over the long term, things like productivity. That has not helped through a weaker currency. So that is definitely going to continue to be one of the big stories going forward.
John, we thank you so much for your time. That is BNN Bloomberg's John Ehrlichman from Toronto. Now, I want to bring you some breaking news outside of New York City. New York Governor Kathy Hochul plans to indefinitely delay New York City's congestion pricing plan, citing inflation and financial pressures. She said the state is exploring other funding options for the MTA. Of course, we know this was a plan that was set to begin June 30th. It would be the first of its kind in the United States, and it was expected to bring in $1 billion a year in a plan to modernize the more than 100-year-old transit system, and now is, of course, getting a significant roadblock when it comes to the state. Now, coming up next, we're going to talk about commercial real estate with commercial real estate developer Marianne Gilmartin on the risks and opportunities ahead as interest rates start to potentially cool further. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal.
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg. Context changes everything.
This is Bloomberg Markets, and I'm Shonali Bassick, and we're going to get to the commercial real estate market now, taking a look at property values changing over the past 12 months. Office bearing the brunt of the declines. No secret there. Marianne Gilmartin is the founder and CEO of MAG Partners, M-A-G, and has worked on projects from the New York Times building to Barclays Center. Bloomberg's Abigail Doolittle joins us here as well. You know, the first question is obviously about interest rates and how this might start to impact the sectors that have been the hardest hit.
The NASDAQ hits an intraday record high, last up around 1.3%.
Traders bidding the bond market into lower interest rate territory.
Sure. Well, it's a pleasure to be here. And, you know, rather than focus on where interest rates are going, whether we're entering a recession or a stagflation, I really prefer to focus on what we know. And what we know is that in a crisis, there's great opportunity. And we are seeing movements in interest rates. But in my business, which is ground up development, it's all about long-term value creation. And in long-term value creation, you really focus on the future, and interest rates are going to move. But we're confident that over the term, interest rates will settle down. When you're building a massive skyscraper, you're not thinking about what interest rates are today. You're trying to really get hold of land and opportunity and think about the next cycle, building through cycles, not into any one particular cycle.
So just last week, you had a topping out ceremony for two residential buildings here in New York City. Now, I've heard so many stories, Shonali and I have heard so many stories through these conversations about how the development situation here in New York City around multifamily and residential has really ground to a halt because of the tax abatement coming to an end, or the expiration of that, plus rates not knowing quite where they are. How did you manage to get that done?
Well, first, I'm fond of saying that building two ground-up residential buildings would be essentially another day at the office before all the disruption in the credit markets. I would say that it was harder to put these two buildings into the ground than it was to build Barclays Center, which was a 10-year crawl, 35 lawsuits, and really a decade of litigation and delay. And so at once, I thought it was the hardest thing I'd ever do in my career, and that multifamily, a sector that has been strong and really delivers as the gift that keeps on giving, would be so difficult to start two new buildings is quite extraordinary. And it's all about the credit markets and the crisis, and the fact that being able to land construction loans and capital partners in the last 18 months was near impossible.
How did you do that? Because when you were with Forest City, that was obviously a public company, so you just had money coming at you. But now a huge part of your job here at MAG is to raise capital. How did you get those loans done in such a tough environment?
First of all, world-class capital wants to be with folks that know how to deliver value in world-class markets, and that is earning our stripes. And I did that at Forest City, but I'd say that the last 18 months has proven it yet again. And it's about the quality of the sponsorship, the quality of the dirt. And so we have amazing locations, one on the Upper East Side and one in West Chelsea. When we talk about what's happening in the multifamily market today, vacancy rates are at 1.8%. This is a 50-year low. There just simply isn't enough housing. This week there was a lottery for affordable housing, 150,000 applications in 12 hours.
Yeah, that was amazing.
So there simply isn't, it is impossible to overbuild in this market. And because of that, high quality sponsorship, repeat performance with lenders like OZK, and capital that wants to be in New York and realizes that there is no better asset class than multifamily.
So curious about the capital story, because you mentioned OZK, regional lending here. Yes. And of course, the regional lending system has been pretty clogged up in the last 18 months, as you've been saying. So how do you encourage more capital into the system? Does it require more government assistance? Does it require more tax breaks? I mean, how do you encourage that money to flow in?
It's such a nuanced and great question. I'd start by saying we are seeing so many more non-traditional lenders. debt funds. We're seeing ways to access capital that previously weren't typical, particularly for construction loans. And so, for example, when we built Ruby, a 480-unit multifamily building in West Chelsea, which in the course of a single year, we leased up to 90% at $5 over the pro forma. We built that in the pandemic when everybody ran away from New York and conventional lenders had no interest in going to an investment committee meeting and putting forward a construction loan for a building in New York City. And yet, Madison stepped up. You know, they understand development. Josh Zegan looked at it and said, this is a bet on the future of New York. I've seen the obituary been written for New York many, many times over the course of my career, and we bet on the fact that the pandemic would be a moment in time, or maybe a very long period of time, but that people would come back to the city. And so we're looking at capital that is patient and focuses on long-term value creation, which is what development really is. Very little patience for this in the public markets. And debt funds and non-traditional lenders have really been an extremely effective source of capital for us.
Well, Josh Zegan is certainly a friend of ours.
Yes.
He joined us about a month ago and had some great commentary as well. Let's switch cities. Baltimore, you're partnered with Kevin Plank on a redevelopment down there. How did that come to be about, and what is it exactly?
So it started as a courtesy call where I was asked to go visit Kevin, who had amassed 235 acres of land south of 95 in Baltimore. Now, I knew about the aquarium, frankly, didn't know a lot about Baltimore. Went out to Baltimore to meet with him. It was completely taken by his commitment. There is nobody that flies Baltimore's flag better than Kevin Plank, who started his business there in 1996 by his own election. Didn't have to open the business there, didn't have to grow the business there. And when you think about great civic leaders like Dan Gilbert out of Detroit, this is what it often takes to lift a city up. And so I was intrigued by the partnership. Goldman Sachs, their urban investment fund, also backed Kevin Plank. And looking at the real estate, 14 million square feet. It's a master plan where you build what you want, when you want, where you want. In the world of a developer, that is not common in a great American city. So I'm betting big on Baltimore. Why? Because it has an unbelievable diverse and educated workforce. Obviously, beds and meds is a big part of that. The land is high quality. It's proximate to DC. With hybrid working, it's easy to get to New York. And so yes, it has its challenges, right? But I think all cities have its challenges. And New York is able to really draft in behind its history of being the greatest place to live in this country for many of us. But I think that Baltimore is going to see enormous growth and opportunity. It was just selected by the feds as a tech hub, and $4 billion of capital has been flowing into that city since I started taking a look at it 2 years ago.
Very curious. You know, you're clearly not afraid to get your hands dirty in tougher cities and tougher situations where a lot of investors have maybe left behind or are leaving the area in some cases. What other cities are you excited about right now?
So I have a thought that what we do is so focused on boots on the ground, it's very hard for me to imagine exporting my human capital because it's not very efficient and it takes a lot of tender care and feeding to build a building. And so to me, it has to be a train right away. And so the focus for us is the Mid-Atlantic, Northeast region, at least until we stood up an office somewhere else. And so we are a 30-year-old startup. We are a little engine that could. We are trying to do the kinds of things we did at scale at Forest City when we were with a public company, but I believe that in the private markets, the world of a ground-up developer is much more doable at the scale and the kind of dramatic change and positive impact that we want to bring.
Marianne, we thank you so much for your time here today. That is Marianne Gilmartin, the founder and CEO of MAG Partners, as well as Bloomberg's Abigail Doolittle, and certainly what has been the hot topic of the year. Another hot topic coming up, the NBA reportedly near a deal with multiple broadcasters to air games for $76 billion over the next decade. We're going to discuss sports and streaming up next. Stick with us. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
This is Bloomberg.
This is Bloomberg Markets, and I'm Shonali Basak. And a fresh report out today that the NBA is getting nearer to a deal to sell media rights to Amazon, Disney, and NBC for the next 11 years, worth up to $76 billion. Disney would retain the rights to air the finals and other games for some $2.6 billion per year, and the deal potentially leaves Warner Brother Discovery behind. Let's discuss this with Bloomberg's Randall Williams, because of course these deals don't come along all that often. Talk to us about the nuance here that we're seeing.
So ESPN gets the first package. The Wall Street Journal's the newest detail in the Wall Street Journal report is that they believe that the NBC is getting the second package, and then of course we have Amazon as the newcomer. Now the official details aren't yet final, but I expect that probably after the NBA Finals that Adam Silver is going to get up on a podium and say, hey, this is what's new.
Right. How soon is there pressure to announce that kind of right away after the finals? I
don't know that there's pressure. I think that this negotiating period went a little longer than what people expected it to. And that, in large part, that's because Warner Brothers Discovery is out, TNT's out. And so with a new partner in NBC, it just provides a little bit more, I'd say, you want to be careful around things. When you're welcoming a new partner and a one that you had that's a little older, it's just, you want to be careful.
And what does it mean for Warner? I mean, do they still have any stake in the game here, so to speak?
Well, they have one final season left. Inside the NBA, we'll get one last season. And unless, you know, Charles Barkley, he's talked about hiring his co-host as teammates and selling that to NBC. I don't know how interested NBC would be in that besides hiring their own talent. We're just going to have to wait and see. But if everything holds as is, this will be the final season of Inside the NBA and NBA on TNT.
Lot of money at play here, Randall. We thank you so much for keeping an eye on the whole story for us. That is Bloomberg's Randall Williams. Now, still ahead, a big win for hedge funds and private equity firms. A court had struck down SEC rules requiring certain disclosures. The details on that up next. This is Bloomberg.
look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
This is Bloomberg Markets. I'm Shonali Bassick. Let's get a check on these markets flying high today. You have the S&P 500 reaching new highs on the day, now up about 0.7%, and the NASDAQ 100 just resuming that gain, up almost 1.5% on the day. The two-year yield now about 4.74 on the day, only about 2 basis points or more lower on the day, and the 10-year yield still below that critical level of 4.30. We closed the day at 4.29, and perhaps we have some direction lower at that longer end of the curve, still almost 3 basis points lower on the day. Some midday movers on the equity side, HPE shares hitting a record high after the company reported better than expected revenue fueled by sales of servers built for AI. HPE's current backlog for AI systems is now $3.1 billion. More on that in just a minute. And we are watching shares of Alphabet after it named Eli Lilly executive as its next CFO for a replacement for Ruth Porat. Ashkenazi steps into a role at a pivotal moment for Alphabet as it works to get ahead of peers in the AI race, and Alphabet now up more than 0.3%. Of course, we know that was a highly watched role. Meanwhile, from public markets to the private markets, a federal appeals court struck down the SEC's rules requiring hedge funds and private equity firms to detail quarterly fees and expenses to investors. Bloomberg's Hema Parmar covers the hedge fund space closely, joins me now, knows all the inside baseball, and of course we know this one is something that the Managed Funds Association and others had fought heavily. Yes. How do they win?
Yeah, so this is a huge setback for the regulators, a big win for the industry. They've been pushing really hard for this. This rule essentially would have been cost expensive. It would have been very expensive. It would have been time consuming. And importantly, these funds are generically, very notorious for being private and for not disclosing things and not wanting to. So this would have meant that they would have had to have disclosed things about their fees and their expenses that they may not want to have.
Well, let's talk more about those fees and expenses here, because why is this such a closely held secret? How do these fees work? Why does the fund want to keep them secret in the first place?
Right. So hedge funds and private equity firms, they charge typically 2% of assets, 20% of gains, but there are other fees that are passed through to some of these investors. And hedge funds pass through things like compensation, which has been getting so much more expensive. It could be leases, it could be other sorts of travel expenses, and these things have been adding up, and they're becoming more popular. So you're seeing more funds use these sorts of pass-through fees for their clients, and you're seeing those costs really rise. But it's not always super clear what's being passed through, and it's not always super clear with the amount that is, how much is allocated to certain things.
And of course, the point that the Managed Funds Association was making here is that these are sophisticated investors, big boys and girls that can sit there and negotiate these fees in private funds. But the SEC, even though they were fought and really defeated on this one, it's not that they had been defeated in all cases. What is the SEC really been doing here to overhaul this massive private asset industry?
Right. So they've been making a big push to really increase transparency. This industry is known for being relatively opaque. And so they've been pushing to do a variety of different things. Some have worked out, some have not. Earlier, they imposed rules to limit the preferential treatment that some larger investors may get. If a fund wants to move something out of one fund into another, they've been asking that a independent auditor be needed to value those positions. They scrapped a fee that would have made it easier for investors to sue fund managers if performance was bad. But in general, you are seeing this massive push to increase transparency.
You win some, you lose some. Absolutely. Bloomberg's Hema Parmar, we thank you so much for keeping an eye on a complicated story for us. Another complication, New York Governor Kathy Hochul indefinitely suspending New York City's congestion pricing plan. Bloomberg's Michelle Kasky joins us with the details. And of course, not only did she announce this plan from the governor's office in New York, you also had New Jersey governor also coming out really praising Kathy Hochul's decision here. Michelle, what are the complications?
Yes, this was definitely a surprise today for everybody in the New York City area. Many drivers obviously are relieved by this, but the issues are that congestion pricing was supposed to ease traffic. The goal was to ease traffic in the central business district, which is Midtown Manhattan, and to improve air quality and to also raise money for New York City's transit system, which is more than 100 years old. So the question now is, how are you going to ease traffic, improve air quality, and also get the subway system and the buses and the public transportation the money it needs to have a much more modern, up-to-date system and to attract more riders?
You know, it's interesting here because this is a plan that was supposed to bring in $1 billion a year, Michelle, into the transit system in New York City. Without this plan, what plan is there?
Well, as of now, there isn't one. I mean, Hochul today said that she is currently working on alternative funding, but did not give details of that. So we'll see what she and other lawmakers come up with. We have been hearing that there's consideration of maybe some sort of a tax on New York City businesses. We'll see if that's what it's going to be. State lawmakers last year raised a payroll mobility tax on certain New York City businesses, not all, but some New York City businesses, to help get some money towards MTA, which is the authority that oversees the transit system. So we'll see if there's that appetite to raise taxes again on the business community.
Michelle, we thank you so much for your time and your coverage of a topic, of course, a big surprise coming out of the New York State Governor's Office. Now from New York to Texas. BlackRock and Citadel are among investors backing an upstart stock exchange, a stock market in Texas to challenge the New York Stock Exchange and NASDAQ. We're going to discuss this with Bloomberg's Julie Fine in Dallas. And of course, you've got to love the Dallas-New York competition here. Why are these large investors here looking to start up a newer exchange that rivals what you see in New York City?
Well, a lot of investors obviously talk about the business climate here in the state of Texas. Business, of course, is something that Governor Greg Abbott really goes after, and they find this an easy place to do business. So far, there has been $120 million raised for this upstart stock exchange. Now, it's not going to be doing business for a year or two as they gather money, but they do have big-name investors like BlackRock, like Citadel Securities, so therefore they feel they have a good seed to get going here.
Do we know anything about what this means for competition here? Because you think Citadel Securities, for example, one of the biggest market makers, particularly one of the designated market makers that people turn to on the New York Stock Exchange floor. BlackRock, of course, the largest asset manager in the world here. How do they think about this? Is this idea of Texas versus New York, or is it a little bit of we need more room to shine among everybody here?
Well, I mean, you've seen so many businesses move here. I mean, you talk about Goldman Sachs going here. So this has become somewhat of a financial center. This will be electronic, however, so you've got some time before this can get going. But I think they feel like this is a good opportunity for them to be able to do business. A lot of people feel that Texas has fewer regulations, which make it easier to do business. However, this obviously is an idea as of now. It has not even been filed with the SEC yet. So there's a lot of work to do. But again, with the money that they have to begin doing business, the investors do feel good about this.
Now, what are they really muscling in on here? To your point about this being electronic, that's pretty fascinating. You've seen these exchanges really fight off a lot of the treatment that they've gotten from New York, New Jersey when it comes to data information and taxes that they face. Are there consents that they might get in Texas that they might not have in New Jersey or New York?
Well, again, the paperwork has not been filed yet, so I believe that these companies do think it will, again, be easier to do business here electronically as well. I have been told that the governor has been involved with this for some time, so this is going to be no surprise to the government here. So it remains to be seen exactly what they will run into, but so far, again, these investors feel good about this decision.
Absolutely fascinating. Bloomberg's Julie Fine, we thank you so much for keeping an eye on this and, of course, giving us a view from the governor's office once again, as well as core Wall Street. Now, coming up next, we're going to talk about Hewlett-Packard Enterprises surging to a record high on strong AI server sales. We're going to get more on the company's blockbuster quarter next as it helps to fuel records in stocks. Stick with us. This is Bloomberg.
You have to distill down what is the purpose of what you do, what is the purpose of your company, and make that very clear, and repeat it and repeat it and repeat it. And it's very clear what our purpose is to make money for the Norwegian population.
So why did you accept the job? You had a great life. I mean, you had a hedge fund that was doing very well. You were earning lots of money.
Well, I had a great life. I had a great life, but I still have a great life, and a really good life. No, I was very keen on that job because one, I think it's one of the most important positions in asset management, right? I love asset management. In terms of the opportunity to develop that organization further, there were great opportunities, and I love organizational development. And then to do something nice for the country. I mean, these three things came together in the same job.
Why do you love asset management? Because you can influence and change the future, or is it being cleverer than anyone else?
Asset management is the most interesting job in the world, perhaps after being a journalist. Why is that? Well, everything you eat, drink, drive, all these kind of things is made by a company. You need to understand psychology in terms of the companies. You need to understand the corporate culture of companies. And then these things change all the time, right? You have the macroeconomy is changing, interest rates are changing, currencies are changing. And the data points are just changing all the time. You just couldn't invent a more fascinating game even if you tried.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
DOJ or other authorities
could face big
bigger challenge listens next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg Markets. I'm Shonali Bassick, and it's time now for the stock of the hour. We're looking at Hewlett-Packard and Hewlett-Packard Enterprises because it's trading now at a record high after the company beat revenue expectations thanks to servers built for artificial intelligence. Revenue jumped by 3.3% to $7.2 billion when Wall Street expected a 2% decline to $6.82 billion. Joining us with more is Bloomberg's Brody Ford, because what a surprise, because computers were the hot thing once upon a time, but now servers are the hot thing thanks to AI.
Servers, who would have thought they'd be an interesting growth business, but it turns out that on-prem is interesting again, right? And so the storyline we've seen is that Supermicro jumped, 200% this year. Dell did some similar order of magnitude. And everyone said, what about HPE? They make servers too. Are they going to get forgotten here? And then last night they surprisingly disclosed that, hey, we have a couple $100 million in this AI server revenue. And so they're starting to be taken seriously in this storyline as well, which is how we see this giant stock pop today.
Well, when you look at the pop today, this is a company that really split up when you think about Hewlett-Packard. How well did HPE do before this? What was the story, and how does today change the narrative around it?
Yeah, I mean, there was that 2015, breakups are always a little sad. No different with HP and HPE. They broke up. HP took the consumer stuff. HPE took the enterprises, networking. And they had been a bit of a sleepier company, right? I mean, they recently purchased Juniper Networks, saying that we're going to go all in on networking. We're going to really help be at the edges of cloud infrastructure, provide the hardware. But then there's this kind of new growth business that a lot of folks didn't predict a year and a half ago. So yeah, I would say that there are a lot more investor eyes on HPE today than there have been, at least for the last couple of years.
Now, when you think about the competition here, it's funny because you had Antonio Neri saying that he thinks the market will start waking up to this now. After today's announcement, they will understand even more. Do you think Wall Street is fully sold on the vision?
There's a little skepticism, right? I mean, they made some money here. There's no question about it, but the backlog is not growing at the same rate as Dell's is. One thing they have going for them is that the margins appear to be a little higher. Dell lost a lot of their market value about a week ago because some analysts said, wait a second, the margins on these AI servers appear to be very low because NVIDIA charges a lot of money for these chips. HPE managed to cut their expenses to an extent that the margins were decent, so they have that going. But I'd say they're still probably third in this.
Fascinating, Brody. Want to walk with you through a server farm one day. Apparently, it's the hot thing to do. Bloomberg's Brody Ford keeping an eye on what's been a surprising story for many people today. Now, coming up, we're going to speak to deal maker Jim Langston on the M&A outlook and his new role at Paul Weiss, of course, one of the top M&A advisors in the country. We're going to talk about the rebound and the merger boom next. This is Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. The world has very few
experts in C++ and C. But the world has many people who knows how to converse and ask somebody for help. Instead of instruction-driven computing, it's now intention-driven computing.
You know, this AI opportunity is really tremendous. You have an ecosystem of companies coming together along with all these incredible innovations. It's causing a new industrial revolution.
This is a tsunami, Ed. This is a tsunami of change. And only the smart ones are going to recognize I have to plant the flag now.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg Markets, and I'm Shonali Bassick. It's time now for the Wall Street Beat. And we're joined by dealmaker Jim Langston. He's the partner at Paul, Weiss, Rifkind, Wharton, and Garrison. All those legal names. Those past clients include Goldman Sachs, Starbucks, and General Mills. We are also joined by Bloomberg's Michelle Davis, who's senior correspondent on Bloomberg Deals. And of course, we're joined by both of you at a time where deals are finally coming back. Before we get to all the limitations, because we know there are some, perhaps talk to us about what you're seeing in conversations with your clients.
So M&A, we think the stars are aligning for it to be a busy year, the second half of the year and beyond. Confidence is returning to boardrooms, to C-suites. Companies are willing to make big, bold bets on M&A. The private equity market hasn't been as active, but we feel like that is going to be unlocked so we get greater certainty on interest rates, and private equity pulls additional levers to achieve exits.
There is obviously an election coming up this year, as you may have heard, and I know you're expecting, a pickup in activity. I'm curious what your advice is to clients who may be worried about their deal getting caught up in the rhetoric. Is there advice around avoiding deals that might be too controversial or high profile? What's the election, impact to M&A?
Yeah, so you have to separate the noise from the reality, right? We're in election year, everything gets politicized. M&A is no exception. There's been a lot of headlines around antitrust, that's stopping deals, chilling activity. But the bottom line is that deals that were getting done in the past can still get done today. So if the deal makes strategic sense, and it's a deal that could get done, you should go for it, right? But what you have to have is a plan, a strategy. You can't wait for the noise to surround the deal. You can't wait for a congressman, a senator, the White House, a state to take a shot at the deal. You have to be prepared and control the narrative and have a way to get the deal done and then sell that to the shareholders.
I'm pretty sure we're going to want to talk more about antitrust as well, but another big blockage has been this concern around foreign buyers. You think of what happened with Nippon Steel, for example, in the Biden administration. How does the tone around cross-border M&A change as the election cycle progresses?
I think this is what I said. Everything gets more politicized. That deal is an example of it. It's a challenging environment for cross-border M&A, right? The geopolitical battle lines are hardening, nationalistic, protectionist impulses are intensifying, and companies want to invest closer to home rather than abroad. And you look at the U.S., the growth in the U.S. relative to the rest of the Western world, the deepness of the capital markets has really been a beacon to M&A in the U.S. and Europeans that are trying to enhance their growth profile. So when you put all that together, it's harder to get a global cross-border deal done today than has been in the past.
So Jim, I was at an event this morning on M&A, and the head of banking at JP Morgan, the head of M&A, said that she's noticed there was a pickup in unsolicited M&A last year. It reached a 10-year high. Is that something you're noticing on your end as well? Absolutely.
The number of letters landing in boardrooms on an unsolicited basis is up. And it goes back to this confidence theme that we talked about earlier, right? Companies are more confident. they're willing to reach for their M&A hopes and dreams, and realizing that you can't just wait for a company to go on the auction block. If you have a deal, you want to pursue it, it's part of your broader strategy, you have conviction around it, sometimes you have to take matters into your own hands. So we think there's going to be more of that for the rest of the year.
It's pretty fascinating to see people with, the green light on everywhere you go, slowly starting to really come back to the surface. It sounds like that confidence has come back despite some of the headwinds we've been talking about. So if you think about that confidence moving into the rest of the year, do you think it can be firmly planted within the world of private equity, given what you were saying about the muted nature of the deals we've been seeing?
I think we're about to turn a corner and get into the early stage of a private M&A super cycle, right? Those investors have been on the sidelines for 18 plus months now.
Couldn't happen fast enough.
It couldn't happen fast enough. Their LPs are clamoring for them to return capital. The dry powder remains at a high water mark. They need to invest, and debt markets are more constructive now than they have been at any point of the year. And there's creative structures available, structured equity, rollovers. I think we're going to see more rollover equity in take privates. And so that M&A activity, we think, is going to beget more M&A activity on the private equity side.
Can you talk to us a little bit about antitrust? I know there's been a narrative that antitrust scrutiny has been chilling deals, but recently we've been hearing about bigger and bigger deals, even seeing, bigger deals attempted, like BHP going after Anglo. What are you seeing? Are companies emboldened now, or are they still worried?
Absolutely. I mean, bigger deals have a bigger target on their back, but you have to be prepared to fight fire with fire, as we talked about earlier, to have a strategy to actually get the deal cleared. But I think companies have gotten used to this heightened antitrust environment, or looking at it and said there's noise and reality. And the truth of the matter is lots of deals are still getting done. So if you have a deal that would have gotten done in the past, despite all the noise, it can still get done today. There's going to be more twists and turns in the process. You have to be prepared to be in the process for a lot longer, or maybe a little bit longer than you had in the past. But at the end of the day, the result should still be the same.
Okay, it's game time. It's almost halfway through the year. The largest deal we've seen is $30-some billion. Do you see something even larger than that? Do you think that there are companies out there that are willing to kind of fight the antitrust storm here and say we are willing to go mega?
Yeah, I mean, mega M&A deals has been a big trend of this year, right? I mean, you look how the year started off with the Synopsys Ansys deal, right? A large tech transaction. You look at the mega deals in the oil patch in pharma, and we think that that's going to continue for the rest of the year, particularly as there's certainty around the election outcome, and people realize that you have to, standing still is not a viable business strategy, right? There's a first mover advantage. And so if there's going to be M&A and consolidation in your sector, it's better to be the first mover than the last mover.
We only have about 30 seconds left here, but Michelle, what are you hearing as well?
It sounds like a lot of the same things are being discussed among, other deal makers. Just people are expecting a big pickup. The mood everyone describes as cautiously optimistic, definitely way better than last year when folks were depressed because their deals were falling apart at the finish line. But yeah, I mean, in a couple words, how would you describe the mood?
I would say it's gone from cautious optimism to more optimism.
Game time. It's halftime. Anything could happen. That is Paul Weiss's Jim Langston and Bloomberg's Michelle Davis. We thank you both for your time. I'm Sonali Basak. That does it for Bloomberg Markets on the day. Remember, we are at all-time highs today. We are shaking off that fear at the beginning of the weekend. We are rolling into fresh highs for the S&P and the NASDAQ 100. Bid in that bond market, too. Stick with us through the close. It's an interesting day. This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
It's the summer of scare tactics, at least says one Republican senator. With a vote today on protecting contraception, one of a series of messaging bills we've been following here on the fastest show in politics. Welcome. I'm Joe Matthew alongside Kaylee Lines in Washington, and it seems we're getting one of these a day, although this is specific, Kaylee, to reproductive rights and one of the biggest issues on the campaign trail.
Yeah, the Right to Contraception Act is what the Senate is going to try to pass today. The issue is it needs 60 votes to do so, and it's unclear whether any Republicans are going to get on board with, as you suggested, Joe, is something that is largely a messaging bill, an attempt by Democrats to get Republicans on the record on an issue that pertains to reproductive health, because we know this is a problem area for the GOP in this election year.
You could argue a messaging bill yesterday in the House to sanction the ICC for trying to arrest Benjamin Netanyahu. And it kind of brings us back to this greater issue, Kaylee, in a world in which probably not a lot's going to get done the rest of this Congress.
Yeah, of course, funding's already done. They got the supplemental aid for U.S. allies passed. Therefore, we might be waiting until the lame duck session after the election for any real legislative work to continue. Although there is a funding deadline on September 30th, and they're going to have to either kick the can or actually do some work between now and then to keep the government open. But
start placing your bets now.
Probably a problem for another week. Let's get an update on trading now. Charlie Pellet is up in New York with a look at the markets. Hey, Charlie.
And good day to you both. A lot of green on the screen right here. In fact, the S&P 500 index is set for its 25th record this year. We are trading above the old record of 53.21. NVIDIA leading a rally in mega caps. Apple up for an 8th consecutive session. Here's where we stand. S&P at 53.34. Up 42 now, up 0.8%. The Dow little changed, up less than 0.1%. Higher by 14 right now. NASDAQ ripping higher by 255 points, up 1.5%. World's largest tech companies driving stocks toward records. Right now, the 10-year's yielding 4.29% with a 2-year, 4.73%. Spot gold up 1.1%, 23.52 the ounce. West Texas Intermediate crude up 1.1%, 74.03 a barrel. I mentioned big tech giving stocks a lift. Case in point, Hewlett-Packard Enterprise after earnings up now by 12.9%. CrowdStrike after earnings up now by 10%. So again, recapping, we've got a tech-fueled rally underway right now. NASDAQ up 1.5%. S&P higher by 0.8%. Balance of Power continues now. Lots going on. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lines.
All right, Charlie Pellet, thank you. I have to say, here in Washington, we're still paying a lot of attention to what's happening up in New York, because big news from Governor Kathy Hochul today, Joe.
Yeah, no doubt.
Indefinitely postponing the congestion pricing tax that was set to go into effect at the end of this month.
That's right.
Obviously was going to raise a ton of money, funnel it towards transit. Climate activists were happy about it, and yet it also could have had some negative political implications potentially for, say, vulnerable Democrats in the state of New York. And I wonder how that factored into this decision.
Look, there's some reporting on this. Politico says that the call came from Washington, potentially in a world where pricing is the number one issue. And for Democrats, you have this deal with a lawsuit already in place from the state of New Jersey. Maybe not a great look when you're trying to win a Democratic majority in the House. Whether Hakeem Jeffries was directly involved, not something that we can verify. But there's a lot of messaging coming out of the House right now and the Senate, as we discussed earlier. And that's why it's good to have Megan Scully with us. Edits our congressional coverage here in Washington, D.C. I guess just pick your issue or pick your day, pick your chamber, pick your party. Everyone has a message to send now.
Absolutely, and we're seeing it in both chambers. This week it seems to be a lot of social issues, whether it's on spending bills in the House or on votes on contraception and IVF and whatnot that are planned in the Senate.
Well, on the contraception, the Right to Contraception Act is what the Senate is going to be voting on today. Is it likely that it will pass, or Republicans are going to not vote for it and say that it was all just, election year gimmicks on the part of Democrats, even if it could hurt them being on the record voting against access to contraception?
I think we're going to see it probably not getting the 60 votes necessary. Even if it were to, it would not pass in the House. This bill isn't going anywhere. It's a pure messaging bill, and it's something we're going to see more and more of in both chambers. Chuck Schumer himself has said they plan several votes over the next several weeks, specifically targeting these issues.
Messaging comes in a lot of different forms. You could hold a hearing, too, and we see a lot of those. That's kind of been a full-time occupation for the Judiciary Committee and for the Oversight Committee, whether it's Hunter Biden we're talking about. In the case of this week, Merrick Garland, which was kind of the most recent example of a hearing moving far away from what its intended purpose originally was, just so we could browbeat a member of the administration. So we're not making laws, we're making commercials.
Absolutely. You're seeing campaigning essentially move to Capitol Hill, even though technically they're not supposed to be campaigning from the Capitol. This happens every cycle. This year, given the stakes with the presidential election year and both chambers in play, we're seeing it a little earlier than usual, I think.
Well, given that it is an election year, it also raises the question around the funding battle to come, considering September 30th is the end of the fiscal year, the deadline to fund the government for the next one that comes 5 weeks out from Election Day, so everybody assumes that the can will be kicked down the road, and yet we are seeing the House, as you suggested earlier, trying to move today on at least one appropriations bill. Should we take this as a sign that they're getting ahead on their work, or they're just starting what could be a very bitter partisan fight early?
I would say starting a bitter partisan fight early. The bill that passed the House today, the Military Construction and Veterans Affairs bill, is the least contentious of all of the spending bills. It's usually the bill that they use as the engine to push other spending bills through. And it is locked in a bitter partisan debate. The White House has threatened to veto it because it cuts military construction spending. It also has language in it, policy language, strongly opposed by Democrats to really restrict diversity and inclusion efforts. It would ban any gender-affirming care or taxpayer dollars being used for gender-affirming care at the VA, and a litany of other things that Democrats really oppose, but that Republicans can use to sell to their base.
The word from Katie Britt was the scary summer. Let me get it. The summer of scare tactics and a campaign of fear-mongering, she called this vote today on contraception. But that's essentially what we're hearing from both parties. They seem to agree on that.
Yes. I mean, they're both equally
messaging.
Yes, they're both equally using their majorities in each chamber to send these messages, to really mobilize their base and to use this for fundraising. We saw last week with Trump's conviction and how Republicans were actually both sides were able to mobilize quickly on that, to rally their bases, to raise money. And we're going to see that on all of these very high-profile bills that are not going to become law.
So much to look forward to. Bloomberg's Megan Scully, who leads our congressional coverage. Thank you so much. And of course, Joe, you brought this up with Megan just a moment ago. The pretty contentious hearing we saw in the House Judiciary Committee yesterday when the Attorney General Merrick Garland was testifying in exchanges that sometimes got pretty fiery, including this one with Republican Congressman from Florida, Matt Gaetz.
Our concern is that the facts and the law aren't being followed. A target is acquired. Here, Trump.
I'm sorry, I don't agree with anything you just said, but I'm not going to comment on it.
Okay, so you won't comment on it, Mr. Attorney General, but you had no problem dispatching Matthew Colangelo. Who's Matthew Colangelo?
That is false. I did not dispatch Matthew Colangelo.
Matthew Colangelo.
For more reaction to what we saw yesterday and what we continually see in terms of messaging from Capitol Hill, I'm pleased to say former Congressman Denver Riggleman is with us, of course, former Republican from Virginia. Welcome back to Balance of Power, sir. Great to have you back on Bloomberg TV and radio. Whether it is what went down in the Judiciary Committee yesterday with Merrick Garland in the hot seat, or just what we have heard over the course of the last almost week from congressional Republicans in the aftermath of Donald Trump's guilty verdict in New York last week, what do you make of it all?
I think, by the way, thanks for having me on again. It's always great to be here with you all. I think when they saw the polling after Trump's conviction, I think you're seeing some panic, especially from the questions. And what you see from people like Matt Gaetz, from Marjorie Taylor Greene, is really not just panic. It's just throwing out as much, it's almost like throwing out as much opaque disinformation or just asking questions, which is what they always say, in order to get talking points for their own fundraising, to make sure that they keep President Trump happy at Mar-a-Lago, and it really has nothing to do with facts. The issue is a lot of the American public can't discern between facts and fiction when you actually have leaders of the free world, congressional representatives, putting that kind of stuff out. But I think what you're seeing really is panic questioning and panic screaming going on from a lot of the far right, especially those close to Trump and Mar-a-Lago. And that's what I make of it, because that's what they do, right? You're messaging to your constituency, not necessarily, to the American public at large.
Well, I'll tell you, Denver, it's good to have you back. While we're talking specifically about this Merrick Garland hearing yesterday, Andy Biggs, Chip Roy, Tom Massey, 3 members of the Freedom Caucus, sent Merrick Garland a letter about January 6th. I brought this up yesterday. I don't mean to belabor it, but you were deeply involved in the investigation into the January 6th riots. And they said in this letter that they wanted to explore the FBI's possible involvement in facilitating the events of January 6th. The involvement in facilitating the sacking of the U.S. Capitol. We've heard this from certain members of Congress before, that there were unmarked vans, that there were FBI agents in the crowd trying to stir all of this up. But this is now going to be on the record from this hearing, Denver. What do you do with that?
I think you do exactly what you should do as a sane, rational human, is you destroy them with facts and data. And the facts and data are this. Did they read the over 1,000 charging documents? Have they actually read the sentencing guidelines? Have they seen the evidence? Do they know the number of weapons that were there? Are they really going to go down this QAnon rabbit hole of a deep state, globalist, false flag, which is exactly what they're inferring, because they're talking to a base that's breathless with this kind of belief systems. This is a religion now. I would say that, when you're talking about J6, when you're talking about QAnon, I think what they're trying to do is they're trying to make J6 people into veterans of some kind of political war where they were on the right side of history. And a lot of that has to do with making Donald Trump happy. This all goes back to Mar-a-Lago. It all goes back to their fundraising. It goes back to their polling. It goes back to cynicism. And the very fact, either they're deliberately obtuse, either they're stupid, right, or they're cynical. Right, and all that is not good for the American public. But the fact that they're going down the conspiracy theory rabbit hole in 2024 when everything has been debunked and it's absolutely ludicrous, maybe they're watching Skinwalker Ranch too much. I think maybe that's where we're at right now as far as these congressional representatives.
But it's not just members of Congress, Denver. You also have former President Trump repeatedly referring to those who've been incarcerated because of their involvement in January 6th as hostages. Especially considering this happened 3.5 years ago, and we are still relitigating the events surrounding it. What exactly happened? Who was involved? Who was at fault? And this is still an ongoing live conversation, and Donald Trump uses language like that still to this day repeatedly. Is it too late at this point? We're too far gone for the truth to really permeate?
Yeah, it's a great question. A lot of this is already baked in, and I've been telling people this, and we've talked before. The best question, right, is the fact is that people believe that J6 was some peaceful tourist thing that a couple people got out of hand. I don't know how we turn that, regardless of evidence, right? And what Trump is saying to his supporters and what his congressional sycophants are saying is, don't believe your lying eyes, believe us. You got to remember, too, is Donald Trump's the same guy who retweeted that, Obama and Biden killed SEAL Team 6. I mean, this isn't a guy, he's either, again, completely cynical and know he's lying, an incredible grifter of disinformation, or he's fairly ignorant, right? He definitely has, he's one piece of wood shy of a cord, right? I mean, that's the only way that you can look at this. And I think, again, we have to be brutally honest about what we're seeing. Is we're seeing disinformation and conspiracy theories being propagated from the former president of the United States all the way down to congressional members and to leaders of the Republican Party.
Well, it's interesting, Denver, you hear this line, you take people at their word, believe people when they show you who they are. Donald Trump was talking to Newsmax and floated the possibility of imprisoning his political opponents if he becomes president again. This is not new. He said not that long ago, it was in June, I will appoint a real special prosecutor to go after the most corrupt president in the history of America, Joe Biden. Do you take him at his word?
Yes. I mean, he likes to do what he says. A lot of it's ridiculous and it's half-baked. I think what you're going to see the difference, though, between 2016 and 2024, if, Donald Trump is to win, is that the cabinet he picks, he's going to value loyalty over any type of competency. And I think that's what should worry individuals, is that if anybody like the Kash Patels or Rick Rennells or Mike Flynn's are in the conversation for being on the cabinet, that's a real issue. Or the Matt Gaetzes, right, which has been in the conversation. I mean, you have really some of the least talented individuals to ever serve in the American government that would actually be in there, and also completely under the thumb of Donald Trump and his sycophants, right? And you see the RNC's already bought by it. So, believe in what they say. How about this, though? And I'm going to ask you all this, too, and I know you're asking me questions. I'm sorry, but, somebody who even says that and doesn't mean it, what's wrong with them, right? Is that a joke? Right? And that's the thing, too, is that you're saying, well, do you believe him? Yes. But if he's just spouting BS, why would somebody who actually held the highest, office in the land be saying that anyway? It's irresponsible, and it goes to his judgment and maybe his advanced age, and maybe he's losing something upstairs.
That's the knock, Kaylee, that you hear, or the response that you hear. It's either locker room talk or he's joking around.
Shortly expecting the results of the Fed reverse repo operation.
Isn't that the line we used to hear?
Yeah,
That's
repeatedly.
what we always
Denver, do you have more on that?
No, exactly right. No, I was just listening to you, and that's exactly right. I mean, you're on it, right? Then they'll say, well, he's just joking. Goodness gracious. They say the worst, most awful, horrible things that goes after the very structures of our American institutions and government, and then somehow it's a joke. It's the same thing that the incels pull. It's the same thing that QAnon conspiracy theorists pull. It's just the same thing, and it's just the same people doing the same thing and pushing the same message every day.
Well, and one of those messages is the unfairness of the U.S. justice system, the idea that it's being weaponized against Donald Trump specifically, and yet
76 counterparties take $371.841 billion at the Fed reverse repo operation.
Quite well, but especially given what we have seen, the panic you were describing in the aftermath of Trump's guilty verdict. What happens if A, Hunter Biden is convicted of these federal gun crimes with which he's charged, or if he's not, if he's found innocent? Does that just make all of this worse?
I mentioned this a little bit yesterday, and again, it's pretty interesting. What if he's convicted and goes to jail? What if he's convicted and gets probation? What if he's convicted and gets community service? What if he's convicted and gets counseling? What if he's not convicted? All these things, I think, have different levels of response. What's going to be very difficult for any Trump apologist or messaging if Biden is convicted at all, number one. Wow. That's, it's going to take away a huge talking point. And I think, by the way, if we can go full circle, I think that's why they're going after Merrick Garland. They need another target because the Biden impeachment stuff is over. It's been proven completely ridiculous. All the laptop stuff's gone. Right. So now what you have right now is that they're trying to actually latch onto something. But if Hunter is actually convicted of this gun charge, and you have to let law and order take its course, right? And President Joe Biden said that too. If he's convicted of this and gets probation, and it's pretty dire, I think it's going to be very difficult for any of the MAGA types to actually go after it. If he gets jail time, which would be very unfortunate based on his addiction and this gun charge, that would be something. But you know what I find amazing is that the Lindsey Grahams and people like that are starting to come out saying, why are they actually going after him based on this gun charge, where I think it's just so little people have actually been actually prosecuted for this. So I think you're seeing a real issue here. Hunter could be found guilty. If he gets probation or jail time, I think it's going to be very difficult for the Trump acolytes to actually play what's going on with Trump in a good way. But if he's innocent, I think then you're going to see conspiracy theory screaming happening at the top of everybody's lungs. I mean, hair on fire ridiculousness.
Come back and see us when we get a verdict. Denver, it's good to see you. Denver,
I'd love to talk
former
about
Republican congressman from Virginia. It's always a pleasure to get you back on Bloomberg TV and radio. Never a dull moment, Kaylee, even when we're not making laws in Washington. I think we've learned here today.
Yeah, absolutely. Messaging bills.
That's correct. With a lot more where those came from. Stay with us on the fastest show in politics. We'll assemble the panel next. Ginny Shanzano, Lisa Camusa Miller with us today, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The top names at the Fed are on Bloomberg.
The way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced.
I do think that our new steady state is likely to be higher than what people have known over the last decade. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question. That's a question I get all night.
Bloomberg. Top experts. Great questions.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
We'll have to build a portfolio of interventions. Lifestyle will also play into for some of them, and I think we can help many patients get down to a weight that they can maintain and live the life they want to live and avoid many comorbidities for the healthcare systems.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all advancing. Could see records today. S&P 500 on track for its 25th record this year. as NVIDIA leads a rally in mega caps. NVIDIA right now up 3.7%. Apple up for an 8th consecutive session, its longest winning streak since March of 2022. But right now we've got the Dow Jones Industrial Average just turning negative, lower now by 15 points, down less than 0.1%, little changed. The S&P up 39, gain there of 0.7%. NASDAQ Composite Index higher now by 244 points, up 1.5%. 10-year 4.30% with a 2-year that's now yielding 4.74%. Spot gold up 1.1%, 23.53 the ounce. And West Texas Intermediate crude up 1.3%, 74.17 for a barrel of WTI. The discount retailer Dollar Tree is reviewing options for its troubled Family Dollar business, including a potential sale or a spinoff. Dollar Tree, they're down now by 4.2%. So again, recapping, S&P 500 on track for a record, up 40 points right now to 53.32, a gain of 0.8%. Balance of Power continues now. Back we go to Washington, and once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet up in New York, thank you so much. I'm Kaylee Lyons alongside Joe Matthew here in Washington, where up until last Thursday, we were all captivated by the proceedings in New York of the first ever criminal trial of a former president. And of course, it was on Thursday that Donald Trump was found guilty of 34 felony counts of falsifying business records. We know very well how Donald Trump feels about this conviction. He plans to appeal it. He maintains his innocence of these crimes and also continually suggests that this is a persecution, a political persecution, that the justice system is being weaponized against him. And it raises the question whether he would look to potentially weaponize it in return if he does indeed win another go at the White House come November. He was asked a question about this in an interview on Newsmax yesterday, and this was his response.
Nobody wanted to bring it until I decided to run, and then was beating everybody by a lot, and then was beating Biden by a lot in the polls. But, you know, it's a very terrible thing. It's a terrible precedent for our country. Does that mean the next president does it to them? That's really the question.
He said more than that. That's really the question. It's very possible that it's going to have to happen to them. And this is not new, Kaylee. The former president already said in the wake of the documents case being announced, quote, "I will appoint a real special prosecutor to go after the most corrupt president in the history of America, Joe Biden, and go after the Biden crime family," unquote, tying in Hunter Biden as well into the conversation. As we assemble our panel for their take on this and some of the other stories we're following, Jeannie Shanzano, Bloomberg Politics contributor and senior democracy fellow with the Center for the Study of the Presidency and Congress, joined today by Lisa Camuso-Miller, Republican strategist, former communications director at the RNC, host of the Friday Reporter podcast. I guess we get back to a question I already asked Denver Riggleman earlier this hour, Lisa. Do you actually take Donald Trump at his word?
I absolutely do. I thought Denver's comments about the former president were absolutely spot on. I thought that he was right. I think that it's a calculated mistake that members have made and Republicans have made over and over again to not accept him and not take him for his word. If you and I remember, the four of us probably were on just months ago talking about the fact that the reason why people were speculating that Donald Trump got into the race as early as he did was because he was already anticipating that there were going to be charges brought against him, and he was seeing that as an opportunity to perhaps make sure that some of that didn't happen to him. And now, of course, it has. And he's changing history just like he always is. He changes the rules and he changes the sort of the facts to his own benefit. So, yes, I think we should accept him for his word, at his word. And I think that it's the challenge that I think Republicans are going to have to make over and over again about how much they defend what he has to say, because he keeps saying these things that are concerning and that are worrisome. The American people don't want more investigations. What they want is for the American electeds to get back to work and to help them with the issues that they are elected to fix, right? And so this just becomes another back and forth between Donald Trump and Joe Biden, and it's going to continue to go on. As I mentioned earlier in the broadcast, is that this is the kind of election that we're going to see over and over again, the back and forth, and Donald Trump creating sort of these stories that are going to be ones that we have to respond to.
Well, Jeannie, when we consider the prospects of this actually happening, should Donald Trump win in November, isn't this just as much about who he surrounds himself with, who would be leading Donald Trump's Department of Justice as Attorney General?
Absolutely. And he said that. He said you get the right person in there. He equated it to getting the right builder, the right contractor in place. You can do great things, he said. And so this is another one of those norms that Donald Trump has said that he will break if he goes back to the White House. And when you think about it, this is not just Donald Trump, and I want to stress that. You are hearing it all throughout his base, from Steve Bannon, who is a big voice for Donald Trump's base, who are talking about prosecuting and jailing Alvin Bragg, the Manhattan DA. You're also hearing calls for Republican, red state public officials, DAs, if you will, to start charging Democratic public officials. So this is a real possibility, and I would just stress it is much, much bigger than Donald Trump, although he is certainly the leader at this point in terms of this movement.
Yeah, Jeannie, referring to comments from Steve Bannon, talking with Axios, Kaylee, pretty remarkable here, about Manhattan District Attorney Alvin Bragg. The quote, "Of course Bragg should be and will be jailed," he said in this interview, pointing to the 14th Amendment equal protection, the 4th Amendment outlawing unreasonable searches and seizures, plus, quote, scores of other laws. Jeannie, should the Manhattan DA prepare to go to jail if Donald Trump's elected?
I hope not. I have big questions and challenges with the prosecution, but, that is not the response. But this is the reality we are living in, and you're hearing this. And the fact is, Steve Bannon has a big microphone, as do so many other people who are making these cases. I will just point to the head of the Federalists, for instance, who has made similarly really upsetting and frustrating comments. And so I think people have to think about this as they go to the ballot box and have a choice that many Americans aren't happy about between Biden and Trump.
Well, and one of the reasons many Americans aren't happy about those choices is because the majority of them both think these candidates are simply too old. But that seems to be a problem much larger for Joe Biden, who is 81. And perhaps that problem exacerbated by reporting today in the Wall Street Journal, the headline reading, "Behind closed doors, Biden shows signs of slipping." Now, in the contents of the article, while they detail a number of meetings that happened at the White House, characterizations largely from Republicans about how those went down, it does say most of those who said Biden performed poorly were Republicans, though some Democrats said he showed his age in several of the exchanges. So, Lisa, we have to consider that there are caveats in this reporting. Even Nancy Pelosi, the Speaker Emerita, suggested a number of Democrats spent time with the Wall Street Journal and did not have their views adequately expressed. But isn't this damaging nonetheless?
It's absolutely damaging, but this is the Wall Street Journal, which to me is another sort of outreach and another sort of voice that people look to for Republican points of view, regardless of how you feel about the Journal or how you feel about the ownership of the Journal. It is one of those things that people are starting to say maybe that's a little bit irresponsible for them to have talked about that and not necessarily about how his administration is governing. But there's other questions about all of this, right? I mean, we have to consider the fact that people are starting to think about either one of these candidates. I think the reality is that either one of these candidates stands a chance of not making it through the next 4 years. And that means we have to consider who is their vice president and who is underneath them and who is working with them in their cabinet. And those kinds of things are even unknown on the Republican side at this point.
Well, it is interesting here, as the article notes itself, quote, "Most of those who said Biden performed poorly were Republicans," unquote. The White House, Jeannie, with a statement calling the claims, quote, "false and politically motivated." But does it matter? Or is this welcome to the NFL?
It's campaign season. I think that the Journal can be questioned for only quoting Republicans, sure. The White House and others are trying to spin this as a political hit job. But I would just suggest that you look at those two reporters, those two journalists. There is nothing about their past work that suggests a political hit job.
Putin says we aren't able to find a solution in relations with the EU.
And I have a lot of respect for both of them. The fact is that Wall Street Journal is not alone today. There is also a transcript out from a Time magazine interview the president did, which is raising big, big questions amongst people. And you can criticize the Biden team and Joe Biden for not being accessible to the press to the extent that they should, which is helping fuel these problems. So, you know, I am not sure. I think all of the Democratic pushback on this, I really raised questions about. Just yesterday, the House was talking about release the Her interview. Why not? I still don't understand why not release it. It suggests that it is that bad. So I think the White House is walking into this. I am not suggesting there's truth to the fact of what people are saying about Joe Biden, but please make yourself more accessible. It makes the debate much more important. Talk to the press. You are president of the United States. You've done very good things. And the American public deserve that because, quite frankly, you're in your 80s running for president and asking for another 4 years. So I just mostly want to say that those journalists have my respect. And this is something that I have a problem with, the attacks on the journalists in particular.
Very well said. Jeannie Shanzano, thank you so much for joining us alongside Lisa Camuso-Miller today, our wonderful political panel. Great to have both of you. And of course, Joe, we should point out, Jeannie's in New York. Lisa's from New Jersey. There's been a lot of news in that region today as Kathy Hochul pauses the congestion tax.
That's right. They had the gantries already up there.
Yeah.
It's supposed to start June 30th. Now it's an indefinite wait. What are the chances this might be scheduled for after November, I wonder?
It's an excellent question as we consider the implications for all of the incumbent representatives in the state of New York. That's something we'll continue to explore for you here on Bloomberg TV and radio. First, though, let's get an update on world and national news. Amy Morris has that for in the 99 newsroom here in Washington. Hey, Amy.
Hey, Kayleen, you're absolutely right. This is what everybody's talking about. Those tolling gantries are in place. The congestion pricing set to begin in New York City on June 30th, but New York Governor Kathy Hochul has delayed implementing the plan indefinitely. It would have been the first system in the whole country designed to charge motorists who are driving into the city, raising money to improve the mass transit system. U.S. veterans who stormed the beaches of Normandy are in France for the 80th anniversary of D-Day tomorrow. Many of the veterans are now more than 100 years old. Ceremonies are planned to mark the 80th anniversary of the important World War II turning point. President Biden is there, too. He'll be among the world leaders in France to attend those ceremonies. He arrived in France today for a 4-day visit, including those ceremonies, a meeting with France President Emmanuel Macron and Ukraine President Vladimir Zelensky. And testimony is underway in Hunter Biden's gun trial. Cross-examination of an FBI agent questioned about messages that he sent around the time of the gun purchase in question. Prosecutors say the president's son had a drug problem that was ongoing when he lied on a form to buy the firearm. Hunter Biden says he's being unfairly targeted by the Justice Department. Global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
So what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you...
I had actually run tech banking and took Google Public, so I had a little sneak preview.
The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg. Context changes everything.
Good morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow Jones Industrial Average back in the green. S&P, NASDAQ both moving higher. S&P on track for its 25th record this year. NVIDIA leading a rally in mega caps. Apple shares are gaining, up for an 8th consecutive session. Right now, the S&P's up 47, up 0.9%. Dow Industrials higher by 32, up 0.1%. While the NASDAQ Composite Index is up 282 points now, surging by 1.7%. 10-year yield at 4.29% now, with the 10-year at 4.74%. Gold up 1.1%, 23.53 the ounce. West Texas Intermediate crude oil up 1.1%, 74.08 a barrel. And Bitcoin up 1.5%, 71,511 now on Bitcoin. Alphabet has named Anat Ashkenazi as its new chief financial officer, replacing Ruth Porat, who announced last year she would be stepping down from the role. Ashkenazi is a former CFO and executive vice president at Eli Lilly, where she worked for more than 23 years. Alphabet shares, they're up now by about 0.7%. Again, recapping, tech rally underway, S&P up 0.9, NASDAQ up by 1.7%. Balance of Power continues now. Back we go to Washington, and once again, here are your hosts, Joe Matthew and Kaylee Lyons.
Charlie Pellet, thank you as always, and thank you for being with us here on Bloomberg TV and radio, the fastest show in politics, live from Washington with a vote that we are anticipating later today in the U.S. Senate on the Right to Contraception Act. We've been talking about this a bit today because it's being looked at as a messaging bill. Democrats say it would make it federal law that an individual has the right to obtain contraceptives and engage in contraception. Kaylee, I'm not sure this would even be an issue if Donald Trump hadn't said in that interview that he might move to outlaw contraception, but then he walked that back. The fact of the matter is we're anticipating a really important ruling on mifepristone, the abortion pill, from the U.S. Supreme Court.
Yeah, that's due by the end of the term, so we should have an answer on that from the High Court by the end of June. But all of this, Joe, spells out how just confusing the law can be in many cases in a post-Dobbs America since the overturning of Roe versus Wade. So we wanted to get some expert insight into this. I'm pleased to say joining us is Mary Ziegler. She is Martin Luther King Jr. Professor of Law at the University of California at Davis and the author of a number of books, including Roe, The History of a National Obsession. Professor, welcome back to Bloomberg TV and radio. It's great to have you. Can I first just ask you, considering that this has probably very little likelihood of becoming law, even if it got through the Senate, probably wouldn't pass the House, if it doesn't become law, is there not legal protection nationally for contraception in a post-Roe America?
There is, right? So the Supreme Court hasn't overruled its decisions on the right to contraception from 1965 and 1972. I think the reason there's been some anxiety about it is because the logic of the Supreme Court's decision overturning Roe v. Wade essentially said we only have rights that were recognized as rights at the time the 14th Amendment was ratified. And if that's how the Supreme Court is actually going to approach rights going forward, no one would have thought there was a right to use contraception in 1868 or 1865, right? It was at pretty much precisely that time that states were actually criminalizing access to contraception for the first time. So I think there's some fear that down the road, the court may reconsider its rulings on contraception. There's also some concern that states are redefining contraception. In other words, there are concerns that conservatives believe that the morning after pill is an abortifacient, or the birth control pill is an abortifacient, or IUDs are abortifacients. And so while they may not pass laws banning contraception, they may pass laws redefining contraception in ways that threaten access to common FDA-approved drugs.
Well, as we've seen so many states act in the wake of the Roe ruling, what's your take on this actual piece of legislation? Is this something that's necessary on the federal level?
Well, I'm kind of torn about it because, I mean, on the one hand, to your point, this is obviously a messaging bill. I think Democrats have introduced this bill in part because they know Republicans will vote against it. But at the same time, the fact that Republicans will vote against it is revealing in and of itself, right? I mean, we've seen the equivalent strategy unfolding at the state level, as many state right to contraception bills have also been defeated in state legislatures by Republicans who claim to support the right to contraception. Now, some of the Republican responses is simply say there's no need for these bills because the right to contraception is already protected. And that's true as far as it goes, but the same also applied to same-sex marriage. And Congress did pass protections for same-sex marriage, even as Republicans claimed that those protections were unnecessary. I think the reason you're seeing a different response from Republicans to some extent is because some of their constituents are either worried about what they view as conscience-based objections raised by conservative Christians who don't support contraception, or they're concerned about the objections of constituents who see a lot of common contraceptives as abortifacients and therefore on the merits don't support right to contraception bills. So I think this is both a messaging bill and a messaging bill that's exposing that Republicans are more uncomfortable with this issue than they'd like to admit. And that might help make sense of what you saw former President Trump do, right? And making a statement that he would think about how to regulate contraception and then walking it back because he's probably not up on exactly how complicated the feelings of the Republican base could be on some of parts of this issue.
Well, we've also seen some complications around Republican messaging on IVF in particular after, of course, the ruling in Alabama earlier this year. Even though IVF protections have been put back into place in that state, there was efforts to protect that federally that haven't necessarily been able to find further progress on Capitol Hill. Mary, how should we think about that issue in particular and where the conversation around in vitro fertilization goes from here in a post-Dobbs world?
Yeah, I think that, again, the idea that there's no threat to in vitro fertilization, which is something you're also hearing Republicans saying, is a little bit misguided. We've seen, for example, prominent figures in the Southern Baptist Convention, which is the largest conservative Christian denomination in the United States, announcing that they're going to be pushing for a resolution condemning in vitro fertilization and urging conservative Protestant churches to begin lobbying for state laws prohibiting or regulating in vitro fertilization. We've seen prominent campaigns announced by anti-abortion groups to either litigate to establish that fetuses and embryos are persons and that in vitro fertilization is potentially unconstitutional, or urging legislatures to introduce new restrictions on it. And so I think as a result, the in vitro fertilization restriction issue is a long way from over. Even in Alabama, there's new litigation seeking to establish that Alabama's new law protecting IVF providers violates the state constitution by denying embryos constitutional rights. So the conversation in the states is a really complicated one, even if it's not one that's likely to change anything imminently, because voters do support in vitro fertilization. I think, again, Republicans are in a tricky place on this because there's so much popular support for IVF. But a lot of conservatives in base voters view IVF as contradicting the principle that a fetus or embryo is a constitutional person, which is what many of them believe in the context of abortion as well. So you're likely to see, I think, Republicans continuing to thread this needle of saying they support IVF while being unwilling to actually introduce legal protections for IVF that would be unpopular with some of their constituents.
Well, lastly, Mary, as senators are asked to put their name on the record here on where they stand, Patty Murray, who chairs the Senate Health Committee, says Americans, quote, will be watching closely as this vote takes place. Is she correct?
Well, I don't know. I mean, I think it's unclear if Americans take seriously threats to contraception. I think that the threats are not imminent, but they're real. And so I think it may be a question of whether Americans are watching now or whether they will look back on this vote later when there maybe are some of the moves to address contraception come to fruition. This vote may look very different in historical context to voters than it does today.
Mary, it's great to have you back. Mary Ziegler with us as we anticipate the vote later today. Mary, appreciate the insights as always. Martin Luther King Jr., Professor of Law at the University of California at Davis. I'm Joe Matthew alongside Kaylee Lyons. We had another breaker, speaking of the Supreme Court earlier today, that has to do with the SEC. This is not what Gary Gensler wanted.
Yeah, the Federal Appeals Court striking down a rule he had put into place, one of many that targets the private funds industry, that would require hedge funds, private equity firms to essentially detail their fees to investors. It is a blow to Gary Gensler, and it begs the question what the fate is of all of these other rules he has tried to impose on this industry.
Yeah, that's true. We're joined for more on this by Elliot Stein, Bloomberg Intelligence Senior Litigation Analyst for Financials. Let's go to the source in New York. Elliot, did you see this coming? Why the ruling?
Hey, Joe. Hey, Kaylee. How you guys doing? I did anticipate this. I think probably a lot of people watching the courts these days anticipated it. We're essentially in this perfect storm where you have, the Biden administration and its regulators taking a pretty aggressive approach to regulation. And then you have federal courts that, are skeptical of administrative overreach. And so you have this perfect storm where these two are meeting and the courts are looking at what the administration is doing and thinking that they've exceeded their statutory authority, which is what happened in this case.
Mm-hmm.
So does this effectively kill the rule, or does the SEC have further recourse for appeal here?
Well, in theory, the SEC does have further recourse. This decision was by a 3-judge panel of the Fifth Circuit Court of Appeals down in New Orleans. The SEC now has 45 days to ask the full Fifth Circuit to review the decision, and the SEC could ask the Supreme Court to review it as well, or they can go to the Supreme Court after they ask for en banc review, which is the full Fifth Circuit. But I don't think the SEC is going to get any traction on either of those paths because the full Fifth Circuit and the Supreme Court are essentially aligned ideologically with the 3 judges on this panel that issued this ruling today.
Yeah, to Kaylee's point, we're talking about the Fifth Circuit Court of Appeals in New Orleans. Kaylee, thank you. The reaction from Gensler, the staff will take a look. I guess that's all you need to hear.
Yeah, I mean, right. They always say that, but, again, I don't think there's much they can do. There's not much they can do in the courts with this.
Okay, so what about all of the other rules targeting the private funds industry, Elliot? Does this spell potential trouble for them too?
Yeah, I mean, and it's not just rules, targeting private funds, right? I mean, we're seeing this across many sectors. In fact, Bloomberg Intelligence just put out a deep dive report on sort of the demise of judicial deference to regulatory agencies, and we've seen it with the major questions doctrine. This affects, various SEC rules, as you suggested, including the dealer rule, its climate disclosure rule. I think, it also touches on things like the CFPB credit card late fee rule, which is being litigated currently. My colleagues in other sectors have written about how this could affect the FCC's rules on broadband regulation, the FTC's rules on non-competes, banning non-competes, the EPA's rules on PFAS. So this really is indicative of a cross-sector issue that we're seeing where the courts are really skeptical of what the Biden administration regulators are doing.
Well, and one of those areas as well that's gotten a lot of attention was the climate disclosure rules, Elliot, that the SEC has actually taken it upon itself to stop enforcing, given the just scale of the legal challenges that they were facing. My understanding, though, is a lot of the climate-focused lawsuits that didn't think the rule has gone far enough are now not happening anymore. Those have been dropped. Where exactly do the legal challenges around that in particular stand? Yeah,
that's exactly right, Kaylee. Just this week, or maybe late last week, we saw the Sierra Club and the NRDC, the Natural Resources Defense Council, drop their lawsuits. And you're exactly right. They had filed lawsuits, wanting the SEC to go farther than it did, but they have now withdrawn those lawsuits, and they're going to focus on, fighting to preserve what the SEC did do, which again is now also being challenged by, several Republican, red-leaning states that have Republican attorneys general, and then also some, industry groups. All right, Elliot Stein of Bloomberg Intelligence, thank you so much, as always, for joining us. And I wonder, speaking of climate activists and lawsuits that they bring, Joe, how they might react in the aftermath of Kathy Hochul's decision today, the governor of New York, pausing indefinitely this congestion tax going into effect. People wanted that to combat emissions in Manhattan, and I guess it's not happening.
She says they will continue to pursue their environmental objectives, rather. And I wonder, easy for me to say, what will come of this, if there's another study or if there are exceptions that are made here. It's a big question. I'm sure that it's something that Tim and Molly are going to be talking about. Molly Smith holding forth with Tim Stenevec on Bloomberg Business Week. Guys, what do you have coming up?
Hey, we're certainly diving into congestion pricing a little bit later in our program because it's something that everybody is talking about here in New York City, a shocking move from the governor. We're also talking about that bond rally that we've seen in recent days and the economic data underlying the trade. And Molly, I don't know, do you have a pair of Birkenstocks?
I need to replenish my supply.
Okay.
I was big into it in middle school, but I mean, this is now a luxury brand. I'm clearly behind the times.
All right, we're talking about big Birkenstocks.
You can't play tennis in Birkenstocks.
That's right.
Oh, my husband would beg to differ on that one.
Really?
Joe.
Plays tennis?
Birks
Can you do that,
take
Molly?
you anywhere.
Wow.
At least so he says.
I have a lot to learn still. I'll meet you back here at 5, Kaylee, for the late edition of Balance of Power, only on Bloomberg TV and radio.
This is Bloomberg.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everyone, live on TV, radio, Bloomberg Originals, and YouTube. It is Bloomberg Business Week. I'm Tim Stenevec, along with my co-host for the afternoon, Molly Smith, from Bloomberg News, economics editor. She's filling in for Carol this afternoon. Molly, how are you?
Happy to be here, Tim.
Hey, well, you know what else is happy is the equity market, because we're seeing stocks set to close at an all-time high if they continue this direction. We'll have more details on that in just a minute. Also, on the latest economic data that is a little bit conflicting with Fed-friendly and not so Fed-friendly numbers coming out over the last couple of days. We're going to make sense of the data and also the bond market reaction to that data. In addition, we're going to talk about the ballad of Birkenstock, how the 250-year-old German orthopedic shoe company with succession family-level drama transformed itself into a luxury behemoth, all thanks to someone whose last name is not Birkenstock. We talk about that a little later in the program. Also, Apple needs his help as much as he needs Apple's. We're going to tell you about the entrepreneur who's helping the company catch up when it comes to AI. And one more thing, congestion pricing. It was set to go into effect at the end of the month. Now, not so fast. It's our one more thing on Bloomberg Business Week. All that and more over the next hour. First up, though, a check of the day's trade and top season stories. Here's Charles Pellet.
All right, thank you very much. And here's what's going on. We got ourselves a major rally underway. Let us begin in Techland because NASDAQ surging 1.65% right now. NASDAQ 100 index up 1.7%. Small caps, part of a broad-based rally today with the Russell 2000 up now by 1.3%. Put it all in context, S&P up 48. We're trading at a record up 0.9%. 53.39 right now on the S&P 500 index. The Dow up 51, gain there of 0.1%. S&P on track for its 25th record this year. NVIDIA leading a rally in mega caps. Apple up for an 8th consecutive session. NVIDIA right now up by 4.2%. 10-year 4.29% with a 2-year 4.73%. Gold up 1.2%, 23.54 the ounce. And West Texas Intermediate crude up 1.3%, $74.19 a barrel. A couple of high-profile tech stocks surging today. Hewlett-Packard Enterprise reported revenue that beat analyst estimates. HPE up 12.8% right now. Also reporting last night, CrowdStrike Holdings, that stock surging by 11.5%. So again, recapping here, S&P up 48, up 0.9%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Certainly do appreciate it. A global bond rally that began the week continues. And when we say rally, we mean it, at least on Monday and Tuesday. 10-year rates have declined by more than a quarter point in recent trading sessions. And on the first 2 days of the week, some Treasury benchmark yields registered their largest two-day drop this year amid signs of a cooling U.S. economy.
And those signs include data that showed hiring at U.S. companies grew at the slowest pace since the start of the year. That came out earlier this morning. We'll get into that in a minute. And it comes a day after we got a downside surprise with JOLTS data.
Okay, all that said, Molly, we also got data that showed the services sector expanded by the most in 9 months, powered by the largest monthly gain in a measure of business activity since 2021. So some conflicting data to be sure. For a picture of the bond market and to help us make sense of the data, we turn to Bloomberg News rates reporter Michael McKenzie and Bloomberg Economics U.S. economist Stuart Paul. They're both here in the Bloomberg studio this afternoon. Michael, I want to start with you because we have seen quite the rally in treasuries this week. What is the bet that these traders are making? Is it all about the Fed?
Yep, soft landing. The economy's going to slow down. We're still not prepared to price in the first rate cut. The first rate cut's been priced in for November, but we're beginning to move a little bit more towards September. It's about 18 basis points now priced in. So the market's not as big as it has been in the past, really jumping the gun here on the Fed pivot trade. But they're thinking the data is showing maybe, because if you get to July, it'll be 15 months since the Fed last hiked. And if you think back to 2006, 2007, that was kind of the similar time frame when things started to slow down. So the bond market's been waiting and waiting and waiting here for the economy to really start to show signs of cooling. So I think it's a pretty promising sign, but of course the wild cards are we've got a payroll report on Friday and we've got CPI Wednesday morning next week.
Just and a Fed meeting as well.
And a Fed meeting thrown in as well.
Those things. We'll get to those things in a few minutes. Okay, but put into context the moves that we saw. As I said, the rally's continuing today. But put into moves the context of the moves that we saw on Monday and Tuesday, especially on the 10-year.
I think it's a combination of people who are bearish getting caught out, but then we are hearing from money managers they're buying U.S. duration. They're sort of buying that sort of 5 to 10 year area. They like that part of the curve, had done for a while. Various banks have said that, based on positioning, they're very overweight. They're very overweight mortgages as well. They love corporate credit. Spreads are very tight. And this is all predicated on the idea that the economy is going to cool, but not actually fall off a cliff. So you're still taking down yields, between 4, 4.5, upwards of 4.75 and 2. So it's a good time to take it down if you think that's the direction of travel.
Yeah, cool but not fall off a cliff. That really seems to be the name of the game, at least the labor market data recently. So I want to bring in Stuart here to go over that. We had the JOLTS data that came out yesterday. This is obviously for the month of April. So now we're sitting here June 5th now. 5th, correct. Seems a little like
You're right.
Like April was 100 years ago. And then this morning we got the ADP data, and that was for the month of May, showing that hiring at U.S. companies was, slowed down a bit compared to the previous month. And then we also got today this strong services data. So how are you reconciling all this, Stu?
So focusing primarily on the labor market data, we did see some cooling in the JOLTS data, major downward revision, about 100,000 fewer jobs in the March data, and then a major downside surprise showing about just over 8 million job openings available. The thing that's also notable there, so not only is there dissipating excess demand for labor, but workers are quitting at a pace of about, the quits rate is registering about 2.2%, so that's a touch lower than it was pre-COVID. It was about 2.3%. Workers are less confident that they can find new jobs at higher wages. So there's going to be less churn in the labor market, less upward pressure on wages. Molly, as you said, we also saw the ADP data this morning, which also surprised to the downside, 152,000 private sector jobs added. There were a handful of industries that were shedding jobs, though, right?
Manufacturing, big one.
Manufacturing. Information, two of the more cyclically sensitive sectors, mining and resource extraction. If you need to feed fewer resources into the machines to produce less stuff, you would expect to see some layoffs there. So even though some folks look at ADP and perhaps counterintuitively look at it as a contra-indicator of what to expect with NFP,
and that's what we're getting on Friday.
And that's what we're getting on Friday. The industry level composition of the ADP data does speak to monetary policy gaining traction in the real economy.
Well, there's one other sector to call out within that ADP report, that leisure and hospitality hiring. This has been where so much of the strength has been really coming out of the depths of COVID in terms of where we've seen so much job growth. And that was really weak in this latest month. How do we jive that then when you've got this ISM services report that comes out and shows that business activity, I think, expanded in the fastest pace in 3 years? How does that match?
There's always a little bit of a grain of salt that I take the survey data with. And if we're looking at the hard data like ADP, or if we're looking at the hard data like JOLTS, we see more of a normalization of the pace of hiring and the extent of labor demand in the industries that were most affected by COVID. So we saw in JOLTS a major reduction in the number of job openings for healthcare workers, same for leisure and hospitality workers, and that had been a major source of hiring because they were being rehired after all the shutdowns. So I think that that's really my takeaway from both JOLTS and ADP when it comes to the services side. There's more of a normalization of those industries that had been affected.
Michael McKenzie, come on back in here, because I'm wondering about your view of the services sector expanding by the most in 9 months, because we got this idea that a lot of the jobs data that we saw this week already has been really Fed friendly, and then this ISM report comes out and it kind of goes against the idea of a cooling economy.
Yes, and it also highlights services, and that's been the sticky part of inflation. So I suspect the rally we're seeing this week, it could very well run into some headwinds, because I'm not sure you're going to get the kind of inflation data you really want to see from this bond market. And again, payrolls on Friday, it's always an important number. It kind of sets the tone for the rest of the month. And again, in wages, they're expected to come in at a 3.9 annual pace. That's still pretty good. And the unemployment rates, I mean, you need to see the unemployment rate go above 4%, I think, for the bond market to think, okay, this economy is cooling a little bit more now.
Okay.
I think that's kind of where we're sort of, what things we're focusing on.
I mean, what happens if we don't see that? What happens if, like Stuart mentioned, the ADP data is a contra-indicator for the most recent jobs report?
Then I think you're going to go back into the range here. You're going to see the market continue to price less than 50 basis points of cuts this year, which has been the case now really since that third inflation print for the year arrived in March. And the next question, of course, will be, does the market start to dial back some of the rate cut expectations for 2025? That's where the Fed dot plot next week could be quite interesting if they actually do show a higher long-term dot, but also pull back a little bit on the cuts for next year they were expecting before. And then I think ultimately that puts your 2-year yield in that sort of 4.75% range, and it keeps the 10-year, pushes it back towards 4.50, which seems to be the kind of level that people like.
But not toward 5%?
I don't think you're going to get 10s back towards 5% unless you get some kind of inflation shock.
I want to stick with you on one more here, Michael. Stuart was mentioning, he's an economist, so he thinks about it this way, is looking at the hard data versus the soft data. If we're looking at reports that are coming out from the government officially, or more these like survey-based softer indicators. Does the bond market react? Does it make that kind of differentiation between the two, or it's just, green light go or like red light sell off?
It depends on who's trading. I mean, for the sort of active traders within the bond market, they're going to look at everything and react and interpret it the best way they think is appropriate. I think for longer term investors, you've seen a lot of money coming into bond funds this year, into active bond funds, and they're pretty comfortable loading up on 5 to 10 year treasuries, pretty comfortable loading up on credit, pretty comfortable loading up on mortgages. So if we get this sort of cooling continuing, they're going to be fine. But if you get an upside inflation sticky shock in the next few months that derails the Fed, if the labor market manages to remain resilient, then some of those positions could be vulnerable. The other thing too is if the economy really does start to cool down, the real pain is going to be in corporate credit, because even the top investment grade corporate credit will reprice lower. because the economy is starting to really slow down.
Always comes back to bonds on this show, doesn't it?
It has to.
Just the way of life. You mentioned
I've heard that's where the smart money is.
That's where they all go.
So I've heard.
So you mentioned, of course, employment and inflation.
Yep. Names
of the game. Stuart, we've got two of the biggest reports on those coming up right now. Let's start with employment first. So we've got the jobs report coming out on Friday. What's your take there?
So starting on the establishment survey side of the report, as I mentioned earlier, as Tim repeated, we think that ADP is a bit of a contraindicator when it comes to payrolls themselves. So the consensus is at 185,000 jobs added in the month of May. We're at 220,000. Part of that is because there's only so much that you can map from private sector employment within ADP to private sector employment within non-farm payrolls. And part of that is because of the birth-death model that's operative in the back of the Bureau of Labor Statistics.
Okay, talk about what that is, because I heard this on Surveillance this morning. It's a new report out from you and the team over at Bloomberg Economics.
Yeah. So the Bureau of Labor Statistics, when it sends out the establishment survey, reaches out to about 600,000 workplace sites. Now, there are about 11 million different business sites that are out there, and that gets covered in a more comprehensive quarterly survey. But we could set that aside for now. Every single month, they're reaching out to 600,000 businesses.
The same 600,000?
Not necessarily the same 600,000, and there are different response rates every month.
Got it.
But the thing to keep in mind is that businesses are born and businesses die. They go bankrupt every month. So in the background, the Bureau of Labor Statistics has to estimate, to the best of their ability, the number of businesses that are born and the number of businesses that are dying, that are closing, and how many jobs they think that'll add, and they need to use that to supplement the small sample of the universe of businesses that they're surveying.
Okay.
Now, if that birth-death model is contributing substantially to the number of printed, non-seasonally adjusted jobs that are added each month, that's sort of troubling. And if that birth-death model is adding a vector of job growth to the estimates that's positive at the time that we're seeing the pace of bankruptcies, for example, rising, which we are seeing, you have to take into question the number of payrolls that the birth-death model is generating.
So they may be overstating it, is
they
what
may
you're
be
saying.
overstating it by, call it 750,000 jobs in 2023 alone.
That's a lot.
That is a lot, and so we would expect to see some sort of downward revision of those past jobs. Now, that birth-death model is still operating in the background right now, so that's different from what we'd be getting from ADP, which is modeling nationwide payrolls based on the clients that it's servicing and the additional headcount that it's seeing its own clients adding, right? So it's a different approach here, and so we are taking the over on the consensus. Consensus is 185. We're at 220. Now that's different though from what we're going to get from the household survey. Michael was saying earlier that that 4% unemployment rate threshold is what bond traders have been looking at. We do think that it's within reach, and the household survey has been substantially weaker than the establishment survey, in part because of different estimation processes, and there is not that birth-death model in the background of the household survey. Right?
Right.
Because you're just reaching out to households and asking, have you been working in the past 4 weeks? So we do think that we can touch that 4% unemployment rate in this May report.
Okay. Michael McKenzie, do you want to weigh in on this?
I think, again, payrolls is always the most important piece of data for the bond market.
Okay.
And
that or CPI?
Well, that's what I was going to say.
It's a heavy couple days coming up.
Yeah, it is, but I think actually payrolls is more, because I think if the employment market starts to crack, the Fed has told you that they will react to that.
Right.
Even if inflation's still high and sticky, if they see material weakness in labor, they're going to have to do what the Bank of Canada did today, right? They're trying to get ahead of a slowdown, because you don't want the economy to really fall apart. You actually want to get that soft landing.
Of course, but they also said, that material unexpected weakening is not just, an unemployment rate going up by 1/10 of a percentage point or so. It's got to be more than that. So
yes,
going up from 3.9 to 4 is not the material
weakening. But the bond market it'll tee off on that, I think.
And would one report that came in softer than expected indeed prompt the Fed to do something drastic, or do they want to see month after month after month of weakened data?
I think the Fed does want to see a consistent pattern. What's interesting at the moment is Jay Powell is clearly being dovish. He was very dovish at the end of last year, and he's also continued to stick to that, hint at that. His problem is, of course, he's got to get agreement of the Fed. And we've heard a lot of different, sort of views coming from Fed speakers recently. So that'll be the task for Powell.
Okay, Stuart, I know you're a U.S. economist, but I want to talk Canada. We just heard Michael mention the Canadian Central Bank cutting interest rates, first of the G7 central banks to ease. How should we, or how are you as a U.S. economist looking at that?
Well, so I'm doing both. I'm spending about 70% of my time in the U.S., about 30% on Canada. And as Michael was saying, in Canada, the central bank is looking to get out ahead of changes in economic activity. What's substantially different between the U.S. and Canada is the housing market, for the first thing. The average mortgage in Canada is a 25-year amortization, but the mortgage rate resets every 5 years. Compare that to the U.S. with 30-year amortization with a fixed rate. And with the average rate paid on existing mortgages still below 4% in the U.S., the transmission of monetary policy into the economy is really slow. In Canada, about 75% of mortgages are going to be resetting between now and 2026. And if folks see their costs of servicing their mortgage on a monthly basis going up by 50% or so because of that higher mortgage rate, that's going to substantially slow the pace of consumption growth. So the Bank of Canada is trying to get out ahead of that. They're trying to let the dollar circulate, and they're trying to really take advantage of the good inflation prints they had to start the year. We have not had those good inflation prints in the U.S.
Okay, we're going to have you guys back on in the coming days as we do get more and more data. Big thank you to both of you. This is exactly where we wanted to go. That's Bloomberg News rates reporter Michael McKenzie and Bloomberg Economics U.S. economist Stuart Paul here in the Bloomberg studio. Coming up next, it's the Ballad of Birkenstock, how the 250-year-old German orthopedic shoe company transformed itself into a luxury behemoth.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The top names at the Fed are on Bloomberg.
The way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced.
I do think that our new steady state is likely to be higher than what people have known over the last decade. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep winning World Cup. This is a three.
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
On Wall Street, we do check markets all day long. Here at Bloomberg, we have got the Dow, the S&P, NASDAQ pushing higher. S&P just about the best level of the day right now, up 48 to 53.39, up 0.9%. S&P, by the way, on track for its 25th record this year. We've got the Dow up 76 now, up 0.2%. NASDAQ Composite Index up 1.6%, up 273 points. The NASDAQ 100 Index up 1.7%. And the Russell 2000 Index of small cap shares up 1.3%. 10-year yield at 4.29% with a 2-year 4.72%. Gold up 1.2%. Spot now at $23.54 the ounce. And West Texas Intermediate crude up 1.2%. Higher by 82 cents a barrel. WTI just above 74.07. Archer Air says it has received FAA certification to begin operating its electric aircraft in commercial use, moving it a step closer to offering an air taxi service. After the bell, Victoria's Secret and Lululemon. Again, S&P up 49, up 9/10. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Do appreciate it. Okay, call it what you will. An orthopedic shoe company, a luxury fashion house, or even a healthcare company. Birkenstock has staying power. It's the favorite ugly shoe of many, from hippies to hypebeasts, and yes, to Steve Jobs.
The company has seen many ups and downs in its 250-year history and capped off a decade of explosive growth with an IPO last fall, making Christian and Alex Birkenstock, the two brothers who are seventh-generation members of the German footwear dynasty, billionaires.
For the forthcoming issue of Business Week magazine, Bloomberg News European healthcare and consumer reporter Tim Lowe profiles Birkenstock and the man responsible for the company's explosive growth. You can read Tim's story on the Bloomberg terminal and at bloomberg.com/businessweek. Tim joins us now from Munich, Germany. Tim, I mentioned the Birkenstock brothers, or just Emily just did just now, Alex and Christian, who are now billionaires. But there's a man who's not a Birkenstock, who is responsible for the company's recent growth. Who is Oliver Reichert?
Yeah, Oliver Reichert is a really fascinating character. He is not from the footwear industry. He is brought in. He's a former journalist. He's German. He's about a 6'6" tall. He's and not skinny. He's a big guy with a beard, a deep voice, a big personality. And so he's this ex-journalist who randomly, back in about 2008, got introduced to Christian Birkenstock, who at the time was in the midst of this massive kind of squabbles with his two brothers and father over control of where the brand was headed. And Oliver Reichert, who's now the CEO of the company, sort of was a friendly ear to Christian, helped him sort through a couple problems early on. And then Christian hired him to be sort of his personal consultant. And Oliver's got a very powerful personality, and he sort of came in and helped sort through the Birkenstock family problems, which were massive. And basically since 2013, he's been basically steering the ship. And the company has grown, I think, fivefold since then. It's been on a 20% a year sales growth trajectory, very profitable. And it's really been his baby over the last decade and continues to be now that they're a publicly traded company. A really fascinating man.
It's really been a remarkable trajectory, Tim, and this story really gets all into it. I encourage all of you who are listening to read it, and talking about all these different upstarts along the way, like Crocs and these other brands that were coming in. It sounds like you've met with Reichert. I'd love to hear more about your reporting for this story, because he really, like you said, is such a character. Even you said akin to a bully in this story, which I thought was kind of interesting.
Sure. Yeah, that's a word that I heard repeatedly in my reporting, talking to people who have either worked for him or have, sat across the negotiating table from him. Certainly a strong personality, as I've mentioned, and I kind of think it requires such a character to kind of wade into this family drama as he did about 10, 15 years ago and survive. I talked to one German local marketing professor here in Munich who, basically described the role of a turnaround guy from outside who comes into a traditional family business in Germany. And, one might call that in German a Himmelfahrtsmission, which is basically like a suicide mission. So Oliver came in.
One might. We believe you, Tim. We believe you.
He managed to survive it. Not just that, but thrive. So it's kind of evident in him. I think it's kind of his personality, a very strong-willed individual. He, with his journalist background, I think he was, when he came in, he spent a lot of time sort of trying to distill the essence of what it is he thought the brand was and can be. And since that sort of crystallized to him, he's been, he's an individual who can sort of push through.
We're working to get Tim Lowe's audio back out there in Munich, Germany. Again, as Molly mentioned, it's worth checking out this story on the Bloomberg terminal and at bloomberg.com/businessweek. And if you're thinking to yourself, okay, 7 generations of a family business, sounds like I need maybe a family tree to kind of understand what's going on. Well, you're in luck because there is a family tree in the piece. It starts with Johannes Birkenstock back in 1749 and goes all the way to Suzanne Birkenstock, who was formerly Suzanne Papenbrock, born in 1971. And that's exactly where I want to go, Tim, because I know the last 15 years for the company have been incredibly important for where the company is now, but the company does indeed go back to the 1700s. So I don't want to get tied up too much in the history, but give us the sort of 2-minute history version of Birkenstock as a company. And I want to particular focus what happened with Carl Birkenstock before the current generation took it over.
Sure. Yeah. As you said, back to 1774 is when the first evidence is of a Birkenstock in the Frankfurt area who's listed as a kind of a cobbler who makes shoes. And really, the first 100 years, not a lot happened. There was a bunch of cobblers that were trying to make shoes. It was a trade route that they were on, so a lot of salespeople walking to and from, and they needed new footwear. And nothing quite big happened. But around the turn of the century, 1900, there was a character, Conrad Birkenstock, and he really invented the elements that became the Birkenstock footbed. And he had a couple of innovations, a flexible insole in people's shoes. Back in those days, shoemakers didn't differentiate between your left and right foot. Conrad Birkenstock did. So that was a major breakthrough.
That is wild. Wait, we're like literally walking around with 2 left feet.
It's an incredible innovation.
Exactly.
That's crazy.
And he thought this is crazy. And he kind of invented a new way to make the shoes. You would think it might catch on. It didn't. He struggled to find customers for this. His son, Carl, with a C Birkenstock, he took his dad's innovations and he himself tried to find new ways to market it. And his ambition in life was to create what he called an ideal shoe, which would incorporate all the family kind of innovations into one mass producible product. He failed at that. It was his son, Carl, with a K Birkenstock in the early 1960s, who had the kind of the eureka moment where he said, hey, if we put these, innovations into an open-toed sandal, suddenly we can mass produce this. And so that's what he did. It was the early 60s. He created basically all the designs that we know today. Even then, people thought they were ugly, but even then, they had hardcore fans. And Carl with a K, for the next 50 years, he kind of ruled the company with an iron fist. He had his own 3 sons, And the transition from Carl to his sons created all sorts of problems about where the company was headed. And that's kind of the 2000s. The Birkenstock was a bit directionless. Crocs was not, came out of nowhere and ate their lunch. And that kind of set the table for where we were 2010, say, when Oliver Reichert came in.
Well, thank you for catching us up on the last
Seeing NYMEX WTI crude July futures settle at $74.07 a barrel, which is up 82 cents or 1.12%. A diesel July futures settling at $2.30. Gasoline July futures at $2.35.
Your headline says, the whole point of this.
The NYMEX natural gas July futures settle at $2.75.
That it's a luxury brand. How do you square? I'm saying this as like a woman who's worn many pairs of shoes in my life. How do you square an orthopedic shoe with a luxury brand? Because to me, the two seem like totally different things.
Yeah, I think you put your finger right there on the central tension of the company right now, particularly since the IPO. What is it? And I think investors have been asking that question and trying to sort of categorize it. As a footwear brand, there's a couple things that, set it apart. It still owns all of its factories, which like no other footwear company really does. And not only that, but they're all located basically in Germany. So they never left. So that alone, sets them apart from other brands. The company is obsessed with the footbed, as I say, and they really think of it as like the beating heart of the company. When I first met them, they thought it was kind of ironic that I have a weird beat here where I cover both like healthcare, pharmaceutical companies, and companies like Adidas and Puma. And they were like, oh, that's perfect because you're a healthcare guy and we're a healthcare company. And I was like, what? So I found that fascinating. And it's true. They say, we're a healthcare company focused on the feet. And it's there in all of their, security filings leading up to their IPO in October. They're pretty hardcore about that. And yet they've made this pivot and they're, partnering with Dior. They sold themselves into the universe of LVMH. So they're succeeding a lot by, these very glitzy collaborations. It's working for them right now.
Yeah, it was a tough IPO.
So US index is extending gains here. S&P 500 up a whole percent now.
To understand at least what Reichert is saying the company is. Tim, it's a great story. It's in the upcoming issue of Bloomberg Business Week. Read it now on the terminal or at Bloomberg.com. Our thanks to Tim Lowe joining us from Germany. Up next, Apple needs his help as much as he needs Apple's. We'll tell you about the entrepreneur who's helping the company catch up on AI. First up, though, world and national news with Amy Morris in the Bloomberg 99.1 newsroom in D.C. Hey, Amy.
Hi, Tim. Congestion pricing in New York City was delayed indefinitely today. New York Governor Kathy Hochul.
My team worked into the final hours to find a way to implement this because the goals.
The comments from Russia's Putin says Russia and China will continue holding joint military drills.
Important, but hard-working New Yorkers are getting hammered on costs, and the economic vitality of our city must be protected.
The tolling plan was set to begin June 30th. It would have been the first in the U.S. A super political action committee, a super PAC supporting Donald Trump, raised $70 million last month and is outlining a strategy to target voters in key swing states. It's a sign of how Republicans are seizing on the surge in donations after the former president's criminal conviction in a New York court. The super PAC is called MAGA Inc. and will spend at least $100 million through early September in key states, including Georgia, Arizona, and Nevada. That's according to a memo obtained by Bloomberg News. With a ceasefire proposal on the table between Israel and Hamas, the National Security Advisor Jake Sullivan says the decision is really up to one side.
At this point, the ball is in Hamas's court. Israel has accepted the proposal. The world has endorsed the proposal. Now it's
Global News 24 hours a day and whenever you want it with Bloomberg News Now.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
We'll have to build a portfolio of interventions. Lifestyle will also play into for some of them, and I think we can help many patients get down to a weight that they can maintain and live the life they want to live and avoid many comorbidities for the healthcare systems.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost.
And Saudi Arabia sets July Arab light crude oil official selling price to Asia at plus $2.40 versus Oman Dubai average, according to Aramco.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg. Context changes everything.
And Saudi Arabia sets July Arab light crude oil official selling price to Northwest Europe at plus $3.10 versus the ICE Brent average, according to Aramco.
Right now, the S&P 500 index, best level of the day, a 1% gain in the S&P, up 55 points now to 53.46. On track for a record, not just a record, but the 25th record this year for the S&P. Nvidia leading the way higher. Nvidia right now up by about 4.6%. So here's where we stand. The Dow up 116. Up
And Saudi Arabia sets July Arab light crude oil official selling price to the United States at plus $4.75 versus ASCII.
4.72%. Spot gold.
And Brent crude futures settle at $78.41 a barrel. That's up 89 cents, or 1.15%.
Sources tell Bloomberg ticket seller SeatGeek has added banks to the lineup for its planned IPO that could take place toward the end of the year. The company is said to be working with Citigroup and Wells Fargo on the planned listing, which is being led by Morgan Stanley. Citigroup up 0.9%. Wells Fargo right now down 0.3%. Morgan Stanley up 0.3%. Again, recapping, S&P at the high of the day, up 55, up 1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Do appreciate it. Well, next week, Tim Cook is going to take the stage to deliver the keynote address at Apple's WWDC, its Worldwide Developers Conference. Bloomberg News chief technology correspondent Mark Gurman writes that the keynote is Apple's biggest sales pitch in years, as the company has to convince consumers, developers, and investors, Molly, that it can thrive in the AI era.
That's right. And there's added pressure because Apple's existing business is stagnant, with revenue declining in 5 of the last 6 quarters.
So Apple's turning to none other than Sam Altman of OpenAI for some help. Mark joins us now from Los Angeles. Mark, before we get to the latest partnership and what exactly OpenAI is going to do for Apple, and more, equally as important, vice versa, give us a little bit of the history between Apple and Sam Altman, because the relationship, as you write in your piece, it goes back years to just after the iPhone was first released. Why did a then 23-year-old Sam Altman take the stage at WWDC?
So interesting. The last time that Sam Altman was involved with Apple in any public sense was, like you said, 2008. Now, let me take you back to 2008. The App Store had not yet launched. The App Store launched in July, right? Actually, July 9th of 2008. And in June, early June, they held their final Worldwide Developers Conference before that launch. To get people interested in the App Store and app development on iOS, they spent a good half, nearly an hour of that conference that year. And this was back when Steve Jobs was leading the company, bringing up different app developers to talk about their different app initiatives. And Sam Altman came up to present Looped. This was a precursor sort of to Find My iPhone, Find My Friends. It was a very well-received app. Ultimately, the app did so well that it got acquired back almost 15 years ago for about $50 million. So this was a big deal. And for Altman, this helped give him promotion to sell Looped, right? But for Apple, it also proved the App Store as a third-party application platform.
Mark, tell us why Apple is turning now to Altman in 2024 for something to do with AI. I mean, this would seem like, Apple, where I would think the biggest and brightest minds in the tech world reside. Why is it that they don't have those people in-house and that they're turning to Sam Altman for help?
I have to tell you, Molly, it's pretty embarrassing for Apple.
It seems like it is. I would think so.
Right. They missed the boat on generative AI and probably modern artificial intelligence as a whole. And it's very interesting to me that they've had to go this way and partner with OpenAI versus being able to build a chatbot in-house. So Apple will have its own large language models and different technologies to run AI on the iPhone. But for a chatbot, something that people are used to already now since the end of 2022, those OpenAI-like features, they're partnering with OpenAI to integrate that deep into the iPhone experience. They held talks with Anthropic, they held talks with Google Gemini as well, but ultimately they've landed on OpenAI as their initial launch partner. I expect them to eventually strike a deal with Gemini and others in the future. They're still talking to Google about this. But this is really interesting. I thought last year, with the introduction of the Vision Pro, that last year's WWDC was the biggest Apple launch in 5 years or so. Truth is, it's this year, because AI not only is the current, but it is the future. It's going to make their current devices better, but if they don't get their AI technology in order, they're going to miss out on the next wave of artificial intelligence-driven devices. In my Power On column this Sunday, I'm going to get into more what that means for Apple, but just to give you a little bit of a taste here. You've seen other people come out with devices sort of like the Humane AI Pin, complete failure, they're up for sale. You've seen the Rabbit R1. You've seen Samsung integrate AI into their phone, similar to how Apple's going to do so next week. But the real stuff is what's enabled by AI. Things like next generation AirPods, humanoid robots, augmented reality glasses, future versions of the Vision Pro, more advanced processors in Macs. That requires an extraordinarily sophisticated handle on next generation AI technologies. That's why this is so important. This is not about the iPhone 15, 16, 17, or even 18. This is about the product categories that don't exist yet. And if they don't get their AI in good shape, those categories will never exist.
So how are we going to get there? Because, you know, you quote somebody in the piece, Dag Kitlos, who's a tech veteran, co-founded and ran the Siri business before it was acquired by Apple. He said that the OpenAI partnership is likely to be a, quote, short to medium term partnership. So where does Apple go beyond that? Surely there's got to be some kind of development of talent or bringing somebody in who's going to run the AI, you know, themed projects going forward.
Yeah, Dag is completely right. So just to be clear, there's the OpenAI component, which is the more advanced AI stuff. Then there's the less advanced AI stuff. That's the first-party Apple AI features. They're all going to be there next week, right? Eventually, Apple will shift the more advanced technologies over to its own infrastructure, its own AI systems. OpenAI will be there as a placeholder, I would guess, for 3 years until they're able to roll out their own chatbot, right? You want to be able to get your phone to write a letter to someone or an email to someone. You want to get your phone to be able to create an image for you, right? These are things that Gen Z and everyone else at this point is doing in the ChatGPT app. Apple doesn't have the tech to do it, so they had no choice but to partner with OpenAI. They say internally they're allergic, and they have a philosophical allergy, I would say, actually, towards chatbots. They don't believe in it as a concept. They believe in this more highly integrated approach to AI, apps, privacy that you'll see next week. I have to tell you, if I'm being just very blunt with you,
please,
I think it's an excuse for their technology not being ready. As soon as their technology is ready, their whole philosophical standpoint on this is going to shift immediately. But it's going to take some time. It is unbelievable to me that the launch of ChatGPT in 2022, the launch of Gemini or Bard previously last year, completely took these guys by surprise.
Yeah.
They did not start working on this in any meaningful way until after ChatGPT hit the market like a surprise.
Sounds like it's been catch up from the beginning.
Yeah, it's just remarkable, Mark, the way that you've painted this picture for us about Apple being caught on its back foot. Hey, I'm wondering about historical precedents for a partnership like this. I mean, the only type of partnership I can think of, and correct me if I'm wrong, is like an Alphabet Google partnership with search, where Apple really relies on the company for that. Has there ever been a precedent for what Apple's going to be relying on OpenAI for?
Tim, you are spot on. The difference is, though, that when Apple struck this Google search partnership 20 years ago, there was no expectation that Apple should be in the search business. Search is extraordinarily important to the operation of the web browser, right?
Yeah.
AI is important to the whole platform, right? It's two different ball games, so to speak. There's no risk in Apple not creating its own competitor or replacement to Google search. There's a fundamental risk to the very core of the future of the company if it is not able to get its AI up to snuff. There are serious questions from people in the Apple world about how long the management in charge of artificial intelligence at Apple is going to last if this thing doesn't get turned around. They're going to have some fancy and impressive demos on Monday, but that doesn't change the overall story about how flat-footed they were here and how behind they are. And striking an OpenAI partnership, best case scenario for them. They're getting the best tech, and they're going to have to sort of eat some crow in the short term. They had no other choice but to do this.
Okay.
And if investors are looking for a positive here, it's that Apple was able to eat its wounds here and get it done.
Mark, your reporting on this has been just incredible. Also, your analysis. You got to sign up if you haven't for the Power On newsletter. Mark Gurman, Bloomberg News Chief Technology Correspondent, joining us from LA. Up next, it's One More Thing. We talk congestion pricing. This is Bloomberg.
You have to distill down what is the purpose of what you do, what is the purpose of your company, and make that very clear, and repeat it and repeat it and repeat it. And it's very clear what our purpose is to make money for the Norwegian population.
So why did you accept the job? You had a great life. I mean, you had a hedge fund that was doing very well. You were earning lots of money.
Well, I had a great life. I had a great life, but I still have a great life, and a really good life. No, I was very keen on that job because one, I think it's one of the most important positions in asset management. Right, I love asset management. In terms of the opportunity to develop that organization further, there were great opportunities, and I love organizational development. And then to do something nice for the country. I mean, these three things came together in the same job.
Why do you love asset management? Because you can influence and change the future, or is it being cleverer than anyone else?
Asset management is the most interesting job in the world, perhaps after being a journalist. Why is that? Well, everything you eat, drink, drive, all these kind of things is made by a company. You need to understand psychology in terms of the companies. You need to understand the corporate culture of companies. And then these things change all the time, right? You have the macroeconomies changing, interest rates are changing, currencies are changing. And the data points are just changing all the time. You just couldn't invent a more fascinating game even if you tried.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions. Now, your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. We have got a stock market rally underway. NVIDIA leading stocks higher, up 4.5%, but HP Enterprise reported revenue that beat analyst estimates on a big jump in sales of servers built to handle artificial intelligence work.
And crude oil futures rise by more than $1 to $78.53 a barrel in post-settlement trade.
Now $3.1 billion. Shares of HPE, they're up by 12%. CrowdStrike Holdings delivered first quarter earnings that beat Wall Street's expectations despite a pullback in spending that has challenged its cybersecurity rivals. Expectations were high heading into the company's earnings release. The company's shares have roughly doubled over the past year. CrowdStrike up now by 11.1%. The discount retailer Dollar Tree is reviewing options for its troubled Family Dollar business, including a potential sale or spin-off. The company said it began a review of its portfolio last year and has not set a timetable for the process, and there is no assurance that it will lead to a transaction. Dollar Tree bought Family Dollar for $8.9 billion less than a decade ago in what has turned out to be an expensive and lackluster acquisition. eBay will drop American Express cards as a payment option because of what eBay says are unacceptably high fees. That according to an email reviewed by Bloomberg News that the online marketplace plans to send to customers. eBay shares down today by 1.1%. American Express down 0.8%. And the personal styling company Stitch Fix reported a narrower loss per share than analysts were expecting in the third quarter. Shares of Stitch Fix up 23%. Those are our top company stories. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is a Bloomberg Business Week. Let's get a check on the latest world and national news. We got Amy Morris in the Bloomberg 99.1 Newsroom in Washington, D.C. Hey, Amy.
Hi, Tim. Congestion pricing in New York City is on hold. New York Governor Kathy Hochul.
I have come to the difficult decision that implementing the planned congestion pricing system risks too many unintended consequences for New Yorkers at this time. For that reason, I have directed the MTA to indefinitely pause the program.
The tolling plan was set to begin June 30th and would have been the first in the U.S. U.S. veterans who stormed the beaches of Normandy are in France for the 80th anniversary of D-Day tomorrow. Ceremonies are planned to mark the 80th anniversary of this important turning point in World War II. President Biden will be among the world leaders to attend those ceremonies. He arrived in France today for a 4-day visit that includes the ceremonies, a meeting with France's President Emmanuel Emmanuel Macron and Ukraine President Vladimir Zelensky. UN Secretary General Antonio Guterres has called for a windfall tax on profits of fossil fuel companies to help pay for the fight against global warming. Guterres decried them as the godfathers of climate chaos. He's repeatedly spoken out about the threat of climate change and says the global emissions of carbon dioxide must fall 9% each year to 2030 for that 1.5-degree target to be kept alive. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. Now back to Bloomberg Business Week with Tim Stinovic and Molly Smith.
Thank you so much, Amy. Do appreciate it. As Amy mentioned, among the top stories right now on the Bloomberg terminal, the most read story in the last hour and the fourth most read story in the last 8 hours is the shocking move from the New York governor, Kathy Hochul, who put a halt to congestion pricing. She upended an initiative, years in the making, Molly, that was finally set to kick in at the end of the month.
Yeah, this has been in the works for a long time, Tim. The governor cited inflation and financial pressures on working class New Yorkers as reasons not to implement congestion pricing. But the initiative was shaping up to be a political albatross ahead of this year's congressional elections.
Okay, we heard the tape from Amy just now, but worth repeating the recorded statement that the governor released. Quote, "The decision is about doing what's right for the people who make our city thrive. My focus must be on putting more money back into people's pockets."
Yeah, this is just, it's so controversial because like you can see what, you know, on the one hand that she's saying, which resonates with so many people right now, that inflation has been horrific. You know, we're facing higher charges for literally anything and everything in your everyday life. But then there are other people who are really counting on this initiative, which was going to bring in $1 billion a year in revenue for much needed repairs throughout the city and to be paid for by people who use the city's resources every day, but don't pay for taxes here.
I think that was the exact point of the implementation of the program. I'm glad you brought that part up. The question is, where now is the MTA going to get that $1 billion a year?
Right.
Our team has reported that there perhaps could be a tax on New York City businesses.
Right.
But
who knows if that's going to, and if that'll bring in and to your point, yeah, what will that mean for New York City businesses? And is that also going to raise $1 billion a year?
Yeah.
Like, is that going to be a consistent source of revenue? How is that going to actually go through? And also, I mean, something I was just asking you before we came back, where is Eric Adams in all of this? I mean, I don't personally know the jurisdiction of who calls the shots here, but it sounds like Kathy Hochul is all over this.
Right. The MTA is a state agency, so she ultimately has the say over this. Right. What I would say is, as our team points out in the piece, is that it's politically unpopular. A Siena poll from April found that 63% of New Yorkers disapproved of the plan. So it's a story that we'll continue to watch. And speaking of continuing to watch, The Close is up next on Bloomberg TV. If you're sticking with us for Bloomberg Business Week, we've got a great program around the corner from 3 to 5. This is Bloomberg.
Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
So the Treasury Department buyback targets coupons maturing 2044 to 2054 and accepts 20 of 30 eligible issues in the debt buyback.
Stocks rise a fourth day, bond yields fall a fifth, and Bitcoin poking back above 71,000. Live from Studio One here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. Let's get a check on where markets stand right now. The S&P 500 currently poised for its 25th record high of this year. So yes, it is back at record levels once again. But you take a look at what's really driving some of the advance, and it's the NASDAQ 100, up 1.8% as a group. But within the Magnificent Seven, that's where the real gains are showing up. Treasuries started the day kind of little change, but they've since moved higher. The two-year yield, 4.72%. We've got the FOMC meeting next week, of course. And paying attention to the loonie because the Bank of Canada has cut rates and signals it is reasonable to expect further rate cuts as well. Romaine?
All right, well, going back to the U.S. market, record highs on the S&P and the NASDAQ, and kind of telling that the intraday low today came right at 9:59 a.m. New York time, which was just 1 minute before the ISM released that data showing the U.S. services sector returning to expansion. That was powered by the largest monthly gain in business activity going all the way back to 2021. Chip stocks set for their best day in 3 months, and the Mag 7 as a group perched right now at fresh record high, with most of the risk-on appetite clearly seeded by that 10 a.m. ISM report. You also saw that embrace of risk sentiment reflected in the 10 a.m. spike in Bitcoin, the 10 a.m. plunge in the VIX, and the massive volatility in the Treasury space during that same hour. Take a closer look here at the intraday move on Treasuries, and you're going to see that push and pull of bond traders really looking for reason to tilt dovish. That would seem counterintuitive given the hot ISM reading, but other numbers in that report, including moderation in input costs and a further slowdown in hiring, provide data-dependent arguments, for the Fed to cut rates sooner rather than later. You put it all together and voila, you got the risk on buy. But anytime that market gets collectively happy, Scarlett, there's always someone standing by with a data point to march everyone's mellow.
So I'm going to be the buzzkill today, at least for the stock market bulls. According to the Bloomberg Intelligence Market Pulse Index, which we have here, sentiment in May was so risk-on that it actually approached a manic state. If you look at the y-axis, 1 represents extreme mania, 0 shows extreme panic. And you can see that we're in the upper band right now. And this is a contrarian indicator. So when the index climbs above this top red dotted line of 0.75, that means there will be some mean reversion activity in stocks over the next 3 months. And in this case, perhaps slower gains or maybe even a decline.
All right, as we kick you off to the close, let's get right to it. Dan Greenhouse joining us right now, Solus Alternative Asset Management Chief Economist and Strategist. And Scarlett there, walking right there in the background. We love it. Don't worry, Scarlett. We're going to give you a hard time for that. I will only mention that at least 6 more times during the show today. But nevertheless, we try here. Dan, great to have you here. You turned around and you looked at that chart that Scarlett showed. When you look at that chart there, I mean, what's your reaction to that?
Yeah, listen, we were talking off air that I felt like the next month or two was probably gun to the head, more likely to trade sideways or down a little bit rather than continue to make new highs for a variety of reasons. And the Market Pulse Index, which we have up on the screen right now, plays into that idea. But at the same time, I think the larger question for investors is this the end, so to speak? Is this some blow off top and we're now going to start moving lower in a more sustained and damaging fashion? And I don't think that's the case.
Give me the case, though, for further gains. Is it more just technical and momentum-driven factors? Is it fundamental? Or is it still about the elephant in the room, which is the Fed and interest rates?
Well, it's hard to ignore the technical and the momentum factor at play here. There's no doubt about that. A few stocks are doing a lot of the work here, driving the market higher, both for fundamental and technical reasons, and that's likely to continue over the next couple of months. But at the same time, you have a positive backdrop. The economy continues to expand, albeit at a slower rate, which is good because it plays into the idea that at some point over the next 9, 12 months, the Fed will feel a little more comfortable talking again about reducing interest rates, if not actually doing so. And all of that, assuming the economy continues to expand and profits grow. And to be clear, earnings expectations have been going up for the next 4-6 quarters, not down. Then the bias for equities in that type of environment is probably to the upside, although admittedly that's built on a foundation here, again, where over the next 1 or 2 months, maybe we correct 3, 5, 6%, something like that.
How do you fold in things like meme stocks, like GameStop, like AMC, or the crypto miners or crypto tide companies that seem to get a boost every time Bitcoin gets into that $70,000 range, given the fundamentals? Or maybe there is no fundamentals to speak of when you look at that group of equities.
Yeah, I pay no mind to the fundamentals. Well, hold on. We're involved in a little bit of what we're talking about, so I want to be careful here. But as a general rule, those meme stocks aren't trading on fundamentals. They're trading on Reddit mentions. I checked earlier because someone had asked me about it. I'm not even sure there's more than 1 or 2 analysts on the street that follow GameStop from a fundamental standpoint, which doesn't mean it's not a valid company, which doesn't mean there isn't money to be made. It just means on the institutional side of things where I live, it's just not of particular interest. It's not important to the index. I don't know many managers that are involved in the space, particularly as it relates to some of the short covering that may need to be done if something goes on again. So I don't pay too much attention to them. Now, at the same time, is it emblematic of a risk-on, game-on type environment? Yeah, I think so. But I don't know that it tells me anything beyond that investors feel comfortable putting money to work in riskier names. Yeah, I like to be aware of that. But at the end of the day, we're a fundamental shop, and we pay attention to the fundamentals.
I just want to point out, Scarlett, there are actually 3 analysts on the Bloomberg terminal that cover GameStop, and 2 of them don't even have a rating on it.
Well, there you go.
There you go.
Well, I mean, it's an input into that mania that we were talking about earlier. So when you back up a little bit and you look at equities relative to treasuries, a lot of people are saying this is going to be it for treasuries. We're going to start seeing things take off here. How are you evaluating the relative value here?
Well, listen, equities, fixed income, particularly treasuries, have been a really powerful absorbent of capital over the last 12, 18 months. Now, we're a hedge fund. Institutional investors probably not going to be satiated by 4 to 5% returns. We're an absolute return vehicle. We're looking for returns exponentially larger than that. But for a large majority of the investment community, 5% risk-free does a lot of your work. If you think that your return is going to be somewhere around the market average, call it 7 or 8% for the S&P over the long term, you can get 5 of that 7% in a risk-free fashion for at least 2 years, if not at some points over the last couple of months for 10 years.
I do want to, sorry, just to cut you off here,
Please.
I do want to ask you a question here about the broader tech rally. We're getting a headline crossing the wire right now. This on NVIDIA, the rally there continues with the shares up 5% on the day, and now, at least in the intraday here, at the $3 trillion market cap level, only the third company in U.S. stock history to ever reach that mark here. And it gets to a broader question about crowded trades here. The idea that anytime we see these rallies, the strong rallies, it does seem like everyone is gravitating back to the NVIDIAs and the Microsofts of the world, because that's where at least some modicum of safety, or at least the perception of safety is.
Yeah, well, so to be clear, I mean, we pay a lot of attention to these names because they're the AI trade. But at the same time, let's be clear, revenues, net income, EPS, all grow exponentially larger for these names, not Tesla, but the other, let's call it 5, grow exponentially larger for these names than do the rest of the market. And in the case of something like Google, and to be clear, Solus is not a particularly large tech investor. We don't own any of these names as far as I know, and I should know, these names, they grow exponentially larger. They provide you safety in the sense that they appear to continue to be doing so. They're not as interest rate sensitive as perhaps the rest of the market. But at the same time, these are really powerful names from a momentum standpoint. I don't know how you don't own them if your goal is to outperform the index. At a minimum, you have to be market weight, but you probably have to be overweight by 100 basis points or something if, again, your goal is to at least meet the index. I don't know how you would do it if you weren't allocated to these names. So it draws money in constantly as they continue to do better and better.
All right, Dan, got to leave it there. Dan Greenhouse over at Solus Alternative Asset Management here on a record-setting day for the S&P and NASDAQ, powered ostensibly here by NVIDIA. NVIDIA shares up more than 4% here on the day and crossing that $3 trillion threshold. If it closes at that market cap level, it will be only the third company in history to reach that level. That includes Apple, which has a $3 trillion market cap, and Microsoft, which has a $3.1 trillion market cap. All right, coming up, we're going to take a look at a company that has a much smaller market cap but is in the news today, Dollar Tree, posting another quarter of slumping sales and now reevaluating that monster acquisition of Family Dollar that it made just a decade ago as a spinoff. The key to a turnaround, some perspective from the sell side up next.
Plus, they say everything's bigger in Texas, but does that include equities? The state has big plans for a new stock exchange that is meant to grab business away from the New York Stock Exchange and NASDAQ.
And here on this record-setting day, as we count you down to the close, we're going to get some insights out of Steve Soshnick, Chief Strategist over at Interactive Brokers. Stick around. A lot coming up right here on The Close on Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt.
That's why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
It is official. NVIDIA has become the third stock ever to reach $3 trillion in market cap. And it happens as NVIDIA and the other big tech names rally today on the back of excitement over its AI business. Of course, NVIDIA really the poster child for all this AI excitement because it makes the chips that power all that AI software. So joining us now is Bloomberg's Caroline Hyde, who has been, of course, keeping track of all these moves. And the question here for NVIDIA is whether fundamentally, these gains are justified.
That is the key question, and for most analysts out there, they'd say yes. If you look at the ultimate amount of still buyers on the rating,
NVIDIA overtakes Apple in market value as 2024 gains hits 147%.
The P ratios, they ain't that crazy, because why? Revenue is growing at such a pace. Just take their previous quarter numbers. When you've got revenue climbing at 200%, no wonder the share price is already climbing 200%. We're meant to be anticipating these sorts of gains. It's meant to be a future indication of value. And ultimately, at the moment, many feel that, yes, it's an equivalent to an Apple right now in terms of market cap. It should be.
Actually, as NVIDIA continues to move higher, it has now overtaken Apple. Of course, this is a parlor game. We have to wait till we get to the actual closing bell for this to be official here, but it really does sort of show how much has changed. Because remember, Apple was the big growth stock a few years ago, and now some people would say it's just basically just a cash-generating dividend stock.
Value remains value.
Oh, sorry, value. Excuse me. But NVIDIA is the growth stock, right? Now, whether they, whether they actually make good on all those growth expectations, that remains to be seen over the long term. But at least for right now, this is where it's at. Is there anything else out there?
Well, in terms of comparable, where else you could, well, HPE today was showing that AI can bathe glory on some of the other infrastructure players. So if you want to be buying into future server demand, well, HPE see an 11% increase in its stock today and a new record high, but it is well off the market cap of an NVIDIA. Now, remember, come Monday, we get a stock split.
Yeah.
This has got so expensive. Maybe some of that valuation has been picking up because we anticipate retail investors are getting more into the stock.
Well, that's what I'm curious whether that's probably driving this as well. And what does that mean? That Monday's going to be a dud? Is all this going to be priced in by the time we get there?
Isn't that what the market's meant to do?
Caroline Hyde, of course, you can check her out as the co-host of Bloomberg Technology. A closer look here as NVIDIA continues to power higher, now up more than 5% on the day, and now eclipsing Apple in market cap. We'll keep an eye on that stock, but we want to move, I guess, to the other end of the market cap spectrum here and take a closer look at Dollar Tree. Those shares on the back foot after its quarterly report didn't live up to expectations. And now a lot of discussion here about whether the company should sell off its Family Dollar business. The company acknowledging that it is considering strategic alternatives here for that asset, an asset that it just acquired less than 10 years ago. Anthony Chicumba joining us right now, senior research analyst at Loop Capital Markets. He's still still has a buy rating on Dollar Tree shares. And Anthony, I want to go back to 2014 when the rumors started circling that Family Dollar was in play by Dollar Tree. There were a lot of people that questioned whether this was a good acquisition for them, whether they were paying too much. And now, with the benefit of hindsight, do you think it was?
Oh, there's no question about that. I mean, look, hindsight's obviously 2020, but I was writing back in 2016, I believe, for the first time that they should sell Family Dollar. It just become apparent even back then that they just weren't good at running a multi-price point retailer. Now, fast forward to now, you've had a couple of changes in management. Most recently, you had Manuel Riggs, so an activist investor, gain control of the board, bring in Rick Dreiling, who turned around Dollar General. And even he couldn't fix Family Dollar. I mean, quite frankly, I don't think the reincarnation of Sam Walton could fix Family Dollar. And so I applaud them. I absolutely positively applaud them for finally saying, you know what, we can't fix this. Let's sell this and move on.
The question is, Anthony, who, if anybody, do you think is going to step in to buy it?
Yeah, that's a really good question. I think at the right price, there's a buy for just about anything. Now, look, to be clear, it won't be a strategic acquirer. There are no strategic acquirers that make any sense whatsoever. But I could definitely see a private equity firm buying Family Dollar. And I think that the idea would be, first off, don't pay a whole heck of a lot for it. Close a bunch of underperforming stores, just kind of cherry pick the best stores, and maybe bring in the next Rick Dreiling, try to catch lightning in a bottle. One thing that I think that will be on private equity firms' mind is the fact that, when KKR and Goldman Sachs did an LBO of Dollar General back in, I believe it was 2008, and brought in Rick Dreiling, it was a home run investment for them. So I think that they believe that they could do that again.
I don't understand why they couldn't do more with Family Dollar. Why couldn't they integrate the supply chain, the merchandising, and the retail part? Why couldn't they, achieve synergies between these two businesses?
They're just very, very different businesses, right? Dollar Tree, everything, or the vast majority of the merchandise is $1.25. Used to be $1. It's a more middle-income customer. It's a location that's in a strip mall that's anchored by like a Walmart or a Target or a nice supermarket. It's 50% discretionary, 50% consumable. Family Dollar is a small supermarket. It's 75, almost 80% consumable. It's multiple price points, a lot of price points. It's a lower income customer. It's lower quality real estate. There just are not nearly as many synergies between these two businesses as you might suspect. And unfortunately, as Dollar Tree found out the hard way.
Yeah, even though their names might suggest otherwise. So is Dollar General a winner here, Anthony?
Look, it certainly can't hurt them, right? Particularly if Family Dollar is sold and then the buyer closes a bunch of stores. That would certainly help them.
All right, Anthony, good stuff. Appreciate you jumping on for us. Anthony Giacomba there over at Loop Capital Markets. A closer look right now at Dollar Tree and all the speculation about the potential spinoff or sale of Family Dollar. Dollar Tree shares down about 5.7% here on the day. Meanwhile, we go back to the top of the leaderboard, and that is NVIDIA. Those shares higher by 5% here, giving it a market cap of roughly $3 billion, a market cap that, at least for the moment, Scarlet Fu, eclipses even Apple. So that basically just leaves one company ahead of it, and that's Microsoft.
Yeah, well, Microsoft is light years ahead of it, but certainly NVIDIA giving Apple a run for its money. And the issue here, we talked about fundamentals and that 200% gain it's seen in revenue the last couple of quarters. Analysts have been marking up their earnings estimates, so valuation-wise, the stock actually looks reasonable compared to maybe where it was a year ago.
The question is did this go too fast, though? Because, even when you look at those multiples and you look at how long it took for Apple, Microsoft to get to the $1 trillion level, and then that $2 trillion, and then that $3 trillion level, here, I'm sure all the folks at Bloomberg on the other side of the room are going to be counting the days here. But I think this has to be even faster than what we saw.
It definitely is faster, and that's why it's giving people pause. And that's going to be a concern. Yeah, that gives people pause, but if the underlying business is there, if the underlying demand is there, and that's what it looks like, it's making chips as fast as it possibly can, then there isn't reason to doubt that it can achieve the numbers it set out.
All right, coming up here, we're going to focus a little bit more on the market structure, and more importantly, I guess, the idea that we need a new stock exchange. Some folks down in Texas think they've got an answer that I guess can rival the NYSE and the NASDAQ. That discussion coming up next here on The Close on Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something. There's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Good morning from our world headquarters in New York. I'm Menace Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
BlackRock and Citadel are among investors backing a new stock exchange in Texas. It is part of a big push by the Lone Star State to expand its financial services industry. This exchange would start trading in 2025. Texas also developing a business court system to handle the types of cases that Delaware is known for. And Texas is increasingly luring financial firms with lower taxes and relaxed regulation. Joining us now from Dallas is Bloomberg's Julie Fine. And Dallas is where the TXSE, as it will be known, will be based. But this will be a virtual exchange, is that right?
Yes, this is going to be all electronic, but yes, located here in Texas. They have their website up. The paperwork is out. The paperwork will be at the SEC later this year, but this group seems determined to start the stock exchange right here in Dallas.
Why, Julie?
I think they feel that it will be easier to do business here, and why not give it a try? And I think they've got some big names behind it. You find, supporting the group, when you have names like BlackRock and Citadel Securities, I mean, you've got some behind it. So I think that they believe this is the right time to move forward.
There's a lot of questions right now as to whether this really matters. When we talk about the location of exchanges, that was much more of a critical factor when people were really doing things in open call systems, using paper. Now with everything electronic here, is there any sense that it matters where these companies list? I mean, other than the initial costs to list, what would be the benefit?
Well, I think the benefit would be a different way to do business. A lot of bigger businesses are moving down here. I mean, Goldman Sachs will soon be headquartered right here in Dallas. You have Charles Schwab here as well. Other companies moving a lot of workers down here. So I think they believe this is a good opportunity. The question is, can it really happen, and can it happen on that timetable?
What are you hearing from folks and companies in Texas about the possibility of this stock exchange? Is this something they're getting excited about? Is this only for financial firms, or does this extend beyond that particular industry?
I think companies are excited about it, but not that many companies that we know of have gotten involved, have invested yet. I mean, right now you're only looking at $120 million, but I think people are excited about trying to do more financial business in Texas. They like the regulations here. So really, though, the question is, how many people can they really get to back it? And again, like you pointed out, this is all electronic.
All right, Julie Fine, thank you so much. Julie Fine reporting for us from Dallas. And Romaine, I wonder if the new Texas Stock Exchange is going to have an opening bell, a closing bell, and have, all this celebration that comes with it, get people to ring the bell.
Yeah, I guess you have to, right?
It's part of it, right?
Yeah, I mean, sure. Otherwise, why not? I mean, let's be honest. When it's all electronic, I mean, I hate to say it, but a lot of what goes on the floor is more for show these days. I mean, we see that at the NYSE.
It's like a museum.
You see that at the NASDAQ. So yeah, so you need those ceremonial things, and I'm sure Texas will find a way to do it big. Be a lot of hats and boots, I'm sure, and some other things as well.
I like that. I can picture the imagery there already.
So they can keep the power on.
Coming up, Shamela Khan, the head of emerging markets fixed income at UBS Asset Management, will be joining us to talk a little bit more about what's going on in India. This is The Close on Bloomberg.
So what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Scarlett Fu. And on this day, Romaine, I know you do on this day in the 4 p.m. hour, but on this day right now, guess what company has a market value of $3 trillion?
Yeah, I love this because now I know 1 year from now, I actually have something already baked in
your calendar.
for one day. Yeah, I mean, look, it's all the talk of the town. All big tech is back, but no more than NVIDIA, which is up 5% on the day, and now at that $3 trillion market cap level.
Yeah, the leader, the Magnificent Seven, the poster child for everything AI, and the beneficiary, right now, the biggest beneficiary of all the demand for AI software. All right, let's shift gears a little bit here because we want to talk about what's been going on overseas, particularly in the emerging markets. You look at India, and the Prime Minister Narendra Modi has won crucial backing from two key allies in his coalition, allowing him to form a government and extend his decade in power. Now, the nation's markets rallying on the news, recouping some of its previous day's sell-off. Joining us now with more is Shamila Khan, UBS Asset Management's head of fixed income for emerging markets. Great to see you.
Good to see you too.
So for markets, what does a Modi-led coalition government look like versus a ruling party-led government?
Well, a coalition government is always complicated, but I think the most important thing is that BJP has to reflect now on what led to the losses in the elections. And that is likely to lead to some shift in policy. What they've been doing so far was quite market-friendly, but apparently it was not well received by the electorate. So what our concerns are is that if that shift in policy leads to fiscal loosening, that's not a positive for the bonds of the country.
And what about for the currency of the country?
It's a net negative for all Indian assets. What we are really hoping to see is that the coalition maintains policies that are market friendly, but reality is in order to gain popularity in general, you have to spend more money.
It was kind of interesting that this election came at the same time as two other relatively critical elections. So I don't think everyone thought they were going to be as critical as they turned out to be. That includes the results in South Africa, but also Mexico. We saw a pretty severe market reaction, particularly in the pesos. I know it's rebounded a little bit today here. But even though the final outcome, meaning Sheinbaum elected, everyone knew that was going to happen. Similar to Modi, the question now is, what's the complexion of that government and what does it mean for the market?
Yeah, we thought the market was being overly complacent about these elections. The reality is, and I'm not sure what it takes for investors to realize this, polls are not predictive. And you really can't follow them. So there were tail risks in all of these elections, and they actually materialized. And what that means is that the risk premium for these countries should be higher going forward. In the case of Mexico, what the government does with a supermajority is going to be key. If they try to pass legislation that is going to be either relating to fiscal loosening or compromising the institutions of the country, that's going to be a negative for Mexican assets.
Do you see right now, based on what we know, an investment opportunity there? And I'm talking like new positions, not people who are already
I think you
invested.
should be cautious.
Yeah.
I think you should be cautious until you understand what the policy mix is going to be going forward.
When you say the risk premium should be higher, how will we know when we've reached a point where it's about right?
Well, that's something we analyze every single day, and that's why you need active management in these countries. These have been consensus bets. Everybody has loved Mexico and India. The reality is we have found value in countries that are much less loved, the distressed countries in emerging market, sovereign dollar-denominated debt, countries like Argentina, Egypt, Angola, and even some countries that are going to emerge out of default this year, like Ghana and Sri Lanka. We prefer to avoid these consensus bets, and especially with some of these tail risks materializing, we think that you have to be cautious going forward and continuously assess them to see what policy mix is emerging and how much risk premium is warranted.
What about folks who don't need to be in emerging markets at all? I mean, we talk about the risk premium, how they should be higher, and you're talking about looking at markets that people don't love right now. It's a high bar for people to get to if it's easy for them to make 5%, 6% somewhere else at a risk-free rate.
It's an excellent question. The reality is the countries that we've liked have been up as much as 30 to 50% in the last 1 year. So I don't think this is an opportunity that investors should mix. The only difference is you have to really do your homework and choose the right countries.
Is the rate story, though, going to start to work in their favor? I mean, we've talked a lot about central banks starting to lower rates. We saw that from Bank of Canada. The expectation is ECB tomorrow, and it might be a while before the Fed gets there, but we're starting to see the direction that monetary policymakers are looking, and at least for right now, they're looking down.
Absolutely, and that is going to be another tailwind for emerging market fixed income assets. So we don't think this is an area you should absolutely ignore. There are going to be countries that perform better versus the other ones, and that's our job to basically create alpha for our investors.
We can't talk about EM without talking about, I guess, the biggest EM country out there, which is still China. We don't talk about China anymore. I feel like it's like, the uncle that we keep in the attic that nobody wants to talk about. Are we going to see a rebound there anytime soon? Do you anticipate one?
We are constructive on China fixed income assets. The reason being is because so much negativity was already priced in. And we believe the government is serious about addressing some of the structural and liquidity issues in the housing sector, which is key to maintaining the growth levels that you are mentioning. So that, to us, is still a very attractive opportunity. And again, much less loved by the market, as you mentioned.
Because there's almost no uncertainty there. I mean, I know people are like, okay, when's the growth come back? But, I mean, nobody's questioning what Xi Jinping's policies are going to be over the next couple of years. I mean,
absolutely.
He's telegraphed
and look, the China high-yield assets have performed extremely well. I mean, they're close to U.S. equity markets, which is a difficult feat to accomplish.
So bottom line, Shamila, what should the leaders of these countries, Mexico, India, South Africa, what should be their takeaway from investors and from their own electorate?
So there's a different takeaway from investors versus the electors. The investors want policy continuity. Policy continuity has unfortunately not worked for India and South Africa. So they will basically be looking to see what they can do differently without impacting the markets. In the case of Mexico, it has clearly worked. So if they continue doing what they were doing, that would actually be a positive. But, having the supermajority can be a temptation.
All right, Shamila, great stuff here. Shamila Khan, one of the best in the business, UBS Asset Management's head of fixed income for emerging markets. A closer look at those emerging markets, Scarlett. And when you look at the MSCI Emerging Markets Index, the big sell-off we had last week, the big sell-off we had yesterday, we are seeing some of those losses get recouped today, as a lot of people now, I think, are kind of taking a cue from, I think, what Shamila was talking about really here, is that maybe the sell-off was a little bit overdone.
Maybe it was a little overdone, but the shock of the election results, perhaps giving people a reason not to look at at emerging markets right now because they're like, I don't need to, get involved in all of that. I can get my returns somewhere else.
Yeah, I mean, and where else can you get them? You come back to you come back to the U.S. here. We still remain king, and NVIDIA is at the top of the hill right now, a $3 trillion market cap as that stock continues to power higher here. We're going to have a fuller breakdown here of some of the moves out there and just how fast NVIDIA went from next to nothing to one of the most valuable companies in the world. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
All right, welcome back. It's time now for our stock of the hour. A closer look at shares of NVIDIA rising 5% here on the day, setting up at the close for what could be the third stock ever to close at a $3 trillion market cap. Abigail Doolittle joining us right now to talk a little bit more about this. And Abigail, I was just going through the Bloomberg terminal and looking at this. It took 2 decades for NVIDIA to get to that $1 trillion market cap. It took less than a year for them to get to the $2 trillion, which we should point out was in March of this year. And now 13 weeks later, here it is perched on the precipice of a $3 trillion market cap.
Is that another way, Romaine, of saying it went parabolic?
I think so, yeah.
And parabolic.
And you compare that, sorry, not to cut you off, but you compare that to Apple. Took a lot longer to get to that level. Similar story with Microsoft.
Yes, and I think that the point you're making is maybe too far, too fast. And that's the definition of a parabolic uptrend. And they typically do reverse to some degree. From a physics standpoint, it's 90 degrees up. That cannot hold, with the exception of Tesla back in 2013 or 2014. Will NVIDIA turn out to be of Tesla with relative to this massive rally? It's hard to know, but also, I mean, this was a $2 stock back in 2010. We're now looking at a $1,200 stock. You know, since the pandemic, just 4 years ago, up 13%. We're not talking about small numbers either. Now, the numbers, speaking to revenue, are there. The last year, for the fiscal year that ended in 2024, their revenues grew 126%. The thing is, we've gotten so used to these big numbers, these big guides. I mean, last May, when they put up a revenue guide that I think it was 51% better than what the street was expecting, I don't remember ever hearing about that before from a big company. But at some point, it seems likely that's going to stop. And it really depends on AI. I mean, I think we're all still trying to discover, you know, is AI, it certainly is not blockchain, which, you know, seemed to go the way, but is it the internet?
The interesting thing, though, too, and just to the point you make about it being $2, I don't think you can find a stock or a major company out there that has had that type of run-up and that didn't turn out to be like a complete house of cards. Because there's legitimacy, and I think Scarlett was getting at this a little bit earlier, because when you talk about multiples and whether that growth is justified, this is a real company making real things, generating real dollar bills.
Yes. Well, it's interesting you're saying that, Romaine, because I had enough time to write down one note, all things AI. This is the Amazon of AI, is what Amazon was to the internet. And Amazon was, I think, a 30-cent stock and then has kind of done a similar thing. So to your point, this is the real deal. Now, the question is, when will we see some sort of a pullback, and what will potentially cause it? I think that when AI has its first hiccup of some way, when there's headlines that it's not quite as big as, we don't know that. We really don't know that yet. But there are going to be hiccups along the way, just as there were for the internet and other technologies.
And I think a lot of people are looking forward to that hiccup because it's a way for them to get in.
I
Look
agree.
at the analyst ratings on NVIDIA, and 65 buys and 7 holds and 0 sells. That is a 90% buy rating.
It's incredible.
On this company, right? I mean, it is a hardware company and has a profit margin, a gross margin that's expected to rise to 76% this year. It's a hardware company with a gross margin of 76%.
It's incredible, and that's a great stat. Another one is right now it's trading almost...
Hardware company, it's at this point, it's a monopolistic hardware company because you're not getting those chips from anywhere else, at least for right now.
At least for right now, from the stock standpoint, right now, it's almost 100% above its 200-day moving average. It's done that a few other times in history. During the bubble, it went well above, but that's a long way of going back to the parabolic uptrend, and then at some point that there's going to be some consolidation. Again, what will be the trigger for that? It's hard to say, but that buying opportunity, people are going to be really pretty excited for it.
They're excited about the potential hiccups and the potential pullbacks because, yes, NVIDIA shares, you could say they're relatively expensive, 39 times expected profit over the next 12 months. But before the May 2023 earnings report, they were trading at 60 times forward earnings. So it's seen as relatively cheap.
The E is going up.
Yes, because the E is, they keep marking up the E.
Yeah, and that's what I mean. It's like when you look at any type of stock that's had this type of parabolic move, few of them had the fundamentals that NVIDIA had. So I don't know if that means it's justified, but it's certainly a lot more justified than, I don't know, let's just say GameStop.
And the valuation in its 5-year range is actually near the lower end. The one question is, though, when will sentiment shift?
Yeah, gotcha.
Again, lots of people waiting to get in. Abigail Doolittle, thank you so much as we continue to track NVIDIA's gains, currently up $54 at $12.18. This is before the stock split next week. $3 trillion market cap for NVIDIA. Coming up, we've got Steve Sosnick. Oh, my God. He's mocking me. Steve Sosnick is coming up, Interactive Brokers. This is the close on Bloomberg.
top names at the Fed are on Bloomberg.
The way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced.
I do think that our new steady state is likely to be higher than what people have known over the last decade. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything.
I decided to acquire Indeed 12 years ago. When I was 36, I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company, but I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right. That's
so
right.
whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
So we're looking now to the market on close imbalance. S&P 500 seeing a sell side of 1.1 billion. NASDAQ 100 sell side 285 million to the sell side. Dow 30 170 million to sell, with the Mag 7 all sales at almost 200 million.
This is the countdown to the close. Romaine Bostick alongside Scarlett Fu with record highs right now on the S&P and NASDAQ. We could thank a lot of the big tech stocks, Scarlett, but I think there's only one that anybody wants to talk about.
Yeah, it's the one that so many people didn't know how to pronounce up until the last year, NVIDIA. NVIDIA? I go with NVIDIA. And I think Jensen Huang does too, but whatever you want to call it, it is now a $3 trillion company because its market cap exceeded $3 trillion for the first time today. That makes it more valuable than Apple and just trailing Microsoft, which is what, worth $3.1 trillion?
Yeah, so 3.1 trillion. And we'll see the neck-to-neck battle right now between Apple and NVIDIA, I guess, will be settled over the next 9 minutes here. And it's kind of fitting right now that as we count you down to the close, joining us right now is Steve Soshnick. He's the chief strategist for Interactive Brokers and actually one of the folks who gets credit for coining the term the Magnificent Seven. And a couple of years ago when we started using that term, I think NVIDIA was like trading just a few $100 a share. And now, of course, it's over $1,000, although we had a big stock split coming. And now at a $3 trillion market cap, when you sort of singled out those 7 stocks as being the real drivers of this market, did you think NVIDIA would really rise to the top?
Well, first of all, hello, Romaine. I thought it was going to be one of the best stocks, and certainly thought it had many more prospects than the others because it was already starting to generate the growth and the excitement and the AI enthusiasm. As early as like February 23, I think I did a count at how many times they used the word AI in their conference call, and it was like 82 times or something insane. I don't remember offhand, but they leaned into it early. So yeah, once this AI became the investment theme, NVIDIA became the stock to watch. But at this point right now, my thesis is it's NVIDIA's market. We're all just trading in it.
Yeah. Absolutely, and it gets to this idea too. I mean, we talk about how a lot of times market moves really run on narratives, and obviously AI, and for that matter, NVIDIA have had kind of the ultimate narrative. But baked into that also is the idea that this was a stock, even before this run-up, that was already favored by retail traders. The institutions, to a certain degree, followed, and it's just kind of created this groundswell that just seems unstoppable.
Well, you know, what's amazing about NVIDIA is the way they can pivot. Remember, this was the cryptocurrency play.
Yeah.
This was the bricks and mortar for Bitcoin and the other stocks.
And before that, it was video games.
Before that, it was video games.
Yeah.
I give these guys an amazing amount of credit for just pivoting and knowing what the next big thing is in advance. Now, all big things run their course, and so I don't know what that is. And quite frankly, Mark Zuckerberg's comments in Facebook's, in Meta's last conference call, where he said, you know, it's going to cost us billions of dollars, and I don't know when this AI investment is going to pay off. That to me is a little problematic, because it does mean at some point, if Meta's having trouble figuring out how to make this a bottom line issue, at some point the chip spending slows, but there's been no sign of it because they raised guidance yet again. So here we are off to the races. A lot of that, of course, is propelled by the split.
Right, but the CapEx is going to be something that'll take a couple of years to pay off. And in the meantime, the orders are in at NVIDIA, and they're trying to fulfill them as quickly as they can. Abigail was talking earlier about how the question is, when does this momentum stop? When is it due for a pullback? If there is a pullback, everything that you've seen on your platform suggests that there's a mountain of people waiting to rush in the minute there's a pullback.
Yes, but I think a lot of them have been rushing in. Remember, you know, we have a lot of momentum traders on our platform too, and so I think a lot of them have been rushing in. I think a lot of the momentum has actually been driven by people who'd been writing calls, then finding out, uh-oh, I'm about to get called away, and by the way, not only do I not want to get called away, but I'm going to have to pay taxes if I get called away. So then they rush back and buy the calls, and it becomes this weird feedback loop.
I see.
So there's a lot of this is a momentum animal right now. My fear, to some extent, is that it's a bit of buy the rumor, sell the news based on Monday. We'll know the answer to that Monday and Tuesday.
So let's just say that you want to get into NVIDIA, but you don't necessarily want to jump in front of a speeding train. What's the next best play? Is it AMD? Is it Intel?
You know, I'm not a semi-analyst, but I would say certainly ARM that is benefiting tremendously from NVIDIA, because they use a lot of ARM design. You know, AMD is sort of the also-ran. If you can't get the NVIDIA chips, well, I might as well take the AMD chips. But I think right now it's just everything following in the wake. And you know, it's really, you know, I think Intel is a little behind on the game, but you know, it's just so much. To me, this has whiffs of the internet era, but not necessarily exactly the same, because the internet, remember that in '99 and 2000, unfortunately, you two are old enough to remember this.
Those were the eyeball days, right? Everyone's like, we're counting eyeballs.
But the promise of the internet was amazing, right? And it actually lived up to it. But the initial hype, it took years for that to develop, and that's the one thing that sort of nags at me a little bit, is what happens. What happens when the fervor just normalizes?
Well, that's a broader question too. I mean, we kicked off the show, kicking off to the close about an hour ago, with a discussion about this latest Market Pulse index that Bloomberg puts out, and it's backwards looking, but it basically showed in May that the risk sentiment had gotten so high that it had basically become that proverbial contrarian signal. The idea that, okay, when it's this high, the next trend is going to be downside. When you look at the broader market, so much broader than NVIDIA here, do you think sentiment right now is maybe a little out of whack?
I do. I think sentiment, you know, by several different measures, sentiment is very euphoric. The VIX is off its lows. I mean, we're at least when I last looked at it, a 12 handle in the high 12s as opposed to like 11 and
yeah, 12.6 right now.
But you know, when I look at certain individual stocks, I see basically no risk aversion in Apple, and in NVIDIA ahead of their earnings, ahead of their events next week, the split and the developers conference, but yet on the other hand, I am starting to see some risk aversion creep in to SPYs and Qs, because there are big global events as well. But in general, people are euphoric.
But given the weighting, though, too, I mean, you mentioned Apple and its worldwide developer. That stock on an 8-day run, kind of a stealth rally there, hasn't quite got back to its record highs, but it looks like it's getting close to it. It raises the question, though, too, about their influence over the market. So if we do get a hiccup in NVIDIA, and maybe you get a slowdown in chip sales, or Apple for some reason comes out and does nothing on Monday and everybody decides it's a dog, is that going to drag the whole market down?
You have no choice. I mean, you know, as I mentioned with the feedback loop about NVIDIA, you know, if it breaks, you know, it's dragging us up. If there's any significant break in NVIDIA, yeah, that's my big fear before every earnings event, which is that, you know, if they fail to deliver, if they fail to guide higher at this point, you know, and you get a pullback, it changes the whole sentiment of the market because so much is wrapped up in these stocks.
All right, Steve, got to leave it there. And we didn't give it a chance to talk about GameStop. They're up 17% today for reasons unknown to everyone. Steve Soshnick over at Interactive Brokers. A conversation here about market sentiment, and I guess ostensibly, really, Scarlett, a conversation about NVIDIA.
Yeah, absolutely. And this whole market's been about NVIDIA for the past year when you come down to it, right? We all talk about how narrow the rally has been, how it's been on the back of one company and one theme, and that theme is AI, and that company is NVIDIA. Yeah,
well, in terms of percent gains, there are a lot of other stocks moving, including GameStop, CrowdStrike, Hewlett-Packard, and a few others. So some folks out there are finding a way to broaden out, I guess, what they buy to the downside. The biggest decliners, Dollar Tree, Brown-Forman, and Logistic Properties. As we move closer to those closing bells, sit tight. Full market coverage coming up right here on Bloomberg as we take you to the bell and beyond.
Beyond the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast. We're joined now by Tim Stenovic and Molly Smith, Carol Masser and Alex Seal on assignment today as we welcome our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube as a neck-and-neck battle right now, Tim, between NVIDIA and Apple for market cap dominance.
Yeah, $3 trillion versus $2.99999 trillion is the latest that I saw when it came to that battle. But we do still have about a minute before the markets close, so as they say, Molly, anything can happen.
I don't know, Manny. That would be pretty wild if that did not hold on to the next, gosh, what do we have, 30 or so seconds here until the close. But, I mean, really, if it doesn't have AI in the title, I mean, what are you doing? You got to be involved in these kinds of stocks right now. I saw it with NVIDIA, saw it with HPE today, and we talked about how Apple is really just lagging in this game. So it's just going to be a race of who can get out in front of AI the fastest.
I'm looking at the most actively traded stocks by value. So this is the companies with the most money moving through them. NVIDIA has $54 billion worth of shares changing hands today. That is more than 5 times the next most active stock by value, which is Tesla at $9.2 billion. That just gives you a sense of how much money it's sucking up right now.
Yeah, and we talk about also the volume on the shares right now, 47 million shares. Biggest volume mover, Hewlett-Packard, but that's more of a reflection here of the difference in valuations. GameStop also getting a nice bid on the day, up about 19%. Tesla, modest gains on the day after being in the red for a good portion of it. This is one of those days where you do clap and cheer because you are looking at record highs for at least 2 of the major indices. That includes the S&P 500, which is going to close higher by about 63 points or about 1.2%. It takes a while for these numbers to settle, but the NASDAQ composite also higher by 330 points or roughly 2% on the day. The NASDAQ 100 up about 2% here on the day as well. The Dow Jones Industrial Average higher by 96 points or 0.3%, and the Russell 2000 going to close out the day higher by 1.5% here. But the big drum roll here, guys, is who finished higher on the day in market cap, NVIDIA or Apple?
All right, I'm doing the calculation right now, Romaine.
Well, I'm just looking at my terminal. Right now, NVIDIA edging out at $3.008 billion, Apple at $3.003. We should point out these numbers will shift a little bit as our number crunchers wait for final settlement.
That was trillion, rather, right?
Trillion, thank you.
Perhaps no surprise if you've been following the trade today. Mega cap tech just absolutely dominating today. The S&P 500, though, did see
S&P 500 and the NASDAQ composite registered record closing highs.
And 177 decline.
And that is why the IMAP, the big pie, is basically all green because tech, which is the heaviest weighted sector in the S&P 500, is up 2.7% as a group. Your weak links are utilities, consumer staples, and REITs. They are among the smallest sectors within the S&P 500.
All right, let's take a look at, we still got earnings coming at us, guys. I want to talk a little bit about Five Below. Second quarter net sales forecast did miss estimates, those coming out just moments ago. The company sees second quarter net sales 830 to 850 million. Estimates were for 879.5 million. The company sees second quarter earnings per share coming at 57 to 69 cents. That's way below estimates of $1.01, and sees fiscal year net income from 275 million to 297 million dollars. I do want to get to some of the gainers that we have. Oh, and I should say the stock down in the after hours right now.
Ooh, a lot.
Wow, it's taking a real hit because of that fiscal year second quarter EPS, I should say, coming in way below estimates, down double digits right now. Let's get to some of these gainers though, because we got to start with NVIDIA. Market cap hit $3 trillion today for the first time. Shares just have rallied 147% or so this year, adding about $1.8 trillion as the demand for AI chips used to power AI tasks has just skyrocketed. As Romain mentioned, it is neck and neck with Apple, but did surpass Apple today. Get this, guys, at the beginning of 2023, it was a company that had a market cap of about $360 billion. It's up more than 750% just in the last 18 months or so. Also, Hewlett Packard Enterprise.
Get me one of these chips now. I
Go
feel
ahead.
like it's all the rage, right?
The Blackwell?
I don't know.
Yeah,
I don't know. Is that
Get
what
in
they're
line,
called?
Romain.
I was gonna say.
I mean, why not? It's a hot thing, right?
Yeah, just got to call up Meta or Elon Musk.
The wait list is longer than to get a Birkin bag.
Just call Elon to get one of those.
Yeah. Okay. Which company do I need to call?
XAI is the one I believe that has all the chips. Yeah, he'll hook you up. Hey, speaking of AI, Hewlett Packard Enterprise, HPE, hitting an all-time high.
Closes with a market cap above $3 trillion, the first since January.
After the company reported better than expected revenue fueled by sales of servers built for AI. Increased demand and better availability of high-powered semiconductors from NVIDIA led to the increase in AI system sales, according to Antonio Neri. In an interview with our Bloomberg News team, shares higher by 10% on the day today. And then here's one that is related to AI and machine learning, believe it or not.
What's that?
Sweet Green.
Machine learning and AI?
The salad chain, okay?
Are they
12% today.
Okay.
Highest intraday going back to March 2022. The company participated in a fireside chat at the William Blair 44th Annual Growth Stock Conference.
Fireside.
Actual fire? A little warm for a fire.
Okay.
The company discussed urban and suburban stores, machine learning data.
Machine learning.
Unit productivity, new store learnings, among other topics.
Oh.
Machine learning when it comes to salad.
Oh, okay.
Yeah, that's your AI. That's your AI story right there.
Did that stock hit a $3 trillion market cap today?
Not today. Not today.
And I'm going to tell there wasn't a lot for me to choose from here to go into the decliners today. Really green all over the screen today, but a few of them not so lucky. So let's start with Madrigal Pharma. This is a company that is developing therapies for metabolic steatohepatitis. Sorry, I kind of matched that a little bit, but it's a liver disease. And these are companies that were falling today after a data abstract from a trial of Eli Lilly and Co.'s experimental GLP-1 drug to treat patients with the disease. So we saw Madrigal fall today. Also 89 Bio Inc. shares down on the day as well. Let's take it over now to Brown-Forman. These are down. These shares also ended the day down.
That's alcohol, Tim.
Yeah, that's right.
I heard.
Doesn't seem like there's an AI story in here, so maybe that's why it's down. But after the alcoholic beverage maker reported revenue for fourth quarter that missed expectations, also missed the forecast for organic net sales for next year. So those shares down today as well over at Brown-Forman. Last one, let's get over to some fertilizer stocks. These were retreating as Egypt is expected to resume nitrogen output. So then those had been disrupted by natural gas supply shortages. So not looking so good today for CF Industries. Also Mosaic, Nutrien, and Yara International were down during the day.
All right, let's get to some of the big movers here in after hours trading. Lululemon shares up 11% right now. The company reporting earnings for the first quarter, looking at EPS coming in at $2.54 a share. That's a beat. The street on average was looking for $2.39 a share. Revenue came in pretty much in line with estimates at about $2.21 billion, and comp sales overall were up about 7% when you X out the FX effects. Now that's slightly below what the street was looking for, but here's your guidance. 2Q net revenue, 2.48